Markets, speculation, and risk. This is the Chat with Traders podcast, hosted by Aaron Fifield.
Hey ladies and gents, thank you for joining me on the first episode of 2018. Let's make this a good year. Now, the feature of this episode is an interview I did with a trader, and he's also the managing partner / co-founder of a New York City prop firm, 7 Points Capital. One of the things which struck me about Michael is the sheer amount of volume which he trades, which is most impressive due to the fact that he's trading by hand without the assistance of algorithms. In addition to trading big volume, I asked Mike to discuss things such as the strategies and setups which he trades, both momentum and scalping, with
and ended up being a blast.
Very nice. How many kids do you have?
I got three kids, 2 boys and a girl. I call it 2 bodyguards and a girl. and yeah, they're growing up fast, man. And we got this nice big snowstorm here now that nobody was really expecting.
Right.
Yeah, I ended up staying in home today. Figured I'll work from home, so that kind of worked out. Traded a little bit in the morning, and now pretty much ready to go.
Okay.
How have you been?
Yeah, it was good. I mean, I guess my Christmas and New Year was very different. It was stinking hot here in Australia, or in Brisbane particularly. But anyway, let's waste no time. Let's get stuck into this. What is your story? Like, how did you get started in trading?
So I got started in trading like most people do, right? Back in late 90s, I was, in my late teens, and I kept on hearing from my friends about all these internet stocks that were going up. And for a while I said, I don't know what that is, what the market is. But it just kept on hearing over and over from all my friends who kept on making lots of money in the market. And so I decided to kind of look into it. And then basically I started doing some research, started asking friends, and I ended up opening a small account, a few $1,000s back then, trading those .com stocks that, went crazy throughout the bubble. And obviously I blew up a couple of accounts real early, real fast. But, started learning and definitely got more and more interested in the markets and what it had to offer. So I started searching for people who, might be able to teach me what I should be looking at. So I came across a firm, Equity Trading Online, and it was run by a guy called Gary Roth, who was giving these lessons on how to trade. And so I attended, and I really got hooked right away. And I decided that I want to be a trader right then and there.
I've been keen to ask someone who was trading actively during that .com era. Do you see any comparisons from the .com period to what we're seeing currently in the space of cryptocurrencies?
Yeah, I mean, it's a great question. Definitely a lot of parallels. Everything's moving with crazy volatility, lots of, unexplainable moves, both in these coins and some of the symbols that just, these companies that all of a sudden announce that they have something to do with crypto, or they just added blockchain to their name, and all of a sudden the stock goes up 500%, right? We see that every day. So a lot of parallels like that as far as, unexplainable moves where people who know what they're doing are being a little bit more careful and probably missing out on some of these moves. And then you have the average individual that, knows a little bit less and is willing to take on blind risk, and, they're probably crushing it. And those are the parallels that I'm seeing. And, I get phone calls from people all the time, asking me about these coins. And honestly, crazy moves, lots of big gains people are having, but while I do trade them, I'm very skeptical, and I'm very short term in them.
Do you think there are any differences though? Like, obviously I asked you if you see any similarities between both of these things, but do you also see some big differences?
The main difference I see is that in the .com bubble, the move started on Wall Street. Everything started on Wall Street. And then when retail got involved, when the mom and pops got involved, they caught the tail end of it. They had some good times, but eventually they got hurt when the crash happened, right? But I think with the crypto world, what's going on is you have a lot of retail that's driving it initially, whereas you don't have the Wall Street support and you don't have a lot of the big trader support. And then now Wall Street is starting to get into the space. So that's the main difference I see. And I'm not sure how that plays out as far as, is it a bubble? Is it going to crash? That's the only difference I see, because most big firms, they're not going to want to put up $1 million or $10 million with, some unknown exchange somewhere. And so I think that's been holding Wall Street back a little bit.
Yeah, that's an interesting point, because I mean, when you put it like that, it's pretty much the exact opposite to how it was with the .com stocks, right?
Yeah, absolutely. I mean, I remember when I was trading back then, I would come in and towards the end of it, in the trading firm, I'd have all kinds of people sitting next to me, people that were traders for a long time. And then all of a sudden, the cab driver and the moms and the pops just sitting next to me and putting up capital and trading back then. And it was wild. There were some crazy moves, a lot of volatility and good trading. But, that was the end of it when that happened. So I'm also trying to draw these parallels in Bitcoin and coins in general. And there are some parallels, but the differences right now, I think, are still there. The key will be to see if there is really any value add with the cryptocurrencies. And I'm just really on the lookout. I'm trading them, but I'm always in the back of my head thinking, okay, there could be a big crash right around the corner.
Yeah, I mean, I think that's probably a healthy mindset, is to be a little bit skeptical.
It's not going to take a lot, right? Either the government cracks down or the SEC says these are not, you can't trade these. These are convertible securities. So it won't take a lot to get a big move. But at the same time, you can't miss out. You got to be involved.
That's it. Yeah. I mean, it is very bizarre times. Like we had a few people around our place for New Year's Eve, and Yeah, I was getting asked questions about Bitcoin or mostly Bitcoin actually, some of the other cryptos, but it was just like people who have no interest in it. And these are more like sort of, my girlfriend's friends, partners and all that who sort of have a little bit of an idea on what I do. And yeah, it was kind of bizarre to be having those conversations with people like that. But anyway, it is what it is. So, so you said that you blew up a couple accounts early on. Was that during the .com era? Like, were you still trying to go long as these stocks were all crashing, or what led to you blowing up those few accounts in the early days?
Yeah, exactly. So on the way up, things were easy. Everybody's making money. It wasn't a matter of if you were making money. It was just how much risk were you willing to put on and how much money were you going to make on the long side, right? It was just a play of, well, what am I going to buy tonight so it gaps up overnight? And money was easy. But then when the market crashed, there was a huge whoosh to the downside. And, beginning trader, I didn't know what I was doing. And risk management was obviously very poor. And I ended up writing things down as they went lower and adding to losing positions. And, when the bounce didn't come, it was just a matter of getting margined out and reloading, and the same thing happening again. So the key was obviously in hindsight to minimize the losses, but back then, I was definitely not thinking that way.
Okay. So walk us through maybe the few years which followed on from then. Like, what happened between kind of where we're at now in terms of your career and what happened, between then and now where you've started 7 Points Capital?
Sure. So I feel like I'm very fortunate to have been in that position when, after I blew up a couple of accounts, we had the technology at that trading firm where, back then everybody was placing orders through their phone calls and calling the brokers and paying crazy commissions. And, the specialists and the market makers were always screwing them on their orders. So when we had the technology and we used to go to their desktop and say, hey, I can offer you a trading platform. I can cut your commission in half and basically give you an edge. I decided I'm going to become a broker and start pitching some of these hedge funds and institutions, these trading platforms that were fairly new back then. And that bought me probably a few years worth of a window where I was still involved in the market. I was still doing very well as a broker, and allowed me to get screen time and continue to learn what works and what doesn't work in the market. And, still losing money as a trader early on, but it allowed me to continue to learn. And the screen time, I think, was key.
So at what point did 7 Points Capital start to kick off? Like, how did that come about?
So when we were executing customer orders, working orders, we started developing a very good understanding of the microstructure in the equity space, understanding what's involved in executing orders, specifically large orders. And we started dealing with these floor brokers that on the New York Stock Exchange. And one of them gave us an idea of how to trade a certain edge that they had on the floor back then. The NYSE gave them an edge called parity, so that they won't go out of business due to electronic trading. And we started trading that way, and we realized, hey, there's something here. There's clearly an edge. And we took that, and I said, all right, I'm going to start focusing on this, start applying some of the skills I've learned over the years as a trader, and started trading, and very quickly saw good results. And then it was just a matter of, okay, let's go out and go from just me and one other guy doing it to bringing on one more person and grow from 1 to 2. And when that worked out really well, we went from 2 to 4 and so on and so forth, and kept on growing that way. And before you know it, 7 Points Capital, we decided we're no longer going to be executing customer business because the commissions were getting very skinny and we were just doing very well on the trading side. And the partners, well, back then I mentioned Gary Roth, who has since passed away a couple of years ago, who was a fantastic individual, and Mike Mangieri and myself, we were running 7 Points. And Mike Mangieri, a brilliant guy who's really good at running companies, running personalities, and dealing with individuals, was pushing us to say, let's start trading more and focus less on the commission side. And before you know it, we turned into a trading firm.
Would you mind just explaining what is parity trading? I'm not really familiar with that.
So parity trading, the advantage was that if you have a thick quote in a low price stock, let's say back then Citibank was really active, there used to be 1 million shares on the bid. And with parity trading, you used to be able to buy on the bid through the floor brokers and get a good early fill and collect a small rebate and just constantly make a market. And that's as close as you're going to get to a zero risk trade, right? Where if I'm able to buy on the bid when there's quite a bit on the bid, then I can either scratch when I see that the stock's going down and hit the bid and break even, or I can make money if it goes up.
So it essentially gave you like priority in the queue position.
Exactly. And the market was so dislocated, and still is to this day, that basically any flow that went to the New York Stock Exchange, we used to be able to trade with, while other market centers were just waiting there to get the fill.
That seems like a pretty big advantage to have.
I would think so. It definitely is a big advantage. But since then, it started diminishing because the NYSE kept on losing order flow as more and more people wanted to go electronic. And all these other exchanges and dark pools popped up. Less and less would go to the NYSE. So they started losing that edge there.
Okay. Now, so how has your edge evolved today? Like, can you describe to us what sort of strategies you and also your firm are trading nowadays?
Sure. So we took that and we were able to expand it and develop some market making strategies with similar concepts in mind. And in addition, we trade quite a bit of momentum strategies. So those are the two umbrellas that they will fall underneath. I probably trade about 15 different setups on a given day. And for example, on the momentum side, we're trading setups where I'm looking to join trend and look for certain patterns where we've seen these patterns before, and we have rules developed around these patterns and how to trade them, and we'll look to join trend and capitalize on a move once it's already in force. On the market making side, it's mean reversion types of strategies, having the ability to execute on different dark pools, exchanges, market makers, and not have to pay a commission, which is the structure at 7 Points Capital, gives us the huge edge to be able to trade very heavy and scale size whenever we see fit.
What do you mean by not pay commission? How do you get around that?
So that's part of the difference at 7 Points Capital, I'd say. At 7 Points Capital, when we started out as an executing firm, and the trading was kind of a side thing. And that grew into a pretty big business. But the model initially was, let's bring in traders, let's back them, let's not charge them commissions because, we don't pay a commission as a firm. So it's our captions, including medium-sized brokerage firms that are ones that are executing large order flow. We connect to them, and when we see the order flow and the tape printing a certain way, what we could do is we try to throw out feelers and see where these prints are taking place. And a lot of times we're able to interact with large block buyers or sellers, and that gives us good liquidity. So if I'm in a situation where I know I've seen this pattern before, let's take, for example, something that's trending up and is now dipping into support, pulling back into support. And I want to be able to get involved on the long side, joining the trend at a very specific spot at support. I want to be able to put on as much size as possible because that's a very low risk trade if I keep my stop close, right? So the dark pools are able to give us this advantage where we can get in and interact with some of the bigger traders and bypass some of the HFTs.
But is there not more volume traded on the actual like lit exchanges?
I would say these days, yes, there's a decent amount on the lit exchanges. A lot of it gets internalized by the market makers, the large ones like the Citadels of the world, and a decent amount also goes through the dark pools as well.
Okay, so how come you're able to put on larger positions by going through a dark pool than you would going through a lit exchange?
Because it could be that on the other side, the counterparty that I'm trading with saying, I don't want to trade with anything less than 50,000 shares. So they have a minimum quantity on their order. And most HFTs, they're buying, selling 100 shares all day long. They're not going to interact with that. Most retail is not going to interact with that. So the institutions want to be able to trade with large players to get the order flow done without too much information leakage.
Okay, and having access to these dark pools, that's one of the advantages, I'd presume, of trading with a prop firm, right?
Yes, I would think so. So having access to multiple trading venues is definitely an edge that we have. Other advantages of trading at a prop firm, I would say, is depending on the commission structure, maybe a commission edge. Getting good locates is definitely a big edge. Being able to borrow stock that might not be available through your typical E-Trade and retail type of brokerage firms. Let's see, other edge I'd say is just being around good traders that want to share ideas, want to go over their day together with the guy next to them and see what they did well and what they did poorly and what they want to improve on. I would say those are the main advantages to trading at a prop firm.
Chat with Traders is brought to you by Trade Zero. Do you want to trade the U.S. markets? With Trade Zero International, you can trade equities, ETFs, pennies, options, and crypto, and get access to 4 different platforms to fit different trading styles. There are no pattern day trader rules with a $500 account maintenance and 6-to-1 intraday leverage for accounts that maintain $2,500. Trade from 4 a.m. to 8 p.m. Eastern. Get 24/7, 365 days live website client support plus live phone support from 6 a.m. to 6 p.m. Eastern. Trade Zero is the winner of the 2020 and 2021 Benzinga FinTech Award for Best Broker for Short Selling. Get access to an extensive variety of locatable symbols for shorting. Sell back locates you no longer need through a patent-pending innovation, giving you the ability to recoup some of your initial locate cost. Visit tradezero.co/chat to learn more. Again, that's tradezero.co/chat.
Now, I'd like to go into hear a bit more about your actual marketing strategies, because if I understand right, you guys actually do very little automation there. I would have thought that makes it very difficult to run market making types of strategies in US equity markets.
So the market making strategies are going to work on very specific types of symbols. We're not going to do a whole lot of that in some very high-flying names like NVIDIA and Apples of the world. Those symbols, I'd rather join trend and try to capitalize on a move, take a lot smaller size, and capitalize on potential big move that's unfolding, right? On the market-making side, it's probably, lower price name, doing a lot of volume, might have like a 20, 30, 50 cent range on the day. And you can go in there and trade size, know that you have liquidity. I can easily buy whatever I want to buy and sell whatever I want to sell without really moving the market too much.
So what would be an example of some stocks which you would consider a market making strategy?
I mean, these days you have a lot of these names like the AMDs of the world, anything that's, between $5 and $20 and doing at least 10 million shares a day, that's going to be a good candidate for that.
And so what would be your time frame on those trades?
So on those particular trades, the time frame is probably, I'd say, minutes to an hour. Whereas some of the other trades we trade, hour to a few days.
So what would define it as a market making strategy though? Like you're obviously posting liquidity.
I guess market making strategy is just what we kind of call it internally, but it's, if you want to just call it scalping, where you're in and out with decent size, sometimes adding liquidity, sometimes taking liquidity, and trying to capture a piece of a range.
Right. And you said your trading also consists of a lot of momentum trading as well. If you had to kind of break it down, what percentage would you say, of your own P&L comes from these strategies which you classify as market making strategies compared to momentum? Like, where is the bulk of your P&L coming from?
If you asked me that question a few years ago, it would be a lot more on the market making side and the scalping side and less on the momentum. But I'd say today, myself and the firm as a whole lot more is being traded on the momentum, pattern recognition, technical analysis, and short-term catalysts. That's where most of our profits come from these days. We still do a decent amount of scalping and market making, but less and less. Just so much opportunity out there in some of these low cap names that are moving, 500 or 1,000% in very short periods of time, or a large cap name like like an Apple or like an Intel that has a catalyst, either a fresh piece of news that we can trade for 2-3 days and move on to the next one.
Right. Okay. Now, one of the things which really stuck out to me when I was doing a bit of preparation for this interview is the amount of volume that you're trading yourself. I think, you can correct me if I'm wrong here, but I think about on average, you're doing about 50 million shares per month, which seems like an awful lot. How are you able to trade, on average, about 50 million shares per month as a click trader?
So I think a lot of it has to do with edge, reading order flow, having confidence in what I'm doing, and it's the actual method of how we trade, hotkeys and having direct market access, connections to all these different places allows us to really size in when we see opportunity and take advantage of it. So it's a lot of shares, and that's kind of the goal of every trader. You want to keep growing and pushing it as much as possible until you kind of see it that you've reached the max of what you can accomplish.
So how are you able to get so much size on though?
Well, a lot of it is not going to be at just one price, right? So it's a lot of scaling in and scaling out at different prices, accumulating shares and scaling out, I'd say.
Yeah, okay. Well, talk to us a little bit about that. Like, how are you scaling in? How are you scaling out? Like, adding, reducing size? Like, how do you think about that sort of thing?
It's kind of tough. So the way I approach trading is, let's say I mentioned before, we have 15 different setups, right? Each one of those setups is going to have its own rules of how I first look for the setup, how I'm going to put the trade on, whether I'm going to scale in or put it on one shot, where my stop goes, how much I'm going to put on, in a very high conviction situation. So each one of those setups will have its own rules that I have written down on paper in my Evernote. And, every day I will measure my performance, not just on the P&L, but also on whether or not I was able to follow my rules. And I think that's the big differentiator right there.
I don't know if this is too much, but would you mind sharing one of those setups?
Sure. So let's see. A setup that I personally like to trade, and those who have seen our YouTube videos at the end of the day, I go over this one quite a bit, is like a descending triangle in a low cap trash name, right? So when a low cap stock goes up, a few 100% and finally starts to stall out and puts in lower high and showing that it's now on the backside, I'm looking for a certain pattern, and that would be a descending triangle, meaning that it had a dip, and the next time it came back up, it made a lower high, and when it had the next dip, it's starting to look like a triangle, right? And on that scenario, I know that I have three ways I'm going to enter that setup. One is within the triangle. The other one is when it breaks. And then the third one is if it comes back to retest a breakout level. So each one of those will have a rule and say, okay, when I get in here, I'm going to risk X dollars. And then my stop goes above that high. And so very specific, very methodical. And every day when I see these setups, I will take a screenshot, send it to my Evernote, and that way it stays fresh in my mind. And my confidence grows whenever I do that, right? If I've seen a setup 1,000 times, and, I know what the win rate's going to be. I know what to expect. I know what it's going to look like when it's about to fail. And I know where I need to really size in and take advantage of a good opportunity.
Now, something like that, are you taking this trade every time you see a setup which fits that criteria? Or are you kind of selective about which ones you actually execute on?
So if it meets my criteria, and it's setting up as that particular setup, I have to take it. If I don't take it, then I'm just adding a lot more variation to the results, and that's just going to cause frustration. So I'm going to try to take that setup every time I see it. Now, do I do it every time? There are times where, you're a little bit more gun shy, maybe because you're not running as well, or you might jump the gun where that setup hasn't really fully presented itself yet. And, then you go in a little bit earlier. But if I see it, I'm going to take it. And then at the end of the day, I'm going to measure how I did. Did I go in too early, or did I completely miss the trade? And why did I miss it? Mm.
So just going back to the volume that you're trading, I guess I still have a couple questions around that. And this might take a little bit of explaining about how things work in the US equity market, but how much of your P&L, or how much does rebate contribute to your P&L? Like, is that a big part of your strategy?
No, not anymore. I think it's there and it's useful to have access to that, but it's not the driver these days. These days, the HFTs who are co-located and have fast connections and best hardware, and the special order types, those guys are going to be there much earlier than me. So just trading for the rebates, that game I think is done unless you're, one of the best HFT guys out there. Now, it doesn't mean that I don't trade for rebates. I don't try to be efficient and maximize what I could get, but we don't specifically trade for rebates. That's not a big part of what we do.
Okay. What sort of stocks are you trading? I know you spoke about this a little bit before, and that setup you gave, you spoke about trash names, which I'm sure are mostly the lower cap stocks. But where is most of your volume done? Is it done on these big blue chip names where you can really get a lot of size on, or is it done mostly in low floats?
I'd say it's probably a third in these low price stocks that you could do a lot of volume, blue chip names, you could do a lot of volume. And then the other third would be these low cap stocks.
And how many names would you be in and out of on any given day? Like, how many stocks are you watching?
I'd probably trade about 8-10 names on any given day. And some of those might be, something I'm swinging for a few days or a couple of weeks, or and I'm trading around a core position, while others I'm just, something with fresh news that, short-term trading, and I'm in and out, and probably putting on 5-10 trades in that symbol.
So how are you deciding if a trade is going to be just a short-term intraday trade or something that you might swing for a couple of days?
Most of the time when I put the trade on, I already know if this is something I want to swing. It's setting up as a swing trade in a different time frame. For example, on a 15-minute chart, on a 1-minute chart, on a 1-hour chart rather, I already know that this is something that if it keeps on acting like it should, I'll take it home, and I'd want to keep it for, a few days, a couple of weeks, if it keeps acting right.
So what might be a reason a reason for you to swing? Like you say, if it looks like you usually know when you put a trade on how long you're going to hold that stock for, presuming it keeps acting how you anticipate it to act. What would what's the word? What would give you reason to think that this is a good trade to swing for a few days?
It's simple, right? In this business, it's mostly about green or red. And if I put on a swing position and it's working, the earlier it works, the better. And by the end of the day, if it's green and it's working, then I'm going to keep that one and allow my exit rules to take over. In this business, it's a lot of black. It's a lot of black and white. It's very easy to know when you're wrong, and it's very easy to know when you're right. It's not like when you open a retail store, you might need 6 months to figure out if the business model is working. You know instantly that the trade that you put on, if it's right or wrong, and the best trades will start working right away.
Mm. And these 8 to 10 names that you're trading, on average most days, how are you finding these 8 to 10 names? Like out of all the stocks you can pick from in the US market, how do you decide that these are a good 8 names to be trading for this day?
Yeah, so when we get in early, we'll start doing research. First of all, see on the macro picture what's going on. Any news overnight overseas that might have moved markets or could potentially move markets. So do the research early as far as what's in the news, any macro themes that we need to be aware of. And then in the morning, whatever's gapping, whatever's got a piece of news, a catalyst that might move a stock up or down and make it gap, we're interested in that. And then during the day, we'll use scanners that are looking for specific criteria that once it's met, it spits out a symbol and says, here, look at this one. This is a criteria we're looking for.
What's some of the criteria that you might put into a scanner, just as an idea?
Volume, volatility, range on a day, float, mainly those are fresh news.
Now these 8, I keep saying 8 stocks, but give or take, these names that you're trading each day, is it often the case that, particularly if you're trading a catalyst, that these 8 stocks or however many stocks are tightly, I don't know if correlated is the right word, but tightly linked, like in the same sector?
No, they don't have to be. For example, I could be trading Intel. Like yesterday, I had some fresh news about, their security problems that they're going to have with their chips. So that was really active yesterday. I was trading one semiconductor name, and in the level 2 right next to it, I could be trading, blockchain name, something that just moves because they got a mention in the cryptocurrency space.
Right. And your entries on these trades, what are they based on? I know you've talked a little bit about using technical analysis. Is that what actually determines your entry? Is that how you time your entries, or are you looking at the order book, or is there's something else to it?
For me, a lot of those come together. So I would say it's reading the tape and order flow, technical analysis, a good understanding of charts and volume. And for me, volume is very important. And in addition to that, I'd say what's moving the stock, what's the catalyst. And then if it's something that I've seen in the past, that I've kind of encountered it to behave a certain way when that catalyst comes out, that also plays into it.
When you say volume is important, can you just flesh that out a little more? Like, what do you like to see in the volume?
2 main things, and I'd recommend individuals who are interested about learning more about volume, the book by Anna Cooling, Volume Price Analysis. For me, that helped quite a bit because I always knew the volume was important, and I just could never really understand and put my finger on exactly what I wanted to see until I read that book, and she kind of clears this up pretty well. So volume with how it's displaying itself between different bars as the bars unfold and as the chart unfolds, how different volume patterns develop with different chart patterns. And what I specifically like quite a bit is volume profile, where the volume is displayed on the side axis and showing me not just the price, but how much volume traded at different price levels.
Okay, that's interesting, because is that uncommon for equity traders to be using volume profile? Typically, when I hear about volume profile, it's usually coming from someone who trades futures, right?
Yeah, I think it's more common in the futures world, and I think we spent a decent amount talking about equity trades, but we do trade quite a bit of equities, futures, options, and pretty much all the products out there. But I would say that it probably did start in the futures world, and the reason I like to use it is it gives more context to support and resistance levels. So turning points on the chart are more important than if there's a lot of volume that traded on that at that level. If that makes sense.
No, it does. It does. Mike, one of the things I'd like to speak with you about, actually, there's a couple other big things I'd like to talk to you about. The first being consistency, right? So for the past 3 years, I'm pretty sure you've been green every month. Now, that's quite an achievement. What's your secret to consistency?
Great question. I think consistency is what is really going to differentiate the great traders from the ones who are just going to get lucky here and there. So what does it take to be consistent? I'd say, first of all, you got to have a clear and definable edge. Then you got to always minimize your bad losses and just avoid those big losses that, take a big chunk of your account that might take some time to work back. Which is why I kind of scale back when I'm not running well, when my trading is not doing too well. I'll scale back. I'll risk maybe half or a quarter of what I risk on average, and I'll do less when I'm not thinking clearly, when I'm not performing well, or I'll really scale up and put some serious size on and multiples of what I usually risk whenever I'm in the zone and whenever I'm thinking clearly and the market's lining up with what I'm thinking as well. So just being able to throttle the risk that I put on, I think, is important. And then risk management is pretty much everything. I know a lot of your guests do mention that quite a bit, and I can't stress it enough. Risk management is king, right?
So what are some of the things you do to manage risk? Like, obviously you mentioned a few there, but can you go into that a little more? Like, what are some of maybe the big takeaways which you could share about, some of the things you do on how to manage risk?
Sure. So before I put any trade on, I already know where I'll be getting out if it starts to go against me. I think that's a big one, right? If you compare any retail trader to a professional trader, I'd say that's probably one of the main differentiators, where when I say retail, I mean just, someone who is very new to the markets, not necessarily, retail traders, but they put trades on, they're just hoping for the best. And if you ask them, well, what do you think what are you going to do if a trade doesn't go your way? They never even thought about it, right? So I like to make sure I know where I'm getting out before I even get in. And by doing that, I'm able to also figure out how much to put on, because I want to risk a fixed dollar amount on every trade, right? And in order to do that, I first have to know where I'm going to get out when I'm wrong. So that allows me to also size my positions correctly. Okay. So I think those are really important. The stop loss, focusing on where I get out, where does the pattern fall apart, is where my stop belongs, right? If I'm in a pattern, if I'm in a trade because of a specific pattern, then my stop needs to be outside of the pattern, where if the stock or the future or whatever, if it goes there, then the pattern is no longer valid. And so you got to know before you put the trade on where you're getting out.
Yeah, and another thing you mentioned just before was reducing size when you're not performing as well as you could be. This might sound like a silly question, and maybe an obvious that would have an obvious answer, but how do you know when you're not performing well? Like, is that after you've taken a large hit, or is it anticipation that you might be due for a large hit? Like when you might just come in one day and you might not be in sync with markets, things just aren't working out. Do you feel like you're out of touch at the moment and you should reduce your size before something bad happens? Like, how do you know when you should be trading less size?
That's fantastic question, because it's very easy to kind of blur the lines between, be aggressive, be confident, and stay the course versus, pushing it too hard and just being stubborn, right? So the way I know that I need to size down is usually when I'm breaking my rules. So every one of my setups, as I mentioned, has all the rules I need to trade that setup from beginning of the trade till the end, right? When I start to break my rules, that's usually a sign that I'm not thinking clearly, I'm not performing at my peak level, and that's usually coinciding with P&L also, not being there. So I think that's a big trigger for me to size down. But a lot of times, you can't tell right away, especially when you're in the trade. It might take a few losses. It might take, a few rules broken before you realize that you need to size down. You need to slow down, maybe take a break, take a walk, take a day off, and come back. But yeah. I would say the rule breaking is definitely a big one.
Okay. Yeah, I think that's a good point to note. Yeah, that's a good answer. And one of the other, or the first key you mentioned, or first secret to your consistency, was having a clear, definable edge. So how do you think about an edge as a discretionary trader? Like to you, what does it mean to have an edge? Because I think I've spoken about this on a previous episode, but I think like someone who might be more of a quantitative algorithmic trader is going to think about edge differently to someone who's more of a discretionary trader. So, the way you see it, how do you think about an edge?
That's definitely an ambiguous word, right? The way I see edge is anything that I can do or I have access to that most people do not or can't do. I think that's an edge, right? So if I'm able to take losses quickly and have good risk management, where that really goes against human nature and most people can't do that, I consider that an edge. If I'm able to execute and have access to multiple dark pools and read the tape and have good order flow management, I should say actually order flow reading, that's an edge too, right? I'm able to have my finger on the pulse of the symbol, the pulse of the market, and I'm able to kind of become one with the symbol. That's really the best place I want to be, right? Where I can read the signs that the stock's telling me, as opposed to just ignore it and bring my own opinions. So being an order flow trader, being a pattern trader, and seeing where things don't act like they should allows me to kind of get a feel for what's going on. And a busted pattern, I think, is a good way to kind of reverse and go the other way, because obviously what you were thinking is not working. So I think an edge is all those things. It's tough to define, but it's got to be something that is not readily accessible to everybody.
And it's largely based on your setups as well, right?
Yes, and the setups and the experience of seeing it before, right? I'm a big fan of journaling. And all our traders, they journal and they have to email myself and some of the other senior traders every night. Yeah, the trades that they did and why they did it, and were they able to follow their rules? Do they have to tweak their rules? And I'm a big proponent of journaling. It forces you to go back and review what you did. And I think anytime you're doing anything competitive, whether it's sports or trading or poker, whatever it is, the idea is you got to have a plan going in. You got to try to execute your plan, during the game. And then at the end, after the game, you go back, you watch tape, and you try to review what you did well and what you might want to tweak for the next game. So I think journaling is huge.
Yeah. This is perhaps a question I should have asked you a little earlier, but these setups that you're trading, how have you come to identify those setups? Like, where did they come from? Was it just purely from screen time, or was it from deliberate research? How have you come to identify these setups as having an edge?
I would say that over time, you start to develop a trading method where you're grabbing things from here and from there, and you kind of putting together your strategy, your setups, but you could get little nuances from different places, right? So I love watching, traders on YouTube. That's like my Netflix, where I want to see what other people are doing. It doesn't mean I'm going to trade that way, but I always try to learn something from someone, whether it's the guy sitting next to me or the guy on YouTube. And I can't say enough about how much I've learned from your podcasts. I always want to try to get as much as I can from everywhere. But I still have to bring it back and make it my own and add it to my way of trading. And I never want to follow anybody else. I never want to put a trade on just because somebody else said so. It's got to be my own. But I'm willing to learn from everywhere I could learn from.
Yeah, I really like that. I think that's so important, is to make ideas your own, or like to come up with your own ideas. Like, you can take influence and ideas from other people, but ultimately you need to make it your own. Like, I'm often surprised by some of the emails I get. People are asking, like, who's a good person to learn from, and I never suggest anyone. I mean, yeah, I feel like you've sort of got to come up with your own ideas, test them. It's not just like a matter of watching someone and then just replicating exactly what they do, right?
Absolutely. Absolutely. I mean, what works for me, a very specific way, somebody else trying to replicate the exact same setup with the exact same rules, even if they have it written down on paper in front of them, it's not going to work for them, because I might have traded this setup 100 times, and it's evolved over time, and I've made my tweaks, and throughout time, my confidence has grown in it. And, I journal it, and next time I see it, because I've journaled it, because I've taken a screenshot, and because I've reviewed what I've done, the next time I see it, my confidence is going to be that much higher, and I'll see it much earlier than the guy next to me who's never even traded this setup before. So that's why I think following others and doing something because others are doing it's not going to work, because your confidence in it is going to be very low. And what's going to happen is the first time you're going to take a loss, and everybody takes losses, right? The first time you're going to take a loss, you're just going to scrap it. You're going to think, it's not working. It's not moving averages that I have to be focused on. It's MACD, or it's stochastic, or it's volume profile, or whatever the next hot thing is, right?
Yeah. No, I completely agree. Mike, just to take us out here, I said a little earlier there was two big things I wanted to talk to you about. One of them was being consistency. The other one is, I feel like this is an appropriate question given the time of the year we're at. Let's say for someone who, they know the basics about trading, okay? They're not a complete newbie, but they've been spinning their wheels, right? They haven't really been making much progress over the past year or two. They feel like 2018 is going to be the year where they start to succeed as a trader. What would you say are some of the best things they could do to give them the best shot of making that happen? These might be basic things, but things which you feel might be fundamental for a developing trader to do.
It's a great question. I wish I came across your podcast like 10 years before I did. I would have done it better earlier. But I'd say the first thing has to be set rules for each setup. Don't leave anything for emotion, and know what you want to do before you even start, right? Have a business plan for each setup. It's extremely important. The other thing I'd say is surround yourself with good, smart people. If you're a retail guy and trading from home, you might be on Skype, in a group chat with other good traders. If you're looking for a firm, look for a good firm that has good traders and a good setup. So surround yourself with good people that are genuinely going to teach you and work with you and mentor you on how to trade. I think that's big. And be careful because, these days, Twitter is fantastic and YouTube, all that is great. But I think that some people might fall into the trap of following some guru that, has a trading room or has a DVD, just buy my DVD and, you'll do well, or just let me, mirror my trades and things like that. So you got to be careful with that. It's still got to come back and be your own trades. You see all these guys on Twitter and all over. Some of them are, I'm sure are pretty good, but for everyone that's good and really trading, there might be 10 that's just looking to sell you something. So just beware of that and just feel your trades. When I have positions on and I have a couple of traders shadowing me as they're learning, that feels real, right? And that's the way I see it. And learning from someone where you can actually see what's going on is huge, as opposed to just following someone else. I think that's very important. So have rules. Be careful who you follow. There are some really great traders out there that are doing some great things. A buddy of mine smashed a bid. He started a room. He's a really good guy, and he trades well. So there are some people out there that have a real service to offer, and you can really benefit from it. But you just got to be careful not to follow too many gurus. They're just gonna mix you up, and before you know it, one day you're trading one way, and the next day you're trading another way.
Of course, yeah. And I mean, I know some guys on Twitter who are very legitimate traders and have like a few hundred followers. So don't only go a follower count either, because there are some guys who keep a low profile but also make some very decent money. So yeah, solid advice. Let's wrap this up, Mike. If someone wants to find out more about you, where is the best place to go?
So I have Twitter. This year in 2017, I've become more active on Twitter. So it's Michael_Katz, Katz 11 on Twitter, and then we have our website 7pointscapital.com, and I think those are probably the easiest ways to get in touch with us.
Okay, sounds good, man. Well, I'll make sure to include those links in the show notes. I think that's it. So, yeah, let's end it there, Mike. I appreciate you doing the chat.
I'd like to say, Aaron, thank you for what you do. The podcast that you've been able to put together over the years are just fantastic. You're able to really tap into some great minds, and I think you're doing a great service for traders. And I recommend to all our traders to follow you and to listen to every one of your podcasts, because I think there's a lot of value out there.
Oh, thanks so much. I appreciate it.
You've reached the end of this episode of Chat with Traders, but rest assured there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes, and we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
Chat with Traders is brought to you by Trade the Pool. Did you know that every decade the market reinvents itself? Online brokers opened the doors, mobile apps made trading seamless, and commission-free trading erased barriers. Now, a new era has begun. Meet Trade the Pool, limited risk trading. And now you also have unlimited time to reach the profit target. From now on, your trading risk is capped, and your trading opportunities are limitless. Trade the Pool funds home-based stock traders with up to $200,000 in buying power. That means you can trade larger positions and scale your strategies without risking your own savings. It's time to trade with more capital, making it truly worth your time and effort. Ready to trade the pool? Click the link in the description and join the stock trading revolution today.
Are you ready to get serious about trading? Then join Tasty Trade, Investopedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade all in one platform. Get low commissions, including 0 commissions on stocks, so you can keep more of what you earn. Trade smarter with advanced charting tools, a pre-built strategy selector, risk analysis tools, and more features. Visit tastytrade.com/chat for more information. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC.
Markets, speculation, and risk. This is the Chat with Traders podcast, hosted by Aaron Fifield.
Hey boys and girls, Aaron Fifield here. Welcome to Chat with Traders podcast. Before I introduce my guest, I have something cool to share, which mostly applies to folks in Sydney, because I'm planning a Chat with Traders drinks/get-together for Sunday, the 11th of February. At the time of recording this, I'm yet to lock down a location, but it will be somewhere around the city, the CBD area. So if you don't have plans for Sunday, the 11th of February, it would be nice to see you there. It'll be a great opportunity to meet other traders, etc. To find out more and to RSVP, simply visit chatwithtraders.com/Sydney. Now, moving along, my guest who you're about to hear from is someone who I featured last year on episode 119. It's Alex, or who you may also know as @TaggerTrades on Twitter. That's TAGR Trades. When Alex was on for the first time back in April, he was beginning to make headway as a full-time day trader since abandoning a secure job a few years back. But since then, he's really stepped it up a notch. Alex finished 2017 with a compounded return of 1,400%, with almost zero drawdown. Well, of course there was some drawdown, but it was very minimal, which, I mean, it sounds absurd saying it out loud because it is, but he really did it. Over the course of this episode, you're going to hear Alex and I reviewing his performance of 2017, what he did well, and the areas where he would like to further improve. Alex also talks about his strategy from scanning to entries to managing positions, plus psychology, self-discipline, and more. And at the risk of sounding cheesy, Alex is a good dude, and I really think he's a great role model for upcoming traders, especially those who want to trade equities on a short time frame. Please enjoy, and please share this episode on Twitter and Facebook so it reaches more ears. I'll be very grateful if you can do that. Here is my conversation with Alex. Search your email address, but anyway, nice to be chatting, dude. How are you?
Yeah, good. How are you?
I'm all right. I'm doing well.
Is it just your weekend?
Yeah, it is. Yeah, it's nice and early Saturday morning here.
Well, good. Start off on the right foot.
Yeah, absolutely. How was your day? All right?
It was all right. Yeah, I mean, nothing to write home about, but can't complain ending the week on a green note.
Nice. You survived. That's the main thing, right?
I did, exactly.
So I know there's been a few changes since we last spoke. I mean, you've got a little girl now, another member of the family. How's she doing?
She's doing good, man. I'm pretty lucky. My wife works from home, so she kind of gets to manage that whole aspect and kind of leave me to pure business. But sleep deprivation is no joke. Definitely not as much sleep as I used to get. But other than that, I really can't complain.
Okay. How old is she now?
She's almost 4 months.
4 months. Right.
Yeah.
Okay.
So still quite still haven't gotten a full night of sleep in 4 months. Let's put it that way. So that's been fun.
It obviously hasn't affected your trading too much.
No, I think it might have got me into gear too, knowing that I got somebody else to support now. So
Exactly. Yeah. More responsibilities, right?
Word.
Actually, that's funny. I remember I interviewed Aaron Brown, must have been a couple months ago, and he actually spoke about sleep deprivation and said how it can actually have some positive effects.
Really?
Yeah.
I know
I'll
for
link
me,
you to it.
if I don't get a good night of sleep, I'm pretty cranky. But definitely been going to sleep earlier to kind of make up for that. But
He said it like activates a part of your brain that is often sort of dormant. Or
that's my secret weapon, then, man. That's what it is.
It almost like makes you more alert in some ways. I don't know. I'm probably getting this really wrong, but I'll link you to the episode. It might be interesting.
I believe it.
So what does your wife do that she's working from home?
Nothing, man. She's just a stay-at-home mom now.
Oh, okay.
Yeah, we're kind of doing the single income thing, giving that a shot. But childcare in the first place is like, I don't know, the translation of dollars were like $20,000 or $30,000 a year. So for her to go get a job, it would basically just to be like paying childcare anyway. So
I know that's so crazy, right? Like,
yeah,
I've never really looked into it too much because I obviously haven't had to. But you know, the odd thing you hear here and there about how expensive childcare is, it's like you're almost just going to work to pay for that, right?
Yeah. And then it's a pain in the ass, and then it's just hard to manage everything else. So she's just at home kind of, I guess I run the actual financial side of the business, and she runs, I consider, like the back office. She just gets everything done, so I don't have to deal with it. So it works out for everyone. I like it that way.
Right. I like the way you put that. That's funny. All right, man. Well, let's get into things. I mean, obviously, one of the first things I wanted to ask you about, and I guess just speak to you about as well, is what's been happening since we last spoke. So we first did the first podcast in April last year, 2017. And you've just been going from strength to strength ever since. I mean, it's been really cool to see. December last year, I believe, was your best month.
It was, yeah.
And I actually saw you say somewhere that December alone was better than the first 5 months combined of 2017. So let me just ask you, how come? What went so well for you in December?
So basically the first 6 months of the year last year was me kind of grinding it out, building up the account, getting it to where I had enough cash in the account that I could really, really put some force behind my trades. And I kind of walked into the perfect storm towards the end of the year with a whole Bitcoin blockchain stuff exploding. I didn't actually trade the cryptos themselves, but all these companies were popping up saying that they were getting into mining or the blockchain or something like that, and they were exploding. And I was just well capitalized and well prepared, and had I guess the training, the mess ups before, and I kind of came into it just better.
So can you maybe share a few of the plays which worked really well for you in December, like that were related to this whole blockchain mania that was taking place?
Yeah, so kind of like I remember last time we talked at the beginning of the year was the shipper mania that was going on, and they all kind of ran together. There's always about 4 or 5 stocks in each sector that fuel off each other, and people think they're going to go from $100 to $100, and there's just so much speculation, and I'd kind of call it like a risk-on atmosphere where people are just chasing and going for everything and buying every dip. So it creates a positive atmosphere for somebody who's long biased. And there was a few companies that were pretty much just going up every day, and when they pulled back, they'd go. So there was one in particular. The ticker's MARA, and there's ones DPW and RIOT, and about 4 or 5 more. And any day that they opened up weak, you could almost kind of track them all together and see when one started getting bid up, the other two were not far behind. So it really gave you the opportunity to kind of be aggressive and use each other, use them as almost like leading indicators or things like that. So you could, I would wake up one morning and 3 of them, let's say all 3 of them were down, a few percent, but one of them was down more, and the other 2 turned green. Well, the one that I always traded was the MARA, and I was able to get in there with confidence. And as the other ones went, I was able to kind of hold those positions longer than I was normally. I've normally considered myself kind of a cash flow, kind of a scalper, but those would allow me to hold them longer because there was just so much mania going on. I mean, they were making 50 to 100% moves daily. And so I was just able to get in and hold longer and put in more size. And there was so much liquidity. You could sell a lot of shares. There's pretty much always somebody there to sell to whatever you bought.
Yeah, it was crazy. I just remember, like, obviously wasn't trading this sort of thing, but I just remember like coming into work in the morning and seeing the headlines on Bloomberg about how this company just added blockchain to the end of its name, and now it's up like 100% on the day or whatever. I'm just like, what's going on?
Oh, completely ridiculous. Like there'd be biotech stocks that were clearly had drugs in the pipeline. All of a sudden they'd put out some kind of PR saying, oh, and now we're in the blockchain, and it would just explode. And it was the kind of things that you were able to risk a little more on that, because there was so many other people that were just sitting. You could just tell people had their fingers on their triggers waiting for the next trade. So it gave you a higher probability to go for it. They didn't always work, and a lot of times they didn't, but when your odds are there, that's when you kind of put more risk on.
Yeah. And I really like how you've described this, because it's like, you've taken everything you've learned since you've come into trading and it's kind of built up. You've had that really sound knowledge base so that you've been well prepared for the next time that, a catalyst like this comes into play, that, you can really hit it hard and make the most of it.
Yeah, I've botched 3 or 4 of these exact same scenarios in different sectors, different names, different everything, but they all pretty much end up the same, and they kind of work a little bit differently, but very similar. And I'd botched enough to learn what not to do, basically. So I could still definitely have a lot of improvement. There's no doubt if I could get better at holding longer, holding overnight, things like that. But baby steps, I'm getting there.
Yeah. But I mean, how long have you been trading for now?
June will be 5 years. So still, I would be probably considered a young gun out there.
Yeah, for sure. But how long have you been trading for full time now? It's not.
That's how long it's been. Yeah.
Oh,
so I've been dabbling since, but by dabbling I mean putting on like 3 or 4 trades a year and just being interested in the markets for, I don't know, 10 years. But nothing serious at all. Just had a healthy fascination, I guess.
Yeah, and like you said, you've botched a fair few of these kind of themes that come into play in the past. What did you do differently this time around? I mean, obviously, like we just discussed, you were a lot better prepared, but what are some of the mistakes you made in the past which you perhaps didn't make this time around?
Preparation. So knowing the names, I wouldn't say inside it out, because I try not to fall in love with any single one of them, but knowing what's going to launch the next one, knowing which ones are the leaders and which ones are the laggards in the sector. Because what I used to always do is I would always just go for the laggards in the sector and try to play catch up. But a lot of times those are the biggest dogs. And I really focus this time on trying to find the best few and being one of the ones that was the front runners on them. And so trying to not wait and catch the last few percent, I was trying to get the majority of the percent on them. And then also knowing when the party stops. That was a big one that hurt me in the past, where I would do well. Let's say it was a 2-week period and do really well for a week and a half or a week. And then I would just hold on too long or buy too many dips or give up too much of that phase. Well, this time I didn't catch the last couple of days of craziness. I just kind of thought it's a little too crazy, a little too hot. It's time to back off and just protect the profits now and go for much shorter trades. So if anything, I guess that was probably the biggest thing, is knowing when to back off, because you always hear it's easy to make money in the market, but it's really hard to keep it. So knowing when to take the foot off the pedal, and then when to apply it back, because as soon as they run, they pull and they'll do a second run, and just kind of getting the feel and the flow and riding the wave versus, I guess, getting hit by the wave.
So I'm sure we'll get into this a lot more as we get going, but in this particular instance, as the blockchain mania we're talking about, how did you gauge when to get out of these stocks? Like, how did you know when the party was over?
It kind of sounds funny, and I've seen it, other people talk about it, but whenever you get texts from your friends and family that want to get involved and they have never traded before, then okay, the whole boat is loaded one side. Everyone wants to be long these names. And that's when it gets dangerous, because at some point the buyers are going to run out and the sellers are going to take over. And it's a healthy part of the market that obviously there's shorts that are on the other side. So it's knowing when there's too much optimism, and it's, I guess it's a mixture of technical analysis by looking at charts and just saying this. I mean, it can go further. There's no doubt it can go further, and it can always go higher. But at some point, the risk reward just isn't there anymore. And when you're looking for what's the next push going to be, it becomes less and less likely that it's going to continue. And like I said, I did miss quite a bit of it, so I didn't time it perfectly by any means. But there's a point when you kind of have to stop. It's not so risk on anymore. It's a little bit more defensive.
Yeah, but I think that's an interesting point that you raised, because you say you didn't capture the whole move, but you obviously captured a decent chunk of it, and as a result, you had the best month out of the whole trading year.
Exactly. Yeah. And it comes down to looking at that month, even if you broke it down day by day. In any week period, it was really like one day or even 2 days in the month that just really pushed over the edge. And the rest of it was just being there, hitting base hits and just taking what's there, but not going for too much. And I mean, I'm sure there are people out there that just slammed it and did way better than me. And maybe I'll be there in another 5 years. But where I was now I was very comfortable with what I was doing.
Well played, man. Well played. Now, you've shared your I guess you could call it your equity curve. I've seen you posting that on Twitter, and it's just incredible to me how consistent you've been. Like, it's such a smooth equity curve. How have you been able to achieve such great consistency?
It looks really stretched out, but if you look in there, there's still quite a few days where there's just not much I can get going. So there's, again, if you look at any month, there's some days I don't even place any trades, but when you look at the grand scheme of things, it's the days that when not to go for it, that were my biggest mistakes in the past, where, let's say I just had a bunch of good days and I just kept pressing and pressing and pressing. Well, now I just kind of know that there's being okay with periods of not doing anything, but still being there in case something comes up. I don't just have a couple good days and walk away. I'm still here, but being okay with knowing that I don't come looking for something to the market. And I think that was really, really big for me last year. Being okay with just kind of letting a half a day go where there's no trades, or a couple days, and not forcing things, and just really waiting for, and I know I talked about on the last time we talked kind of the A, B, C setups. There's days that you can go for C's setups, and when risk is on and when risk is not on, you really just got to be patient and go for the A's, and maybe just take a couple bucks here and there. But when that compounds, that was the big thing that makes that chart look really awesome, is compounding, that the size just gets a little bit bigger. So your small days just get a little bit bigger, and just protecting to the downside. And risk management is always my probably the thing that I guess is my Achilles heel, from keeping me to get like the outrageous huge percent win days or dollar days, I guess, and just staying consistent, staying focused, and trying to stay disciplined.
How often would you say that there are days which you don't place any trades? Like, are they pretty few and far between, or maybe more often than most would think?
I would say more often than most would think. This year, I've only had one day where I placed 0 trades, but I've had a couple of days where I've done 1 or 2, and they've been not much, and I've just had to be okay with it and just accepting it and just moving on, and not letting it fluster me, or not thinking I have to come back the next day and go for more, try to play catch up. I let the the longer term numbers speak. So I would say in any given month, there's probably 2 or 3 days where I literally sit at the screen from open to close and don't click any buttons at all. It's hard.
Yeah, I think that definitely is hard for a lot of people. That must be something which, you've learned how to do. Like, I don't think that comes naturally, right?
Oh, not at all. No, that was the thing. I mean, it's the day that I wouldn't wait. The day that I put zero trades on is the day that would have been a week killer, or would have taken 2 weeks worth of work away. Just taking the step back, and it happened, and that's why I do it now, because I've done it. I've stepped on the landmines, and now I'll just rather just wait it out and be not aggressive. And I do let things pass, and there are things that I could hit on those days, but it's just got to be selective.
Yeah, there's that saying. How does it go? It's like, you're better to be out of a trade wishing you were in a trade than to be in a trade wishing you were out of a trade.
100%. And there were times that whenever I was posting my P&L every day, and there'd be days, and that's kind of around our last conversation, that I wouldn't have much. People say, "Oh, how come you didn't hit this? How come you didn't have that? Did you not see that?" And I can't hit it all, man. I'm here. I'm not perfect. I miss a lot, but it's just that selectivity, I guess, that is probably one of my edges.
Yeah. Now, looking at your equity curve, very smooth, like I mentioned, you wouldn't be able to tell that you'd had any kind of significant slip-ups or anything like that, but has there been any slip-ups or substantial mistakes which you've made since we last spoke, 8 months ago?
Yeah, it seems to be the same thing that happens to me every so often. And luckily, it's been spreading out. It doesn't happen as often, but this year it's happened. I have had one red day so far this year. And it all stems from when I kind of get in this flow trading state, and I'm just kind of working, and I'm having maybe some trades on, and I make an error. And the stocks that I trade, they're under $10. They're considerably low float. There's liquidity issues involved sometimes. And what happens is, let's say I put in a wrong order. For example, what happened this year was I was pretty full size into a trade. I got the breakout I was looking for. I thought I was scaling out of the trade, but was actually adding size into the trade. And by the time I realized it, the trade was over, it broken down, and I get in almost this flight or fight reflex where I try to battle it, or I try to wiggle my way out, or I try to outsmart the market or something like that. But there's no one there to buy the shares that I accidentally bought. And I take a much bigger hit than if I were to just say, dude, you made the error, put your market order and just sell out and take the loss. And I let it snowball. And that's happened probably about 4 or 5 times. And that would be my current fatal flaw that I'm working on. It's easy. I have it written down. It says, Alex, if you get into a trade you don't mean to, just mark it half out. But when you're in the heat of the moment, sometimes your brain just kind of doesn't work.
So what are some of the traits which you can attribute to you making money as a trader? Like, what are some of the things which you've actually tried to do really well? Like, is there a short list of things which you've really tried to focus on over the past, 8 months, 12 months sort of thing?
Yeah, I would say, and I have a whiteboard in my office, and I have something written down. The three things that I'm really, really working on to get better. Better preparation. You hear it a lot. I mean, there's preparation in the market, before the market, during the market, after the market close. Just getting better at, and something I do much better now than I have in the past. But having a system in the morning that you follow every single day. Sometimes when I have 3 or 4 really good days, I think I can cut a corner and I don't have to do something in the morning, and then the market opens and I miss out. And it's definitely something that I've improved on, but I'm still working on improving. And then having a clear criteria to hold longer. I'm in this. I get in this short-term scalper cash flow mentality that I let a lot of really big trades go, and I have to watch them from the sidelines. And that's just one of my big flaws. And then I'm also working on getting bigger size onto trades. But also, when you do that, you can't just get bigger. You have to get better. You have to be able to read the order book, know kind of liquidity and all those kinds of things.
Yeah, absolutely. Especially in the stocks that you're playing, right? That's even more important.
Yeah, totally. And I remember somebody told me that last year as I saw my equity curve going up. They were said, I don't know if you know this, but you're going to get to some point where the game's going to completely change because you have to almost think one step ahead. And I was like, yeah, I get it. And then, then you get there and you go, yeah, this is what he was talking about. that you really have to be careful because, you can't, just because you have more money in your account doesn't mean that stocks care, that you can take all the shares. And if you don't have somebody there on the other side to be there, you can get into some serious trouble.
Yeah. I know a lot of people are probably listening to this right now and they're saying that that's a good problem to have though.
Yes. It's something that's going to have to continue to get harder and harder, but it's even harder when you're starting, you have a small account. You are much more nimble, but there are times that you think you can get aggressive or not. And you don't even realize that there's that issue there, that there's not always a bid behind you. And you go, oh, how come I can't get out of the stock? That's happened to me before. How come I can't sell it? Well, there's no one there to buy it from you. So
one of the things you mentioned just before was having like good preparation before, during, after the market. And you said, when you have a few really good days, sometimes you feel as though you can cut corners a little bit and sometimes become a little bit complacent. But, you said it's important to follow some sort of routine. Would you mind sharing maybe your pre-market routine?
So for my time here, I'm Central Zone. The market opens at 8:30 in the morning. Some guys wake up really, really early and they trade in the pre-market, but I don't at all. So I usually wake up and I start to kind of take a look at markets about an hour and a half before they open. First thing I do, I know most blogs and things like that say don't check your phone first thing when you wake up in the morning, but that's the first thing I do. Check Twitter, check the news. The night before, I have a watch list ready of the stocks that I'm interested in, and I like to kind of keep updated on the news. So if we're looking at, the end of the good month last year in December, I had my names of stocks that I was watching that I was familiar with. Which names are now saying they're involved in blockchain that have nothing to do with it. You really want to know those things, and you want to know them before the market opens, and you kind of want to be familiar. So I have my watch list, and I have on my screen about 12 charts that I'm watching. And one of the things that I've really worked on is kind of having an organization, because that's a lot of data to watch. So when I come to the market, I want to know where my charts are, which ones have to be watched right out of the open to get trades for, which ones need to set up a little bit longer, and having a plan for each of those, but also being familiar with what their daily charts look like, where the closest support and resistance. That's a lot to take in. And that's something that I'm still getting better at, but it's having a plan, and then at the same time being really flexible, knowing that as soon as the bell rings, your plan can go upside down. One PR comes out and it changes everything. If, like I know they were saying I think it was like South Korea was going, gonna try to make trading cryptos harder, and it just changed the entire game that day. So no matter how much homework I did, no matter how prepared I was, what I had written down on my notepad, it all doesn't matter at that point. You have to be flexible, but still be prepared. And I think if you're prepared, you can be flexible.
That particular example, where are you getting most of your news? Like this South Korea announcement about trying to make trading cryptos harder for people who live there. How did you receive that information? Like, where do you get most of your information during the trading day?
Twitter is a beautiful place. There's a lot of great information on there. It's one of the nice things that you can curate what you do and don't see, because there's a lot of garbage, there's a lot of good stuff. So following the right people on Twitter. I also have 2 news feeds that I pay for. They have the actual news that scrolls, and they also both have squawk boxes, which is really nice. So they read out the news, because a lot of times when there's a lot going on in the mornings, there's all these trades happening and you're tracking a lot. It helps to have the news read out to you. So if something you're trading, all of a sudden they say, oh, they're just filed for, either something positive or negative, you can right then and there make a decision versus missing something because you don't have eyeballs on it. Okay.
So what are those 2 services that you pay for?
One of them is called Trade Exchange, and the other one's Benzinga Pro.
Okay. So Benzinga Pro is the squawk?
Yes. And so is Trade Exchange. They both have squawk services and news services, and they do cost money, but basically I take a look at how much it costs and how much it typically makes me, and those services typically make me a lot more money than they cost.
Yeah. Sometimes you've got to spend money to make money.
Right.
Okay, and those are purely sort of equity-based services?
Exactly. Yeah. So I'm sure I know there's certain ones for, for people that'll read more Forex news and different kinds of services, but these ones are pretty much geared towards what I trade. They also talk about stocks that I don't trade, Apple, Amazon, etc. But they also have breaking news on a lot of small cap stocks, which if you can hear it and hear it first, that's a huge edge in the market.
Are you ready to get serious about trading? Then join Tasty Trade, Investorpedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including 0 commission on stocks, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, risk analysis tools, and more features to help you trade smarter. See equities and derivatives with high trading volumes, dividends, upcoming earnings reports, and more with their pre-built watch lists. Or create a custom watch list to keep an eye on the companies and sectors that matter to you. Manage your positions with speed and precision using active trader mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Visit tastytrade.com/chat for more info. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Have you ever watched a stock explode and thought, if only I had the capital? Or sat on the sidelines because your account balance felt too small to matter? Good news, with Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 U.S. listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with 0 locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
Now, going to the other end of the day after the market closes, I remember last time we spoke, we spent quite a bit of time actually talking about how you're journaling, how you're reviewing your performance each day, each week, etc. Is that something you're still really big on, or have you dialed it back a little bit?
I'm still very pro journaling and tracking all of your trades, but I'm not currently tracking like I used to be honest. I think it's a great thing. For me, it was all about finding those where my high probability trades were, where I was losing money, where I was making the most money. I took that data and essentially now I'm not journaling. I'm still journaling kind of notes on the trading day, but not tracking every single one of my trades because it became such a habit that it was almost like I could do it on my own. And I would still go back to it at some point. Let's say my strategy just completely stopped working. I couldn't make money. I couldn't figure anything out. I would dust that thing off in a heartbeat and get back to work. But it really got me to where I was comfortable doing it on my own in my head.
Okay, that's interesting. And as you've grown your account over the past 8 months, 12 months, etc., has that taken some psychological adjustment? Because I presume that your P&L swings during the day are a lot bigger. You know, there might have been a few $100s at the beginning of 2017. Nowadays, there might be a few $1,000s each way. Has that required some psychological adjustment to get used to that sort of thing? Because, you know, it's not a small amount of money you're throwing around. Yes,
it really has, because I consider myself a somewhat simple person outside of the markets. I'm not a big spender. So having trades, you know, that are both positive trades are great, but it's those big losses that still hurt. I mean, and what used to be big back in 2017 is much bigger now number wise, but it's around the same percent wise. But it's still hard to swallow whenever you see, you know, you're down $2,000 or $3,000 on a trade. It's still a tough pill to swallow, knowing that what could you do with that? And then on the same side, on the flip side, sometimes, and this is something that I have to work on, is that when I have a couple really good trades and I put up a big a big P&L in the day, I have to remember that there's still only maybe 1 or 2 days in a month that really make your month good. And I can't just get up and celebrate and call it a day, or just get excited and start slipping up. Really have to be careful on both sides. But as far as psychologically, I know this was one of the questions that was asked on Twitter a lot, like how much of your account do you risk per trade? And just because my account's bigger, I still don't ever really go all in or put my entire account in there. But I have been working on slowly being more comfortable putting more size on. But I'm a much more slowly raising that than just saying, okay, I'm going to double my size the next day.
Okay, so if we were to look at it from like a percentage point of view, you're still risking roughly about the same percentage of your account as you were when it was smaller.
I am, and one of the things that I might do differently than most traders, and maybe call it good or bad, is I truly don't say I'm going to risk 2% on this trade or 3%. I typically have a setup that I'm looking for, and I don't know if it's just become natural, the size that I take, but if a trade's not working, I'm not going to let it get to that max, let's say 2 or 3% loss or whatnot. I really just let the trade work as it's supposed to, and I have gotten comfortable with it. So if I'm trying to trade a breakout, I don't set a wider stop than I need to. Sometimes my stops are really, really tight, and I don't really technically risk a lot, other than the fact that there's liquidity issues and slippage and things can change. But my potential losses are larger, but on a percentage basis, they may even be getting tighter because I'm actually improving my entries and my exits, if that makes sense.
No, it does. It does. It makes a lot of sense. Now, you said a little bit earlier about how it hasn't really become an issue too much for you now, but it's something that you've been given a little bit of consideration to, is that, some of these more low float stocks, when you're trading larger size, you can have liquidity issues and some significant slippage. Have you been thinking much about stepping over to more of the larger cap stocks? Is that something which interests you, that you think you may work your way up to at some point?
It is. I've kind of dipped my toe in a couple times, trying to see how I kind of read the small cap markets translates exactly over to the larger cap markets, and it doesn't exactly, because the percent moves are much smaller, but the dollar numbers are much bigger, and it's similar. But I keep telling myself that I'm going to have to make that jump at some point. There's going to be a certain period where I just keep getting too much slippage, or I can't grow the way I want to grow. But I haven't gotten there yet. And I try to kind of keep my eye on the prize right now, or on the ball, which is just the next day. And I actually, had a conversation with one of the traders you had on here, Bryce Edwards. I reached out to him because I was kind of preparing myself for that issue, I guess, before it got there. And I was looking at either starting to try position trading or swing trading or expanding my book. And he just hit me with some truth that was, just keep getting bigger at what you do well, and just keep pressing and getting better at what you do. And I've done it so far, and it's worked, and I haven't had to change. And I appreciate those comments. But I basically know it's going to happen at some point, but I haven't gotten there yet.
Yeah. I remember last time when we spoke, you said that you were interested in, lots of other strategies as well, as you develop as a trader. Like you were saying that, it'd be good to eventually be able to trade like some trend following strategies and some more like longer term position trades and that sort of thing. That's not really something you've gotten into yet?
I've tried. I've tried paper trading, just the good old fashioned way, on a literal piece of paper, writing, okay, here's where I would take a swing position. Let's hold it overnight and see what happens. And my accuracy is just, it's not very high there. I'm not comfortable with it. I don't have confidence in it yet. Maybe one day I will. Maybe one day I'll put my head down and really try to work on it and hammer that in, because I do think that's probably the next step. Maybe, again, I don't know. I'm just speculating, but that may be the direction I have to go at some point. But I'm having a lot of fun where I am right now. I'm pretty low stress, so honestly, I'm almost thinking that at some point if I did have a liquidity issue, heck, I'm doing pretty well for myself. So maybe I can just continue to, I wouldn't say plateau, but just get a little bit better on what I do.
No, I think that's really important, and that's, I think because a lot of the reason why you've done so well is because of that, because you found something which you're good at and you're just focused on it, right?
Right.
Like striking while the iron's hot, as they say.
Yeah, and I get this question a lot from people. They say, "Oh, you're a long bias trader in a really big bull market. Well, how do you know? How do you know you're still going to be successful in a year or two or three?" And the answer is, I don't. Things completely change upside down and a flash. And all I know is kind of what got me here. And going back to like the journaling and tracking trades, and I have to only assume that if everything that I know just stopped working, but the market still traded, that I could readjust and I could find something that worked, and I would have to start backwards and I'd have to set smaller goals and I'd have to work my way back up and be patient and be ready to fall and stumble. But as of right now, I'm just trying to get better at the few things that I'm good at.
Yeah. I mean, I have complete confidence that you would be fine. I mean, you've got to trade the market that we're in. Last time we spoke, that was one of the interesting things that we spoke about, actually, is about how you do play the long side. You're trading these low float stocks, and most of the guests who I've had on in the past who trade this market are very short biased, where you predominantly trade the long side. Is that still the case, or have you started to take more short trades, or is it something which is still not really of interest to you?
I'm slowly creeping over to the dark side. I would say last time we talked, I was about a 98% of the time long trader with just every once in a while I would short. Now I'm still, I would say 85% long side, and I'm dipping my toe, I would say a 20th of the size I trade on the long side, trying to get comfortable. And what I was doing before was I was trying to short things that I wasn't really familiar with. I don't really know why, but just like I'm kind of focusing on the Bitcoin sector at the end of last year on the long side, I was also aware of how they moved up and down. So I was trying to kind of flip the script a little bit and work a little bit on the short side, but it wasn't a huge profit bucket for me. I wasn't making a ton on it, but I'm hopefully going to be increasing it a little bit.
Okay. So you'd say that still about 98% of your trades are long?
About 85%. I'm getting a little bit more, about 15% on the short side now, I would say.
Okay. And as you're kind of less experienced playing the short side, how have you been treating that? Like, have you been taking much smaller size on those trades?
Yes, much smaller size. My emotions, I don't really have them in check because I just have this, I don't know if you want to say natural fear, I guess, of just getting caught in something outrageous, which happens every once in a while. So I take much smaller size. I give myself one bullet in the chamber. So I'm not going to add and get myself into something bad. I basically said, I've got one shot to pick a good spot and you got to stick with it. Set your stop. And it's a work in progress, to say the least. It's profitable overall for me, but it's nothing big. And the thing I also don't want it to be is a distraction on my long side. So I kind of, I only kind of shift towards that when I really feel there's just not much on the long side.
Okay. Now, Alex, when you posted on Twitter yesterday, I think it was, that you were going to be coming on and did anyone have any questions? One of the questions which kept popping up over and over again was, how are you scanning and identifying these stocks which may offer trading opportunities? So obviously, when you hear about these blockchain catalysts which are coming into play, it's kind of hard to miss that sort of thing, or to not know about it, right? But when there's not a catalyst in play, or a catalyst which to the same magnitude, how are you finding stocks to trade on just a regular sort of day?
Yeah, so it's good you differentiated that, because scanning when there is a catalyst is almost just being at the market, seeing what's moving, being familiar, and having that list of the top 10 names that have the most volume. But when the market does slow down, and it will slow down, and it goes in phases. And let's say like August of last year, I remember everybody was just saying, "Oh my gosh, there's nothing to do. Is the market done?" And it just, it slows down. So at that point, you do have to do some scanning. And so what I do, and I don't know how the different sites work for different countries and different exchanges, but we have a site, FinViz. I don't know how you pronounce it, but it's a free site, and it allows you to search every single stock. And you can kind of break it down into really complex search terms for people who like fundamental analysis. How much do they earn? What's their debt ratios, et cetera, et cetera. But then it also has technical side. And so I keep my scanning pretty simple. I like to look for stocks under $10 because that's where I, at the time, and I still do now, have my expertise, I guess you could say. And then the one thing that I know people talk about over and over again is how important volume is to trading. And it took me a long time to realize why, but I scanned for stocks under $10 and stocks that are trading at least 2.5 times their daily average. And the reason is you can scan for amazing charts all day long. And you can find a great chart. And this is what I did a lot when I started was I find a great chart, 10 great charts, and I'd trade the wrong 3 ones, I guess you could say. Nothing, it didn't go anywhere, but it was a great chart. But that doesn't matter because other people weren't watching it. There wasn't other people that wanted to get involved. There wasn't other people sitting with their fingers on the trigger waiting for that entry that wherever they're looking for. So when you scan for charts, it's really important to look for volume and look for above average volume, because that means people are getting interested or it's people are already interested. And that's something you want to watch. And it's free. And so it usually brings up a list of, let's say, I don't know, 20 or 30 stocks that are trading above average volume at under 10. Then you can start breaking down how do their charts look? What are their catalysts? What sectors are they in? And then let's say there's 10 that you find that have good chart setups. I would move those over to my watch list and I would arrange them based on, the ABC setups where, the A would be, it's a great chart. It's in a great sector. It's got a low float. It's got a high short percentage. It's got, all these little things that you want to look at, whatever you care about. And you kind of arrange those. And that's how I set my priority. So when the day starts, I know the top 5 and I know the bottom 5, and those bottom 5 sometimes are the biggest winners. You got to keep your eye on them. But that's how I do my scanning, and it's really nothing crazy.
So once you filter it down, you end up with about 10 names to watch that day.
Well, I guess if it's a slow period, sometimes there's only 3, 4, or 5, and that's sometimes a good thing because that means there's a higher percent chance that everyone's going to get fixated on 1 or 2 of the names that you're watching. So I would say usually you can find, even in really crappy markets, you can find 3 names that are trading above average volume for some reason.
I think it's really cool that you still use FinViz, even at this point. You're using like a free tool. It's really cool.
Yeah, I mean, I'm sure you could probably pay for something a little bit better, but I mean, all you have to do is like watch a commercial every once in a while, and then you can just X out. And so,
no, it's a very comprehensive scanner. I mean, I occasionally get emails, people asking, and that's usually the one I suggest.
Yeah, and you can set it up really detailed. And I have some detailed scans, and I found that simple works.
Yeah. And you said daily average volume. You like to see stocks which are 2.5 times the daily average volume. That's the average over what period? Like the last 10 days, or?
That's a good question. I want to say it's 20, but I'd be lying. I think it's just whatever's standard in there. To be honest, I haven't really messed with that. But then sometimes if that scan doesn't show anything, if the market's like really dead, sometimes you kind of have to take it down a notch. But when everything's going, and your list is too long, you just kind of increase that. And that's just showing you where are the eyeballs, basically. Where is everyone else looking?
And to what extent do you care about the broader, higher time frame trend? Or are you only focused on intraday price action?
I always start with a daily chart. So when I'm scanning, that's where I look. I probably could zoom in more like on a 1 hour because I am such a short time frame. I'm basically trading an intraday breakouts, and I don't look back, let's say, a year and really care about like what the high levels of resistance and support is. I'll look back maybe 20 days and see what the support and resistance there is. Cause that's where the people that I'm typically doing business with and transacting, that's where everyone's focused on. So I typically start with the 1 day chart. And then now I've been really, really focusing a lot more on the 1 hour chart, because it's even more zoned in to where I'm concerned with support and resistance is. And then I focus intraday on the 3-minute chart.
Okay. So you're not trading off a 1 hour chart, are you?
Right. No. So that's kind of where, when I talk about I'm trying to get better at having criteria for longer term trades, I like to know that the daily chart and the 1 hour chart is lined up in some sort of way. And that would allow me to hold longer, but I'm not trading off of those charts. I guess you'd call it, quote unquote, my entry signals are on the 3-minute chart.
Okay. Got it. Yeah, cool. Alex, would you mind talking about one of the setups which has been working best for you as of late? Maybe one of these intraday breakout trades? Yeah.
So again, even going back to the scan being simple, I've really kind of learned that simplicity in what you're looking for intraday. I used to be really rigid, looking for drawing trend lines and being really rigid. Like it's got to touch heat. It's got to touch, the number's got to exactly touch that line if I'm going to buy either a dip or a breakout. But what I've kind of learned is watching intraday is flag patterns or pennant patterns, which are just simple, like a breakout and then a consolidation. And then that's kind of where I zone in. After something breaks out, I'm never the first one into a breakout. I don't think that probably happens like once or twice a year, and it's completely lucky. I typically wait for a chart to break out. Let's just keep referring to Bitcoin because it's fresh in everybody's minds right now. A chart makes a big move and it kind of hits a high point, it pulls back. And that's where I get interested, because that kind of gives me an area where I can watch and say that's where people are either considering it to be the high of the day at that point, and there's maybe shorts that are using that as a kind of a buffer, and then looking for certain patterns in the order book. You know, there's a big bidder step in. You can overcomplicate it definitely, but essentially looking for a breakout, consolidation pattern, and then that next push. But it can get very detailed and the fine details that you're looking for within those patterns.
Yeah. How about indicators? Are you using any indicators? I think VWAP may be one that you use.
Yes, that's the only one that I use on every single chart. Well, I guess on the daily it doesn't really look that good, but every single intraday chart I have the VWAP on. It's a simple guide that I use. I don't overanalyze it. I know there's a lot to it technically, and a lot of people have written code for it, but I just kind of use it as a really quick gauge. If I'm going to pull up a chart that I'm not familiar with, that I'm not watching, where is it in relation to its VWAP? If it's over, theoretically, it means that bulls are in control. And if it's under, it means that bears are in control. But it's not always the case, but it gives you a quick idea to say, okay, the average person's holding this in their green, or it gives you a quick basis. And then I also use on my daily charts and hourly charts, the 50 and 200 day moving average. Not anything for any crazy reason other than I know a lot of people have it on their charts. And that's kind of really what tools are, right? I mean, they're just the fact that a lot of people are watching them, so they act around those tools for specific reasons. So I a lot of times use them as targets. So if I'm underneath on the daily chart, a 200-day moving average, but it's pretty close, and we're getting close to a breakout underneath that, then that's going to kind of be a target that I'm going to be shooting for to try to start taking some shares off or looking for a breakout through that. And at the same time, on a daily chart, if it's pulling back, I'm not a big dip buyer anymore. I've learned my lesson. I'm not really good at that. But if it starts pulling back into, let's say, the 200 or 50 moving average on a daily chart, then I start looking for intraday breakouts off of those levels. So That's all I use.
Yeah, and I'll just point out that I think you wrote an article about, or you posted something on your blog about how you actually use VWAP. So if anyone's interested in a slightly more detailed explanation, maybe check that out. I'll put a link to it in the show notes. Now, one of the things which I think you're really good at is actually trade management. So once you get set in a trade, can you talk to us about some of the things which go through your mind, as in, like, how do you manage this position from that point?
Again, it goes back to what some might consider a strength, others might consider a weakness. So for me, I'm really consistent. I don't take a lot of big losses. So when I enter a position, because primarily what I trade is breakout trades, but it doesn't always mean that I'm trying to like a 52-week high or something like that. It's patterns within a day. If I'm looking for a breakout, and I've learned, last time we spoke, I was really big into scaling into trades and scaling out of trades. What I've learned over this last 6 months is that I'm much better just going full size, one bullet into my trades. So when that happens, as soon as I enter a position, I know exactly where I want the breakout to happen. If it doesn't work, I know exactly where hopefully somebody in the order book's out there that I can get rid of my shares to. So as soon as I put on a trade and I get a breakout, I'm instantly selling some shares. And that may hurt me at sometimes because it could go up another 50% and I sold it for 2 or 3% or partial, and then I'm scaling out on the way up. But that's a big part of my trade management is taking some risk off right away, reducing those emotions, letting me have a clear head. Once I'm in that trade, if I get the breakout, I'm very aware that there's false breakouts. And as soon as you get that, everyone's loaded on one side and they break down. So literally, as soon as I put on a trade, I have my first order ready to execute on a sell. And most of the time, luckily, I can get the first scale as a profit. And then I am prepared right then and there to completely sell my position, even at a tiny loss or at a slight profit, because I know breakouts fail. And I'm just really trying to capture something on every trade. And then once that position goes, the thing I've been really working on managing trades is getting a bigger position size and trying to hold a little piece a little bit longer. So if my target, going back to what we said before, is the 200-day moving average, but I'm a substantial amount away, I'll take some just right off the bat off that breakout. And then I'll slowly scale out of my position to where typically I'm at like a fifth of my size when I hit my final target. I wish I could just man up and go for more and go for a fuller, bigger position towards those targets. But that's kind of how I manage trades is I basically put on my max risk right away and I start taking that risk off as soon as I can.
So let's say if you are sort of trading towards a point where you think is a good point to get out, like have your entire trade off the book, how willing are you to change your mind as things play out? Are you kind of reading price action as the trade is in motion? And, if it looks like it might be turning around a little bit, like how willing are you to kind of give it room to breathe and move around? Or are you just cutting the trade?
Most of the time I'm cutting the trade. And that's my risk aversion right there. And that's something that I continue to work on, is knowing when I should let it wiggle more and when I should give it a longer time to run for a target. But typically, let's say a lot of it has to do with reading the chart and the order book and flow. And let's say there's just so much buying going on at a certain level, but the price isn't moving. It's just a sign for me to say, look, they may bust through this wall. They may keep pushing it and it could go higher, but I've just got to protect myself. I've always got to just look out for protecting myself. And I usually just start scaling out. And I don't typically, if it doesn't go right where I want to go right away, I don't just typically slam out of my whole position, but I start lowering risk. And when I don't do that and I try to go for more and it pulls back, I just get that kind of ticked off feeling. Like you said earlier, I'd rather be out of it. I'd rather wish I was being in a trade than wish I wasn't in a trade. So I just start scaling out, and doesn't always work in my benefit, but that's kind of keeps me consistent.
Cool, man. Well, let me ask you, what's on the cards for the next 12 months? Like, what are your big kind of goals for 2018? Where do you want to take this?
Continue to scale, and perfect little things here and there. So I've noticed that the biggest changes are really just making a few small changes have a huge impact on the P&L in the grand scheme of things. Trying to continue to get into larger positions. And I would love to find different areas to trade, different, larger markets or more liquid markets. But I'm still keeping my eye on the prize, waking up every day and looking at just what I did the day before, doing it all over again, just a little bit better. Trying to get more comfortable with bigger swings in those profit and losses, and being not getting overexcited on any either direction. Yeah, I mean, I guess just trying to get a little bit better.
Nice, man. Eye on the prize. I like that. That's very good. Do you have one tidbit, one piece of wisdom, just a lesson you'd like to pass on or share to younger traders coming up?
Well, I did have one of the questions that I really like. Well, I guess I kind of addressed both of them, but I'll readdress them, because I got a question like, what are some of the habits of a really profitable trader or a consistently profitable trader? And I just really did want to harp on the self-discipline and the flexibility part, because I know that was a huge turning point for me, is whenever you're going to slip up, you're going to make really bad trades. But the self-discipline's so important to keep yourself on the right track, to know, at least if you're doing something wrong, at least know that you're doing it wrong, and try to make the right adjustments, and being flexible. I think a lot of people get into trading, and they want something. They either want to make really big gains, or they want to be a hot shot, whatever options trader or whatever. But if you realize pretty quickly it just doesn't fit you, you got to be flexible. And I think that's what a problem a lot of new traders have is they kind of see one mold, it doesn't work, and either they give up or they lose a lot. So I wish people would really, really hammer down on that self-discipline, because I get a lot of the same questions all the time of people messing up over and over and over and over and over again about the same things. But at some point you gotta make some big changes there.
Yeah. No, I appreciate you sharing that, man. I'm glad you addressed that. So yeah, let's wrap things up there. I do want to say it's been really good catching up again. It's been really cool to see your progress. I'm really proud of you, man, and I wish you all the best moving forward still. So where can listeners go to find out more about you? I know you've got a blog that you've put together, and you're also on Twitter. Do you want to share those couple things?
Yeah. So my Twitter's Tagger Trades, TAGR Trades. Don't keep up with it as much as I used to. Maybe I'll come to and get back into it, but recently about to have almost a 4-month-old daughter now. So my life has been strictly trading, and then that. But then I also have the blog. Geez, I haven't even gone in a long time. It's taggertrades.com. There's some interesting stuff in the past, but I'll try to keep a little bit more updated for everyone in 2018.
Yeah. Oh, you're a busy man. You've got to focus on what's most important. So
yep.
Yeah, keep doing you, man.
Thanks as always, Aaron.
Yeah. Thank you very much for sharing. We'll talk again soon, I'm sure.
See you, man.
You've reached the end of this episode of Chat with Traders, but rest assured there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes, and we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
Chat with Traders is brought to you by Trade the Pool. Did you know that every decade the market reinvents itself? Online brokers opened the doors, mobile apps made trading seamless, and commission-free trading erased barriers. Now, a new era has begun. Meet Trade the Pool, limited risk trading. And now you also have unlimited time to reach the profit target. From now on, your trading risk is capped, and your trading opportunities are limitless. Trade the Pool funds home-based stock traders with up to $200,000 in buying power. That means you can trade larger positions and scale your strategies without risking your own savings. It's time to trade with more capital, making it truly worth your time and effort. Ready to trade the pool? Click the link in the description and join the stock trading revolution today.
Are you ready to get serious about trading? Then join Tasty Trade, Investopedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade all in one platform. Get low commissions, including 0 commissions on stocks, so you can keep more of what you earn. Trade smarter with advanced charting tools, a pre-built strategy selector, risk analysis tools, and more features. Visit tastytrade.com/chat for more information. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC.
Markets, speculation, and risk. This is the Chat with Traders podcast, hosted by Aaron Fifield.
Sup? What's happening, team? Episode 158. My name is Aaron Fifield. Let's get into it. The trader who you're soon to hear from is Phil Godecker, though some of you may know him better by his Twitter handle at Ozark Trades. Phil's been trading stocks for about 15 years. He started young, in college, made a shitload of money in a short period of time, which then afforded him the luxury of never having to work a quote-unquote real job. Admittedly, Phil will tell you luck was a major factor early on, but nonetheless, he's been abundantly successful and has continued trading full-time, but now with a strategy, with rules, and with an edge. Phil's way of trading, just to give you a bit of an idea, is to short parabolic moves on low float stocks which have been seriously hyped up. And when he senses golden opportunities, he strikes with real conviction. In many ways, Phil is similar to Alex, who was on the previous episode, except the key difference being Alex trades the long side of these moves, whereas Phil has found his niche in trading the opposite side, the short side. As you continue listening, you'll hear Phil speak about his early days and progression, his obsession with cutting losses quickly and sizing up on those trades, which can make a good year a great year. Plus some talk about strategy, timing, setups, and why Phil is set on filtering his trading profits into farmland, which he describes as boring investments. I'm going to stop right here. Please relax and enjoy this episode with Phil Godecker.
No, not a ton. Just watching, we're in the midst of earnings season, so small caps are a little slow. Just watching Kodak and traded a little RGSE this morning, and LTBR I held overnight, but that's it. Overall, bit of a slower day.
Okay. Do you have many earnings plays? Like, are they a big thing in the small cap world?
No, not really. I really don't play earnings plays really much at all. But when you have, in the midst of earnings season, you just don't see small cap runners like you do, like we have had the last several weeks. So, it's just something that happens, during earnings season. Small caps slow down, and that's kind of the way it is. So usually just kind of chill out a little bit more and take a little bit more, time off, during those times.
Right, save your energy.
Right, exactly.
Like we were speaking the other day, you told me that you started trading while you were in college. How did that come about?
Really I was in, high school, maybe my junior, senior year, and I was kind of looking ahead to figure out what I wanted to do, what I wanted to be. And, the only thing I knew was that, I wanted to make money. I mean, I was driven at that time. I worked, every summer, and the only thing I really knew was I wanted money. And I thought, well, what are the jobs out there that can provide that? You can be a doctor, you can be a lawyer, and those are all great, but they also come with a lot of school. And I thought, well, I don't want to wait till I'm 30s to have money, or huge student loans on top of that. So, it was coming across to me that, if you want to work for yourself or be an entrepreneur, there's real estate or there's the stock market. And, back then when I'm, 15, 16, 17 years old, whatever, I thought, well, real estate, you usually have to have money to make money. And you probably have to be a little bit older, but, as far as the stock market goes, anybody can open up a brokerage account at any time. And that's when I kind of thought, then let's investigate the market a little bit. And I just started reading on it, studying on it, just different newspapers or articles, and even our local business section, in our local newspaper. And from then it just took off. I was immediately interested. I mean, it immediately grabbed my attention. And, this was back in the late 90s when the stock market was roaring and you were seeing all these .com tech companies just, skyrocket. And the whole, the headlines were everybody's just making, lots and lots and lots of money. So I was instantly ready to go. I mean, attracted to it. Absolutely. Yeah.
Yeah. And what was your experience like starting out? You were mostly a long trader back then, right?
Yeah. So when I started out, I didn't have everything I learned or everything I knew. I just did it on my own from doing different research. I had no idea shorting was even possible. So I didn't really actually open my first brokerage account. I think I was a sophomore in college, and I had saved up $3,000 that I made over the summer. Basically that time I was a long bias trader. I was trying to, still in school. So I was swing trading, mostly trying to kind of buy breakouts and hope that I could hold them a couple days, a couple weeks, and, kind of hope for the best. And at that time, again, I was just studying everything that I could. I was studying, different chart patterns, trying to find out some patterns, trying to find out what made a good setup. My sophomore year in college, I just slowly lost that money. It was $3,000, and I slowly lost that over the course of the year. Well, the very next summer, I worked again. I worked for my dad. He has a business here in Missouri, and I worked for him over the summer, and I saved up another $3,000, and I kind of did the same my junior year. I slowly kind of lost that money, just trading long. I couldn't find any consistency, but, I was still – the losses didn't scare me at all. I was so intrigued by the market. I knew there were ways to make money and ways to make big money, and I didn't have the patience to buy and hold. I just, I was reading so many books in the Warren Buffett method of, buy good companies and never ever sell them, and I thought, well, I just can't do that. I mean, I want money and I want it, now. This is what I want to do. So, I never gave up. And then my senior year, I did the same thing. I saved up money over the summer. I had about $5,000. And then it was right at the very start of my senior year in college, maybe around August or so, I finally found out that you could short. You could bet stocks would go down. And I thought, well, hell, I'm great at that. I mean, that's what I've done the last 2 years. Everything I, buy goes down. So, at that time, after studying for 2 years, I have seen so many patterns of stocks that have gone from $5 to $20 or $1 to $10 or 20 to 100 or whatever it is. And there was a stock out there in August of my senior year of college. The symbol was CAFE, C-A-F-E. The name of the company was Host America, and I can remember it like it was yesterday. They put out a press release that they were going to do some sort of business with Walmart and some sort of partnership with Walmart. The stock went from about $4 or $5 up to $15, and it's about a 2-3 day span. And I shorted it at 15. I shorted all I could. It wasn't much, maybe a couple thousand shares. And the very next day, the stock was halted, and it was halted for a month. And I was on Yahoo message boards, and I was reading all this stuff about, they're going to be bought out. And I thought, well, I'm going to be wiped out. I was scared to death. And needless to say, after a month, the stock went from 15 and it opened up at 5. So I had turned around $5,000 into approximately, maybe $15,000. So it just clicked. I mean, it opened up my eyes. And it wasn't so much the monetary gain that I was excited about. I was just excited because after 2 years, I had finally figured out something that can work. I mean, finally it clicked. So my senior year in college, I did the same thing. I just, shorted, I guess you'd call them overhyped or overbought stocks. I hit a huge market. I mean, it was an unbelievable run in the market at that time. And from that August to when I graduated in May, I finished with about $1 million. So I turned that 5,000 into $1 million right when I graduated. So obviously at that time I knew that, I'm not, I had studied accounting, so I graduated with an accounting degree, but I thought there's no way I'm going to be an accountant. I mean, this is what I'm going to do. And then, I just stuck with it from there.
That's incredible. So starting with $5,000, or once you refunded your account a couple times, You had a $5,000 balance and you grew that into $1 million. What sort of time frame are we looking at? Was that about 12 months?
No, that was from August to May. That was about 9 months.
Wow.
From $5,000 to $1 million in 9 months. And I thought I was on top of the world. I mean, from that point, it was incredible. But, again, at that time, I had no rules. I had no money management. I was going all in on every position, no matter what. And that's how I grew it from 5,000 to $1 million. I mean, there would be no way to make that return if you're not risking everything you have. Now, so needless to say, when I graduated in May, I thought, well, hell, if I had just turned 5,000 into $1 million in 9 months, in June, July, August, I want to turn that 1 million into maybe 3 million, maybe 4. And that's when I'll have some big money. Well, needless to say, the market kind of turned south, and that million went down to 500,000 pretty quick. So it was August, and now I had lost 50%, and it was quite scary. So what I did was I immediately took 400,000 out. I put it in my bank account, and I thought, well, hell, this is savings. I'm never going to touch this. It's in the bank. And then I started trading again with 100,000. And I did that consistently for about the next 3 years or so. I just, whatever I made at the end of every month out of 100 grand, I just took it out, put it in the bank, took it out, put it in the bank. And then I had, 3 pretty good years of making around $500,000, when I was, again, I was about 22, 23, 24 years old.
Was there a part to this which seemed kind of surreal?
It did. It really did. But at the same time, I had put in so much time. When I was in college, to be honest, I wasn't the best student. And, I got grades good enough just to kind of squeak by. And in every spare minute I had, I was studying the market. I mean, I really was. I had stock screeners out there, and I was studying every big winner on a weekly basis, monthly basis, quarterly basis, yearly basis. I was just looking at those patterns over and over and over again until I was, blue in the face. So it was surreal that I had the money, but at the same time, I had spent thousands and thousands of hours. So the same time of it being surreal, it was kind of like, finally it's clicking, you know what I mean? So finally it was making sense.
And what was the reaction from like your friends and family when they heard about how much money you were making in the stock market?
Well, to my friends, I never really disclosed it. I mean, I did have, a house before a lot of my friends did. I actually had a vacation house, and I had a Hummer back then, a Hummer H2. So they knew I was making money. My family, was kind of, they were excited, but, they didn't, I guess it was more of a surprise than excitement. And I did, trade for my parents at the time, and I still do today. So obviously they like to see their account go up a little bit as well. But I was never one to go around and say, look what I made this year. Look what I made last week. For the most part, I kind of kept it quiet, but I think everybody was kind of surprised or intrigued because, again, you'd have friends that say, oh, well, why don't you teach me what you do so I can start it next week? I got laid off. And it's like, oh man, it takes a little more than just a couple drinks to explain what you do.
Yeah. So from the sounds of things, from a very early age, you were very motivated to make money, and you were kind of somewhat impatient, right? Right, go ahead. Did this ever lead to any irrational decisions? Like when you look back on those early years, did you make some pretty crazy decisions?
Oh, looking back in my early years, I made every decision you could make: good, bad, irrational, impatient. I went through everything. I went through every failure, every high, every low that you could possibly imagine. Because again, the market's the only thing I've ever done. I have never had a job. Again, my dad owns a business in Missouri, so I've always worked a little bit on and off for him. But other than that, I have never had a job. I've done the market from my sophomore year in college to today, which is, was that 13, 14 years or something. So again, when you do something full time and you learn from your mistakes, I'm not saying I've been through everything, but I've been through a lot. So I have.
Sure. So tell us about how you actually lost. You made $1 million and then you lost about half of it. How did you lose half of it? Well,
again, I think I was very lucky to turn 5,000 into $1 million. I don't think I don't even know if I could do that again today. My bet is that no, I couldn't replicate that. And, the reason being, is that, back then I had no rules. I would just put everything into one stock, one idea, and kind of hope that it worked. And, how did I lose it? It was just, the market kind of turned, and, the good setups weren't there. And the thing is, back then, I had to be in a ticker at all times. I mean, I didn't take a day off. If there was not a top-notch setup right then and there, well, I would trade a secondary setup. I would trade a setup that I don't normally trade. I just, I had to be in a ticker at all times. And I didn't really, again, I just didn't have any rules. I didn't really know what I was doing. I mean, looking back from today to that time, I was really kind of clueless. I was lucky, to be honest, I'm kind of lucky I didn't lose more. I'm lucky that I, finally took $1 million, went down to 500. I'm lucky that I put 400 in the bank right then and there, because if I would have kept going, who knows? I could have lost it all. And I could have, maybe I had to restart again at $5,000. Thank God I didn't have to do that.
Yeah. Yeah. So, having made $1 million, that was kind of like the high point. You then lost half of it.
Right.
Was it ever in your mind, when you were trading with a smaller account balance, that you were just sort of trying to get back to that $1 million mark? Like, was that a mental hurdle of some sort?
No, I don't think so. It took, obviously when you take $1 million and you go down to 500, it's mentally kind of demoralizing. It's kind of like a punch in the stomach. And then after a couple weeks, you realize, hey, I've got 400,000 in the bank and I'm only 22 years old. It's still pretty darn good. So my point then was there, hey, let's trade with $100,000 and let's see what I can make at the end of every single month. If I can make, $30,000 to $40,000 every single month, I mean, hell, I would never have been able to get a job that could even remotely come close to that. So it wasn't really about getting back to $1 million. It was about just, at the end of every month, the 30th of the month, what did I make? I mean, that was my biggest goal. Let's be positive at the end of every single month, whether it's $5,000, $10,000, $50,000. So getting back to that dollar amount, it really wasn't in my mind, back then. It was really just being positive and making sure that this career path I had chosen, a day trader, that I could do this consistently and profitably, for a long period of time. That was my main focus. Okay.
Right. So what have the last few years been like for you? I guess maybe a little bit further back. So we spoke, we've been speaking about your first years in the market, but as you said, you've been trading about, 12, 13, 14 years now. And I know you've been doing very well the past couple years. What about prior to that, like kind of that in-between period? What's that been like?
Yeah. So again, when I went down to 500, I immediately, like I said, put 400 in the bank, traded with 100. About the next, I would say 3 to 4 years, I traded extremely consistent. I made about $500,000 a year, or, give or take about $500,000 a year. And then I was, maybe 25, 26 years old. And I said, well, again, I'm very happy with what I'm making, but, there's got to be a way to get to the next level. I mean, what do I need to do to break out of this? I don't want to call it a rut, but again, I was right about that $500,000 level. And I thought there's got to be a way to break through. So there was 1 year in there, and I kind of got away from my strategy. I started to do a few other things. I got away from, I guess you'd say, from my bread and butter, and I started to go long more. I started to, swing trade more. I would trade more triple leveraged ETFs. I was also 25 years old. I was partying a little bit and probably wasn't concentrating as much as I should. And I did have one losing year at that time. I didn't lose a ton, but I did finish the year red. And that was a big wake-up call for me. I mean, literally I slapped myself in the face and said, hey, you need to get back. Don't worry about getting better than where you've been the last few years. $500,000 is a hell of a lot of money. Get back to what you know, get back to what you're good at, and stick with it. And that's what I did, for the next 1 or 2 years I did. I stuck with it, got right back, and I was still right around that, I don't know, maybe $500,000, $600,000, $700,000 level. And then after that, I started to kind of diversify my brokers, because again, at that time I had still really traded, I think, with one broker. And I started to open up a few other brokerage accounts, put a few more money in, a little bit more money into my accounts. And I started to really sit down and think about, okay, I know what my niche is at this point. Again, it's shorting small caps. That is where I make all of my money. And I knew, okay, at that point, I'm going to stick with that. And I thought, what can I do again to get to the next level without, revamping my whole strategy? And I thought, there's two real ways to do that. Again, this was when I was looking at my tax returns. I would look at my tax returns and I would see all of these pretty big wins. I'd make 50 grand here, 80 grand here, 100 grand here, 20 grand here. And at the same time, I would see all these big losses, lose 40 grand, lose 60 grand, lose 20 grand, lose 75,000. And I thought, well, hell, what if I just try to not even make more money, not even increase my position size, not take on any more risk? What if I just try my best to eliminate all of these losing trades that I have in there, all these losing setups? So again, I went back and I studied all of my trades, and I kind of learned that a lot of these losing setups, either they just weren't the top-notch setups out there, but I was still putting on, maybe full position size where I just shouldn't do that. Or I was just letting losses get a little too big. I was letting those losses grow a little bit more than I should. So, the very next year I said, well, hell, let me try to just cut my losses faster. Let me try to cut my losses faster and see what that does. And the very next year, I think I grew, maybe 50 to 75%. I did that a couple of years in a row. And then, again, at the same point, I started to increase my position size on what I would call, your golden setups, your top-notch trades, whatever they were. Increase my position size comfortably, and again, that the next few years my returns really grew quite nicely.
Are you ready to get serious about trading? Then join Tasty Trade, Investorpedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including 0 commission on stocks, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, risk analysis tools, and more features to help you trade smarter. See equities and derivatives with high trading volumes, dividends, upcoming earnings reports, and more with their pre-built watch lists. Or create a custom watch list to keep an eye on the companies and sectors that matter to you. Manage your positions with speed and precision using active trader mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Visit tastytrade.com/chat for more info. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Have you ever watched a stock explode and thought, if only I had the capital? Or sat on the sidelines because your account balance felt too small to matter? Good news, with Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 U.S. listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with zero locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
Okay, well, let's flesh those couple things out a little more. So you spoke about cutting losses and trading with larger size when you have a golden setup. Perhaps what might be a good thing to cover first of all before we go more into those two things is if you could just talk a little bit about, like, what are your golden setups? Like, what are these golden opportunities that you're looking for? Like, where do you really make most of your money, on what sort of opportunities?
Yeah, there's been a couple recent ones, in late 2017. HMNY is a great example, and that was back in, I think it was October. They went from just a couple dollars a share all the way up to, I think, about $37 a share. And, something like Riot, RIOT, is a blockchain play, went from, it was actually I think a biotech company. They switched over to do blockchain. The stock went from, sub $10 all the way up to about $46. And I consider, a lot of these moves are what I consider hype trades. There's just so much hype and, so much hype behind them that they're just bubbles. So that to me would be a golden setup or something that I'm looking for to make, most of my money on.
Okay, and you're making it only on the short side, right?
Only on the short side. Yeah, I would not. I don't play those long at all. They're just too risky.
So what sort of things actually drive these stocks up in the first place? Like, what's an example of, what was it, HMNY? Like, what was the catalyst behind that?
HMNY. So the catalyst was MoviePass. I think they bought about a 50% stake in MoviePass, which was, some, I think for $10, $12 a month, you get unlimited movies to a theater. And, I was never a big believer in that news. I never thought it was that legitimate. I thought, okay, the stock should maybe go up, 50% off that news, not, several 100% off that news. These momentum names are tough because a lot of them are manipulated. You need to look at the press releases. You need to see why they're moving. And you also need to have a firm understanding of level 2. And a lot of these names that move, they're thinly traded. They're low floats. A lot of them trade less than 5 million shares, and they're moving because a lot of hype, I think a lot of manipulation, and, I consider them a bubble. I mean, it's kind of like some of these cryptocurrencies that you're seeing moving. I mean, they're just, there's just a lot of mania behind them, and that's how you see moves up to 500%, 1,000%, 1,500%. Really, it's just a lot of, momentum and hype.
So how come the short side presents such great profit potential for you, like as opposed to playing the long side and kind of running with the hype?
Well, the thing is, you never know how high they're going to go. I mean, yeah, obviously it's easy to say, if you see a stock like HMNY that goes from 5 to 37, I'd love to play that on the long side. But realistically, there's a lot of companies out there that release, similar type news, and they don't run up 1,000%. They might run up from $5 to $6 or, 5 to 7. So you never really know when those big moves are going to present themselves. That's the thing. And, there's always halt risk on a lot of these. And, to me, it all goes back to where I'm profitable as a trader. Again, after trading for 5 years or 10 years or 15 years, I think everybody should know where they're profitable. I mean, if you're profitable on the long side, then you could be then go for that. Go for that strategy. I'm profitable on the short side because I would rather see something that goes from $5 to $30. Know that it's overbought. Know that it's gonna eventually crash and fade. And I'd rather. I just think the risk reward for me personally is much, much greater on the short side than the long side.
Okay, and like you said just a couple of moments ago, you don't know how high these stocks are going to go. So how are you timing your short trades? Like, how do you time this? At what point of the cycle are you getting ready to take a short?
Well, the timing is very difficult. I mean, HMNY, I shorted, it was around maybe 850 or so, and I had about 100,000 shares short, and I cut that loss maybe high nines, and I took a loss on that. But, a lot of these I'm taking, now that one was not a paper cut loss, but a lot of these I'm taking small, what I call paper cut losses on the way up. I mean, the timing is very, very difficult because even if you have a stock like Riot, RIOT, that went up to 46, if traders were to go back and look at that final day where it put up that final candle up to $46, I mean, those intraday swings are incredibly difficult. I mean, there are head fakes galore. It is incredibly difficult to try to time that correctly. Usually what I do, again, is I'm taking paper cut losses on the upside. I'm starting with a starter size, whether it's 5,000 shares, 10,000 shares, whatever it is. And, I'm hoping that I have, maybe hit the top right there and it's going to go down. If it goes down, I'm going to add. If something goes up or breaks through support, I'm getting out. I mean, I'm cutting that loss, sitting back, and I'm going to look for again a re-entry either later that day or the next day or the following day or whatever that is. But I'm not a trader that's going to start a short and look to add higher. I just don't do that. I did that in my younger days, but again, going back to the thought process of keeping your losses small, that just does not work, of shorting and adding higher. I would rather short, look for a breakdown, look for a failed bounce, short that, and I want to keep adding, when I'm in the money. I don't want to add against me. We've all seen a stock like Dry's that was last year, that was in 2016, go from $15 up to $115. So adding to a losing position is not something that I ever really want to do.
Okay, so that's what signals that you may have an opportunity to enter a short, is when you get a failed bounce of some sort.
Yeah, failed bounce, just a real parabolic move. I mean, usually, a day 3 of a parabolic move is, should be hopefully a winning entry. But again, entries are tough. I mean, on these parabolic moves that are low float, that are highly manipulated, I mean, trust me, it is extremely aggravating. I mean, I have no miracle work entry. I just don't. I mean, it is extremely, extremely tough. I am usually, again, I am taking lots of small losses on these before I finally try to nail it, on the downside. But it is certainly not easy. The other thing I really pay a lot of attention to is volume. On my charts, when I'm looking at charts, the only things I really use are price and I use volume. Sometimes I do use VWAP, but you want to look at volume and also level 2 to see what's going on there. I mean, when you see a big drop on heavy volume, that's usually a key to me that, hey, this could be the end, or this could be the exit. Somebody big is getting out. That's one of the main indicators that I will look at.
Okay, so let's talk about how you're actually cutting losses. So you say that you're cutting losses fairly quickly, if things don't start to move in your favor. Can you just go into that a little more? Like, at what point would you say that the trade is not going against you and you need to cut this trade? Because, we often hear, it's good to cut your losses quickly and that, but when you actually put that into action, it can be a little more difficult than it is to talk about.
Sure. Yeah, well, it really comes down to the price action for that day. I mean, let's say you've had a stock that's gone from maybe $5 to $30, and you think that 30 is a good entry. You shorted at, it's up to 30, it falls to 29.70, 29.80, and you enter right there, and you have a short, it drops a little bit to 29.50. I mean, usually my point is I'm going to use kind of, I guess you could say, a resistance exit, and if 30 was the high of the day, you maybe give it a little bit more than that, but basically it's based off the chart. I mean, my trading is, I would say, 80 to 90% technical analysis and looking at the chart and reading the chart, looking at the volume, and it's based off that. And that takes, to be honest, that takes a while to figure that out. It took me a long, long, long time, and I'm still trying to, I'm not saying perfect technical analysis at all, but a lot of it is just looking at support, looking at resistance, and if it breaks, if I'm short and something breaks through resistance, and definitely if it breaks through resistance on volume, I'm just going to cut that loss. I mean, it's just as simple as that. I try my hardest not to fight anything. I don't want to get emotional. I never want to say, hey, this can't go higher. I mean, it's impossible. It can't go higher. It's so overbought. This news is BS. If something doesn't act right, it breaks that resistance, I'm just out.
How many times are you willing to be wrong on a particular move?
Well, I've never given up on a move. I mean, never. I mean, I have never been really with a stock and said, well, it's just going up too much. I'm not gonna, I'm just gonna completely take it off my radar. Now, going back to like HMNY, I originally shorted that, like I said, in the 8s. I cut it in the high 9s, and it took, I'm just going off memory here, but it probably took 2 or 3 weeks for it to get back into the 30s, where I finally reshorted it. So there are times where, I will get out. It'll take, several more weeks for maybe the pattern to complete itself before I will get back in. But rarely is rarely is there a time out there where I just, I'll never just give up. But, sometimes you just have to be patient for the entire move to, happen before you get back in it, before the timing is right, I should say.
Now, the other thing you had brought up was like having conviction on your really good setups. So trades which look very promising, you want to hit those with as much real size as you can. I'd like to hear a bit more about how you think about this type of thing, because, what signals to you that this particular trade might be better than these last few trades? Like,
right.
Yeah, let's hear a little more about that.
So I guess it all goes back to finding your niche as a trader. I'm not trying to get sidetracked here, but I think, the great thing about being a trader, the great thing about trading is that you can make money doing so many different things, going long, going short, day trading, swing trading, trading options, trading stocks. So I think it's so important that we find our niche. We find what we're good at. We don't have to be good at everything. We can just be good at one thing, and we can make a ton of money just being good at one thing. So on the short side, or for me, finding that one thing is a parabolic setup. And again, what is a parabolic setup? Well, it's something that moves, I'm going to say, usually it's several hundred, maybe 1,000% on news that is just, that it just doesn't justify it. So, again, after trading for several years, this is something that, is probably not for a beginner, but after trading for several years or hitting, again, no matter what your strategy is, you should see setups out there that you can know, okay, 9 out of 10 times I'm going to be profitable on this setup, or 95% of the time I'm going to be profitable on the setup. So obviously the risk reward is such in your favor on those setups. Why would you not want to put as much money as you can behind that trade? I mean, it's just simple. Something, again, for me, something like an HMNY in the 30s, or a Riot in the 40s, or a year ago we had ETRM that ran from a few bucks all the way up to $30 a share. I mean, there are just such huge, pockets of air in these stocks that, for me, it's a twofold. I mean, yeah, A, it's about the money because I like to make money. I mean, that's what we're here for. But B, it's also about kind of, I don't know if it's feeding your hunger inside or your need or your want. It's just like, you see these setups and I know that, I just know they're going to crash. But again, it's like we talked about a couple minutes ago. It's the timing. It's the timing that's difficult. So I think as traders want to get to the next level or take things to the next level, it's always best to, A, study your trades, know where you're making money, know, you can say without, a shadow of a doubt, hey, 99 out of 10 times on this setup, I'm going to be profitable, or 95% of the time I'm going to be profitable. And if you have odds like that, you don't see odds like that in the stock market all the time, right? But if you have odds like that, why would you not want to put as much money as you can behind that trade? Obviously with a tight stop loss, like we've mentioned, but when I see those setups out there, it's hard for me even to sleep at night. I'm so excited. I'm up very early in the morning, ready to try to hit those moves, because again, they don't happen all the time. These setups are not something that's going to happen every day. You might have them 3 times a year, 4 times a year, 5 times a year, 6 times a year, whatever it is. But even for me, at this point in my trading career, when I go back at the end of every single year and I look at all of my wins and all of my losses, these, Riots, RIOT, and HMNY, and maybe XNET, these type of moves are going to make me, they're going to account for maybe, 75 to 80% of my income. So I know that this is where I'm going to make the big money. For me personally, the big money is going to be in the big moves. And the rest of the stuff day to day is just kind of scalping. I'm trading more of smaller size, medium size, and just trying to, kind of scalp some trades.
Okay, but your niche is shorting these parabolic moves, right?
Right, correct, yep.
So that's pretty much your thing. That's what you do. What makes, one trade different from the next? Like, how do you know that this particular setup, what I'm seeing right here, this is a trade that I need to trade with much larger size as opposed to the last one? Like, before these big moves actually unfold, what gives you the conviction that you really need to hit this particular one with a lot more size?
Right. Well, it really comes down to if it's a multi-day runner or a multi-week runner or, maybe a multi-month runner. I mean, it really comes down to how high is the stock? How high is the move? I mean, that's what it's going to come down to. If something is a day one runner and it's only up, 30, 40, maybe 50%, well, obviously I'm not going to put my whole account behind that move. If we have something that over the course of 3 or 4 or 5 weeks has gone from, or even 5 days, I mean, it's gone from $3 or $4 up to $20, $30, $40, $50. Basically, it's the higher it goes, the more conviction I'm going to have that it's going to fall. I mean, again, like we talked about a little bit ago, I'm probably 80% at least technical bias, but the other 20% is fundamentals, and you want to know why that move. Why is that move occurring? So the fundamentals are going to come in there as well. But overall, my conviction. How do I know I'm going to put this much money behind this trade? Is it how high is it? How much air is in that stock? How manipulated is it? How much how high has the move gone? I guess overall, I mean something that has gone from 3 to 30. I'm going to put a heck of a lot more money in something that's gone from 3 to 30 than I am stock that's only gone from 3 to 4. I mean, there's just not that much meat on the bone, I guess you could say.
Okay. I like your analogy of a stock having more air in it.
Right. Well, again, something I've done since I've started trading, I've gotten a little lazy since I have 2 kids, but after trading for 10, 12 years, what I do is I try to, at the end of every single year, go back and print out a chart of that year's biggest winners. Stocks that have gone from 5 to 50 or 5 to 15, 3 to 30, whatever it is. And I print out every chart. And every single one of these falls right back to earth. I mean, almost every single one of these, after hitting a peak, is going to fall, 40, 50, 60, maybe 70%. So I print out all of these charts and I keep them handy so I can go back and I can, maybe compare one move to another move. And I call them pockets of air because I honestly, I don't remember one of these ever really holding up long term. I mean, they're all gonna crack, and that's what I'm looking for. Some of them hold up longer than others. Some of them go a lot further than others, like we talked about dries, going from 5 to 115. But at the end of the day, every one of these low float, I call them hype trades. Most of them are manipulated. They're just momentum plays. I mean, literally, I cannot remember one that has not crashed. So yeah, I do. I call them. They just have pockets of air in there that it's like a balloon just waiting for a needle to prick it. And once it happens, it's like bam. I mean, they fall, so hard, so fast that again, that's what keeps me in the game. Just looking for that next move, that next setup.
So when you get a good entry on a trade and it starts to move in your favor, are you adding size as it breaks down?
Yeah, usually I am. I mean, that's when I'll, again, I like to be in the money when I'm adding. I mean, now again, I don't want to chase. I mean, if I can, I try to do whatever I can not to chase as much as possible. But, on these thinly traded momentum stocks, from what we've seen is that when it's the end, it can end pretty darn fast, and you can have some downside pretty quick, pretty fast. So yeah, usually it's on the downside that I'm getting in and I'm slamming that bid and I'm, adding size to it.
Okay. And what about holding positions overnight? Can you add a bit of color to that?
Again, it comes down to, how overbought the stock is that I'm trading. Something that's a multi-week runner, I'm going to hold that overnight, sometimes for weeks on end. I mean, I might hold it 2 weeks. I might hold it 3 weeks.
Are you ever worried about overnight risk? Like, is that something you try to mitigate at all?
Usually I mean, it is. It depends what I'm trading. I mean, usually if I'm trading something garbage, the only overnight risk you're going to have is a PR. And you do want to know, it all depends on the setup. I mean, every setup is different. If I have something like Riot or HMNY or, ETRM a year ago, or, there's so many others. If it has run its course, I'm going to hold that overnight, and I'm going to have, zero problem holding that overnight. If something just popped up day one and it went from 2 to 250 or 2 to 3, and you think there could be more PRs in the future, the next couple days, then yeah, I'm not going to hold much overnight, and I'm not going to hold, if I do, I'm not going to hold much size overnight, because, when you have something low float, 1 million shares, 2 million shares, 3 million shares, and your stock is, just a couple bucks, I mean, there definitely is real risk to holding those overnight. We saw with KBIO, I think that was 3 years ago, KBIO filed for bankruptcy, and the stock was around $2. And I think when they liquidated, I think they had enough assets, I think, for around 75 cents a share. So I was short. I know a lot of people were short. And I was short, decent size, because the float at that time, again, it's about 3 years ago, I think it was about 3 million shares. And then, overnight, Martin Shkreli said, or it was announced, through Form 4s, that he had bought maybe 75% of the company. And that stock went from a closing price of around 2 to the next day it opened, I forgot exactly where it opened, maybe 10, 12 bucks. And within a couple days, it was up to 40. So, you definitely need to, be very cautious holding these overnight. And, you need to know, the real story behind them. Something that's low float, cheap stock with a low float, it can be dangerous to hold them overnight. I've seen a lot of traders blow up making mistakes like that. So you definitely need to, proceed with caution, I'll say.
Do you ever feel comfortable in these big trades?
Do I ever feel comfortable? I would say, and again, it's waiting for the backside of the move. I mean, that's the most difficult thing out there, is waiting for the backside. Again, it's the same thing as we talked about a few minutes ago, is timing it right. When do you time these shorts, and when do you get in with size? It's the backside. I mean, that's when you want to do it. So when a move has hit the backside, I would say, the upward move is done. It's hit its exhaustion. It's coming down. It's the backside of the move. Rarely then do I get nervous. I mean, usually then it's, you're breathing a sigh of relief. You're saying, yeah, I'm going to nail this. I mean, you're, pretty excited. So on the backside of the move, I'm rarely uncomfortable with my trading. The only time I'm uncomfortable is if I don't have enough size on. If I didn't get enough shares and I can't locate shares anywhere, then I'm almost angry. I want to add more size to these, but I try to have enough caution out there that I don't play too much size on the front side of a move ever. I'm really waiting for the backside. I'm waiting for the downside, the backside, whatever you want to call it. And then once that happens, I'm good. I'm feeling good, and I'm, know that the move, should be over at that point.
This might be a little bit of a silly question, but I'm curious to hear what you say anyway. Trading the size that you are trading, when you get these golden opportunities, and your experience, your knowledge of, level 2, the order book, and because these stocks that you're trading are low floats, are you ever able to kind of bully the price a little bit?
Well, you mean, do I ever try to manipulate it, or do my orders just move it, is what you're saying?
Well, I wasn't going to use the word manipulate, but
yeah. No, I mean, I will say that your orders do move the stock. I mean, yeah, I've placed, a lot of times, I have traded with traders, good short sellers, will have a big front side of the move, stock up 200%, 300%, 400%, and they'll say, the downside will start, and it'll happen faster than any of us think, and they'll say, oh, it just missed my entry by 5 cents or missed my entry by 10 cents. And I say, well, shit, it didn't miss my entry because I slammed the bid. I mean, I slam it over and over and over again, and I have no problems taking liquidity. And yeah, on something low float, if I'm slamming the bid, I will, you'll definitely see that. I mean, you'll definitely see on something low float that I'm moving the stock. I mean, there's no doubt about that. Do I ever get in and try to play games on level 2? No. I mean, I've probably, I've placed a few orders in my time, and, yeah, I don't really mess around with that too much.
Okay. So I think you may have mentioned this a little earlier, but this going really big on certain trades as opposed to other trades when you think that you have a golden setup, a golden opportunity, would you advise that this is something for slightly more experienced traders? Like, it's not really something you should be doing if this is your first year of trading. Is that a fair statement?
Well, yeah, and I think in your first year of trading, I don't know that you're going to know what your golden setups are. Again, because, I'm a firm believer in the market that, the market's difficult, right? I mean, 90 to 95% of traders fail. And, I think, why do they fail? They fail because they lose money. I mean, they lose too much money. They don't fail because they don't make money, but, they fail because they lose money. And, they fail because maybe they don't have their niche. Maybe they follow people on Twitter that tweet, all these new ideas every 30 seconds, long and short and swing trade and day trade and a buyout opportunity or whatever it is. And, I think if you're especially in your first year or you're just starting out in a couple of years, I would say, number one, find your niche, find what you're good at and then try to perfect that. Now, after you've perfected that, maybe you can try to move on to something else. But, I would say it's going to be very hard to, add to your top setups until you at least know what they are. And then after you know what they are, I would say you can definitely add to them, but do it with appropriate size. So if you're used to putting on maybe $50,000 positions and you have a top setup, well, maybe put on a $60,000 or $70,000 position, Don't just go from 50,000 position to a $500,000 position or whatever it is, add accordingly, increase your size, maybe 10 to 15%, if those work and, you're still making money consistently on these top setups, we'll increase it to 25%, 30%, 50%, whatever it is. Take it slow, take it in stages, and then go from there.
Yeah. And just going back to another thing you said earlier on, multiple brokers. Can you just shine a little light on why you are trading through multiple brokers? Like, why do you have all these various accounts?
Sure. Yeah, I trade with probably 7-8 brokers. I mean, for a couple of reasons. It depends, I guess, whether you're a long bias trader or short biased. If you're a long bias trader, I don't really know that I see a reason to have more than one broker. I mean, for ease of use and ease of purpose. Now, a short seller is a lot different. Number one, your broker has to have the shares. And the stuff that I'm trading, the low floats that I'm trading, well, a lot of brokers don't have them. I mean, so the more brokers you have, the more the increased the amount of chances that you're going to get those shares. I mean, that's the main reason right there. The second reason is one broker might have something easy to borrow. And if one broker has it easy to borrow, then you don't have to pay for locates. Different brokers will also charge different fees to either locate these stocks or to hold these stocks short overnight. So having multiple brokers on the short side is really, like I said, two-faceted. Number one, to try to get that locate. And number two, try to decrease your fees, because as a short seller, something you have to think about are fees. I mean, short locate fees are extremely high. Short interest is extremely high. And these overnight charges are, they're going to take at least 10, 15, maybe more percent of your trading profits.
Yeah. And I guess maybe if you want to throw in a third reason, it probably mitigates your risk a little bit as well, in case one broker, touch wood, goes down.
Right. Sure.
All your capital's not tied up.
Well, and it also, again, like you said, mitigates your risk for that reason or for another reason in case you get a margin call. I had an instance where I was actually long GBTC, which is it's a Bitcoin ETF about several weeks ago when it dipped down to 1,100, and one of my brokers that I went long in, I had no idea it wasn't marginable. So the next day I had a monster margin call. So that broker was down for the day, and I had to wire in from another broker. So yeah, I would always advise having, even if you're long biased, having two brokers is never going to hurt you. But if you're short biased, yeah, I would say, the more brokers you can have, the better. If you're just getting started out, it's not really wise to do that because you may not have the funds for it. But once you get a little more advanced, it helped my trading dramatically, to have more brokers than fewer.
Okay. Yeah, cool. So I was reading through your 2017 review, And there was an interesting comment you made towards the end where you spoke about some of the things you do with your trading profits
Yes.
outside of the market. So can you tell us a little bit about what some of those things are and your thoughts around that?
Yeah. So again, being that I've traded for 13, 14 years, I've been around several other good traders that have blown up. I mean, several traders that have traded 5 years or 10 years or 15 years and one mistake or two mistakes and they're gone. That's the thing about trading is you never know that one instance or two instances or whatever it is where you could just blow up. You could make a couple mistakes like dries or KBIO or whatever it is, and you just get stubborn and you're done. So, I think it's so great to have a backup plan. I mean, have a backup plan, have money elsewhere. And it doesn't really matter where it is. I mean, it doesn't matter whether it's in the bank. It doesn't matter whether it's in CDs. It doesn't matter whether you invest in real estate. I mean, I choose to, obviously, I do have a 401k. My wife and I both do. So we max that out every single year. And then I started, just buying land in Missouri, farmland in Missouri. That is, to be honest, it's a very boring investment. I mean, you probably couldn't get more boring than just buying farmland. But over the last 100 years or so, in the Midwest, land is appreciated at least around 4 to 5% a year, and then we get, cash rent. We rent that out to farmers, and we make another 5 to 6% a year. And the reason that I chose farmland, obviously I try to keep money in the bank, and I try to put money away in the bank every single month, every single quarter, whatever it is. But when that money is accessible to me, I always find something else to put it in. I always find something that's high risk. I mean, even though I've been trading the market, I've had success, it's still very high risk. I mean, at the end of the day, it's very high risk. So I like to get that money almost out of my hands, pay for land, and then I can't touch it. I mean, that money is there. It's safe. It's not going anywhere. It's extremely boring, yes, but it's almost, the exact opposite of what I do on a daily basis, which is, again, it's just very risky. So, again, as traders, the longer we trade and the older we get, I think the less, maybe I don't say the less able we would be able to go get another job, but I couldn't imagine what would happen to me if I blew up tomorrow and I have to go get a job again. I've never had a job. I mean, I've never done anything outside of maybe work for my family's business a little bit and then trade. So that's why it makes me sleep better at night knowing that, one day, I mean, obviously I think, well, maybe I'll retire one day, even though I love the markets, but whether you retire or whether you blow up or whether you just want some time off, no matter what it is, you have another avenue out there, another revenue stream out there to support you if you need it.
Yeah, I think that's a smart move for sure. I'm just curious why you gravitated towards farmland as opposed to, more traditional forms of real estate like buying rental properties and that sort of thing.
Oh, I've done that. I've owned lots of rental properties, and they were just, I first owned rental properties in St. Louis. I've owned them at another location in Missouri, kind of a vacation destination in Missouri, and it just turned out to be a big pain in the butt. I mean, tenants. I've had tenants, nightmare tenants, and then I got property managers. I mean, I thought, well, hell, I got a property manager to deal with these people. Well, the property managers couldn't deal with them. I had a deal. I found out that instead of managing the tenants, I was managing the property managers, and I was having to talk to them on a daily basis, whether they had dogs, whether they were partying, whether they weren't paying their rent on time, whether they were trashing the place. I mean, and then I had to repair the roof, had to fix the HV. I mean, at the end of the day, I wanted a side investment that didn't take away my time or efforts from the market. I mean, at the end of the day, my market is my main focus. My market will always be the main focus. So I wanted this investment to be something that A, I couldn't touch, was just completely safe and I couldn't touch the money, but B, it didn't take up time. I mean, it didn't take up time or energy or focus. And that's why, the returns for farmland, yeah, they probably are a little bit lower than I could get elsewhere, but they also take up, I mean, they are literally zero stress, zero time, and zero maintenance. I mean, it's just a raw piece of land that a farmer, farms at every year. You couldn't ask for anything easier or lower maintenance than that.
Yeah. No, that's a great point you make, actually. Being very mindful about where your time has been spent, because
Right.
if you're starting to manage people and that sort of thing, it can be a great distraction, right?
Yeah. I mean, again, I knew, when I had, owned apartment buildings, I owned, several buildings and several condos that were rentals. And, it's fun knowing that you own these. But at the end of the day, if it's taken away from your main revenue stream, I thought, well, why the hell am I doing this? I mean, I'm not in this to be a real estate investor. I mean, I'm a day trader and I just want something on the side. Well, it was kind of to the point where I'm getting phone calls during market hours. And I thought, well, hell, this is taken away from my main gig. That's not what I wanted. And that's why I sold all those and I looked for something different.
Yeah. Well, Phil, I have to say it's been a real pleasure to have you on the podcast, and I'm very grateful that you agreed to do this. So I just want to say thank you very much.
Sure, I appreciate you having me on, and I hope I hope that I can help some people out there. I hope my interview helps some people make some money.
I have no doubt. Now, if someone wants to find out a little more about you, I know you don't have a great presence online besides Twitter. What is your Twitter handle?
Ozark Trades.
Okay, and that is spelled OZARK Trades, correct?
Trades, yep, that's correct, yep.
Cool. All right, Phil, once again, got to say, thank you very much for doing this. I appreciate it.
Yep, appreciate it, Aaron. Thank you, sir.
You've reached the end of this episode of Chat with Traders, but rest assured, there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes, and we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
Chat with Traders is brought to you by Trade the Pool. Did you know that every decade the market reinvents itself? Online brokers opened the doors, mobile apps made trading seamless, and commission-free trading erased barriers. Now, a new era has begun. Meet Trade the Pool, limited risk trading. And now you also have unlimited time to reach the profit target. From now on, your trading risk is capped, and your trading opportunities are limitless. Trade the Pool funds home-based stock traders with up to $200,000 in buying power. That means you can trade larger positions and scale your strategies without risking your own savings. It's time to trade with more capital, making it truly worth your time and effort. Ready to trade the pool? Click the link in the description and join the stock trading revolution today.
Are you ready to get serious about trading? Then join Tasty Trade, Investopedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade all in one platform. Get low commissions, including 0 commissions on stocks, so you can keep more of what you earn. Trade smarter with advanced charting tools, a pre-built strategy selector, risk analysis tools, and more features. Visit tastytrade.com/chat for more information. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC.
Markets, speculation, and risk. This is the Chat with Traders podcast, hosted by Aaron Fifield.
Hey ladies and gents, Aaron Fifield here, bringing you another installment of the Chat with Traders podcast. My guest on this episode is Greg Newman. He's someone who I was recently introduced to by James King, who you'll remember from episode 133. James was the performance director with a sports science background at a London trading firm. There, James worked closely with Greg to achieve great breakthroughs in performance as he was building out an oil trading desk and significantly multiplied the firm's profits in just a few years. Of course, Greg has continued as a serious trader of oil derivatives and is now a founding partner of Onyx Commodities. Where Greg and his firm are most active is in oil futures and the energy sector, but also trading in related OTC products, or better known as swaps. You'll find this is quite an interesting topic, and it's something new, not previously covered on other episodes. So you'll hear Greg speaking about futures, swaps, carefully tracking the physical, fundamentals and producers. Really, we spend quite some time on this. Greg also shares a few of his own trading and risk management principles, or as he describes it, tradecraft, and how you can use a tried and tested method to overcome obstacles, which was developed by Toyota, the car company. As always, that's just a teaser. There's plenty more coming up right now. Here's Greg Newman for episode 159. So, Greg, I'd be interested to hear a little bit about your first exposure to trading and markets.
Immediately after university, I joined a physical oil and gas company, Russian, and that was only for a few months, but it just gave me a bit of exposure to the physical markets. And I had some understanding, kind of baseline from doing an internship at a bank as well, investment bank as well. But it was only really when I got to my first trading job, which was at Mandara, which was about 6 months after uni, when I really started to get a serious market focus and specific trading, touches on the ball on trading. So when I started Mandara, which is where it was, I got this job. It was still in the startup phase, and we had one particular desk that was doing well, but a lot of junior traders like myself who were coming in and basically supporting the company, but also trying to experiment with small risk and try to build the company doing that. And so I was one of those guys, and there's lots of opportunities for people who could prove themselves. That's kind of where I thrived. Do you want me to go a bit into...
Yeah, well, let me ask you, so just so we're clear, that first job you had where you were working at a physical, an oil company which dealt with physical, that wasn't a trading role in any sense?
No, it was an analyst role. It was a business analyst role whereby I would speak to the traders and get their technological requests just purely from software and how they wanted to see their risk, etc. And then I would be the link between the front office and tech. So it was my job to understand from a trading point what they needed, and then also understand enough to relay that to the tech team so they could then know what to build. And it seems like not relevant, but it did give me a lot of exposure I wouldn't have got to the trading floor and what these guys were doing. And it all comes down to risk management, and a lot of what I was dealing with was the risk systems. So that is where I definitely got some decent exposure and learned quite a bit.
Yeah, I'm sure you would have, especially as you went on to work at Mandara, which, maybe you can shine a little light on this, but from my understanding and from speaking with James King, who was previously on the podcast, who worked there up until recently, that's a firm which is purely focused on trading oil, am I right?
Yeah, so it's oil derivatives specifically. It's no physical, it's just trading the derivatives, the futures, and the swaps market. So everything was linked to ultimately to the futures. When I joined, it was a focus more on the curve arbitrage. So essentially, we were trading, forward prices in the OTC market against the futures. You'll kind of see day-to-day Brent, WTI, and we're trying to profit essentially from the price dislocations. So this is where the company started, but it was never really something I was particularly passionate about. So I tried to bring in some kind of fundamental analysis, even though I didn't know a great deal myself. It was quite novel for the company, and that's where I kind of focused to stand out. I enjoyed, from my experience little bit on the physical, but also in general, I just did have a pretty strong interest in the physical side of the market. And I'd heard a lot of the stories about, some of the bigger oil derivatives traders, Pierre Onderond, Andy Hall, these guys, huge hedge funds now, and they, have made serious amounts of money. And that was kind of how I envisaged my life. Obviously got a bit of a rude awakening when I started. There's a lot of hard work and a lot of deep analysis. And my method was to properly analyze the crude market in particular, and crude being the what you actually dig out of the ground. And ultimately what we sell, what's sold into the rest of the market is the end user product, the gasolines, the diesels, etc. But ultimately the crude fundamentals do have the biggest say. And I'd say what thought I displayed relatively well early on was I didn't really buy into the kind of generic macro headlines and demand analysis you'll typically see on the internet. A lot of people talk about demand forecasts. Goldman Sachs, Morgan Stanley, they'll send out these reports, and so will even the EIA, who are meant to be an official US agency. They will send out these demand forecasts, and they're total rubbish because they're based on their own models and their own forecasts based on GDP, assumptions all over the place. So it really didn't make sense. What made a lot more sense to me was focusing on the supply side. And the supply side, it would be about reading about the actual physical differentials, what prices they were trading at, and looking at the refinery profitability. So what crudes that ultimately the refiners would actually want to buy, and how that would impact the price. And that having that approach it made quite a big difference early on. Yeah. So once I was able to prove myself, not just from an analytical point of view, started with just helping out more senior traders in the company, but I was allowed to trade small proprietary risk myself and start to make a bit of money, improve myself a bit more. Consistent ultimately. And I was given quite early on the crude desk. Nothing was too established at that point. Crude desk was doing minimal at the time, but there was a lot of growth potential, and it was the kind of method, the kind of approach from the company, just to give people small risk and to experiment, to try bits and pieces at a time and try and build it up. And essentially that's exactly what I did. I just tried to look at every avenue within crude and started with low risk, simple strategies and learned by doing. It was really constant experimentation. But another key thing was market making, which was keeping me kind of in the game, keeping the money kind of rolling in. And that goes back to what I was saying before about this idea of arbitrage between the futures market and the OTC market, which is harder for a retail trader to get involved in. It's the access to the OTC market, which I guess we'll talk about in a bit. But that was a way to kind of stay in the game while also trying my directional strategies. I think the big jump came for me when I started to learn more and more about the underlying physical market that was ultimately driving the, what I was doing, driving the futures prices and the OTC prices. But when I started to trade dated Brent, so that's the swaps, the OTC market, which reflects the underlying price of Brent futures. So what everyone sees in the news, that the underlying physical prices for that is displayed and assessed by this data Brent contract. So once I started to learn a lot more about that and started to trade that contract and market make that contract, that's where things started to really take a forward step. And since then built a really strong market making presence in that market, and it's the basis for a lot of what I'm doing now and a lot of the information I'll use to directionally trade. Okay.
So while you've been speaking, I've made a few notes here about some of the topics you've hit on, like supply side, arbitrage between the futures and OTC, fundamentals, etc. I'd really like to pick up on all those things. Just before we get too far into this, though, I'd be curious to hear a little bit more about your actual development as a trader on the trading side, because before joining Mandara, you hadn't really been in a trading position yourself. So how were you able to actually excel as a trader? Like, was there anything in particular which led to your greatest improvements and sort of leaps ahead?
Yeah. So I think the most important thing for me was for improving, going back to this idea of experimentation, because everything was so novel to what we were doing. And ultimately had a small amount of risk, and a lot. I was inexperienced, as inexperienced as you can get. So you really needed to trial and error with as limited amount of money as possible. So I'd say, with James King, he was a prominent member in the firm, and you've spoken to him on your podcast. He was there, and so the kind of two things can be answered in one: my greatest improvements and how James helped me. James King helped me quite a bit personally, because he introduced this approach of kata goal setting. So specifically, it was a change in mentality that was most important for me, I believe. But instead of just hard work at the immediate problem at hand, it was actually, what am I trying to do here? What does success really look like if I break it down? And what is stopping me getting there, or what specifically are the obstacles in the way? So it wasn't just the trading, but also building the desk, building who I was as a person even. But I hugely bought into the concept of, having these goals, trading or whatever, and development, and, relentlessly pursued every avenue I could. So one particular part of that process is what they call the PDCA cycle. So plan, do, check, act, whereby I would take, every obstacle that would stop me being, making millions and millions a year, having a huge desk, et cetera, et cetera. That's where I wanted to get to. And the obstacles getting in the way, I would break those down, and they would have to be very objective. You can't just summarize, oh, it's just really difficult because the market's tricky, et cetera. You need to say, something very specific, like, covering multiple strategies at one time is difficult for one person. Or trading small size in the market, in the OTC market, is perceived negatively by market participants. And, you would then look at that obstacle and then hypothesize about how you could overcome that obstacle. So using that example, about covering multiple strategies, an obvious one would be, all right, let's get someone in and let's get someone to help me out. And will that translate into overcoming that obstacle and me managing to cover multiple strategies at one time? Or, another one might be traders don't like to trade who they don't know. So I would say, okay, fine. So the first experiment I'm going to do is, my hypothesis is, if I meet these guys and they know who I am and they get to know me and they realize I'm not a bad guy, it should help my trading. So I could start to conduct experiments, like go out for drinks, go out and do some kind of social event. And then I would then, as I was running these experiments week in, week out, I would just review them and see how it was going. And then you get to the next step, like, yeah, I did actually notice it was a little easier to trade and people were more willing to accept this small counterpart in the market. And then I could then get to the next stage and slowly start to become more of a, increase my size, things like that, to be more appealing to the rest of the market. And it would just go by that process again and again and again. And it led to, huge breakthroughs. And we're talking from everything from my trading to building the desk. And by the end of my time there, I was hugely scaled the desk to, about 7 times the profits it was making originally. Well, no, more than that. But, from my year 1 to year 3, it was just like a 7 times increase, and expanded to have, a team of 3 on the crew desk. And, it was a pretty serious self-sufficient business towards the end. And but as I say, it was as much a mentality shift for me personally, as well as the define process. And it's evolved to me just having more in general a stoic approach to how I tackle things, and objectively analyzing what the issues are and what our weaknesses are, to really overcome it without emotion. And I just couldn't recommend that way of thinking enough. But I guess just that was the core of everything I was doing as I was trying to improve, because there wasn't that person there to say to me, oh, well, this is how you do it. Because we hadn't done it before as a company. We hadn't been in the crude market. We hadn't traded directionally, really. So it was like really up to me. But as I say, James King's approach to assisting us with things like kata goal setting was just really, really useful. And also set the grounding for a lot of the thinking when building up Onyx Commodities, which is see where I am now. And we train this way of thinking, and so much of it is taking responsibility for guiding your own path. And the idea, any problem and any obstacle can be overcome as long as you break it down and you experiment, hypothesize, and you keep going relentlessly. And I would say that was the key thing.
That kata goal setting, how do you spell that, just in case someone actually wants to look it up and find out a bit more about it online?
Yeah, sure. So I think it's Toyota Kata. So the company Toyota used this approach. So KATA is the actual kata part of it. There's books on it. Yeah, there's plenty on the internet for that.
Okay, cool. Yeah, I'm actually glad you brought that up, because I'm pretty sure when I spoke to James afterwards, when we'd wrapped up the podcast and we were just talking afterwards, he said that was something he actually forgot to mention and wish he had. So you've covered it. So that's good.
So I was just reiterating, because, what's so good about that is James wasn't a trader. He didn't know anything about, the specifics of oil trading or oil or anything. But, that wasn't necessary. It was the mentality shift. And that's what I think was so impressive about it. None of us knew the answer, but it's instead of saying, oh, one day we could, and, oh, let's wait until we get lucky. It was break it all down and let's see. And I owe him a lot for that, and hopefully, we'll continue to work together because it's great.
Yeah, and if anyone wants to hear that episode with James, it's episode 133. So if you go chatwithtraders.com/133, you'll find it. You'll be able to listen to it there. Greg, when you were talking there, you touched on it just a couple times. You said that the mentality shift was a big thing for you. What about the mentality side of it was kind of blocking you from moving ahead previously? Like, what was your mentality like sort of when you've day one at Mandara compared to sort of how you've come out the other side?
I mean, completely different person. I think maturity is probably one of the main things. I was a very young guy when I started, and you just don't really understand how things work in the real world, as cliche it sounds, but it's true. And I think there's a few things that the mentality of, extreme ownership and the 100% responsibility, anything and everything you do is impacted by how you do it and your approach to it. So you can influence anything you want. There's no point saying, well, this happened, the market was poor, and it's really difficult. It's on you, to ultimately generate results, and that's it. And that is what I love about trading as well. It's so binary. It's you make money or you don't. So everything else in between is kind of noise. So that was one thing. I think another big thing was just getting on with it in a sense that if something bad happened or I got told off, there's plenty of that going on, and I would argue back a lot, and I would, and I think that's just a combination of immaturity and ego, really. And as soon as I learned to put that to one side, that really does not. That I am not special. I guess that takes quite a long time for guys coming out of uni to realize, guys and girls coming out of uni to realize, because you think, oh, I've done well, and I think a lot about myself, and I'm looking forward to this great job I've just got. But then you realize, you're at the bottom of the pile, and you're in this heavily competitive industry that everyone wants to make money in, and everyone's, in a way out to get each other. So, that you can't think you're special, and you've really got to have a scientific approach to everything. And you can't get too emotional about things. You can't get defensive about things. They just are what they are. And how are you going to tackle those problems? And again, back to this kata idea, it's all about breaking it down. But the mentality shift in general, I would pretty much put it down to just taking true responsibility. And, in trading in particular, I don't think you'll ever meet a good trader who doesn't have that ability to say, it's all on me and everything. I can account for anything. Even, people say, oh, there's a black swan event, or, oh, I could never have expected that to happen. Well, okay, yes, not specifically, but you should always be aware of these kind of tail risk things, and you should always be aware of the possibility of things happening and have some kind of plan for it. If I'm entering a trading period now, if I'm entering into a trade in particular, of course, I'm planning what I expect to happen, how I'm going to make the most amount of money out of it. But I've also got to think, okay, so what if that doesn't happen? And what if actually the reverse happens? How am I going to protect myself, and how am I not going to lose or lose less and protect the P&L base? And that's a very difficult thing to get your head around, because it's essentially saying, there is no wrong or right, which, is a huge thing for me. There is no one in trading can call themselves wrong or right, because you ultimately never really know why there was a flurry of price action in a given direction. There's so many different types of participants. There's so many different types of traders, and all you can really do is hypothesize about what's going to happen and give yourself the best chance of success by having a clear plan, entering efficiently, and using sound risk management principles. So, like Ray Dalio in his latest book was talking about it as well, that he who lives by the crystal ball soon learns to eat ground glass. It's a really good quote because, you can't go into trading thinking you're some kind of guru. What you really are is a risk manager, and it's about learning how to structure proper trade craft. That's what makes you a professional trader. And that mentality shift of I'm not special, I've got to learn how to do this as best I can with the skills I have and really identify my strengths, but also identify my weaknesses and constantly hypothesize about how to overcome those weaknesses.
Yeah. I really like how you've spoken about taking extreme responsibility for pretty much everything which happens in your trading, because I mean you meet people in just everyday life, right? And from speaking with them that they're always blaming someone else for what's caused this or that, but as a trader, I mean, you just can't succeed with a mentality like that, correct?
I mean, absolutely, and it's, I guess, surprising but not surprising. We see it all the time. Guys coming in fresh from university, especially, they have to just realign their thinking to that. And I know because I had to do it as well. But you almost never look back once you do have that approach. You can't see how you ever thought like it was anything but your fault. Yeah, in a way, it's something that needs to be taught. But it's a shame it does need to be taught because I wish I'd basically realized that a lot earlier. I guess it didn't really. I still ended up in a good job, but it's just my approach to even university work would have changed because there's always something you can blame, and it's just the idea of just get down to it, have a methodical approach, and get going, and that there's no excuses. It's the only way to think, really.
Are you ready to get serious about trading? Then join Tasty Trade, Investorpedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including 0 commission on stocks, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, risk analysis tools, and more features to help you trade smarter. See equities and derivatives with high trading volumes, dividends, upcoming earnings reports, and more with their pre-built watch lists. Or create a custom watch list to keep an eye on the companies and sectors that matter to you. Manage your positions with speed and precision using active trader mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Visit tastytrade.com/chat for more info. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Have you ever watched a stock explode and thought, if only I had the capital? Or sat on the sidelines because your account balance felt too small to matter? Good news, with Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 U.S. listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with zero locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
So, Greg, we caught up a week or so ago and just had a quick chat. One of the things we spoke about, or you were speaking to me about, is kind of your core trading principles, or you mentioned it, and you described it as trade craft. I'd love to go into that a little more because I think that's kind of interesting. What do you mean when you talk about trade craft?
Yeah, so trade craft is sort of a combination of your trading principles themselves and the risk management principles and the actual structure to your trade. So kind of key steps. So first things first, I prefer more of the fundamental analysis. I know there's a lot of people who trade technically, et cetera, et cetera. Whatever your core reason for it is that works is fine. But for me, I need to formulate an idea of what's going to happen first in the market based on sound reasoning. So most people will call this taking a view, but I don't really like that because it's the idea that, it's a story, etc. I prefer to say you need to form, a hypothesis. So a view might be, I'm really bullish bunker fuel as a conclusion of, there's low stocks, there's the refinery margins aren't running, so they're not going to produce as much of this stuff. And there's rising bunker demand from shipping. That'll be a view. But the next step, when it becomes a hypothesis, is marrying that view with how you actually think the market will react given your understanding of the market dynamics. So it's not just, oil will go up and down. It's, well, okay, I think this, but also I know that, the market might be too long or too short. There might be a big player that needs to either stop out of their position or defend it. You need to know what kind of market condition are we in? Is it volatile? Is it trending? Is it driven by macroeconomics at the moment, or is it driven more by physical pricing? And once you've collated all this information, you can make the best educated guess possible for you on the market's next move. So it's, a very key consideration of mine. And it's, again, something we train at Onyx. And I think probably the next step is you want to stay out of that herd mentality side of trading. So what I mean by that, once you become part of the herd, do you know what I mean by that? So
buying into what they're saying on TV or something like that.
Exactly. Well, just as a loose definition, if there's 10 people trading and 9 out of the 10 people are doing the same thing, that would be part of the herd. It's part of the majority. And once you become part of the majority and trade in the same way or the same direction even, you can quite quickly become in a very dangerous position for a number of reasons. Like, firstly, if you're thinking like the herd, you're thinking like the majority, then you're on the back foot. So if the market goes against you and you need to get out, you need to stop out, all these traders will be stumbling over themselves to do the same thing. And so the reversals will be that much more aggressive and painful.
Well, we saw that just recently in the S&P 500, didn't we?
Exactly. I've got a better example than that, actually. I've heard the Bitcoin situation. So, I do believe in the blockchain methodology. It sounds and looks and reads very well as a concept. But if you map the trading on Bitcoin, it's fascinating. And there's an actual graph I've got kind of permanently on my computer that just exactly mirrors what's going on with Bitcoin at the moment. I just think it's so interesting. And you can kind of map out how this herd reacts. And, you have the initial smart money who believe in the concept and they invest in it and, they're early into it. Then you get enthusiasm for that idea. You get more press and you get, all these people buying into it. Then it gets higher and higher. You get greed. And, eventually you have there's no more buyers and there's literally no one left to buy. And then you're going to fall down. But then the worst bit is, as it comes down, you're susceptible to all these biases. It's just getting lower because it's a slight blip. You could name any type of reason. But that would be an anchor bias. That'd be you're anchoring yourself to a price and you believe it's going to get higher. But why? You don't know what the true value is. You don't know why it would be that high. Then you can also see in the price action the panic, and of course the herd when it panics. Literally like a herd of animals in Africa. That kind of panic and aggression, and it can be hugely damaging to your position. The market also tends to look more irrational when the herd is involved in one particular direction. But I put that down to, there's no one left really to make sense of the current market. You can't sell anymore. So to sell when oversupplied is a good thing. So of oil, that makes sense. But if every single major market participant is already short, then who is left to sell it? That kind of concept. So, you may not even be bullish, but, some typical trades that you'll notice will work. If everyone's one direction, you can literally take the other side. And just by the laws of market dynamics, when these guys need to reverse their position, then of course, it's going to go the other way. So, but as I say, that herd idea is just it's just very dangerous, and it's the tulip mania type thing and we're seeing it in Bitcoin as well, as I was saying.
And what about risk management? Do you have any core principles around managing risk?
Yeah, absolutely. So I was just going to say just the kind of final kind of point on the trading principle.
Go for it.
Yeah. Just this idea of, I just call it trading what you're trading. It sounds a bit of a silly way of putting it, but a lot of people think, like Bitcoin or Brent or whatever it is, you think I'm buying oil. No, you're not buying oil. You're buying Brent oil. You're buying North Sea oil. And of course, North Sea has its own pricing mechanisms as it has its own underlying value. So yeah, for Brent in particular, it's 5 oil fields in the North Sea. It's not even the entire North Sea. And ultimately, those prices of those grades of oil will ultimately set the price for the futures, which is hugely participated in contract that maybe quite a few people don't actually understand how it prices. So, a good example of this, a situation in December, we had a hairline fracture on a pipeline, and it was pipelining crude from one of these oil fields that prices Brent, and it was a big deal, and it did stop crude flowing. But in the global sense of things, it wasn't a big deal, but because it was so centered on the North Sea, cause absolute havoc. And if you hadn't known about that, you really would be on the back foot. And again, you'd be trading like the herd. You'd think, there's so much buying, it's so much huge, irrational, high volume buying I need to buy, or at the very least, I'm going to get stopped out here, and you don't even know why. So that idea of really getting to grips with what it is you're actually trading, and it's the same for gasoline, it's the same for anything that you trade. What is the actual true value concept underlying, and what do I have to pay attention to? Not just the generic analysis. But the risk management side of things. So I think first things first is the stop evaluation. So you have to determine the value expected that you think it's going to get to, but then you also need to determine where the value will get to, or the price of the contract will get to, where you've misjudged it. So if you think it's going to go from 60 to 65 on Brent, but you put yourself and you envisage, okay, but if it does get to 57 or lower, how would you feel in that situation? How are you looking at the market? Is that not a price which is telling you, all the factors you considered are clearly wrong, because then the price wouldn't be this low. So you have to kind of set that level for yourself, and that might be a consideration of volatility, market events, and obviously the timing, the length of the trade. So you have to factor all that in to the evaluation of your stop. And I think it sounds relatively simple, but I just think that people don't do that thinking before. They don't actually, and again, it comes back to the original thing I was saying about believing, you're not actually special. You're not this guru. You need to think, there's a very good chance I'm going to be wrong here. So when do I think I'm wrong? What price do I think I'm wrong? But it's also not making that mistake of putting your stop to a place where, for instance, you think that oil is going to go from 60 to 65. That's a big move. Relative percentage wise, it's not going to happen in a day, and if it did, it would be event you never would have seen coming. So given your analysis and given your hypothesis and why you think that's going to go up to 65, you've got to give it enough time. And so if you were therefore to put that trade on for a week and be like, why is it not 65? Obviously that's silly. But also, if you were to put your stop at 59, it's only $1 and you're expecting 5. $1, if you look at the Brent volatility, that's not a big deal. And that could just be someone doing a huge hedge and moving it, and it's very temporary. And you would have been stopped out when there was no need to be stopped out. You needed to have factored that in to your analysis. And again, it comes back to, if you know when you're wrong, or you've got a good idea of when you are not seeing what you had expected, then that's the number you need to have in mind, basis all these considerations. And then you go and start saying, right, so how much, given this is the level where I think I'm going to be wrong, if that's $3, then, I need to know that I'm risking $3. Therefore, I'm only going to risk the amount of money that correlates to that $3, and I shouldn't be risking any more. Does that make sense? Yeah. So if you've only got, $3,000 to risk, and first of all, you need a $3 stop. So you should only be doing one lot, which is because everything is 1,000 barrels in Brent. So, Yeah, I hope that makes sense. Yeah, so the next thing would be of your total capital available. If someone gives you X amount, there might be an element of, I'm only actually going to risk ultimately 10% of that capital. And of that 10%, I'm only going to risk 10% of that per trade or even less. And you need to establish that and be really quite strict on that, because, you need to keep yourself in the game for as long as possible. And you can't expect a ridiculously high win-loss ratio. You've got to expect that you are going to be wrong a lot of times, or you are going to lose money a lot of times. So this needs to be factored in. There are too many people, they just risk too much up front. And, you could actually have some great ideas and great approaches to the market, but because your trade craft and your risk management is poor, you've been taken out of the game, and a lot of careers are ruined over that. So, Paul Tudor Jones, big time trader, veteran in the market, he would say, I spent all day making his risk kind of vanilla and exactly what he wants, not sporadic risk and this and this and this. He's like, I have this view, this hypothesis, and this is how I'm going to express it, and that's all I want in my book. And he spends his day, he says, making himself feel good in the sense that, you're going to feel good if you've got the right risk on. You're comfortable with it, you've set your parameters. Anything outside of that and you get an edgy feeling and you're unnerved, that's probably a big sign that you're doing something wrong. Another huge one, not adding to your losing position. You buy Bitcoin and it's coming down and everyone's panicking. You say, I'll buy more because I think it's going to go up. And you're averaging into a losing position, and it's can be so cataclysmic and not just, for money, but bias in your head, and it's a terrible cycle to get into. So just do not average into a losing position. Another guy is a top trader, Dennis Gartman. He has a list of rules. And one of them is buy what is strong, sell what is weak. And I love that quote, because to really capture moves, you have to not fall to biases such as anchor bias, a perceived perception of the price being too high or too low, and not realizing that highs and lows are always being set, new highs, new lows are always being set, and the market is constantly in this state of overbought, oversold. So to just say, it's too high, relative to what? There's no, your history is not necessarily representative of what's going to happen in the future, and you need to, run that winner or stop out aggressively, or not be fooled just by a low price and think, I'm just going to buy it because it's low, because there's no real definition of what that means. And I think that's a great risk management principle as well.
Yeah, very good, man. Now, your current situation, so you've moved on from Mandara. How long were you there?
3 years, almost exactly.
And now, what's your situation now? I know you've started Onyx Commodities. Can you just tell us a little bit about what that sort of operation is?
So operations at Onyx, we're a similar type of function in the sense that we're an oil derivative company. We're trading the oil derivatives, crude, but also gasoline, distillates, etc., which all make up the barrel of oil. And the core of what we do, we're a relatively small shop in the sense of, the amount of capital we have. But, we're a major market participant, and that's sourced from our market making. So, end users, producers coming in wanting prices to hedge and to lock in their finances. We're there to take that, and we're there to provide the liquidity for the market. And by doing so, we're able to, alongside analysis, really determine the flows and what's going on. And it's a great edge. So what we're trying to do is, market make some money out of that, but also directionally trade and proprietary trade and add as many different types of strategies as we can, all from a derivative angle, leading towards kind of machine learning type thinking, algorithmic trading, anything and everything to essentially make money from these derivative contracts. So we're consistently hiring junior traders, a bit like myself and how I came through. We're also hiring slightly more experienced guys, and building a tech team alongside to assist with that and make sure we're really firing as efficiently as possible. And the idea, is really to sky's the limit type thing. Making money, and we want to continue to make money. We want to keep scaling the business. We want to keep scaling up our proprietary trading, and using this concept of market making as our core, as the source of our edge. We see things that I would say it's as a collective. We're seeing a lot of things that I'll be sure that most people aren't, because not as many people are as active as we are. Of the cleared volumes on the exchanges, we're well up there, and that will continue.
Okay, so just so I'm clear, you are trading obviously the futures contracts, and you're also involved in the OTC markets as well.
Yes, exactly.
Okay, excellent. So this side of it, the OTC futures, I know very little about. So I'd love to ask a few questions around that. So, I mean, just 101, the very basics. What are OTC futures markets? Oh, sorry. Well, if it's an OTC market, it's not a futures market, is it? Anyway, what are the OTC markets?
The words, yeah, sure. So, that's the way I've defined it. Essentially, all futures markets, you have the screen-based trades. So the Brent, the WTI, the RBOB futures. The things that retail investors and a lot of people can access. And it's the price is there and the liquidity is there, and it's very tight bid offer. So that's the futures. But the futures, they are then priced by the pricing methodology, whatever that might be. So for instance, again, going back to Brent, that's the value of the OTC future market in dated Brent and the actual North Sea physical. So they combine the prices and have a methodology for determining the actual end price, and that will then filter through to the price of the futures ultimately. So the key difference, I would say immediately, is these they're actually swaps. We call them swaps, but they got redefined as futures a while back. But essentially the idea is they price out their contracts, which price out daily, and you can basically specify whatever pricing mechanism you want. You could have it spanning over a day, a week, a month. And the idea being that these contracts are going to more accurately reflect the price of the physical. So there's so many different types of swaps. You've got RBOB gasoline, which is the big gasoline contract you see in the futures market. But then you've got the European gasoline, the Mediterranean gasoline, Los Angeles, et cetera, et cetera, et cetera. It's all got their own contracts. And they reflect the price of the actual location to which where they're defined. So, for instance, Mediterranean gasoline, that's specific to an area in the Mediterranean. The price of the contracts, the price of the physical in that area will price the value of the Mediterranean gasoline derivative contract. So the whole point of it is end users, producers can more accurately hedge, because if they want to hedge their so for producers wanting to hedge, it's not as simple as selling just the futures contracts. They want to have something that more accurately reflects the underlying physical. So, for instance, the West Africans, they're not, when they are producing oil, they're the Nigerians, and they want to lock in the price that they're selling at. If they sell futures, they're going to get the bulk of the hedge off. Generally speaking, 60% of the world's crude is priced against this future price. But if they hedge with dated Brent, so the actual swap, the underlying North Sea swap, that more accurately tracks the underlying physical price relative to the future. So, it could have $1.50 variations to the Brent futures price. So, of course, $1 on, 1 million barrels is obviously a lot of money, and these guys produce millions and millions a day. So they need that more accurate hedge, and that's the whole point of swaps. It's the idea of more accurate hedges. So that's there. But in order for these guys to also get a good price, it's an OTC market, meaning that you have to buy off someone. It's not a screen, it's not an algorithm. You negotiate a price between using a broker or using a screen, saying I'm going to bid you this price, and this person's going to offer that price, and the value is determined by where it trades, not by just numbers immediately there available on the screen. So that's why market makers are so important, because we're providing prices that are quite close to perceived value that you could just not have that price in theory. There's no one to sell. So how do how do you buy? How do you hedge it as an end user? You're going to need someone to give you a price. So that's where we would come in.
Okay. Now, just so that I actually understand the landscape and the various products you're talking about here. So you've essentially got three different things. So you've got the futures markets, which pretty much everyone listening to this podcast, I'm sure, is familiar with. Products which trade on the Chicago exchanges or London exchanges, right?
Mm-hmm.
You've then got the physical, which is the actual barrels of oil that the producers produce, and then you've got the swaps or as you could also call them, OTC market.
Mm-hmm.
Is that correct? That's three.
That's correct. Yes, exactly.
Okay. You spoke about Brent being a combination of a couple of oil from a couple various places, and the futures price represents these oil from these two various areas. How does that work? Because obviously people who are trading the futures market, a lot of them are trading, not even looking at the price of or the value of oil in these other areas. They're purely just trading the listed futures markets. So is this what creates, arbitrage or probably spread opportunities when these prices get out of whack?
So short answer, yes. But I think the best way to put it is these physical prices do ultimately set the price for the future, but the future prices once a month. So, April future will price at the end of February. So February 28th, we'll have the expiry of the April Brent futures contract. And on that day, the price is assessed using the physical, using an index to determine the final value of the Brent future. So there's a week before this expiry date, there's the limit day where, the exchange limits the amount of volume any one person can hold into the final expiry price. And most traders, most guys who essentially don't really care about the physical, they're just maybe putting it more on a spec basis, they would have rolled it to the next month. So they avoid that fluctuation into expiry because they just roll it to the next month, and they keep doing that. And that's a way to avoid this kind of collapse into the final physical price of the North Sea.
Okay. I'm not sure I fully understand that. So can you just explain again what is the Brent contract? Like, what's it made up of?
So the Brent future it's just a financially settled contract. So buying and selling with anyone who's got access to it. And if you were to buy it and wait until that contract expired, it would just expire out and you would have to settle the difference financially.
Yeah, but earlier on you gave an example where you said that Brent is essentially the combined price of X and X. What were those couple things?
So on the expiry day, there's a Brent futures index, which is the methodology used to assess that final price. And what they'll do is they'll take the physical prices that are traded during the day, and they'll take the average of those prices, and those will be the 5 oil fields I discussed, and they will then use that average to determine the final price.
So what's the attraction to someone like yourself, as a trader or a market maker, or what's the benefit for someone like you to trade OTC markets? Like, what's the attraction there?
Well, as I mentioned before, because it's more closely linked to the physical, we get, by trading in and out, obviously there is the ability to actually make money from trading disparities in the forward curve. So we would be, if someone wants to hedge in 6 months, we can trade that contract with them and then trade that versus the a month one contract, and then have a time spread in between and manage that exposure and try and make money like that. We're using the spreads and the outrights to essentially try and close the position but make money while doing it. So there's obviously that attraction by actually just making money, but also probably more importantly, because the physicals has such a big say on the ultimate futures prices, it's the information. It's not as simple as OPEC have cut and the price is going to go up. We actually need to see how the actual physical is reacting, and if we've seen a number of end users coming in and looking to buy, and we're seeing the physical differentials rally, and we're seeing positive refinery profits, so they're going to be running more crude. All these factors we can actually see evidence of in the OTC market, because they're going to go out and forward hedge that. If they think if there is a lack of crude, they're going to go out and hedge it. They're going to go out and buy future contracts to ensure they don't miss out on a cheaper price, because they know the price is going to go in the rally. So, bigger companies have bigger influences on the market because they might be ultimately the bigger buyers of physical or sellers. So paying attention to what these guys are doing and how they're operating is the edge. It's what gives the information, and that's what we weigh up to then ultimately have a discretionary view for ourselves and make money through proprietary trading. Does that make sense?
Yeah. Let's speak about how you actually are transacting. So you said before, there's not really an exchange for this sort of thing because obviously it's an OTC market. How, if you want to buy or sell some swaps, how do you actually go about that?
First of all, we have access to trade these contracts by having access to the exchange, so the ICE or CME exchange. So the exchanges guarantee both sides. So if I was to go in and buy a contract off someone else, the way I would do that is essentially got a broker box, and I will go down to these brokers and I'll say, look, I want to buy this, or they'll tell me, look, I want to sell this. Where could you bid it? And I would say this price, and then we would negotiate that. He would then go talk to the trader who wanted that price, and we would then start negotiating, and then we'd agree on a price, agree on a volume, and that's the trade. It's up to the trader, it's up to us to then risk manage that, to then keep track of what we've done and our exposure, etc. From reports from the exchange, etc.
So a typical trade on a lit exchange is going to happen in literally fractions of a second. What's the timeline of an OTC transaction?
Obviously not quite as quick, but it can be very quick as well. Say someone says, I'm a seller at this price, you buy it, and deal's done. You confirm the trade over a recorded line, and that deal is done, and then it will get posted to the exchange, and you'll see it into your account, and you're done.
So when you say it gets posted to the exchange, which exchange is this?
So like ICE and CME, so Intercontinental Exchange and Chicago Mercantile Exchange.
Okay, but it's not. It's on a swaps market though, isn't it? It's not like the regular crude oil futures or something like that.
It's not in terms of how it prices, but it is in terms of how it clears out. So the same way you would buy a future, even as a retail investor, that would be booked under whatever platform you're using. You would know you now own 5 kb of a Brent future, for instance. It's very similar like that. You'll post it to the exchange, and the exchange will then say you have 5 kb of Brent futures or 5 kb of dated Brent swap, and that's the whole point of using the exchange. Is if you then default as a company and you can't honor the financial difference from where you bought it and where you sold it, they guarantee it, and that's what allows access. And it used to be that a lot of these trades used to be bilateral, so that's why the banks were so much bigger. The banks would give financing and would trade directly with counterparts, and they would finance the deal. So no one would ever see what deal has been taking place, because they would agree, I'm going to buy this off you, and we're going to agree that the settlement price is whatever Platts, the pricing agency, determines it to be, and we'll keep that relationship of who owes what between ourselves. But this is transitioned now onto the exchanges, and that's what I was saying before about them guaranteeing every side, so that you can more frequently trade, and there's more transparency because these trades they're reported and people see the price and the volume done these days.
Okay, so what you're saying is that the volume done in OTC or swaps markets ultimately shows up on exchanges like CME or ICE.
Essentially, yes, but this is the tricky part when you're calling it OTC, because it's really the official. If you say an OTC, it's usually directly between one person and another. I'm talking about the over-the-counter market that I trade. I'm ultimately always posting these to the exchange, and the trades we do are visible to everyone. So it's the over-the-counter market in the sense that I'm trading with other people, but everyone will see that trade, and yeah, essentially.
Okay, I think I'm picking up what you're putting down. Cool. What are the risks inherent to you as a trader of these markets? Like, is there anything which is perhaps unique as opposed to other markets?
Yeah, I mean, well, firstly, trading, if you're trading with someone and not a screen, you might have said to the broker, okay, I'll buy what you just said you'd sell, but because I can't get hold of him, I can't confirm this deal. So you've got that kind of counterpart risk. And you might have some serious exposure that you needed to cover with that price. And if you miss it, you're kind of screwed. So there's that risk. And there's also these prices, as I say, because it's people to people, for it to go from one price to the next, there's no real definition of how that increment needs to work. It doesn't need to go up cent by cent. It could go from $4.50 to $4.75 in one trade, in theory, because it's traded with people, not the screen. So that's why it's such a big deal to understand who the traders are, understand how they operate, and understand the people you're trading and the market you're trading, because you need to know that when situations like that could arise. Like, for instance, in this pipeline example I gave you, you couldn't find sellers because everyone was trying to buy. So if you don't find a seller, then the price can just immediately gap up to whatever the next trade price is, and there was nothing in between. So you could have lost 30-40 cents on that without even anything in between. So that's what a key difficulty.
When you talk about trading with other people, like your counterpart to any given trade, is that an actual trader, or is that sometimes a producer of the physical as well?
Yeah, it's a good question. So I would say these days, most of the time, it is traders. So a trader at BP or Shell, some of these big guys, they are producers and consumers, and they've got all these different types of risk, and it'll be centralized to their traders to manage. So they can be buyers and sellers all the time. You'll never really know their ultimate exposure. But for people to actually trade in these markets, you do need someone who kind of has that, not just okay, I'm just going to sell because I need to sell, or just need to buy because I need to buy. They need to actually understand what's going on. So you would classify pretty much everyone involved as a trader. It wouldn't just be a producer doing something willy-nilly, if you know what I mean.
Yeah, okay. And let's say BP, for example, are they doing proprietary trading to make P&L, or are they only trading to try and hedge a position and manage their inventory?
Well, this is the thing. I mean, you can never really know. I mean, how do you define what speculation is? If you have a lot of inherent exposure from all the physical oil you're buying and selling, then when you choose to hedge it, or when you choose to leave yourself long or leave yourself short, whatever it is, there's always a form of speculation in that. If you don't immediately hedge, let's say the BP guys in Chicago want to trade some US, they want to hedge some US production, and then the refineries in Rotterdam and Europe want to buy some, they want to buy hedge. They've got to buy and sell in the same company, right? So how they deal with it, or maybe one of the guys won't buy, and therefore the net impact of BP is they're short. You'll never know if that's a speculative view they're taking, or how do you really define that? Do you see what I mean? With proprietary traders, of course, we're just trying to make money out of what's there on a blank sheet of paper. We're trying to make money out of any way we can. But these guys have got such big physical exposure that it's a completely different game, and speculation means something different.
Yeah, that's a good point, actually. So, as we're talking about BP, and not trying to pick on BP here, but like, what edge do you have as a smaller player, in the scheme of things, in an area which is dominated by these big companies like BP?
Yes, that is ultimately why it's so dangerous. Should have said that in answer to your previous question about what the potential dangers. If these guys know something we don't, which chances are is quite likely, and we've got the wrong position, it can be very, very dangerous. But again, the edge comes from market making. So this idea of trading, intimately understanding the forward curve. So whereas a bigger player, they'll just tend to be buyers and sellers of something in particular, we'll look at anything and everything. And because ultimately all these contracts are linked, so the way data Brent links to futures and the way gasoline links to futures, et cetera, there is a link, and you can trade the time spreads in between them. So if you're caught short, it doesn't mean you just have to buy what you sold. You can buy something in the future, you can buy a different contract against it and hedge it that way. You can get creative with what you do. So the edges, we've got real expert understanding of that forward curve, and multiple strategies of dealing with risk that's taken on from market participants, and that's how you kind of avoid losses. But also, you can also profit from those dislocations. But as I said before, really, that's the beauty of it. We're seeing what these guys are doing, which is very sought after information. But because we're the ones providing the price, then of course we get to see what the flow is, and that is ultimately very likely to impact the future price.
And what about these markets, just generally speaking, the years that you've been involved in oil, have you seen any big shifts or any big significant changes?
So in the way it's traded?
Essentially, yeah. Yeah,
well, the market's
exactly.
It's constantly changing and evolving, and the latest shift I've seen in the last 5 years is the investment banks having a lot less. They used to be the biggest market participants in oil, and that's kind of power shift, if you like, has gone from them to the trade houses, BP Shells, the Glencores, the Vitols, these guys who trade a lot of physical oil and a lot of derivative contracts. And they're big enough that they can finance big contracts and finance big risk, etc. And the banks, they're pulling out. There's tighter regulation. There's more transparency. And again, this idea I was telling you before about trading on the exchange rather than directly with counterparts, that's bad for banks, because the more transparent it is, the less they can profit from, the number they've given someone they've traded directly with them versus where the actual price is. It tightens that up hugely because everyone knows what's going on and everyone has a clear defined area of where the price is. So it just means you have to be. It's like anything. It's a path to efficiency. We've become a lot more efficient. And on that note, a big one for the future is the blockchain thing, because there's Shell in particular. They recently invested in Applied Blockchain, which is a startup company that is focusing on applying the blockchain methodology to physical oil trading to account for it using that methodology. And that will be huge. The way that's traded and the way funds are allocated and the paperwork, it will completely change things. So it will become more automated, and then it will change the profile of what you would need to be as a physical trader, and that might in turn change the dynamics of the market trading itself. So that point about things becoming more transparent and more efficient is of course, it gives us guys like Onyx more of an edge because we can see what's going on. And I guess the bigger guys less, because they don't own as many of the cards anymore as they used to, because everything they were doing was they didn't have to broadcast.
With this shift of the investment banks becoming less involved, obviously that's created more transparency like you'd just spoken about. Has there been any shift or change in the way that price moves or anything on a more granular level? So
the introduction of algorithms and high-frequency traders in the futures market, that's made a huge difference. So the liquidity, the volumes you see, they're just so much bigger than they ever were. These guys are just trying to profit from flows, essentially. Big order comes in, and they'll essentially buy the offer, see the, register those flows and buy, for instance, and try and profit from little increments like that. And the introduction of that all over the futures market is made things a lot more efficient on a price basis, and in turn a lot more volume. Otherwise, biggest trading on a granular level, I would say, and another interesting point in the last few years, when I first started, a lot of people used to derive their views, hypotheses on the market from macroeconomics, so the dollar ratio with oil and stock prices, etc. And it did used to have and it still does have an impact, but I would say, when I first started, we would have to be all over the news, all over what was happening in FX rates to make sure we were aware of potential fluctuations. But it got to I know exactly when it got to second half or early 2014. And I know it well because it was the first time I'd actually shorted the outright price of oil. And ISIS invaded Iraq. That was the first day they did it, as soon as I shorted it. And, it caused a huge fluctuation up, as you expect, the risk of a war, the risk of supply disruption. But very soon after that, because the underlying market was so weak, the actual physical market was so weak, we plummeted almost like from a few days after that event, all the way down from 117 or so, all the way down to kind of 45. And since then, or at least for a couple of years, we were in this oversupplied market, and it would just ignore macroeconomic events. It felt it just, people said there was correlations with the euro dollar as we came down. Okay, maybe, but it did seem to me that the market would trade much more fundamentally, and the considerations were a lot more on actual physical information. OPEC, the US stocks, and the whole shale production, etc. So little things would start to make a difference in the physical that never would have before, and in turn, the macro had less of an impact. However, in the last 6 months or so, kind of flipped back into a bullish market, more undersupplied than oversupplied. And we're in this current state now, and actually macroeconomics is starting to have another impact. So it's starting to have a big impact again. So we're again having to kind of go back to the drawing board and make sure we're aware of stock sell-offs and prices of FX fluctuations and et cetera. Like only last week, there was a huge speculative long position in Brent. And yes, the underlying market was starting to show signs of weakness, but the real collapse in oil seemed to be most timely with the equity sell-off we had last week. And it was massive. And to ignore macroeconomics these days would just be stupid. And I would say that's kind of always changing. But it's a key thing.
So what type of resources do you rely on for good fundamental and macroeconomics information, like so that you can stay on top of it? What are some of the resources which you lean on?
Kind of endless, really. I'm constantly looking for any source of information. Kind of baseline for anyone can access. Just typing in oil on Google, there's constantly consistent articles every 10 minutes or so, and there's lots of people posting their analysis on there, backed up by stock information and real fundamental stats brought together. There's what OPEC ministers are talking about, what oil companies are discussing about their plans. There's all that kind of, you can constantly be on that cycle. That'd be kind of like upper layer of what I'm doing. But then, of course, as I said before, my real edge is really seeing the evidence of that in this physical linked market, in the swaps. And that's what's happening in that market is the kind of core of my understanding of what's really going on. And you've got to marry that with what you think the overall health is. So that will be mainly, I'd say, refinery profits. So ultimately, refiners are the ones that buy crude. So the price of crude, you've got to know what the refineries are thinking, or what they're doing to make the most amount of money. And if they're making a hell of a lot of profit from running a particular type of grade over another, then you need to be aware of that the price the differentials between those two contracts could be wildly different. And the same with stocks and the same with even shipping rates, etc. There's just any information you can get by what's linked to oil is going to help your view. And so I wouldn't really narrow it down to anything in particular other than this kind of flow concept of market making, what I'm seeing. But my advice to someone who was trading from a retail perspective is, you can never do enough reading, and there's plenty out there. As I say, it's becoming more and more transparent, and it's not, even for myself, when I say I've got a big edge from market making, a lot of this stuff that I ultimately see does find its way into the press. But of course, your access to that press, there is Google, and that's obviously free, but then there's Platts and Argus that are pricing agencies that price a lot of these swaps and these physically linked contracts. They have their own commentary and their own they report cargo fixtures, etc. But of course, you do have to pay for that information, so there is that slight barrier. It's obviously expensive, but that type of thing is crucial as well. And then finally, I'm talking to people. That's something that I'm doing on a consistent basis. I need to know what everyone else is thinking, and even if it's not going to lead anywhere in terms of precisely what's going on, it's at least going to tell me what, generally speaking, what people are thinking and how they're positioned. And then going back to this herd idea, if you think oil's a buy and you're starting to believe it and it's already gone up, but you still think it's a buy, and then you go around and you can't find a single person who's bearish oil, it's pretty dangerous. So you need to start watching out. And there's a lot of people who trade oil in the futures market, thousands and thousands of participants. But in the swaps and the kind of more physically dominated areas, there's not that many people who ultimately have a big say in the price. So staying on top of those people is what they're thinking is huge. Like an event like next week, we have a IP week, which is the International Petroleum Week. Pretty much everyone in the oil market comes to London, and there's event after event and meetings after meetings from people from physical, derivatives, you name it, are all there essentially as a platform to discuss maybe deals or maybe just analysis, but it's a particularly important event. Something usually comes out of it, like a consensus or at least more information, etc.
Well, just a couple questions to bounce off that, and then we'll wrap this up. But you said earlier in your answer there that refinery profits were like a really key factor, which is quite valuable to know. For example, refinery profits, where would you find out about that sort of information?
So as I say, that information, the most accurate available information you'd have to pay for. I mean, it is accessible, but Reuters, for instance, you can access their refinery margin page, and that will give you like daily updates. But we also do model it ourselves, because we know the way the refinery profit will work is it's the difference between where they can sell or forward hedge the prices of the products they'll produce from running crude versus the price of crude. So we can run our own, really accurate refinery margin model and determine if they're making money or not, because it's not as simple as everyone's making money or everyone's not. There's different types of refiners. There's different types of crudes which yield different types of products. And this is all hugely variable, and you have to have an underlying understanding of that and how these things break down to really properly analyze it. But you'll know pretty soon if it's on the extreme. So if refiners are really making a lot of money, it's hard for that not to get into the news, I'd say, even on Google, etc., just by Googling that. And the same for if it was to be heavily negative. It's unlikely they're going to vary from those two extremes too much. So you're talking about little incremental gains, which will kind of make the difference for myself.
Okay. And then the other thing being like the swaps market. Obviously, that's off limits pretty much to the majority of retail traders, pretty much every retail trader. Is it possible to actually just get market data for the swaps market or some sort of insight, even if you have to pay a little bit for that? Like, is that what I'm trying to ask here is, even if you don't actually want to get involved and actually trade in that market, is it possible to somehow get a glimpse into what's going on there?
Absolutely. I mean, if you Googled right now, you would just need to be specific about if you typed in data Brent prices, or for instance, the European gasoline is EBOB. So type EBOB prices, there'll be things there that would show you these things are reported on a day-to-day basis. The most surefire way to get it is to pay some money for either Platts or Argus subscriptions, where they publish this information, and they even have their own analysis of it. But yeah, as I say, you need to subscribe to that. But it's relatively accessible, and that will tell you what you need to know.
Okay, cool. All right, Greg. Well, let's leave it here. I want to say.
Oh, sorry. Could I just quickly that if you've got a Bloomberg terminal as well, if that's something you can obviously buy. Bloomberg has a big list of swaps prices in oil as well. So that's a relatively easy one, and Reuters as well. So it's not just but Bloomberg, Reuters, Platts, and Argus is the subscriptions you'd need to really know what was going on in the swaps market.
Okay. Bloomberg is also, what, $2,500 a month?
I know. That's the problem, isn't it? So
Yeah. Anyway, it is what it is. Greg, thank you very much for coming on the podcast. This has been really enjoyable, and I've learned a few things. It's been a bit different from previous conversations. And
great. No, I've really enjoyed it.
Cool. If someone did want to follow along or connect with you somehow, is there anywhere they should go online?
With me personally?
Yeah.
Just LinkedIn's probably the best way.
Okay.
Greg Newman.
And you've got a website for Onyx as well. Do you want to mention that?
Yeah, it's just www.onyxcommodities.com. That's relatively straightforward. There's some information there on how to get in touch with us as a company, yeah.
Excellent. All right, once again, appreciate it, man. Thank you very much.
Thanks, Aaron. Thank you.
You've reached the end of this episode of Chat with Traders, but rest assured there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast on iTunes, and we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
Chat with Traders is brought to you by Trade the Pool. Did you know that every decade the market reinvents itself? Online brokers opened the doors, mobile apps made trading seamless, and commission-free trading erased barriers. Now, a new era has begun. Meet Trade the Pool, limited risk trading. And now you also have unlimited time to reach the profit target. From now on, your trading risk is capped, and your trading opportunities are limitless. Trade the Pool funds home-based stock traders with up to $200,000 in buying power. That means you can trade larger positions and scale your strategies without risking your own savings. It's time to trade with more capital, making it truly worth your time and effort. Ready to trade the pool? Click the link in the description and join the stock trading revolution today.
Are you ready to get serious about trading? Then join Tasty Trade, Investopedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade all in one platform. Get low commissions, including 0 commissions on stocks, so you can keep more of what you earn. Trade smarter with advanced charting tools, a pre-built strategy selector, risk analysis tools, and more features. Visit tastytrade.com/chat for more information. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC.
Markets, speculation, and risk. This is the Chat with Traders podcast, hosted by Aaron Fifield.
Traders, investors, punters, what is going on? Welcome. For this episode of Chat with Traders podcast, I'm ironically not chatting with a trader. Instead, I'm speaking with Kimberly Troutman, and Kim is head of DRW Venture Capital. Of course, DRW began as a Chicago trading firm founded by Don Wilson 25 years ago. Since then, it has grown into one of the world's largest firms with offices in 6 major cities around the globe and over 800 employees. It has also become much more than solely a trading firm. If you think back to episode 139, I interviewed Bobby Cho from Cumberland Mining, which is actually the cryptocurrency arm of DRW. Now I'm speaking with Kim, who, as I mentioned, is head of DRW's venture capital arm, and perhaps on a future episode, I may get the opportunity to speak with someone from DRW's real estate and property development arm too. We'll see. So let me quickly run through just a few of the things which Kim and I spoke about. Why founders even seek venture capital in the first place, and how investment capital is used, how investment opportunities are assessed, thoughts on risk reward, how valuations are determined for early stage companies, how DRW VC ultimately get a return on their investments, plus why the firm has a keen interest in fintech companies serious about blockchain technology and even ICOs. Now that you have a bit of an idea about what to expect, here is Kimberly Troutman for episode 160.
That sounds good.
Yeah, awesome. So how did you land the position you're in today? Like, where were you at beforehand?
So prior to DRW, I was working at Goldman Sachs in the Principal Strategic Investment Group, and I was part of that group for almost a decade. I went to college for business marketing, but I wasn't always interested in venture. So growing up, I was very artistic. I painted, I made jewelry that I sold to stores, I sold my artwork, and I never thought as much about moving to the investment side of businesses. I was always dabbling in my own small business idea on the creative side. I was introduced to finance through an internship in college and started working at Citigroup in those years on a trading desk. And that's when I really started to explore my interest in finance. And then the opportunity came up to join the principal investing team at Goldman. And it was a really interesting combination of finance and creativity, because in looking at all of these businesses, there is a creative element to it. From the structuring side, you need to be creative in this space, and you're meeting lots of different people and hearing about lots of different ideas. So it's in my mind, the perfect job that matches someone with a creative thinking skill set with the math-oriented skill set as well.
So principal investing team at Goldman, is that just another word for venture capital?
Well, not as much, because the group is making investments in companies that are a strategic fit to the firm. At DRW Venture Capital, what we're doing here is investing in companies that, on one hand, we know will generate a return from, but on the other, are companies that we can also be a customer of or provide liquidity for or help think through their strategic roadmap. Because we're investing at DRW VC in companies in the fintech space, which is the same space that DRW is in. Okay,
well let's get into that. So DRW, as we know, is a trading firm, like at its core. That's where its roots are at. How come it made sense for DRW to venture out, if you will, and open up a venture capital arm to the business?
DRW was founded in '92 by our CEO, Don Wilson, and the heritage, as you mentioned, is in trading. However, since then, the firm has expanded to include a real estate investing subsidiary called Convexity Properties, Cumberland, which is our OTC liquidity desk for crypto, and venture. Venture was a natural extension for the firm. The firm leads with technology and is known for that. So to move into venture, to have some skin in the game with companies that are also in our space, made complete sense for us.
And what year did DRW VC start?
The first investment on the venture portfolio was made a handful of years ago, probably 5 years ago within my coverage, but we've really made the most meaningful efforts in the last call it like 3 to 5 years.
Okay. So would you say it was an attempt to diversify further? Was that a part of it?
Absolutely. DRW VC has been active in the space for a handful of years, but we've made the most meaningful push in the last, call it 3-ish years. One way we did this was through Don's co-founding of Digital Asset Holdings. That was one of the ways that the firm started to explore crypto. We also helped to develop the patents associated with the Eris Futures Exchange, and we've made direct investments in companies that are already up and live with 5 million plus in revenues, which is now our focus. So VC today is focused on companies that have at least 5 million in revenues.
Okay, interesting. And what I also find interesting is that some other founders of fairly significant trading firms, especially out of Chicago there, like I think the founders of GetCo and possibly Jump as well, are now involved in venture capital also. Do you think it's possible that we might see more trading firms moving into the space over time?
I think that's definitely possible. Over the course of the last 10 years, we've seen a lot of people enter the fintech investing space, and it's because there's so much disruption that's happening, and there's money being made alongside that, which of course makes it an attractive vertical to enter.
Why do founders seek out venture capital? Like, what is the key benefit to them to take a check from someone like yourself?
First and foremost, entrepreneurs look to raise money because typically they need the capital to operate their business. But what we're seeing more of is entrepreneurs that are raising money, not just from capital sources, but from firms or people that can really move the needle for their company beyond dollars. And that's what DRWVC is seeking to do. So we're able to bring our dollars, but we're also able to bring our connections in the fintech space, our expertise around market structure and markets, and meaningful value add related to everything from structuring a deal to recruiting new investors to being a customer to advising on technology. So it's a more comprehensive picture of what an investor could bring to a business, and that's how we see our sweet spot.
Right. Are you able to share an example of how you've helped one of the companies which you've backed to move the needle? Like, as an example, you backed such and such a company and helped them with X?
I can't speak too specifically about how we've helped our companies in that way, but I can tell you that for one of the companies in our portfolio, Celerity, we're super excited about some of the projects that they're building out and the offerings that they have for financial professionals. We initially engaged with Celerity through their event data business, but why we followed on to our investment in that company and why we are working with them so closely today is because we're really excited about what they're doing with artificial intelligence to automate the financial professionals' workflow and to add value directly to that front-end trader, salesperson, decision maker. An example of what they're doing is for salespeople at a large bank, for example, they're consuming content that's generated through chat messages, and they're populating CRMs systematically. So instead of a salesperson needing to step away from a conversation to populate CRM, Celerity is doing that automatically in the background. And then when a client interest matches an inventory, a bond, for example, Celerity will surface that there's a potential trade to be done and who that salesperson should reach out to. So it's generally just helping salespeople do their job better for that use case. But there's lots of use cases that Celerity is working on to solve pain points in financial professionals' workflow.
When you write a check for someone, How much control do you have over how your investment capital is being used and being spent?
We always do the work on the front end to understand the goals of the business and help think through what the money will be used for if the entrepreneur doesn't have a specific direction for that themselves, which they typically would. So we don't reach back into the pockets of our entrepreneurs and tell them, oh, you should have redirected the capital this way or that. We work with them. It's very collaborative to spend the money efficiently and to deliver results.
Okay. So would you say you're more involved than kind of just cutting a check and let them, and then sit back and let them do the work?
We are. You're
more hands-on, right?
Yes. And some companies require more of that than others, but we are very hands-on with our businesses. We talk to some of our entrepreneurs multiple times a week. We're helping them think through everything from their next fundraising round to who we should introduce to the board, to recruiting new customers, to how they're marketing their product. I mean, really, we can be quite hands-on, but we are hands-on as it's helpful.
Yeah. Do you find that some people perhaps want those connections and want that guidance even more so than they actually want the capital backing?
That's a good question. I would say potentially. I of course, that's really valuable, but so many early stage companies are burning money, so they need the capital too.
How come they're burning money?
Well, when you're building a new business and your revenues are, call it even $5 million, you're trying to scale, you're trying to grow, and growth costs money. So there's expense associated with that. And getting to that scalable point where the companies break even can take time.
And how do you decide whether a new investment opportunity actually fits in with your portfolio, like the other holdings, the other businesses which you're already invested in? And just in general, like how do you actually assess new opportunities when they come to you?
DRW VC is investing in companies that have 5 million plus in revenues, and we're investing 1 to 5 million per check for a first check. So that's one initial screen. If the company has significantly less than $5 million of revenue, but it's in our space, we will meet with them and we'll learn about what they're doing for the future, but we likely will not fund. We meet with 10 to 20 companies, call it a week, for an introductory call. And what that looks like is about 30 minutes of us sitting with the entrepreneur, walking through their plan, walking through what they've done to date and what their ask is. And then we go from there. And the next step could be a call with someone from the business side to see whether or not we'd be interested in being a customer, or it's just a follow-up call with the company again to dig deeper into their financials and their business plan. But we spend a lot of time in those first calls fleshing out why we think the opportunity is interesting, what the growth story is, and then we go from there to look at the terms of the deal and the financing considerations to make a decision on funding. Sometimes we bring in other investors to join us. So we lead, but we follow and co-invest, but we also can bring together a syndicate. So if there was a company in the fintech space that would really benefit from the increased engagement of some strategic customers of theirs or some hopeful customers of theirs, we can reach out to the investment teams that work at those firms, loop them in, and get them involved in the syndicate as well. So we have not just a VC voice in the room, but we have a couple of other strategic customers. So we're really good at bringing others into the conversation if it makes sense for the company. If it doesn't make as much sense for the company, we're also very happy to lead rounds.
What do you mean by that? What do you mean by lead rounds?
Lead rounds without bringing in other co-investors. We could fund something directly, just us.
Got it. And you said 10 to 20 companies per week is kind of the normal for how many companies you would speak with on a given week. That seems like quite a few. Where do these people come from? Like, how do you, where does that, how do I say this? Like, are you approaching them or do they approach you? Like, how do you connect with 10 to 20 companies per week?
We get a lot of inbound referrals from co-investors that have met with companies that they think are interesting, but are either, in some cases, not in their sweet spot, so they send them to us, or they're interested but would like to co-invest with someone, or they would like a second opinion, or they've been asked directly to refer a company to us. So we get lots of inbounds. And then we also have internal referrals. So from the 800 people that work here at DRW, there's referrals made through this ecosystem. And then we have companies that reach out directly. And I'd say that the latter is probably the majority of the introductions, and they typically come through someone that we know. So a company will reach out to someone that knows DRW VC and get an introduction. And I think that's the best way to typically engage with us. But you're right, it is a lot of meetings. It probably, I was thinking through the math, it translates to anywhere between sort of 2 to 4 calls a day. And we have a team that handles the calls, and we handle them one-on-one or two-on-one. So we're able to split that work up and get through it. But as I mentioned, that first call is typically 30 minutes where we learn about what the company's doing, what the ask is, what the business plan is, and go from there.
Okay. So, over the space of a month, that adds up to what, let's say somewhere between 40 to 80 different companies which you're speaking with. Obviously, you're not investing in all of these companies. There must only be a small portion of those that you speak with actually get a backing from you.
Right. I think that's pretty common when you speak to other venture capitalists, that the hit rate isn't anywhere close to 100%. So it's the same for us. I mean, we're funding, call it 5 deals a year, 5 to 10. It's variable. We are going to engage when we're excited, and we're going to invest those dollars when it makes sense. So the frequency of check isn't so much defined up front. It's really more defined by the opportunity set. And we can be flexible here because our LP base is effectively the firm. The firm's balance sheet is what is funding this strategy. We have no external LPs, and that allows us to be much more flexible in how we think about investing.
What's an LP?
A limited partner. So
Okay.
Typically with a venture fund, there are individuals, institutions, groups that are invested in it as limited partners who have an interest in the returns that fund generates. So most name brand VC firms are funded by investors, and our group is funded by the firm.
Okay, I'm with you. One question I would like to ask you, Kim, how do you determine the valuation of an early stage business? I mean, I'm sure this is quite a complex subject and we could probably do a whole podcast around it, but just in brief, these companies which you're investing in are just starting out. They have smallish revenues in the scheme of things. How do you determine the valuation of an early stage business? Is it in the idea or, what they have currently, or is it more so about the potential that this business has?
Most of it is the potential, because the actual math of calculating of valuation or price is looking at forward cash flows and then discounting them back to today. So you're looking at what you expect that business to do in the future, and then you're discounting it back to today for a price. Now, if you have 0 revenues, you're obviously going to have to make a lot of assumptions. And for our companies that have 5 million plus in revenues, they've already shown some traction. So if it took you 20 years to get to 5 million in revenue, or it took you 6 months to get there, it could help inform what your future projection looks like. And those are the kinds of things that we think about. But it's not an exact science valuation. It's how much money is the company raising? How much equity do they want to give up for that? What does their future roadmap look like? So that piece does speak more to the valuation. But You're weighing lots of factors, not just price. So, for example, if there was a company that had some amount of revenue and the valuation was very, very cheap on some metric, but the management team didn't have great experience or had come across trouble in the past or wasn't well regarded, then that wouldn't be something we would want to do. We like to look at operators that have a vision, that we are confident can execute, that have a great track record, and that have shown some traction in their product to date.
Do you ever back a company with $0 in revenue?
We don't. So we are focused today on companies that have at least 5 million in revenue.
Okay.
Sometimes we see companies that have a bit less than 5, and we will meet with those companies. But the target's 5. And if the company has a good visibility into their pipeline to get to 5 quickly, that could fall into scope. So it's not a hard line, but it is something that we're targeting, and we're focused on companies right around there, 5 million plus.
Another subject I'd be interested to hear more about and how you think about it is risk. Obviously, as traders, one of the things we think about quite often is risk to reward, and I presume it's quite the same in your field of venture capital. How do you think about risk to reward? Because obviously you're taking a risk when you're writing a check and putting your capital into some of these businesses. How do you think about the risk to reward?
DRW has 25 years of risk management experience, which is part of what makes us different. And it's how we approach all aspects of our business, including VC.
Okay. And let's say, just to play along with the same theme of trading, we normally have an exit plan if things don't work out as anticipated. Okay. We cut our losses. What happens if one of your investments doesn't go as anticipated?
We're focusing on the long term with the goal of positive returns. We plan in advance so that if something is flagged as not tracking, we're able to address it sooner rather than later so that there's no surprises.
Are you able to go into that a little more? Like, what happens if something unexpected comes up?
Well, we're tracking the cash balance of our companies and what the companies are burning per month if they're not cash flow positive. So one trigger could be that the company is short on cash and might need funding. So for that type of case, we know how they're tracking and when, such that if the company has less than, say, 12 months of cash, we know that we need to start thinking about fundraising. So we're able to plan ahead by tracking our companies from a financial perspective. So there shouldn't be too many surprises there, if that makes sense.
So when you talk about fundraising, you're talking about raising like the next round of venture capital, right? Okay.
Exactly. So if we make an investment and the company burns more money than we were expecting, well, you'll see that come through in the financials, and you can start to plan around that. You can say, why is this happening? Is this because the company's not generating revenues like we expected? Is this because the company's spending more money than we expected? And then you can drill in from there to understand the dynamic. And if it is the case that the company needs to raise money, you should be able to see in advance that that's coming up as the case. Okay. We're not looking to fund a company for our money to last for 6 months. We're looking to fund companies so they have at least 12 months of runway.
Okay, before they need to raise more capital or they become sort of
profitable,
self-sufficient. Yeah, profitable.
Exactly.
Okay. And just sticking with this theme of risk to reward, how do you actually seek to get a return on your investment? Like, are there various ways which you can do so, or is it only when you have an exit, when someone actually buys the business?
Well, an exit is technically the only way you're going to get your money back. So you're exiting your discrete position, selling it in a secondary. So the company doesn't sell, but you've sold your position, or the whole company sells. or you can sell through a private transaction. You could sell through a public IPO. Those are the only ways that you will exit your investment from a cash perspective. Your investment over time will be marked based on subsequent rounds. So we do mark to subsequent rounds and the valuations implied by those. But that's not a realized return given you haven't returned the dollars yet.
Okay. I might be way off here, but do you also get a return on revenue? Let's say you buy a stake in a business and you have 10%. Do you then also get 10% of the revenue, each year?
No,
Okay.
you don't. So when you make an investment in a private company, what you get is an equity ownership stake in that company. So what that means is the company could make the decision to distribute a dividend. And in that case, you would get some cash flow there. But outside of that, you own the enterprise, and the enterprise will return to you directly on the private side when it is ultimately sold. So you don't get to clip a coupon on revenue every year. You don't own that revenue stream. You own a portion of the entire enterprise.
Okay, so what the business is worth.
Exactly.
Yeah.
Are you ready to get serious about trading? Then join Tasty Trade, Investorpedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including 0 commission on stocks, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, risk analysis tools, and more features to help you trade smarter. See equities and derivatives with high trading volumes, dividends, upcoming earnings reports, and more with their pre-built watch lists. Or create a custom watch list to keep an eye on the companies and sectors that matter to you. Manage your positions with speed and precision using active trader mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Visit tastytrade.com/chat for more info. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Have you ever watched a stock explode and thought, if only I had the capital? Or sat on the sidelines because your account balance felt too small to matter? Good news, with Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 U.S. listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with 0 locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
Now, Kim, right at the beginning, you touched on blockchain, and you almost mentioned that in some ways that was the beginning of DRW Venture Capital, was when Don got involved with a company, I think it was Digital Asset. Beyond Cumberland, I'd just like to speak about this a bit more. So beyond Cumberland, what other ways is DRW actually connected to crypto assets and blockchain technology?
So DRW started entering or thinking about entering the crypto space as early as 2010. We formally formed Cumberland in 2014, and that group is providing liquidity, OTC, over the counter, in the major cryptos and tokens, and is now one of the largest liquidity providers in the crypto space in the world. Separate from Cumberland, the firm is inherently long Bitcoin. Don also co-founded Digital Asset Holdings, which applies distributed ledger technology to large financial institutions and is based in New York. And we are in venture capital looking at companies in the crypto space that leverage the technology and solve for pain points there. We've made an investment in a handful of companies in the space. So if you look back, some of the first investments we made were in companies like Bitfury, CoinFloor, and Simplex. And then most recently, we invested in BitGo, which is one of the leading enterprise custody solutions for crypto. And we're really excited about that investment. One of the questions that Cumberland gets asked the most is related to security. So it fits into that theme. And of course, custody is a major consideration for people that are trading in the space.
So I guess maybe I should have asked this question beforehand, but either way, why Bitcoin and why these cryptocurrencies or crypto assets, I think as Don prefers to call them, what's the attraction? I know there's a lot of hype around it. Obviously, everyone knows that, but you guys started getting involved in the space, you said, as early as 2010, which is, sort of the real early days. What's so attractive about this space to you guys?
Well, from the venture capital perspective, the crypto space is still very early. So there's lots of disruption, but it's very early, and there's a lot that needs to happen to bring that market up to be truly institutional. So thinking about the experience of even buying and selling these assets today, if you're going onto your phone to do that, it's not always the best customer experience. So we're looking at platforms that are helping to shape the space to be a more institutional experience. We're looking at market data companies in the space. We're looking at trading tools, KYC, custody, really the whole ecosystem of solutions that are associated with crypto are things that are on our radar to review from an investment perspective.
Okay, and I noticed on your VC website that you actually have an area now on the homepage which says you're interested in hearing from people who are doing ICOs. How come? Let's speak about the ICO aspect.
Well, carrying on the theme that DRW Venture Capital is investing in businesses where DRW can be helpful outside of just our dollars, ICOs fits because of our Cumberland business. So Cumberland is one of the largest liquidity providers in the world for crypto, and we're able to help companies that are raising an ICO find liquidity on the front end. So if you had a participant who needed to buy ETH to participate in your ICO, that participant could buy that ETH from Cumberland. And then on the back end, if you're a company that's raised a lot of ETH from participants that you would like to sell, Cumberland could facilitate that. So we started reviewing ICOs from the venture perspective because of that obvious synergy between our two teams. And in partnership with Cumberland, we're reviewing them. But I would say that many of them are not quality projects. There's a lot of really large rounds being raised at crazy valuations from projects that are not that interesting. We have a really high bar for what we're participating in on the ICO side. And from a retail perspective, I would certainly proceed with caution in participating there.
Yes, for sure. So at the moment, are you or Cumberland seriously involved in any ICOs currently?
We are. So we have participated in a handful of them. But when you look back to, say, March of last year, if you were invested in all of the ICOs, there's very limited data. But from some data that we pulled, it showed that at that time, your return would have been close to 1,000%. But today, if you were invested in all of the ICOs, it would be materially less. So closer to 50 to 100%, which still sounds like a lot, but I think what's changed is the number of terrible projects has only increased. The lockups in the space have increased materially. So a year ago, the lockups, there weren't even necessarily lockups in these projects. And why people were so excited about ICOs is because they perceived that there would be immediate liquidity, but that's just not true. It's taking a lot of time for ICOs to have a liquidity opportunity. And you could be stuck in the ICO and not able to sell for as long as a year plus. And so some of the things that made the instrument exciting just aren't playing out as it initially was expected to.
So why are the lockup periods becoming longer, over the space of just 12 months?
Well, that's just something that we've observed. So I think a lot of things about the space are changing in a very short amount of time. So, I mean, you could look at the space weekly and conclude that a lot has changed. It's quickly evolving, which is why we're very cautious about the space as we engage with it. And we spend a lot of time thinking about how we engage.
Obviously, when, we hear about Bitcoin in the media, there's a lot of speculation, and I hate this word, but it often comes up that Bitcoin is a bubble and other cryptocurrencies are a bubble. Let's just say that is the case, yeah? How would DRW VC be affected by this? Like the sorts of companies you're investing in, is that a risk?
That would be a risk for a company that had revenues that were associated with Bitcoin. If Bitcoin completely went away, I mean, of course, that could impact the business. But for most of the companies, that do generate revenues from the activity associated with Bitcoin specifically, they're also generating revenues from other cryptos more broadly. So it's not specific just to Bitcoin.
Yeah. So
in that regard, it's not as much a risk. So it's diverse. It's more diversified than that. So someone's not building well, I'm sure people are, but none of our companies are building solutions that are focused only on Bitcoin.
Yeah. So a lot of the companies you're backing are more kind of supplying the technology rather than being dependent on the price of Bitcoin. Is that a fair statement?
Yes.
Okay. Just changing gears as we go out here, Kim. Let's say someone's listening to this. They have a little bit of cash. They're ambitious, entrepreneurial. How could an individual get involved in venture capital, even if it's on a very small scale?
That is hard. I don't always. If it was my parents asking me how to get involved in venture, there are the crowdsourcing platforms that you could look at. But if you wanted to get involved in a really meaningful way and really generate a return for yourself, I think it would be challenging, unless if you could offer some real value to these companies as an angel. So, you could go through an angel network and find opportunities through that. And I've seen people do that, and that's interesting. Or through your own network to back a company that one of your friends is leading or one of your relationships is pursuing. But generally, from a retail perspective, it's been harder to get involved in venture, and is why most people don't have exposure to it directly.
Just one last question, and I know it's a sort of one of those questions you probably get quite a bit of a generic question, but do you see any trends beginning in the space of fintech, and particularly the areas where you are focused on? Is there anything which stands out? Anything that's noticeable?
Yes, of course. I think one of the biggest things that's noticeable is just how workflow is changing and is moving to more automated solutions. So, and I mentioned with Celerity, they're focused on automating workflow. One of our other companies, DWA, is digitizing the law, and they're taking regulation, internal compliance rules, rules in general. They're digitizing that, and they're helping to make decisions be more technically based than human driven. Or I should say, humans can define the rules on the front end, but the technology plays it forward. So one example of how DWA's product works is on the trading side. So from a derivatives perspective, if you're trading a product, do you have to trade this product on an exchange? Do you have to clear it? Do you have to report it, and where? Based on your jurisdiction, based on the time of day, the day itself. DWA's technology can give you answers to that real time, right on your front end. So that to me is a great example of how the financial professionals' workflow is changing for the better, becoming easier and more actionable.
And if someone wants to find out a little bit more about the other companies which you're invested in, besides the few you've mentioned, can they find these on your website?
Yes. So the entire portfolio is listed at drwvc.com. So we have all of our companies posted there with a little description of each and a click through to their homepage.
Cool. And if someone wants to follow along with you personally, where would be the best place to go?
On Twitter, DRW's handle is DRW Trading.
Okay.
That's the best place to follow the firm.
And what about you? You're on Twitter also?
I am. My handle is Kim, Traut, Kim Trout.
Excellent. Kim, I want to say it's been an absolute pleasure speaking with you. I appreciate you taking the time to do this. Thank you very much.
Thank you.
You've reached the end of this episode of Chat with Traders, but rest assured there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes, and we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
Website where they can subscribe in the show notes as well.
Awesome.
Yeah. Now, Mike, have you changed your Twitter handle or have you got the same one still?
Yeah, no, it's an Econ Emotions. So it's at Econ Emotions.
At Econ Emotions. That's your Twitter handle.
ECONEMOTIONS. Yeah.
Okay, great. So
hitting bids. Yeah, and I got my little icon is the Lewis Winthorpe and Valentine.
What's that from Trading Places?
From Trading Places.
Okay. Nice.
Yeah.
All right, man. I appreciate you coming back onto the podcast. It's been an absolute blast. Thank you very much, Mike.
All right, Aaron. Cheers, man.
You've reached the end of this episode of Chat with Traders, but rest assured there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes, and we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
Chat with Traders is brought to you by Trade the Pool. Did you know that every decade the market reinvents itself? Online brokers opened the doors, mobile apps made trading seamless, and commission-free trading erased barriers. Now, a new era has begun. Meet Trade the Pool, limited risk trading. And now you also have unlimited time to reach the profit target. From now on, your trading risk is capped, and your trading opportunities are limitless. Trade the Pool funds home-based stock traders with up to $200,000 in buying power. That means you can trade larger positions and scale your strategies without risking your own savings. It's time to trade with more capital, making it truly worth your time and effort. Ready to trade the pool? Click the link in the description and join the stock trading revolution today.
Are you ready to get serious about trading? Then join Tasty Trade, Investopedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade all in one platform. Get low commissions, including 0 commissions on stocks, so you can keep more of what you earn. Trade smarter with advanced charting tools, a pre-built strategy selector, risk analysis tools, and more features. Visit tastytrade.com/chat for more information. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC.
Markets, speculation, and risk. This is the Chat with Traders podcast, hosted by Aaron Fifield.
Hey crew, what's up? Aaron Fifield here, and I gotta say, I'm actually genuinely very eager for you to hear this episode. Personally, I think you're gonna get a lot out of this one, but I have to tell you something first. Folks, if you are in Sydney or if you are near Sydney, please mark your calendar for Tuesday, the 5th of June, because I'm hosting another live podcast event, and I have a very special guest lined up, John Moulton, though many know him better as Rambo. Coming from Chicago, John, or rather Rambo, arrived in Australia during the 90s, and he quickly earned a reputation as one of the biggest and baddest traders on the floor of the Sydney Futures Exchange. Some days he would equate for well over 10% of the market volume. As I said, John's a very special guest. He's been abundantly successful as a trader, and he's done a great job of staying away from the public spotlight. As far as I'm aware, the only thing you'll find about him online is when he featured in the 90s documentary Bulls and Bears. But I met John last year, and he told me, almost word for word, trading has been very good to me, and I would like to give back. So, here we are. With regard to the actual event, prior to the live interview kicking off, I'm putting on beers and pizza for everyone, and this will also serve as an awesome opportunity to mingle with other traders. Equally important, because this event wouldn't be possible without, are the 2 sponsors who are getting behind this event. And by doing so, they're not only supporting Chat with Traders, but they're supporting the trading community. Those 2 companies are Trading Technologies and Prime IA. Show some love. Now, for more info and to get your ticket, go to chatwithtraders.com/Rambo. Tickets are only $17. That's it. Don't sleep on this. Get your ticket now because the event will sell out, just as each one of these events has done in the past. If you didn't catch the link, it's chatwithtraders.com/Rambo. Go get your ticket. All right, moving along. Returning to the podcast for this episode is Mike Bellafiore. Mike, as you should know, is the co-founder of S&B Capital, a New York City proprietary trading firm. He's also the author of The Playbook and One Good Trade, and he was my guest way back on episode 22. That was in 2015. As the title suggests, the purpose of this episode is to break down how you can become a 7-figure trader. Mike is well qualified to speak on the subject because he's mentored and led traders within his own firm to reach this level of trading success. However, there are no quick fixes packed into this episode, but there is real value. If you listen carefully, take notes, and intentionally act on some of Mike's suggestions, I know it will make a difference over time. All the links and resources mentioned can be found at chatwithtraders.com/162. That's it. I won't say any more. Here is Mike Bellafiore for episode 162. I think a really cool theme for this episode would be something along the lines of the blueprint for becoming a 7-figure day trader. I mean, how do you feel about that?
Yeah, happy to talk about that.
Okay, cool. Well, let's waste no time and get into things. Well, let's take it right back to basics, Mike. So, I know for someone who's, let's say, just coming into trading today, it can be very confusing about where to actually start. How do you go about it? Like, where do you even begin to learn from? Where do you start out?
All right. So, for us, we think of development of a trader in stages. And so the first stage is consistency, and the second stage is sizing, and the third stage is breadth, expressing your edge in different ways, and the fourth step is sophistication in how you express your ideas. And so I always find from my inbox and people I talk to that people in the trading community often mess up at what stage they're in. So a lot of people always want to work on sizing, right? And they start trading and they have a little bit of success, and now they want to just trade bigger. And then when they start trading bigger, they wonder why they're not doing as well as they would want. And if you look at the results, a lot of times they're inconsistent. And it's because that they're focusing on the wrong stage of their development. And so we had recently hired a trader who had a pretty good track record as a retail trader. And we trained them up, put them through our first two parts of our training program, polished the edges a little bit, and said to them, hey, just do what you were doing as a retail trader, and we're sort of not going to get in the way. And let's work on sizing from your live results. And the trader was not doing very well. And we had to take a step back and say, the trader's not consistent. And the trader's run as a retail trader, while it was okay, it wasn't really long enough for us to really conclude that this was a consistent trader. And so we took a step back and we focused on consistency, all the things that go into consistency, coming up with the daily process that you're going to go through, understanding the setups that you trade best, and making sure that you're trading them as much as you ought to be, understanding the trade-ups that you don't trade best and getting rid of them. And so there's a lot that goes into that, right? So do you have a routine that you ought to go through each day? Have you written that out? Do you understand what the best routine is for you? All the things that go into that. Do you understand what you trade best? Have you tagged all of your trades that you made and then put them into a machine, put them into what we use on our desk, which a lot of people call a trader view, and put them into a way for you to measure your results. And then have you taken a look at those results. And then after you've measured and understand what you actually trade best, are you actually doing that? And so, and the first step before that, of course, is getting trained pretty well. I got actually asked a question about that, which I wrote a post about the other day. And you do want to go through, you want to have a really solid foundation. And, for us, that means going through S&B foundation. That means then going into trader development. And that means then going into team trading. Those are 3 parts of our training program that encompass your first year at our firm.
So what goes into that foundation, like the very first step? Because, not everyone is going to be in a position where they can go into a firm. Some of these people who are listening to this are going to be trying to work this out on their own, especially in the very beginning. Like when you decide that, I'd like to give this trading thing a shot. You may not even know about prop firms. So what sort of things would you be wanting to fill your head with? Because there's a lot of content, there's a lot of resources online. Some of it's really great, some of it's maybe not so great. What are the things which you want to focus on?
So for us, there are certain principles that go into a really solid foundation. So I wrote a little bit about that in One Good Trade. I wrote a little bit of that in the playbook. But, if you go to the gym, I actually have a trainer, and I will say to you what my trader is always saying to me, which is it all starts with a really solid core. And so every exercise we do, even if we're doing like lat pull downs, he's always like, make sure you're focusing on your core being solid. And so if you're trading and you don't have a really solid foundation, a really solid core, you're not getting good results. You're not getting good reps. So a good foundation for a particular trade, one good trade would be, are you thinking through the trade properly? Are you controlling your risk? Is it a good stock to be in? Are the technicals aligning? Is there a news catalyst behind it? Is there a thesis overall behind it? And for, the new trader, it really is about developing skills. This is a skill game. So you need to learn technical analysis. You need to learn what news catalysts move stocks. You need to learn the types of stocks you ought to be trading given your account. You need to be understanding what your risk tolerance can be on an intraday level. You need to have a decent platform that can get you in and out of stocks the right way. You want to be being connected to people who are giving you ideas. And for us, what's interesting is that when we first started SMB in 2005, the way that we brought traders in was very different than the way we bring traders in today. And so for us, our training is revamped every year. And then just even last year, for the second part of our training program, Trader Development, we implemented a whole new section on automated trading. And so when guys are coming in today, they're not just coming in with a career path of being a discretionary trader, but they're coming in with an option to be a discretionary trader or an automated trader or what we call a hybrid trader. And so in Trader Development, I sat down with our head quant in New York and Dr. Steenbarger and our floor manager and my partner, Steve Spencer, and we put together a new training program on teaching people how to start as an automated trader, how to back test, how to forward test, how to come up with ideas. And while they're working on the discretionary trading skills, to also be working on their development as an automated trader.
Okay. Who's your head quant? Would that happen to be Morgan Slade?
So Morgan runs quantitative trading for Cloud Quant, which would be for the entire firm. And then he sits in Chicago. And then in New York City, we have a head quant who helps all of the experienced guys here and all of the newer guys here for, there's really three parts to technology here. There's filtering. So how do you build scripts that will alert you to your best setups? There are scripts. How do you just get into a particular trade that the machine gets you into and then you trade out of with discretion? And then thirdly, being able to build automated models. And so we have somebody who helps people with that and then trains the newer guys who are coming in.
Now, as we're still speaking about, this very beginning phase of a trader's development, in your own opinion, do you believe there are certain asset classes which are best suited for new traders?
Well, I think that it really depends on whether or not you're trading as a self-directed trader, whether or not you're trading at a prop firm, whether or not you're trading at an institution. I certainly believe that there's a best asset class for you. And so as a fun experiment, while I was putting together a presentation for a chat that I did recently in New York, I came up with something we call the $1 million trader trading formula. And I, as for fun, came up with the variables that people ought to be thinking about for can they become, or how do they become somebody who can make $1 million in a year net. And the first part to that to me was having a growth mindset, and then having a passion for trading, and then having a really solid training foundation, and then experimenting with different types of setups. And after you experiment with different types of setups, to start to gravitate towards a niche, and to show that you have trading edge in that particular niche, and to work on getting better training to come better at that particular niche, plus really trading your A+ setups bigger, plus having talent, plus using technology to play more offense in markets, plus being patient with how long it's going to take for you to survive a learning curve, or to become good enough to make $1 million net in a year, plus perseverance. And all of those things together is my fun way of coming up with a formula for $1 million a year trader. And so, inside of that, we touched upon niche. And one of the things that we do at our firm is, and we're an active equities trading firm. We do trade other products, but a majority of what we do is active equities trading. And what's interesting is that the larger producers at our firm, they all trade differently. They may all trade, they certainly all come from the same training program. They're all hired the same way, but we expose people to different ways that active traders make money, whether that's trading low floats, whether that's trading large caps, whether that's trading high beta, whether that's scalping, whether that's trading as a technical trader, whether that's international ARB, whether that's M&A work, whether that's only shorting, whether that's only getting long, whether that's being a hybrid trader, whether that's being an inefficiency trader. There's so many different ways to make money as a trader. And so there certainly is a best way for you, and there certainly needs to be you discovering what your niche is to find out how good you're going to be. And so people always ask me the next logical question, which was, how do you find what your niche is going to be? I do think you have to experiment. And I do think that people oftentimes will go to a resource online and take that resource online, not do well with that resource, that learning, and then conclude that I don't need to learn anything, I just have to learn everything myself. When maybe the conclusion is that resource wasn't best for my talents and for the way that I think. You really do have to expose yourself to lots of different ways to trade, and those have to be ways with edge. And so we do that. So here are the setups that we know guys make a lot of money as active intraday traders. Now go try them. Now go measure your results on them. Now let's talk about how you can trade them better. That there's not necessarily, and that's going to depend on what kind of a firm you're at. So there's definitely a best way for you. And I'll give you a good example. When I first started trading, we did a lot of scalping. We have a lot of guys who come through here right now who don't really have they don't have the skills to succeed today as a scalper. So that's fine. Then they can gravitate towards a different type of trading. And so, if you are a retail trader, there's going to be that experiment and learning curve. If you're a prop trader, there's going to be that learning and experimental phase and down the line.
Can we just go back and pick up on, I think it was the first part of that formula you described. You mentioned about having a growth mindset. Can you go into that a little more? What does a growth mindset mean? What's that referring to?
So there's a really great book that we recommend traders read before they actually show up at our firm. And it was written by Carol Dweck, who is a professor, and she wrote this book called Mindset, and really, really great book. And the book essentially, the hypothesis is that if you come into, I'll apply it to trading. If you come into trading and you think that your talent and your talent alone is going to dictate how you do as a trader, that's called a fixed mindset. If you come into trading and think, well, how I'm doing right now is how I'm doing right now, but I can be better tomorrow. And if I do ABC, then I can be a lot better. Then that's a growth mindset. And we found at our firm that the traders who have a growth mindset become very, very successful traders. And a great example of that is at the end of the year, this year, we ask our traders to come up with their yearly goals. And in 2016, one of our traders, who I'm going to talk about their yearly goals in 2018 for, this particular trader earned a green shirt. And at our firm, if you net $1 million in trading profits for a year, you get a green shirt. It's a big honor to be able to hit this level. And in 2017, this trader earned a black shirt. And a black shirt is when a trader nets $2 million plus in trading profits for the year. And so a trader was very successful in 2016 and got even better in 2017. And when he sat down to come up with his yearly goals for 2017, he said, bigger picture, I'm also thinking about making the incremental steps to be a $10 million a year trader. That's what he wants to be. And so he's not settling for being a black shirt trader. He is starting to think about the things that he needs to do and starting to do the work that he needs to do to hit that next level in his development. That's somebody who has a growth mindset.
Do you find that most people in trading naturally have what you would call a growth mindset?
No, absolutely not.
Really?
I definitely think there are a lot of traders that have a growth mindset, but no, I don't think everyone has a growth mindset. I also think while it's preferable that people have a growth mindset, that it's people, there are traders that are so talented that the fact that they don't have a growth mindset also doesn't stop them. But it's highly preferable.
It works in your favor.
Very much so.
What would you say are some of the challenges that traders are going to come up against, which they may not be expecting? Obviously, anyone who's come into trading and been knocking about for a few months, by that point, should realize that, that there's going to be periods where they lose money, and it's very difficult in that. But in your situation and having the experience that you do running the firm, you've seen the paths of a lot of traders develop. What are some of the challenges which they may come up against, which they're often unexpecting?
Well, I think the recent change in volatility is a great example of that, right? So for the last 5 years, into the end of 2017, we saw a market that had historically low volatility. VIX was under 10. And when we had that period of historically low volatility, there are a lot of very talented long-term producers who really struggled. And they really struggled because when the large caps weren't moving with the volatility that they needed for their strategies to work, they very much underperformed. And so in 2017, we had a really great year. We we did very well. We were very, very happy with our progress. I would term it as a year of outperformance. And then we walked into some months where volatility picked up. And I wrote about this in a recent blog post. And when volatility picks up, generally, traders ought to make a lot more money. There's more opportunity. Movement breeds more opportunity, which is best for traders. And when I look back at end of month, like for a particular month like February, we ended up putting together a pretty solid P&L month for ourselves. But we made money in a way that was a little bit unsustaining, and we didn't make and take advantage of the overall market volatility as well as we should have. And so the challenge is going from a low volatility market to a high volatility market. And in our case, going from trading unique sets of stocks to trading the overall market, to trading SPY and trading Qs and trading VXX and trading UVXY. So trading the volatility products, trading the overall market products, trading more large cap stocks related to the market. I thought, and I wrote this, I thought we underperformed relative to the opportunity set. We squeaked it out in terms of P&L success, but I didn't like the way that we didn't take advantage of enough of the opportunity. So we've been talking about that to our guys. We've been talking about, hey, here are some of the tools that you ought to be looking at. And Dr. Steenbarger has been very helpful to our guys in reminding them and putting in front of them ideas for tools that work best when you're trading the overall market. So, here are 4 or 5 tools that you really need to be looking at to trade the overall market, and getting into that mindset to move away from some of those stocks that you had been trading to new ones, and being able to outperform this opportunity set. That's challenging. It's a very difficult thing to spend 5-6 years in a low volatility market and develop trading strategies to outperform in that low volatility market, and then be told, oh, you got to go trade all these things that you've been staying away from for 6 years because they weren't working, and you're going to have to dive in, and you're going to have to dive in with size. That's a hard thing to do.
Would you say that the reason that you underperformed, you said you still had a good month, but it wasn't as good as it could have been, and you felt as though the firm as a whole perhaps underperformed in February. That would be expected though, right? Because as you've described, there was 5 or so years where volatility was very low, and then it was almost like overnight it suddenly just changed. So naturally that's going to catch a lot of people off guard.
Well, I think that's okay for a little bit of time, but you asked what the challenges are for a trader, and I'm sorry, but you got to be able to adapt. You got to be able to shift gears, and all of us were sitting around saying, "Hey, we got to be trading the overall market," and you got to be able to perform. This is a performance sport, and our guys here, and I'm sure a lot of guys, out there understand that there are no excuses. When you underperform, you say it. When you underperform, you run through the reasons why you did, and you take the steps so you don't going forward. And you certainly don't want to sit back and say, oh, it was hard, you're right. But you got to get over that and start getting better and adapting real fast, or else you're gonna lose that opportunity.
Yeah. Just going back to speaking about a growth mindset, I think this is a really cool topic to go into. So I just want to ask one more question around that.
I would say one more thing, which is, and I do think, I don't mean to cut you off, Aaron, but I would say one more thing, which is, it's not just that the volatility is it spikes. There's a very real difference between the stocks that you're trading in a low volatility market and how they trade, and SPY, Qs, UVXY, VIX, and how those trade, even in a high volatility market. And you need to embrace that. They're not going to trade as fluidly or as directionally as some of the other stocks that you were outperforming in a low volatility market. And so there are real edge issues that you need to embrace, on top of looking at the right indicators, on top of having the mindset to attack different products because the volatility has spiked, that is very important.
Are you ready to get serious about trading? Then join Tasty Trade, Investorpedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including 0 commission on stocks, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, risk analysis tools, and more features to help you trade smarter. See equities and derivatives with high trading volumes, dividends, upcoming earnings reports, and more with their pre-built watch lists. Or create a custom watch list to keep an eye on the companies and sectors that matter to you. Manage your positions with speed and precision using active trader mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Visit tastytrade.com/chat for more info. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Have you ever watched a stock explode and thought, if only I had the capital? Or sat on the sidelines because your account balance felt too small to matter? Good news, with Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 U.S. listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with 0 locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
So as we were talking about the growth mindset, and this is something which you say, I think you even sign your emails off with it, you can be better tomorrow than you are today. And that ties in with the growth mindset. I mean, how can traders actually put that into practice? You know, like what is that something they can be doing today which is going to help them tomorrow? Like, how do you think about that and actually apply that every day? Like, it sounds good, but how do you actually put that into practice? Like, what are some actionable steps to make sure that whatever you're doing today is going to help you tomorrow, and then it, rinse and repeat?
So I thought we did pretty well in 2016, and as we were preparing for 2017, I remember talking with Dr. Steenbarger, who we're really lucky to be able to work with. And he's very instrumental in a lot of the things that we do here in New York. And so I was talking with Dr. Steenbarger about, all right, we did pretty well in 2016, but how are we going to do better in 2017? And he came up with an idea to start to ask the top traders to send a daily report card to him and to me, and for us to provide mentoring and coaching. So he would provide the mentoring and also coaching, and I would provide a lot of the coaching as well. I would stick to the ins and outs of the stocks that these guys were writing about, and he would stick to performance overall, and the overall market trading that some guys are doing. And so we developed, so I took that idea and ran with it, and we developed an exercise called the Daily Report Card. And it was, hands down, the MVP of 2017 for our firm. The MVP of 2017 was the Daily Report Card. And I spoke about this at a charity event, Traders for a Cause, and created an outline for how we do this. And at that charity event, I said, I challenged the guys in the room. I said, what if at the end of each trading session, you posted a trading report card and not just your trading P&L? And what if this became a prominent best practice for the online trading community? What if the report card focused on one monthly goal? Perhaps sizing or consistency, perhaps expanding your playbook, perhaps limiting losses. The report card would be your daily progress report on that goal. And you'd give yourself a grade for the trading session on that goal. And so you pick one goal, you work on it intensively, and that's key. You work intensively on this goal. You develop solutions to achieve this goal. So you don't just say, I messed up in sizing today, I should have been bigger. Well, how are you going to get bigger the next time? What are your solutions to get bigger the next time? And you complete a report card at the end of each trading session on the progress for that one goal. So for us, the MVP of 2017 was the Daily Report Card. And for guys who are thinking about growing as a trader, I'd recommend that they do that exercise, to do that Daily Report Card. And I know you're good friends with Austin, who is a Sydney-based hedge fund trader, and he posts his Daily Report Card online every day. And I think he's a tremendous role model. He's a terrific and very successful trader. Posting his P&L online, you can see how good he is. And he's a great role model for everyone out there as to how to grow as a trader.
Yeah, without a doubt. I often read his daily report cards as well. It's quite good. I mean, the way he sets them out and structures his card by sort of listing the stocks that he's traded that day or holding positions in, and then kind of writing a short blurb about each. Is that the way that you would suggest to do it, or does everyone kind of need to find their own way of sort of putting together a daily report card?
I think I like your idea a lot, which is finding your own way is always best. And in fact, it might be best for people not to write down a daily report card, but maybe just verbalize it to a trading buddy. So there's individualizing these exercises is always best. And remember, he's a very advanced trader. So his report card is going to be at a much higher level than a new trader. He's obviously a 7-figure trader. So you want to think about that too when you're thinking about putting your report card together. A newer guy, I think you want to think about a general thing for a newer guy would be to develop a daily process. What are all the things you're going to do during the day to get better? And then did you complete them? Did you go to the gym? Did you eat well? Did you wake up on time? Did you go to bed at the right time? Did you do your playbook trade? You do your book of charts? You do your charts after the close? Did you talk to your buddies about trading? Did you trade the right amount of stocks during the day? Did you prepare for the open? All of those things. Spend some time on yourself to feel good about yourself. Coming up with the daily process is generally a good thing for the newer guys.
Do you think it's important to share your daily report card with someone? I know Austin posts his on Twitter every day. Even if it's not on Twitter, do you think it's at least important to share it with somebody else or a group of people? Or, because it's very different if you do that compared to just kind of writing it for yourself and sticking it in the drawer, How do you feel about that?
So one of the things that we did pretty well in 2018 is we got better at team trading. And so team trading to us is, and I was reading one of your posts the other day, and you talked about Blair Hull, and he stated he has a philosophy that all great things happen in our world happen with teams, not with individuals. Mm-hmm. And we agree with that here, which is you're going to be a better trader when you're working in a team with other people around you. And I think one of the things we did well in 2018 was team trading. And so our senior trader on a desk, he will send his daily report card to myself and Dr. Steenbarger and then all of the people on his team. And I will respond with my thoughts on that person's daily report card, and Dr. Steenbarger will respond as well. And it gives the junior traders the opportunity to see what the senior trader is working on and see the solutions that the senior trader is coming up with to make progress. And what's really great about that as well is that it holds a senior trader accountable. The senior trader knows he can't mess up because the junior guys are going to see it, and it helps him not mess up as much because he knows he's got to write a daily report card at the end of the day and talk about his day. And so, if the senior trader is working on, for instance, not losing too much money, a lot of guys will talk about what's called the front side of a trade. So there's a stock and it's going up too much, and they think it's going to turn around and pull in. And they'll short the stock on what's called the front side, meaning it's still going up, and they're going to short into strength. And so, it's a pretty common thing for a very large trader that we, in fact, one of our best traders last year, we worked on this pretty hard, is that he was losing too much money on the front side. He was going to make all the money back eventually, but he was drawn down 50,000 to make 200,000. And what we wanted to do, and depending on the play, those numbers would vary, but what we wanted to do is have him lose less on the front side and then be able to have more risk on the back side of the trade when the stock is really showing the weakness, when the momentum is actually starting to go down, when the momentum is with you, to be able to make more money. And so if I'm a senior trader and I know that I've committed to a risk rule for how much I can lose in the front side, say $10,000. I can't lose more than $10,000 in the front side. And I've written that in my daily report card, and this is important to my progress as a senior trader. And then on a day I've lost $30,000. Well, it holds you accountable. Why didn't you follow your risk rule? Now, what are the things you need to do to make sure you don't violate your risk rule the next day? And those types of things really add to your P&L when you're a trader and when you're a big trader.
Mm. You also mentioned grading your daily report card. Is that a big part of it as well? And how do you actually think about grading the report card?
It is a big thing. And so different traders do this differently. Some people give themselves an A, B, C, D, E, or F. And another trader who is working on only taking trades in their playbook. I think this is probably something common for developing traders. So the second book that I wrote was the playbook. And the thesis of the playbook is that traders need to develop a trading business, and they ought to trade their trading business. And their trading business should be made up of stocks, of setups that they like the most. So an exercise we do on our desk is at the end of each day, our traders will archive a setup that made the most sense to them. The way that they archive it is in what we call playbook form. They write down the variables of the trade. So today, maybe they're really interested in the Match.com opportunity. Facebook announces that they're going to get into the dating space. What happens to the Match? Tanked. We'll call that a breaking news trade. So let's archive after a day like today, a breaking news trade. What are all the variables that went into it? There was a news catalyst. Here's what the technicals looked like. Here's what the tape looked like. Here's what the intraday chart looked like. Here are the trades that I could make. And let's now take that and put that into our overall playbook. And then we'll have a series of these types of setups that we'll put into our playbook. And that's our business. We trade those trades. We don't trade other trades. We trade those trades that we put in our playbook. And so a trader in their daily report card will grade themselves on how many trades during the session that they took from their playbook. And a common thing is guys will shoot for 80% or better of trades from their playbook. We're not perfect as traders. We all know you're going to sit in front of screens and you're going to dabble in certain trades that maybe you should not have. That's okay. You don't have to be perfect. But you should set a goal for what percentage of the trades you want to take. And so one of our guys will grade what percentage of the trades he took, which were in his playbook.
When you speak about a playbook, what's the format of this, and like how are you archiving plays in a way that's easy to reference? Like, is it a physical book, or is it kind of a folder on your desktop? Like, what does it look like?
So at the end of each trading session, our guys are archiving a setup that made the most sense to them. Those setups have variables. And guys go back and they decode and deconstruct the variables of that setup that they really liked. And they put them into this playbook. We call it the S&B playbook template form. And I wrote about this in the playbook, as I mentioned. But it consists of generally, what is the big picture for the given day overall? And let's make sure that we understand what that is when we're talking about the setup. So in this case, and in our markets, we got below a key SPY technical level yesterday, and we had been selling off and looking for a little bit of a bottom. So overall, we're in a weaker, shorter term market, pulling into looking for that support and still above the 200-day moving average. So that's an example of the big picture. And then we look at overall, what are the long-term technical outlook of a particular stock? Is it at a 52-week high and going higher? Is it at a 52-week low and going lower? Is it in the middle of a range? Where's the next technical support and resistance level? And then we'll look at what's the intraday chart setup showing us. Is it below the opening range? Is it above the opening range? Let's define that. We'll make sure that we understand the news catalyst in the particular setup. So what's the news that's getting people interested to trade this on a given day? We'll make notes of what the tape was telling us about this particular setup. We will talk about an overall trade strategy for how we attack this particular setup. And we'll talk about intuition. What were you feeling in the trade as to what direction it ought to move in? And so that is, and guys, as they get a little bit more experienced, they will add some variables to that. They might take some variables out. And a lot of futures traders have ended up using this for their trading as well. So they might take out a particular news catalyst for that wouldn't work. Maybe they'd have to look at the big picture a little bit harder. And so, but the idea, Aaron, overall is, and you touched upon this in your first question, who are you as a trader? What is your trading business? What do you do best? And the way that you figure out how you do best is, part one, start building your playbook. Start understanding the setups that you can trade really well. Start archiving them. When you write them down, you're internalizing them in your trading brain. They're easier to make in real time. It's easier to go and review your day because you can take a look at, did you make trades inside or out of your playbook? You can tag those trades and measure how well you did because they've got names. This is a breaking news trade in match. Let me measure how I did on that. Oh, okay. I made 5 points. Good. Here was a breaking news trade I made the other day when Citron came out with a hit piece. Okay, I made 4 points. All right, good. I like this. I do well in these breaking news trades. My stats back me up. And I'll give you a really good anecdote about this from one of our guys who is going to be our next 7-figure trader. Every time he passes me, I tell him that. And I'm going to keep telling him that until he actually becomes it. But I remember his first period of success, he asked to come talk to our floor manager and myself about a bump in capital. And I knew the trade that he was going to ask to get bumped up in. And I just personally am not a huge fan of this trade. And I was just like, I didn't want to be in the meeting. I was like, is he really going to ask for money on this trade? Like, this is just such a wuss trade. Like, does he really want to build his career around this trade? And it was an inefficiency trade. Anyway. And so I got to admit, like, before the meeting, I was just, not thinking this was going to be a good idea. And trader walks in, plops his notebook down, plops his computer down, his laptop down on our conference room, and says, here are the measured statistics of this trade for which I would like more capital. And his equity graph was like straight up. It's like, it was straight up. It was like, I kept looking at it. I'm like, we looked at each other and we said, yeah, we'll give you more capital for the idea. That's a great idea. And he's gone on to trade these types of setups bigger and bigger and better and better. And he, in this trade, could probably become a 7-figure trader as it is. He's working on other things, but he playbooked the trades. He measured the trades. He's got the data. It's undeniable. It was undeniable at the time that we ought to give him more capital. And so when you're sitting there at home, trading your money or maybe trading somebody else's money, and you're thinking about how do you scale up? Well, you should be able to prove it to yourself that you make money in certain setups, and you do that first by starting with those playbook trades.
Did I hear you correctly when you said something along the lines of he could potentially become, very potentially become, a 7-figure trader based off this one particular playbook trade?
Yeah, it's a type of trading. There probably would be some subsets of these trades, but this type of trading that he's doing and he was doing, 100% he can be a 7-figure trader just in that niche of trading. And all I do is every time he passes me, I'm like, trade bigger. That's all I say to him. Trade bigger. You're going to be the next 7-figure trader. I think he's getting a little annoyed at me for saying that, but I'm going to keep saying it until he is.
Right. Yeah, that's really interesting because obviously he was, very prepared when he came into this meeting, had all his stats and kind of let the data speak for itself. As a trader becomes more developed, I know this is a term which you've thrown around in the past, is becoming a bionic trader. And you spoke about it a little earlier about using technology to help you in various ways. Even as a discretionary trader, you can leverage technology. Can you speak about an example of how a discretionary trader can leverage technology?
So our firm, S&B, about 5 years ago, in a joint venture with the Kirshner Trading Group, started building out this New York office. And one of the things that really attracted us to this joint venture with the Kirshner Trading Group, and I know that you've talked to Andy Kirshner, and another division of that is a quantitative division, which is run by Morgan Slade at CloudQuant, was the technology that the firm was building. And so when our guys get good and they understand their edge, we want them to play more offense. We want to make sure that they're alerted to all of the setups that they really, really love. And so filtering technology helps traders spot and receive signals for all of the setups that they really, really love. And so they are, during the middle of the day and after the close, writing code, simple code, to make sure that their filters are finding their favorite setups. And this is a huge value add to their trading and a huge boost to their P&L overall, because it's ensuring that they're in the setups that they like the most. So they're making sure they're armed with this information that's alerting them to their best setups. And then another thing that our guys do, and a step further, is they may create a script for a particular setup that automatically gets them into a position. So let's just say you really love breakout trades. That's one of your favorite trades. And you're really looking for one particular stock to break out of an important consolidation. You can write a script and say, get me long if it does. And you can write a script that says, if anything that looks like this type of consolidation and it breaks out, get me long. And then I will trade out of it with discretion. And then certainly another thing that traders are doing more and more of, particularly the newer traders who are coming in, is starting and saying, all right, I want this filter, I want this alert to fire every time a trade like this comes up. But hey, let me take this, let me back test that signal in of itself. So I'm getting these really great signals. What if I just really did get in every time and didn't overlay my description? What happens if I just got in, create some exit rules? How would that do? And or let me just test an idea overall that I couldn't trade perhaps as a discretionary trader, but if the computer was just allowed to work, I could make some money. And so they're building, I think almost all of the, I wouldn't say all the guys, but a very large majority of the experienced traders have built models or partnered with junior traders to build models that supplement their trading. And then there are just some guys that have really moved away from discretionary trading and focused on building models. And certainly newer guys have done that as well. In our last class that came in September, there are two guys in our class who are doing very little discretionary trading and are almost exclusively working on building automated models. And so, I think the big picture is, as a trader in these days, as a discretionary trader with Edge these days, you really want to be armed with technology tools to help you make better decisions and to get into more opportunities that are your strength. And it's not a bad thing also to be working with junior guys who are building models for you that are on your P&L line. So, and I can tell you, and I mentioned this at the beginning, the training that we do for our new hires is substantially different than it used to be. And that teaching and that training of automated trading is a large part of our second part, trader development. Didn't used to exist 3 years ago that does now. And so that gives the person a career path of discretionary trader. It gives them the career path of hybrid trader. It gives them the career path of automated trader.
Now, as a trader is becoming more advanced and becoming consistent, starting to put up some decent gains, as an example, let's say they've grown a $10,000, $15,000 account over a period of time to $100,000. What things need to change for them to take that $100,000 account and turn it to $1 million? What got them from 10 or 15 to 100 Is that doing the same thing? Is that what's going to get them to $1 million, or are there some things which actually need to fundamentally change?
Yeah, in some cases, nothing. In other cases, not much. And in other cases, some other stages that they worked on. So we have had some traders who went from making $4,000 a month consistently to making over $100,000 a month consistently, pretty much doing the same things they were doing all along. They just did them bigger. They just made their trades with more size, and they consistently pushed themselves outside their comfort zone while still being responsible to handle larger size. So we like to think about guys understanding their edge and giving a certain amount of risk for their trades inside their risk book, and then not really doing anything different after a period of success other than just us increasing their buying power and us increasing their risk loss. The percentages of their intraday stops are the same. So, let's just say you had $1,000 of intraday risk, and on your best trades, you risked 20% of your intraday loss, and you had a really wonderful period of success. And we wanted to bump you up. We might bump you up 20% the next month, and your risk loss is $1,200 for the day. And for your best trades, you just risk 20%. You do the math, figure out you keep progressing that way. You don't really do anything different. You're just trading your best setups and just moving doing the math to how much more risk that's going to be, but your percentages are really the same. And so it's a little uncomfortable for guys to trade a little bit bigger, but they get used to it. And I think people tend to go from $1,000 of risk to $5,000 of risk, and that's a really bad idea. Trying to bump yourself up too quickly will bring a car crash and some trauma that will cause you to take some steps back. Bumping yourself up by pushing yourself outside your comfort zone and responsibly doing it, maybe at a 20% larger clip, is a good way to do it. It's a common way that our guys do it. So a lot of the guys haven't done much. I would say that, there are also guys that have added breadth to their trading. So they've looked at where they've had success in the past and applied that to different types of stocks. So they may have had success in one type of stock, and they'll take their favorite trades from that one type of stock, and they'll try and apply it to a more scalable opportunity and grow from there. They might also decide to start using options to supplement their trading as well. We've seen some really nice progression from our top traders by not just expressing their ideas with stock, but also expressing their ideas with options. And so that sophistication of how they express their ideas can also help them take steps in progress.
Yeah, I'm pleased you brought that up, actually, because I remember you mentioned breadth at the beginning is one of the kind of the stages or steps that you get to thinking about the breadth of your trading. And yeah, obviously very important. Just one last question around this, and then we'll wrap things up here. But getting to a seven-figure trader, how much of it is a mindset factor? I know we spoke about having a growth mindset earlier, and that probably ties into this, but do you think that some people, they want to make $1 million, like they can say that, but psychologically perhaps doubt their own ability, or it seems too far beyond the realm of possibility? If that's the case, how do you overcome that?
So I've written about this in the past. I call it small wins. And so you don't want to think about going from $0 to $1 million. You want to think about going from 0 to being able to make $1,500 in a month. I actually would take a step back. When you first start trading, a very common step is you lose too much money. And a real step in progress is to lose less. It's a real step in progress. And a real step in progress is to trade flat. And a real step in progress is to make $1,500. And so after you make $1,500, you set the next goal. Maybe I want to make $4,000 in a month, and then maybe I want to make $10,000 in a month. And so you want to be thinking about what are the things you need to do to get to that next realistic step in your development. And it is a process. We find on our desk that it takes until year 3 before traders are going to make substantial P&L. And you want to come into this game being realistic about your learning curve. You can make some money in year 1 and you can make good money in year 2, but what we're seeing at our desk, guys have all these resources. They get to work with Dr. Steenbarger. They get the best technology in the prop space, both on the front end side, and you can't use our technology unless you trade at our firm, and on the automated side, and you get all the coaching and all the mentoring and plenty of capital to use at the firm. And you have these experienced traders who you can learn from and watch them trade in real time, and it still takes some time to get good at it. And you get the firm backing to make sure you can support yourself through those years, but it still takes some time. So I don't think about trying to go from the 1 yard line to across the from the 20-yard line to all the way across the field to the other team's goal line. I think about, how do I go from the 20 to the 30? How do I get from the 30 to the 40? How do I get to the 30? And just keep plugging away and put your head down and keep working. And it's easy to get from the 20-yard line to the 30-yard line. It's really almost impossible to go from the 20-yard line to scoring a touchdown. So that's what our guys are doing. And that example that I used with one of our top traders who wants to be a $10 million a year trader, he was a 7-figure trader 2 years ago. Before that, he went from a 0 to a 4,000. I remember pushing him when he was about a $8,000 to $10,000 a month trader. I remember pushing him and challenging him to make $30,000 in a month, and getting him to commit to that. And I remember him then doing that. And then he got to the point where he netted $1 million, and then he got to the point where he netted over $2 million, and now he's pushing himself to make even more. But he's taking those incremental steps, and to be a $10 million a year trader, he knows he has to take these incremental steps. And so focus on those incremental steps that you need to take to get to that next level.
Yeah, that's brilliant advice, Mike. And I just want to say something to everyone who's listening to this right now. Like, I don't want you to just listen to this episode for entertainment purposes and be like, oh, that's nice, and sort of carry on as you were going. Like, actually go over this a couple times, take some notes, because there's a lot of actionable strategies and tactics that you can actually implement. And I know, it will make a difference, as it has done for the traders at Mike's firm. So, Mike, I want to say thank you very much for coming on the podcast again for a second time, and giving up your time to share a lot of really valuable, helpful information. So thank you.
Well, Aaron, I want to say thank you to you too. I started writing a bunch of blog posts many, many years ago to share with the trading community, because I felt like I had a unique voice that I wanted to share. And I certainly appreciate when other people are doing that as well. And you're one of those other people, obviously. You've put together a voluminous library of learning for the trading community with really terrific guests that new traders and developing traders can sift through to come up with really good ideas. And as you said, you listen to these ideas and then implement them. They will help you get better. So I really appreciate the help that you're doing for the community and the opportunity to talk with you and your community.
Yeah, it means a lot. Thank you very much. And I should point out the few names we spoke about earlier on in this episode, you can hear on previous episodes of Chat with Traders, Brett Steenbarger, Morgan Slade, and Andy Kirshner. All three of those guys have been on the podcast previously, so you'll find links to those episodes in the show notes. Mike, if someone wants to find out more about yourself, read some of these blog posts you've mentioned, where's the best place to go?
If you want to read my blog post, you can go to smbu.com/blog. If you have a trading question, you certainly can shoot me an email, mbellafury@smbcap.com.
Okay, and you're on Twitter as well. What's your handle?
@MikeBellafury.
Cool. All right, Mike. We'll leave it there. Once again, really appreciate your time. Thanks very much.
Thanks, Aaron.
You've reached the end of this episode of Chat with Traders, but rest assured there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes, and we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
Chat with Traders is brought to you by Trade the Pool. Did you know that every decade the market reinvents itself? Online brokers opened the doors, mobile apps made trading seamless, and commission-free trading erased barriers. Now, a new era has begun. Meet Trade the Pool, limited risk trading. And now you also have unlimited time to reach the profit target. From now on, your trading risk is capped, and your trading opportunities are limitless. Trade the Pool funds home-based stock traders with up to $200,000 in buying power. That means you can trade larger positions and scale your strategies without risking your own savings. It's time to trade with more capital, making it truly worth your time and effort. Ready to trade the pool? Click the link in the description and join the stock trading revolution today.
Are you ready to get serious about trading? Then join Tasty Trade, Investopedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade all in one platform. Get low commissions, including 0 commissions on stocks, so you can keep more of what you earn. Trade smarter with advanced charting tools, a pre-built strategy selector, risk analysis tools, and more features. Visit tastytrade.com/chat for more information. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC.
Markets, speculation, and risk. This is the Chat with Traders podcast, hosted by Aaron Fifield.
Hey ladies, hey gents, I'm Aaron Fifield, and welcome to a special episode of Chat with Traders podcast. This episode was recorded in June 2018 in front of a live audience in Sydney, and it's a conversation I had with John Moulton, though most will know him better as Rambo, particularly those who used to trade with him in the pit. John's a serious trader, and for good reason. He's considered to be somewhat of a legend trader here in Australia. In short, John left the Chicago trading pits in the 80s, bound for the Sydney Futures Exchange, and in the years that followed, he became a very large spread trader of government bonds and bank bills. He was responsible for a major share of the trading volume done each day. Now 40 years on since placing his first trade, John is still an active market participant, trading from a coastal location in Queensland, Australia. There's only been one other time in John's career when he's done any sort of media, and that was roughly 20 years ago when he featured in a documentary about the Sydney Futures Exchange. So it's very cool and a true honour that he was willing to take part in this and openly share his market wisdom. Also, if you'd prefer to watch this episode rather than listen to it as a podcast, you can find a video on the Chat with Traders YouTube channel. By the way, I will say sorry my audio's not crystal clear in this episode. Like I mentioned, it was recorded live, but John's audio is pretty good, and that's what really matters. On that note, I present to you John Moulton, aka Rambo. This might be somewhat of an unconventional interview. I'm not sure exactly how it's going to go. I know John has some of his own ideas, but I'm probably just going to start by asking a couple of questions. We'll see how it goes. We'll keep it casual. We'll have a bit of fun. He may ask the audience for a few questions, so be alert. He might fire something your way. But yeah, I mean, John, tell us a little bit about how you actually got started in trading. I know we're going back to the 80s. We won't spend too much time on this, but just a bit of context for everyone in the room.
We're actually going back to the 70s.
Okay. We keep going back further. Well, yeah, fill us in. Bring us up to speed. Like, where did you get your start? Were you trading in Chicago?
All right, we're going to keep this brief because I don't want to talk about myself too much. I'd rather talk about what's happening right now with these people here. So I'm happy to do this for a couple of minutes, and that's it. I started trading at the Mid-America Exchange in January 1978. The Mid-America Exchange is an exchange in Chicago that wasn't one of the primary exchanges. The primary exchanges were the Chicago Mercantile and the Chicago Board of Trade. The Mid-America Exchange traded in smaller increments, so it was a much cheaper way to get involved with trading. For example, I wanted to trade soybeans. At the Board of Trade, soybeans are traded 5,000 lot increments, 5,000, 10,000, 25,000, 635 lots. Everything's increment of 5,000. At the Mid-America Exchange, everything was 1,000. So you could trade a 1 lot, a 2 lot, an 8 lot, a 12 lot. The prices came across on a price jet. These prices were being sent from across the street from the Board of Trade on a price jet in a random sequence. And we bid and offered basis the prices we saw coming across on a price jet. Really crazy shit. Hard to believe nowadays, isn't it? Anyway, that's where I started, trading 1s and 2 lots in these little contracts at a Mid-America Exchange where the seats cost $12,000. My mother gave me the money, and I put $2,000 in a trading account. There you go. That's how I started.
$2,000. So, I mean, I know you don't want to spend too much time on this, but it's incredibly impressive that you were able to, at a later stage, like I'm sure if there was a few years between that point and when you became a very large portion of the volume that was done on the Sydney Futures Exchange, like how did you work yourself up to that point?
Well, we're talking about floor trading. Right.
Correct,
okay.
Yeah.
Floor trading. I was tailor-made to be a floor trader from this big. At university, I scalped tickets to all the football games, basketball games, hockey games at the University of Wisconsin. I was a ticket scalper. I played poker till 4 o'clock in the morning. I love taking risk. And when I first saw the futures floor, I knew that was my destiny. It's as simple as that.
But how did you scale up?
Well, big balls. I was always an overtrader. I should have been trading 5 lots. I traded 20 lots. I should be trading 20 lots. I traded 50 lots. I should be trading 50 lots. I traded 200 lots. No fear.
And did that ever hurt you at any point? So I imagine you can't.
Yeah. I went broke a few times. Sure.
You went broke.
Yeah.
You lost all your money.
Yeah.
How many times did that happen?
Twice.
Can you walk us through what maybe led you to blow up? Like, I know you said you were trading too big a size.
Yeah, well, it catches up to you. I mean, when you first start learning how to trade, and all you guys are traders here. Anybody here not a trader? No, nobody. That's good. I'm in a room of traders. Everyone here knows this. You start out small and you work your way up, right? That's what you do. You start really small and you work your way up. It's like climbing a ladder, 2 steps up, 1 step down. You're used to trading a 5 lot, say for example. You're used to trading a 5 lot. Is the first time you try to trade a 10 lot, you're going to lose every time. Okay? Then you say, okay, but I know how to trade a 5 lot. So you go back to trading a 5 lot. Then A month or two later, you say, I'm going to have a go at that 10 lot now. And this time it works. And then you go, okay, I can trade a 10 lot now. Now I'll try the 20 lot. First time you try a 20 lot, you lose. And so on and so on and so on. So, you got to learn how to lose. I'm sure everyone in this room knows how to lose, right? It's very important. I want to talk about this later. Losing is extremely important. Winning's easy. Losing is the key to trading. Your turn.
When you went broke those couple times, did you ever doubt yourself that you could make it as a trader? Like, were you contemplating whether you should maybe look for a different career?
Never. You're in your 20s, and I just had a lot of self-belief. A lot of self-belief. It's actually interesting looking back on it because it's a real balancing act between believing in yourself and having a bit of an ego, but not being too big of an ego where you are your own worst enemy or you get greedy and shit like that. You have to really know yourself. And the sooner you can get a real handle on who and what you are, you play to your strengths and you work your weaknesses out of you.
Okay, so after those couple times you went broke, was there a point where things began to click for you, where you felt as though, okay, I'm not going broke again? What changed? What changed to stop you from going broke again?
I'll give you an example of one of the times I went broke, okay? I bought a board of trade seat in January 1980. I was sponsored, and it was a co-signed loan with a gentleman by the name of Bob Collins through the Continental Bank in Chicago, the now defunct Continental Bank in Chicago. And at that time, I had about $25,000 a seat to board of trade. You couldn't rent seats in those days. The only way to gain access to the floor was to buy a seat. The seat at that time was about $212,000, a lot of money in 1980. I had a bid in for the seat of the third week of January of 1980. And that weekend, Bill Clinton put a grain embargo on with Russia. No trading any of the grains Monday, Tuesday at the Chicago Board of Trade. I went, shit. These seats are going to head south. I went in, tried to cancel my bid for the seat. As soon as the doors opened, the Board of Trade, I'm in there, cancel my bid. My bid had already been hit, $212,000. By the end of that day, seats were trading for $185,000, right? Over the next 6 months, seats went down to $135,000. Now, I'm in at the price up here. Most of the money's borrowed. And then to add insult to injury, I wanted to be long soybeans. I saw a spread between soybeans and wheat, and I wanted to be long soybeans and short wheat, right? It's just the spread I wanted. It wasn't working. By mid-June of that year, I was about $30,000 in the hole in my trading account. You have to understand, in Chicago, you can trade with a debit. I know it sounds crazy, but if you're a member of the Chicago Board of Trade or the Chicago Mercantile Steel Exchange, they gave you the grace of trading with a debit. Everybody did it. They just did it. That was just old-fashioned shit. That's what they did. So I walked into Bob Collins' office, and I said, I was about to say mate. I didn't say mate. I said to Bob, listen, I can see that my account's debit. And I'd organized to go to Europe to play golf with this friend of mine I knew since high school. He was #1 man on the Northwestern golf team for 4 years. And for 6 months before that, we'd organized this golf trip in Scotland and England the first 2 weeks of July. And I said to him, listen, I'll cancel this trip because I can see I'm in the hole here. I'm broke. And he looked at me and says, John, don't worry about it. You go on your golf trip and you come back and start trading whenever you want. I was like, wow, that's cool. Okay, I'll go on the trip. And I left long a mere little 3 lot at the Mid-America. I was long 3,000 bushels of soybeans, right? In the 2 weeks I was in Scotland, and you have to understand, there were no cell phones, there was no telephones. I was getting, my price dissemination was coming out of an orange newspaper that came out of London that was called the Financial Times. And it was on a day and a half delay. And all of a sudden I saw soybeans limit up. Next day, soybeans limit up. I'm like, fuck, I want to go back. And by the time I got back to Chicago, my little 3 lot had paid for my holiday. We're in the midst of a massive bull market. In between the second week of July and the first week of September, not only was I out of debit, I had my seat paid off.
Just real quick, can you explain how the seat situation works? Like, why did you need a seat? Just for a little bit of context for everyone who's unfamiliar with how that all works.
I'm going to sound like an old fuck now, sorry. In those days, the only way you could really trade was on the floor. Otherwise, you're sitting in a broker's office looking at price information that's anywhere from 5 to 10 minutes old. Okay? You know, like if you're just a position trader and you just want to have a position, that's fine. But if you want to be a scalper, a day trader, you had to be on the floor. You just had to be.
Were you always a day trader from the get-go? Like that's just naturally what you gravitated towards?
Absolutely. Scalper, day trader.
Yeah, okay. Let's go back to the point you made where you spoke about how it's important to lose. It sounds like you've got a few things you want to say about that. So let's hear it.
Well, it's just my observation the last couple of years of my life that a society in general doesn't really teach people how to lose. They teach you how to win. Winning's easy. Everybody knows how to win. You know, they see LeBron James win a basketball game making the last shot. He knows how to win. He's a winner. Winning's easy. But is there anything in society that teaches you how to lose? Is there a course at university you take that says, hey, come take this course, we're going to teach you how to lose? Engineering. There is one thing that will teach you how to lose, and that's organized sport. Because in organized sport, you will lose. Okay? That's the only thing I can think of that teaches you how to lose. Other than that, you have to figure it out for yourself. You really do. And losing and how you deal with losing is extremely important in trading. Because winning, I'm telling you, is easy. That's easy. It takes care of itself. The key to trading is learning and figuring out how to take a loss and how you deal with that up here. Do you hang on to it and let it bother you? Or do you release it and let it go? All I can say is that you need to learn from when you're trading, you have to learn. And you can learn from being correct and say, I did that correct. And you learn from that. And you can also learn from when you lose. And when you lose, you have to experience the loss, feel it, learn from it, and spit it out and let it go. And focus on the next trade. If you hang on to a loss too long, it will pollute you. It will not allow you to make the next trade. And you have to focus always on the next trade. The next trade is the most important trade in the world. Not the last trade, or the trade before that, or the trade before that. Just let the trades happen and focus on the now of trading.
Do you have the belief that each trade is individual of itself? Like there might be times where you're actually going through a rough period. Do you still treat every
Why
trade?
are you so negative?
I'm not, but we're talking
period.
about losing here.
No, that's true. I mean, the way I've always traded, I don't want to use the word high frequency because you guys have algorithms that are high frequency trading algorithms, and I'm more of a hands-on trader. And what I'm always doing is I'm focusing on the next trade. I don't think about the trade before it, and I'm not analyzing the risk I just took with that previous trade. It's just a fucking trade. I don't care. You know, it's just put it in the books. Let's get on to the next trade. And because I'm mainly a spread trader, so I'm buying here and I'm selling here, I'm trading 20 different things all the time on the bid and offer, blah, blah, blah. A lot of times I have no idea what I'm doing. I'm just trying to make good trades. And then the market closes and I go, I wonder what my position is. Let's look at that position calculator. I look at the position and go, well, okay, I'll get that up on the chart. I'll get that up on the charts and see if that looks good. Oh yeah, it looks good on the charts. I like that position. I might keep that for a day or two. You know, like what motivates me to make trades is when I'm looking at the markets is a lot of different things. It has to do with relative value. It has to do, is there a buy program in the 10 years? Is there a sell program in the 10 years? Are these spreads reaching historical levels? Are we getting near expiration now? These spreads historically have a tendency to move a certain way going into expiration. So there's a lot I'm thinking about when I'm making trades. But I don't dwell on what I've done. I never dwell on what I've done. Ever.
When you're talking about learning how to lose, I mean, I know who here has been trading, let's say, less than 2 years?
Who's been trading for more than 10? Ooh, cool, young crowd. That's cool.
So I imagine, especially for newer traders, that's a very strange concept to put forward. Yeah, learning how to lose. How would you actually know if you've learned how to lose?
You stop doing it. you don't lose as much and you lose less frequently. And then you say to yourself, maybe I'm getting this now. Okay? But you're going to lose. So I don't dwell. once again, I'm repeating myself, but I'm so focused on the next trade. This is real Zen shit, man. This is like living in the now and spitting out what's happened in the past. If you're a Zen Buddhist, if any Zen Buddhist here, you'll make a fortune trading. So what you're trying to do here is you're trying to focus on the absolute moment of the price information that you're getting off the screen. And that's what you're focused on. And everything that's happened before that, you can look at it later, but in an active market, when you're trading, you want to be focused on the now of the price action that you're looking at. And if you're dwelling on other things that have happened in the past, it's gonna keep you from doing that. It's as simple as that. As far as losing is concerned, I mean, like, when do you really actually realize that you've lost money? Well, it's when you get your statement the next day and you look at the total equity at the bottom and you say, fuck, I lost money yesterday. But I don't do that. I've gone months and months without looking at my statement to see if I've made or lost any money. I've gone months with that. One of the things when I first started trading, like a lot of you guys are new traders, I had to keep track of how much money I was making on a daily basis. I used to go from Chicago on the Chicago Northwestern trade up to Lake Forest every day. It's about a 45 to an hour train ride, depending whether I'm taking the express train or not. And I'd sit down, I'd count every trade I made and figure out exactly how much money I made or lost on the day. I did that for a few years, right? So it's an evolutionary thing. When I first started trading, I really wanted to see how I was doing on a daily basis. Right? It was important to me. Then I realized after a period of time that it wasn't so important. Then I got to a point where I said, actually, if I can completely divorce myself from money, I'm going to be a much better trader. I know that's hard to do, but I'm telling you now, if you can get away from the money aspect of trading and just focus on the market and making good trades, you'll be distracted by less things. There you go. I mean, I'm at a point now, and I have been for about 15, 20 years, where I just don't care about the money. I get a monthly statement now. I'll look at a monthly chart of where my equity's been, and that's it. I don't look at daily statements. I look at nothing. I'm focused on my position and the trades I want to make, the trades I'm making.
I feel like in your answer there, you may have, or this may be a good point for me to ask you about your comet analogy. I know anyone who's seen the Bulls and Bears documentary, I think it's in one of the opening scenes, isn't it?
Yeah.
So let's hear a little bit about the comet analogy and how that applies to your trading.
Well, it's kind of like what I just said. I mean, the tail of the comet is looking at charts, and I'm a chartist. I love charts. That's why I don't listen to fundamentals. If the non-farm payrolls are coming out, I don't go, what's number? I don't give a shit. I can see by the price action of the 30-year bonds in the States what it's done to the market. I'm only interested in what all this information is doing to the market. So with the comet analogy, and by the way, that's my old material. I got much better stuff than that. It has to do with, like, the tail of the comet is what you can see when you look up in the sky. And just like you can look at historical charts, you can look at a daily bar chart and you can see what it's done, going back as far back in time. But that comet's moving. Just like the prices that you're trading are moving continuously, moving across that screen. Prices are changing. And looking at the historicals is okay. But really, trading is about being right there in the momentary instance of price creation. Being involved with the second by second price creation. And that's the front of the comet, I suppose.
So do you have a new analogy for that?
No, not right. Not off the top of my head, mate.
Okay, sure. All right, well, let me ask you, there are some subjects which you might like to talk about. I think maybe we can tap into, how long have you been trading? You said you started in the 70s.
Just over 40 years.
Okay, 40 years. So, let's make the most of that and tap into some of the insights which you've gained over that time through hard lessons learned, etc. What are some of the lessons? I know this is a really cliche sort of thing to say, but given someone like yourself who's been doing this for 40 years, I think it might be an interesting subject to go into. What are some of the lessons which you would like to pass on to a younger group of traders?
Believe in yourself. Self-belief. Real big. Real big. Don't quit and never lose all your money. It's like a poker game. You lose all your money, you have to leave the room. Go away. Come back when you have some more money. So Yeah, and that's just very simplistic things to say, but it's really true. Stay in the game and really believe in yourself. It's a real balancing act between having too big of an ego and not having enough of an ego, you know? And you got to know yourself really well. You got to know what your strengths are, and you have to know what your weaknesses are. And it's a real game of inner exploration up here. And I find it interesting now we're all trading from screens. The screen's over there, and I'm here. You want to externalize the experience of trading? Real easy. The screen's over there, and I'm here. But you shouldn't be doing that. You should be internalizing the experience of what you see on that screen into here. Internalizing it. It's not you against the machine. The machine should be part of you, metaphorically. I suppose it's viewpoint. One of the things I would like to talk about a little bit is observational skills. In order to be a good trader, you really need to work on your observational skills. Very important. You need to notice what the market is telling you. I don't make a whole lot of decisions on trade. I don't sit there and go, based on the charts, the 10-year bonds are going to this level. I let the market tell me what to do. I don't buy the bonds unless the market's yelling at me, buy the bloody bonds, you idiot. And then I buy them because I let the market tell me what to do. I kind of divorce myself from my opinion, and I let the market tell me what to do. My opinion is guided by what the market is telling me. How do you figure out what the market's telling you? You have to watch it very closely, but not too closely. Sometimes you can defocus from it and sit there and let your eyes drift away from the screen, and your subconscious brain will be picking up on what's there. And you look back at it and you go, I know what to do now. Use the power of your subconscious mind, your intuition, and the power of observation will really, really help you. Intuition, observation, really, really potent tools for being a good trader.
How do you learn that stuff? Is it purely from sitting there in front of the screen and just building up your screen time? Or are there exercises you can do away from the market? Which
you practice your power of observation every second of your life. I'm looking around here right now and I can see these wooden rafters. I can see the lights over there. I can see about how many people are in this room. My eyes are wide open all the time. And I love looking around. I love just walking on the beach with my eyes open, looking up at the clouds at nighttime, looking at the stars. Just use your power of observation continuously in everything you do in your life. Every waking second, notice what's around you. Use your observational skills. Then when you look at that computer screen, it's going to be so much easier to look at it, focus on it, and make decisions. So you have to practice your observational skills, especially nowadays with social media and everyone I was in the airport this morning. Everybody's on their bloody iPhone, a computer screen. Might put it away and have a look around. If you focus all your attention on one thing, you're not doing justice to your brain. Let your brain work the way it was intended, the way it was made for you. Utilize and hone your observational skills and let your brain do what it wants to do. Your brain wants to be flexible. Your brain wants to work for you. It can't wait to make great trades for you. All you have to do is let it do its thing. Don't stand in the way. What does this mean? You have to have a really open mind. You got to be non-judgmental. You have to open yourself up to everything and utilize the fact that your spirit inside you wants to be open and free. I'm getting really philosophical here, but we all have it in us. Every single human being can be a good trader. I have absolutely no doubt about that. It's inside every one of us. We just got to learn how to find it, dig it out, and don't let anything stand in the way. Don't let any dogmas come in between you and yourself. Get to know yourself really well. It's a great thing about trading, guys. You're going to get to know yourself really, really, really well, and you'll become a better human being for it. The life lessons I've learned from trading have manufactured me into the person I am now, and I like who I am, and I like to think I have an open mind, and I like looking at things, and I like life.
I love it. These intuition and observational skills which you talk about, when do you feel as though, like if a trader is there watching the market every day, how long, if they're doing this day in, day out, do you think it should take for them to sort of feel like that, as cheesy as it sounds, almost like one with the market, like they can really feel when it's screaming at them, telling them to buy the 10-year bonds or whatever?
Well, you'll know. You'll know. It'll just pop into your brain, you know? A lot of times, not all the time, but sometimes I'll be just sitting there and I'll just kind of go into a bit of a Zen moment. I'll empty my mind out of all thought. And I'm not kind of focused at the screen, but I'm not really focused at the screen. But I know that my subconscious is looking at that screen. I'll just kind of zone out for 10 minutes, empty all thoughts out of my brain, come in front of the screen. And all of a sudden, I'll come out, I'll look at the screen, and I go, I knew what to do. That was so easy. Practice a little bit of meditation. Learn how to empty all thoughts out of your head. Are you guys, anybody here have a sleeping disorder? No, you don't have a sleeping disorder. They're really bad. Learn how to completely empty all the thoughts out of your head, and then you can fill it up with the ones that are important. And if you're a trader, okay, let it flow out of you and fill it up with whatever you want looking at that screen, and your brain will do it for you. It really will. The trend is your friend. The market will show you its direction. It gives you little clues. I was talking about this with a bloke from Macquarie Bank today. Anybody here trade the 3-year bonds against the 90-day bank bills in this country? There's one there. There's a couple over there. Good on you. Good on you. I trade that too. In August 8th, 9th, and 10th of 2007, there was a major divergence between the 90-day bank bills and 3-year bonds in this country, to such a point that I was flabbergasted. The price relationship always moved within a certain band, and now it had just gone ballistic. The bank bills were losing against the 3-year bonds massively. I called up one of my friends in Sydney and I said, what's going on? He said, well, you do know what you're trading, don't you? And I go, yeah, of course I know what I'm trading. He goes, well, tell me what you're trading. I said, 90-day bank bills. He goes, 90-day bank bills. I went, yeah. And what's the other thing you're trading? I said, 3-year government bonds. Right. So the banks are in trouble. It would appear the market's telling us that the banks are in trouble. And people are fleeing bank debt and moving it into treasuries, safe haven stuff. This occurred 13 months before the stock market crash. Completely tipped the whole thing off that was going to happen. If you were listening and watching the market, you would have seen it, and you would have said, bloody hell, something's up here. Something's up. I'm not making this up. The market was just saying that to me. Something's going to happen here. Okay? So the market will really help you out if you watch it and listen to it. It'll show you direction. In a big trade like that was monumental. I mean, it's one of those things that I'll always remember for the rest of my life.
What year was this?
August 2007. I got the year wrong, sorry. August 2007. So it was a full 13 months before September 2008 when the shit hit the fan.
How did your trading change during that period?
Well, that's another thing with trading. You have to change with the markets. I don't care what algorithm you built a black box. If that thing doesn't morph with the markets, you're doomed. You have to, and I have nothing against people with algorithms and trading systems that they plug in and just the computer does all the work. There's nothing wrong with that. But most of them over a very long term stop working because the markets are always changing. They do. They completely change. You know, in 2011, the exchange called me up and said, are you worried about these algorithms that are coming to the market? I said, no. Why should I be worried? Only 3 things you can do: buy, sell, or do nothing. And now it is unbelievable. Like you have to have an algorithm to trade. You have to. Well, there's a monumental change in the market. So you have to change with the market. And if you are stubborn or you're closed-minded, it's not going to happen. It's very, very important to change with the markets. What did I do in that scenario? I stopped trading the spread. It was out of control. And I had no idea where it was going to go next.
So you were taking more directional trades?
Well, I stuck to bill spreads.
Okay.
And trading the curve.
Right. Okay.
Are you ready to get serious about trading? Then join Tasty Trade, Investorpedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including 0 commission on stocks, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, risk analysis tools, and more features to help you trade smarter. See equities and derivatives with high trading volumes, dividends, upcoming earnings reports, and more with their pre-built watch lists. Or create a custom watch list to keep an eye on the companies and sectors that matter to you. Manage your positions with speed and precision using active trader mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Visit tastytrade.com/chat for more info. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Have you ever watched a stock explode and thought, if only I had the capital? Or sat on the sidelines because your account balance felt too small to matter? Good news, with Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 U.S. listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with 0 locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
I think a subject which would be really interesting, I know you kind of hinted on this a little earlier, is your appetite for risk. You said it was kind of natural from the beginning. You had this appetite for taking risk. To a lot of people, that probably doesn't come quite so natural. Do you think it's something which can be learned?
It's only risk if the firm you have money with is demanding margin money from you. Then it's risk. But if I'm not asking you for any money, who cares?
Is that possibly why you blew up those couple times?
Probably. I've always been very lucky. They've always allowed me to overtrade because I'm a classic overtrader. I always traded far more than I should.
How do you know when you're overtrading? Like, because obviously you just do huge volume naturally. I mean,
because I only have $100,000 in the account, I'm trading 1,000 lots.
There we go. And going back to an earlier point, you said, and I should not gloss over this because it's a pretty bold statement. You said you must have an algorithm to trade.
Well, you don't have to. I don't.
I know, but what made you say that?
Because it has to do with assuming risk or taking risk. Do you guys know the difference between assuming risk and taking risk? Anybody want to have a crack at this one? What's the difference between assuming risk and taking risk? Anybody? Okay. I'll explain it to you real simple. A casino assumes risk. You walk in the door of a casino, it's sitting there with its doors open. It knows the odds are in its favor. It can't wait for you to come in and bet your money. You're taking the risk, and they're assuming the risk. They're happy to do that. Okay? For a lot of my life as a trader, I was the one assuming the risk. I didn't care whether you bought or sold from me. I'd make a market and I don't care, buy it from me. Good luck. Sell it to me. Good luck. I was making a two-way market in everything because I had built into my head the idea that I was getting an edge if I could buy at this price or I could sell at this price. I was getting an edge. Those edges don't exist anymore, especially in the 5th, 6th, 7th, 8th bill month. There's always 300 to 500 on the bid and offer. So, in 1989, how's the 4th bill month, John? 85 bid at 95. What do you want to do? How hard is that to do? Now it's 88 bid at 89, 500 aside. So, unfortunately, because I don't have an algorithm. If I had an algorithm that completely that stacked me up in the ladder where I could get queue priority, if I had an algorithm that could cancel my bid or offer in a nanosecond like everyone else has, maybe I could go back to making markets like that again. But I am not fast enough with a mouse to cancel bids and offers without getting steamrolled. And that's the problem I have. So now I'm a risk taker. I'm not assuming risk anymore, which I'm not completely happy about. But I'm morphing into that, and it's a challenge for me. So there you go, mate.
So by being a risk taker, you're essentially saying that you have less of an edge nowadays?
There is no edge. The only edge I have is my ability to listen to what the market's telling me, my experience, and I go from there. I mean, you look at a bill month and it'll be like 95 bid for 5,000, 200 offer at 96. On 50 lots of the 200 at 96, I'll get these. There's 5,000 on the bid. No, there's not. There's really only 300. All those other bids in there have been put in by an algorithm. And in a flash of a second, because the eyeball only works 1/27th of a second, this is milliseconds. It not only his bid is gone, there's now 5,000 on the offer at 95 because everyone's piling over the back of each other with their algorithm to get on the offer. So I have to start hitting bids and offers that I reckon are value for me, and it's the trade I want. And in the old days, I could just sit there and someone would eventually buy the 96s off me. Do you understand what I'm saying? How many algo traders here? Hold your hand up. 1, 2, 3. Only 3? Come on, guys. How many algo traders really here? Okay. So there's not that many members of the evil empire, is there? Okay. Well, that's kind of cool. I thought there'd be a lot more algo traders here. What kind of algo do you have? Can you tell me about your algo? No. See how tight-lipped they are about it?
Yeah, here, take them.
Talk about relative value and the trade. What I'm interested in is the entry on one of your legs might be aggressive now. What about the other leg? So you're trading SPY S&P. Are you willing to be passive with the algos on the chance that you're going to get set, or have your costs kind of doubled because you've got to cross both spreads?
Well, good question. It's all about feel for me. And number one, I don't worry about commissions. And that's another thing you guys should do. Fight for every dollar with whoever you're trading through for every commission dollar. So nail them down. Your biggest cost of trading is paying commissions, mate. And just screw them down as far as you can in the commissions you're paying. It'll pay off in the long run. So I don't care about paying extra commissions because I've pretty much screwed it down to next to nothing anyway. But,
the market cost.
Sorry, you mean the market cost? Market cost. I don't perceive it as market cost. I just perceive it as am I going to get it the price I wanted at? No, I'll have to pay up a half tick. That's okay. It doesn't bother me to do that. If I want the trade, I want the trade. Sometimes it works, sometimes it doesn't. Especially if I'm trading, say, like the SPY against the S&P or the 10-year notes in the States against our 10-year bonds, which I don't do a whole lot of. It's very dangerous. And that's another thing, guys. If you guys are all young, go for it, man. Just fucking go for it. I'm at a stage in my life where I'll tell you what, if I did something really stupid in the market and I gave it all back, I'm going to feel like a really fucking idiot. I don't want to do that. I don't want to give it all back. I got a good lifestyle. I don't, you work really hard at something, you get good at it. So one of your concerns is that you're all of a sudden just going to give it back for one stupid trade. My risk taking days of being an overtrader and trading huge size are over with. I don't want it. Any amounts of money that I make now are not going to affect my lifestyle. Making more money does not change my lifestyle. So, when you're young, you want to make money to enhance your lifestyle and hopefully for some other good reasons. Why do you want to make money? Family. That's good. Very noble. Why do you want to make money?
It's a very complex question. I think to make my life more rich.
More rich?
Not only in financial or material things.
Yes.
So, yeah.
It's a good question. I think we should all be asking that of ourselves. Well, what are we chasing the money for? And it is a very funny game, because our only measure of success is how much money you're making. At least LeBron James has a trophy to hold up, and he scored 52 points in the game. He has more of a acknowledged greatness. But if you're sitting at home, and by the way, who trades from home? Hold your hand up, please. Whoa, a lot of you. Cool. That's good. Any of you trade from your mother's basement? No, just kidding. Just kidding. Is it lonely trading at home? Would you prefer to be trading with someone else? Just out of curiosity? You prefer to trade by yourself? Do you prefer to trade by yourself?
I probably because I can concentrate. So I never traded. I don't know any traders at all. So actually, I've one in the US, but I don't talk to anyone. So
okay. Yeah, it's a very insular game if you don't have anyone in your room trading with you, and it's tough, because if you've had a good day or a good week, how do you kind of want some acknowledgement of that, and you don't really have that. You're not going to get acknowledgement of that. Yeah. Well, that's right. You can treat yourself by spending some money, which is always a good idea to do that. But the one thing that I found and about trading, and it's the greatest gift that trading ever gave me, and it has nothing to do with money. It has to do with freedom up here. I knew early in my life I wasn't the type of person who was going to be told what to do. I realized I was going to have to find something that I could do for myself. I wasn't very good at taking orders or working for somebody. And initially, it was like, okay, to do that, I need to make some money on my own. I'll become a trader, okay? Down the track, and I made mistakes. I started, when I first got some money, I started buying stupid things. Then I realized that owning physical possessions was just going to be a burden to someone like myself. I'm no good. Can't look after things. I don't know how to change the oil. I can't do this. I can't do that. Owning physical possessions was a complete burden, so I stopped doing that. And then a little bit further down the track, I realized that the greatest thing that trading was going to do for me was freeing up my mind. Free me up here. I can look at any situation in my life and treat it honestly and fairly without having to accept anybody else's dogma being shoved down my throat. And I like that. I love having freedom up here. It's a really beautiful feeling, and I wouldn't trade it for the world. And that's what money's done for me. It's enhanced my my existence on a lot of different levels, and it has nothing to do with fast cars, fast women, or any other nonsense. Okay, so I just thought I'd pass that one on to you. Hey, listen, can I ask him a few questions?
Yeah, go for it.
Righty-o. So I've asked the algorithm question. How many people here trade their own account? Hold their hands up, please. Just their own money or their family money. They don't trade for anybody else. Wow, cool. That's most of you. That's good. That's good. I've noticed with traders that some are really good at just trading their own money, and they can't trade for anyone else. And there's other people that are the exact opposite. As a matter of fact, a lot of people, they trade for a bank. They're there for 10 years. and it keeps money trading. They go, I'm going to go do this on my own, and they fail. 90% of the time, they fail as soon as they start punting their own money. When you're punting your own money, it changes the psychology of trading completely. But it's good psychology when you're trading your own money. You're going to learn faster. You're going to learn more, and you're going to be more focused on what you're doing. Really important, focused on what you're doing. So I'm a big believer in trading your own money. If you want to trade someone else's money, just be really careful, especially family money and grandma's pension. Just try to trade your own money and go from there and grow organically. If you start with $10,000 in an account, there's nothing wrong with that. It gets up to 15, pull a couple thousand out, build, grow organically, and don't try to make it happen too fast. You got to stand the test of time. If you really want to trade for a longer period of time, you can't go ballistic too early. And what I mean is I knew a lot of traders that would trade for 9 months and they'd make money every week, good money coming in. And then in 3 days after 9 months, they give it all back. And I thought about this over the years because I've seen this more than once. And I've said to myself, well, why does this happen? there seems to be a self-kill in a lot of traders. And I can only put it down to the fact that I think one of the things that happens to us as human beings is we really enjoy the challenge of trading and the climb up the hill. And that's where the thrill is. The thrill is climbing up the hill. And if all of a sudden you think you've reached the top of the hill because you've made a bit of money, a bunch of money, you don't like that. Your subconscious mind takes over and goes, I don't like this. Let's climb the hill again. And you lose everything in just 2 or 3 days, all gone. Oh, now I'm back where I want to be. I'm back down here, and now I'm going to have fun climbing the hill again. So be careful. Be careful. Don't be one of those people. It's no good. Not good. No. Okay? So, but to be aware, it's out there. If you let it crawl into you, it can happen. You got to really know yourself really well. Talk to yourself. Have a chat. Get to know yourself really well. It's very important.
Okay, well, I know we're getting on a little bit, so let's dedicate a little bit of time to some Q&A. I'm sure there's a few of you who do have questions.
Knock yourself out. You can ask me anything, please.
If you have that flaw in your subconscious mind, how would you stop it all? You know?
I'm sorry, could you repeat the question?
If you've got that flaw of climbing the hill in your subconscious mind, yeah, how do you stop that from happening?
You know, I really don't know because it's never happened to me. I never had the self-kill. I'd lose money, but I never beat my... And that's another thing, guys. This is real important, too. Don't beat yourself up when you lose money. You're going to lose money. This is one of the keys to losing money. I had a bunch of traders a few years ago that were beating themselves up because they missed a trade or they had a minor loss. And I'm like, don't beat yourself up. It's going to happen. Just get on with things. You know, especially missing a trade. Right, Aaron? You out there? I missed those 51s the other day in the curve. Now, 2 hours later, the curve's at 53. I missed those 51s. And I'm just like, man, let it go. Let it go. There'll always be another opportunity. So don't beat yourself up. As far as the self-kill, those things, I don't know. You know, I've always just let my subconscious mind do whatever it wanted. But I know my subconscious mind doesn't want to kill me.
Thanks for that.
No worries, mate.
Are there any other questions?
Right here.
Ramo, you say you're more of a price taker now, and you were talking about how the bills and threes, they were a little bit ballistic back then. And just last week, you know, the whites went a bit crazy compared to the reds, and you know, the Eurodollars are up and the whites are kind of flat on the floor and the reds are on fire. Kind of what are you looking at right now in the bill market?
I love you. That's great. Well, the market's telling me that there's been a lot of issues with the first 1 or 2 bill month with the LIBOR rate out of the United States. A lot of you guys aren't going to know what I'm talking about here, but he will. Sorry. So the LIBOR rate out of the States has been creating great, incredible volatility in the first 2 bill months. So volatility that I've never seen before. It's insane. Normally the June bills, which you know will go off the board on Thursday, they would normally for the month of May have a 3-point range. In May they were up 20, down 20, up 10, down 10. It's insane. And it all has to do with the borrowing rates that our banks have to pay to the banks in the United States for short-term cash. The United States rates are going up. The United States wants more bang for their buck, and this country, the banks in this country are having to pay more short-term interest on this country. And it's really, in this country, so it's really quite interesting because the RBA cash rate, which is just sitting at 1.5%, I don't know if the RBA really wants this, but that cash rate that they have at 1.5% is going to become redundant quite quickly. No one's going to pay attention to it anymore. It doesn't mean shit. You know what really important to banks is how much they have to pay for their short-term cash. That's the real interest rate in this country, not the RBA cash rate. RBA cash rate is becoming meaningless very quickly. And I've never seen that before. There you go. That's something completely new. And as far as the structure of the bill market is concerned, I'm just doing what the market tells me. I mean, you see these June bills go 5 under the SEP bills last night. You know, that's tied to the LIBOR thing. I don't want to be long the first 2 bill months. I want to be short them. I don't want to be long out the back because that's the market's telling me that. I want the negatives on, which is something you wouldn't normally do if you thought they were raising interest rates. It's the opposite. Structurally, the bill market, the 3s and 10s act as, I'll get specific with you guys. I'll get real specific with you. Normally, the structure of our bill market and our yield curve acts a certain way, whether it's in a bull market, a bear market, or an in-between market. Right now, we're in an in-between market. And what they normally do is they say, well, we know interest rates are going up, but we don't know when. So they'll beat up on the 10-year bonds. We don't know. So we'll sell long-dated stuff because there's no sense in selling 3 months out, 6 months out, because it might not work. It might just sit here and not move. So they have a tendency to steepen things up in anticipation of rates going up, right? Then when they start actually raising rates, it flip-flops and goes the other way. The 3-year bonds are a funny one. The 3-year bonds in a normal bull market are the strongest thing on the board. In a bear market, they're the weakest thing on the board. But they always predict what's going to happen before it happens. If you watch the 3-year bond contract and its price relationship with the second bill month in the 10 years, okay? I trade something. Here's a good one for you guys. You guys that trade this shit. I trade something called price spread divergence. Right? I made the term up. What it basically what it is, it's a spread relationship that moves in tandem with the market going up and down. So if the market makes new high, the spread's doing a certain thing. I'll give you a perfect example. The curve, the 3 years versus the 10 years. We had a really nice rally on the back of this Italian situation, and the curve was coming in as the market rallied. The 10 years are stronger than the 3 years. They should be. They're more volatile. The spread's coming in, the spread's coming in, the spread's coming in. And what I'm waiting for the market, when it backs off and then it makes new highs, then it backs off and it makes new highs. I'm waiting for the spread's coming in. Every time the market makes new highs, the spread's lower. The price of the spread's lower. I'm waiting for the market to make a new high, but the spread doesn't make a new low. That is price divergence relative to the spread. And that's telling you it's time to buy the bloody curve. Because the strength isn't in the 10 years anymore. They're giving up on the 10 years. The trend has always been for that spread to make new lows as the market makes new highs. Now the market's making new highs. And this happened last week when the 3 years got back up to 40. Their old high was 40 and a half. 10 years old high was, Aaron, where are you? I think the 10 year high was like 41, and they could only get up to 38. So the curve before, when it was making new highs, was in at 50, when 50 sellers. This time the market's back up near its old highs, but the curve's 51 bid. Now, what's the beauty of that is that if you put that spread on, you're going to make money whether the market goes up or down. And that's what I look for. I want to put spread relationships on that are going to work regardless of whether the market goes up or down. And these are the situations I look for. I'm not good at telling whether the market's going up or down. I wouldn't have a clue. That's not my job. My job is to do what the market tells me. That's what I do. I don't second guess the market. I look for these price relationships to diverge relative to the overall price of the market. I'm watching them very carefully. I'm trading them every day. I'm really focused on them. I'm watching them. And I do all the little things that I do. And then when I see the opportunity, I'll jump in. You got that?
Got it right there.
So can I ask about the little things that you do, so building good habits? For example,
Well, you know what? That's a really good question. I'm glad you asked me that. It's funny how the brain likes to categorize and organize everything, but it also wants change. If you get into a routine, your brain will accept it initially, but then eventually after a period of time, it's going to get pissed off. So what I do, if I have a regular way I drive to and from work, I'll change that route. Twice a week, I'll go a completely different way. I just change things up. Instead of just doing the same thing, I'll change it all the time. My brain likes that. It's really quite strange because the brain likes to, it's like, we build computers. It's just a mirror of the brain. And computers can disseminate information much faster than our brains can now. And the brain loves to file and categorize things because it's easier to deal with things like that. You meet a bloke at a cocktail party. His name's Bob. He's got 3 kids. He's an accountant. That's what he does for a living. And you see him, and you put that in your brain because you've now categorized Bob. Bob's categorized. It's in your brain. Your brain wants it. Your psyche likes that. Okay? You see Bob a couple of years later, and you go, "How are the kids?" He goes, "They're gone. I got divorced." He goes, "Are you still an accountant?" "No, I'm a bum." And now you have to recategorize in your brain these different situations. It's very difficult, but try not to categorize things too much in your brain. Keep it really open on all levels and change things up. change the way you talk, change the way you do things. I remember this is going to sound like I'm bragging, but believe me or not, when I was in university, I got so bored at going to lectures that I learned from Da Vinci used to write things in mirror script. And the only way you could read his notes, he did this to disguise it, but it really didn't work, because once you learn how to read it, you can see it anyway. The only way you could read his notes was by holding it up to a mirror and looking at the mirror and reading it that way. So I started taking notes in mirror script because it was a challenge for me. It was a challenge for my brain. And I wanted to do that. I'm challenging my brain all the time. I got a really good question. When someone asks you, what do you do? What do you say? It's really important how you answer that question. What do you do? Okay? I've had a lot of different answers to that question over the last 40 years of my life. I have to size the person up. If I say, I trade 90-day bank bill spreads at the Sydney Futures Exchange, believe me, huh? So I don't always say that. I have to size the person up and then decide what I want to say. 10 years ago, if you ask me, what do you do? I'd say, I'm in the business of losing. They'd look at me and go, what? Yes, it's very important that I lose. Losing is very important to me. And they think I'm out of my mind, and they usually walk away. Nowadays, if you ask me, what do you do? I have to think about what I'm doing on a daily basis. And the answer to that question is, what do I do? On a daily basis, I'm trying to solve problems. I love being a problem solver. I love being challenged by mathematical equations, Euclidean geometry, Sudoku puzzles, everything. I love expanding my brain. I want to learn and learn and learn. And by the way, I'm still learning how to trade. If you think I got all the answers, I don't. Ask me in 5 years, I'll have more answers for you because I'm still learning how to trade. It's hard. It's not easy, but it's fun. That's why I keep doing it, because it's a fun challenge. It's very much a challenge for me up here, but I enjoy the challenge. And I live on a farm now with, 89 steers and 90 acres to look after. And I'm doing shit that I never before did in my life. I have to go out in the barn. If there's a hinge broken up there, I got to figure out how to fix that hinge. Then the cows are pissed off over here and I'm solving problems. I'm solving problems continuously. Then I turn the computer screen on. There's another problem. I got to figure out what the market's going to do next. Another problem. But I revel in trying to solve problems. I love it. I wouldn't have it any other way. Does that answer your question, Connor?
Yes.
Okay, cool.
All right, are there any other questions?
Managing risk is unreal. I'm just wondering, someone like you, do you need a risk hit to get your adrenaline going? Do you need to take a big punt now to have a go and feel like the blood's boiling again?
No, I don't. I don't. I go skiing on really steep mountains. That's a pretty good adrenaline rush. I got a 16-year-old daughter. She's an adrenaline rush. I've got 7 children. I mean, I got a lot of things happening. Do I need an adrenaline rush from trading like I used to get? Actually, I had a little bit of an adrenaline rush in here. I was kind of toey and nervous when this first started up. Was his non-farm payrolls out in about 10 seconds? It's how I get just before non-farm payrolls. I'm like, ooh, like this. So I get fired up, but do I purposely fire myself up by putting on big trades? No, I don't do that. I don't do that. No. Well, maybe I should.
Hi. I'm a soccer player that studied finance, and naturally I gravitated towards analyzing sports data. I guess one of my favorite podcasts was the one you had with Brendan Putz, who is a sports trader, has like the first sports hedge fund. I have a bit of a non-conventional view, which is sports trading to me is essentially trading as well. And I'm often met with a question that is gambling, which often baffles me, because sometimes you need to really explain that. You just have to look at it this way. It's not really what you trade, it's why you trade it. My question to you is, where do you draw the line between gambling and trading? And does it matter what you trade or why you trade?
Well, to me, gambling is going to a casino or betting on the horses or getting involved in a dice game, in an alleyway. That's gambling. Trading, because I like to think that I'm good at it, there's not the same perceived risk for me. To me, trading is something that I think I'm going to win at a lot easier than walking to a casino and playing blackjack. I'm not a casino. I'm staying at the casino, but I won't go to any of the rooms. Doesn't hold any appeal to me. And that's another thing. Once you start trading and you really fall in love with trading, all other forms of gambling are going to pale by comparison. You're not going to be interested in that shit. It always amazed me. I knew some traders in Sydney. I still know them, and it didn't matter whether they were trading futures, hundreds of thousands of dollars back and forth each day. They go to the track and do the same thing. They have $100,000 out at Randwick on the weekend. They go to a casino and they the high roll, and they give them a bunch of chips, and they didn't make a distinction between trading futures or shares or something that they're kind of getting paid to do, because a lot of these guys work at banks. They didn't make a distinction between that and all other forms of gambling. It's semantics and it's psychological. Listen, futures trading is glorified gambling. It is. It's glorified gambling. But I guess it's the way you think about it in your head. You know? Yeah. I mean, I had $250 in the Sacramento Kings to win the NBA. Hopefully they beat LeBron, but he's the king. Sorry, I'm watching basketball right now. The NBA, it's crazy stuff. Crazy stuff. Oh, I do have some little stuff. Just bear with me right here. I was watching the golf over the weekend, and they were at the Memorial Tournament in Ohio, and Jack Nicklaus was there giving a little speech. And I wrote down what he said, and because I think golf is very similar to trading. It's the one sport that draws a lot of parallels to trading. And he said the following. He was talking about Hale Irwin, who was another golfer of his era, who was just receiving a big prize. And he said, Hale Irwin is a great manager of himself and the course. The analogy here is that a golf course is like the market. When you tee off on the first tee, what are you up against? Well, you're up against how are you going to swing the club? What are you thinking in your head? How am I going to play today? It's very internal. The course, how's the wind blowing? How fast are the greens? How thick is the rough? That's the marketplace. That's what you have to deal with. When a professional golfer tees off, he has to deal not only with himself, but the golf course. Every time you turn that machine on, you have to deal with yourself and you have to deal with the market. Very close parallels. Anyway, he said, Hale Irwin's a great manager of himself and the course. And then he just said this to anybody who wanted to hear it. He said, know who you are, know your game, play within yourself. I wrote it down because I said, fuck, this is trading. This is trading. You know what I mean? And he said, believe in yourself. And I've already said that to you guys. Believe in yourself. And another thing he said that I thought was very fascinating, he's talking on the TV. He said, and he's the greatest golfer ever. He's dominated the sport during his era. And he said, I never thought I was the best. I never thought I was the best. He said, if I ever started thinking that way, I was absolutely destined to screw up. Take a triple bogey, lose the tournament, not make the cut. So I never thought about being the best. To me, it was always the challenge to try to be the best. I thought that was interesting. I thought I'd pass that on to you guys. There you go.
Is there anything else in that notebook which we should dig into? We've probably got about 10 minutes left.
You were going to ask me how did I become a large trader, and I'm telling you right now, it wasn't because it was the markets have grown. I had the exchange send me the open interest for the first 6 bill months. In 1998, it was 356,000 on the 1st of June of 1998. First 6 bill months open interest. 10 years later, June 2nd, 2008, 973,000. It's almost tripled. I was going to get the numbers for last week. I didn't get them, but I guarantee you it's gone up again. My volume grew organically because the market volume increased. I didn't force it upon myself to trade larger. As the market volume grew, my volume grew. Okay? I didn't just decide one day I'm going to double my volume. My volume went up because the marketplace allowed my volume to go up. It wasn't predetermined. It just happened that way because I'm riding on the coattails industry that has grown a shitload in the last 40 years. There you go.
Would you say it was a factor of that combined with your risk appetite? like I'm always interested by these really big traders who can throw it around a little bit. I feel as though a large, or maybe not a large, but a great factor of their success is their appetite to take risks.
I'm completely unfocused on risk. Risk to me doesn't exist. I don't put a trade on and think, well, what are the margins in this going to be? What's my risk? Where am I going to get it? I've never used a stop in my life. I've traded millions and millions of contracts over the last 40 years. I've never, ever used a stop. There you go. Pretty wild shit, eh?
But you're managing your risk in other ways, aren't you? Like you adjust your spread, or
yeah, and and you lose, and you win. You become immune. You become immune to winning and losing. Winning and losing don't matter anymore. Risk doesn't matter anymore. I'm telling you. I'm repeating myself here, but you're just focused on the next trade all the time, and the chips will fall how the chips fall. I told you. One time I spent 9 months. I never looked at a statement. I didn't care about the money. Who cares? The money's going to do whatever the money wants to do. I can't change that. I just want to make good trades. I just want to focus on the now of trading. I know that's hard to do when you're starting up. I'm completely aware of that. But what I'm talking about is stuff that you have to evolve into over a period of time. You just can't say, I'm trading now and I'm going to do what Rambo says. You can't do that. It's something you have to evolve into, believe me. And it's something that is hard to do if you're not inclined to be that way. I was just inclined to be that way.
Do you have good options?
No.
So you just spread it?
I'm spreading within the 98% of the time. I'm spreading within the interest rate structure of the yield curve.
Let's just do one more question over that way.
Okay, three. Anything on your reading list? Like recommended books that you like to read and
The Teachings of Buddha.
why did you leave Chicago and come to Sydney?
I'm sorry, man?
Why did you leave Chicago and come to Sydney?
I love that question. You know how many times I've been asked that question? Lifestyle. To put it in a nutshell, lifestyle. Like if I wanted to be a really, really, really rich, I had to stay in either Chicago, New York, or London. And I discovered Australia, and I fell in love with this people, the open spaces, and everything. I'll give you a funny little example. There's many girls here. There's a few girls here. Hi. In America, when I was trading in America at the Chicago Board of Trade, and the girls in Chicago knew if you were a trader at the Chicago Board of Trade. Believe me, they knew. But nonetheless, about the second or third question a girl in Chicago would ask you when you're out and you're 25 years old, roaming around the city, is, so what do you do? What do you do? Now, that's a really polite way of saying, how much money do you make? Because they want to target someone who isn't a complete loser. In those days, I was a bartender. So I would say, I'm a bartender, and just see the reaction on the face, how long they'd stay and want to talk with me if I said bartender. But I knew if I said I'm a trader at the Chicago Board of Trade, the next question, do you own your own seat? They were smart. They knew. In Chicago, the trading mentality is so huge. Everybody knows about the markets. The Merc, the Board of Trade, everybody. There's not a single person that doesn't know about these institutions. When I came to Australia, at the same age, I'd go into a pub somewhere and I'd meet a beautiful Australian young lady, and she would look at me and she'd ask me almost the exact same question, but with completely different meaning. She said, so, you're from Chicago? Yes. So what are you doing? What are you doing? Do you want to go to the beach with me tomorrow? We're having a barbecue tomorrow afternoon. What are you doing while you're here? Let's have some fun together. Do you want to come back to my place? What are you doing? Not what do you do? So I just found it very refreshing that the Australians in general, and in particular the women, were not focused on the money element of things. And that's one of the problems I think they have in the States, to be honest with you, is I think a lot of people they're way too focused on money. But I came here for lifestyle, man. I fell in love with the beaches and the girls and the beer. There's far superior beer. Now with craft beer, the States have made a huge comeback. But in those days, beer in America sucked. Budweiser, Bud Light. You got to be kidding me. Come here and have a Rush's at the Stain Hotel in Manly. That's a real beer.
Can you talk a bit about the doco with Bulls and Bears?
We better wrap this up. Yeah, it's available on YouTube.
Yeah, well, you need to give me a specific question involving that.
Why did they do it on you?
Well, they didn't do it on me. They did it on 4 or 5 different traders, and the whole doco was supposed to be on the closing of the Sydney Futures Exchange, from floor trading to screen trading. And they followed me around with the cameras for a while, and we became really good friends. I became really good friends with the cameraman, the producer, the director of that series. It wasn't a series, a documentary. And I said to them when they were doing this, I said, hey guys, listen, I don't want you misrepresenting me, and I want full abilities when you make this thing. Let me have a look at it, and I can axe anything out of this that I want. They said, no worries, John, we'll do that. So they had the final product. I looked at it. I said, you know what? I use the F word an awful lot in this. And I normally don't use the F word in my real life that much. You heard me use it tonight a couple of times, but it made me sound like, but they were doing that to make it more watchable. Because people, they want to watch something that has a bit of excitement to it. So they gave me full editing rights, and I looked at it and I said, all right, yeah. So if there's anything in there that makes me look bad, I can only blame myself. But I'm not too fussed what people think about me, in case you didn't know.
All right, let's leave it there. John is going to head over to the bar with us afterwards, so you'll be able to catch him there and have a chat over a beer or whatever you drink. Yeah, I got to say, John, absolute honour.
Pleasure, mate. Thank you.
You've reached the end of this episode of Chat with Traders, but rest assured there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes, and we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
Chat with Traders is brought to you by Trade the Pool. Did you know that every decade the market reinvents itself? Online brokers opened the doors, mobile apps made trading seamless, and commission-free trading erased barriers. Now, a new era has begun. Meet Trade the Pool, limited risk trading. And now you also have unlimited time to reach the profit target. From now on, your trading risk is capped, and your trading opportunities are limitless. Trade the Pool funds home-based stock traders with up to $200,000 in buying power. That means you can trade larger positions and scale your strategies without risking your own savings. It's time to trade with more capital, making it truly worth your time and effort. Ready to trade the pool? Click the link in the description and join the stock trading revolution today.
Are you ready to get serious about trading? Then join Tasty Trade, Investopedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade all in one platform. Get low commissions, including 0 commissions on stocks, so you can keep more of what you earn. Trade smarter with advanced charting tools, a pre-built strategy selector, risk analysis tools, and more features. Visit tastytrade.com/chat for more information. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC.
Markets, speculation, and risk. This is the Chat with Traders podcast, hosted by Aaron Fifield.
What's up, traders, investors, and punters? Welcome to Chat with Traders podcast. I'm Aaron Fifield, and joining me for this episode is Nick Fabrio. Nick is an active day trader of ASX-listed stocks with a short bias. He's 28 years old, he's been trading for around about 3 years, and has already surpassed $1 million in trading profits. The dude is a gun. Nick is currently living in Texas, but while he was back in Sydney recently, we were able to catch up and do this podcast, and we filmed it. So again, if you'd prefer to watch a video of this episode instead of listening to the audio only, head over to the Chat with Traders YouTube channel, and while you're there, please subscribe. We chat about many things in this episode, in detail. I'm not going to run through them all right now. Just continue listening, and I think you'll really dig this episode, and I'm sure you'll learn something too. Here is my buddy Nick Fabrio for episode 164. How'd you go at poker?
A bit better than I went trading this week. So, yeah, I think I might even just give up on my trading career and switch to professional poker player.
Have you played a bit of poker? Like, is it something you do half seriously?
Not really. Like, I usually just have a few beers and play.
Okay, but you know how to play.
Mates. I know how to play.
Right.
I wouldn't say I'm like particularly good, but
yeah.
Yeah,
not at the high roller table.
No, not at the high roller table. No.
Cool, man. So before we get into any of the trading stuff, let's chat a bit about what you were doing beforehand, leading up to that, because I know some of the things you were doing were, I think, very interesting, and it says a lot about your character.
Sure.
I don't recall if it was you were running the yogurt shop before.
Yeah, so I ran, I guess to rewind, so out of high school,
okay.
I actually wanted to be a doctor.
Right. What sort of doctor?
I hadn't really decided. I just wanted to do medicine. It was something that interested me, and I got like the marks that I needed to in like this one aspect, but then the like university entrance thing I didn't get in, like with the, I think it's called a UMAT or something. I just missed out on getting the marks there. So I went to university in some like I guess separate course. I think it was like diagnostic radiography or something like that, and then realized I had no clue like what physics was. So I dropped out of that within like 4 weeks, and then actually started working at the casino at Star City.
Oh, so that's right, you did too.
Yeah. And then I figured out that waking up at 2 a.m. driving into the casino to work for 8 hours wasn't my thing either. So
was that your shift, was it?
Yeah. So 4 a.m. to midday was my shift. And
4 a.m. to midday. That's a rough shift.
Yeah, I'd have to wake up at like 2 a.m. and then I'd get home like having micro sleeps behind the wheel almost, and then sleep. And yeah, it was just really bad, like especially as a 19, 18-year-old, like you have no social life. So
yeah,
gave that away. And then I was selling cars for a bit. And then I got a job at like I guess what you'd call a boutique stockbroking firm. Did that for a little while, and then once I quit there, I started a business with one of my mates. It was like we just started our own frozen yogurt shop. So we thought that might be the next big thing, but turned out to be a fad.
Yeah. Just going back to the dealing at the roulette table.
Yep.
What was that like? Like, was it a bit of an eye-opener? I imagine like those people who work behind at the tables in the casinos, you know, they must see some shit.
Yeah, I mean, it's kind of depressing because no one's winning, right? Yeah. So you're like sweeping away everyone's chips and they just like hate you. So yeah, it wasn't like the greatest atmosphere. Plus, you know, there's like no clocks. You don't really know what's going on. The only good thing about it was like you worked for 1 hour and then you got like 15 minutes of break, and there was free food in the like back of house area. So that was one of the perks. But
right, yeah.
Once the food gets old,
yeah, it's good for about a week or so.
Yeah.
Yeah, cool, man. So after that, you went to selling cars.
Selling cars, yeah.
Well, how did that work? Were you a car salesman or were you doing something else?
Yeah, I was a car salesman. Okay. So I kind of have always had an interest in cars. I used to go with my dad to like Bathurst and go to all those races and stuff. So I guess selling cars like made sense to me. And I was pretty good at it. Yeah, I was pretty good at it. Like at selling stuff.
Okay. What sort of cars were you selling?
I was selling Kia, Chrysler, Jeep, and Dodge.
Oh, right.
I guess back in those days, selling Kias wasn't the easiest sell. I think they got a bit of a better reputation now, though.
Yeah. And how long did you do that for?
I think it was about a year, maybe.
Okay.
Yeah.
And then, so you went from there and you did the frozen yogurt venture?
Yeah, a little bit down the track. So I did the frozen yogurt. I think I was like 23 at the time. And we did that for 15 months or so.
Yeah, well, tell us a bit about that. Like, how did that come about? Because, I mean, it's pretty ballsy to just decide that, you know, you and your mate are going to get some cash together and open an actual shop. Like, that has some real overheads and some real expenses that you've got to cover. And, you know, it's a pretty significant risk.
Yeah. I guess we were a little bit naive, like thinking, it's retail, like everyone can do it. And we didn't really understand, like, how horrible retail as an industry is in Australia. Like there's plenty of competition. Plus we were dealing in something that's like so niche, given that it's dessert. You don't have dessert every single day. Do you know what I mean? So you're dealing, like trying to get people in, like is difficult because even if you go out for dinner or something, like you're not always going to have dessert afterwards. It's pretty optional.
Yeah, and it's a little bit seasonal too. Like I imagine some of the ice cream shops down on the Corso here are probably doing it tough during the winter.
The winter, yeah. And like we're faced with other challenges as well, like the so we did it in Wollongong, just down the south coast, and they were redoing the whole like main strip of Wollongong. So there was a lot of like road works, and basically they tore up like the road in front of our shop, so access was difficult. Yeah, it just made a bad situation worse.
Get compensated in any way for that, or it's just
no? Because their pitch is like, it's for the future. You're going to benefit in the long run. But yeah, we didn't hang around to.
What were you doing in the business? Like, were you serving customers, doing a lot?
So me and my mate, we split the shift in two. So the shop would be open for 12 hours every single day. So we'd do six hours each, Monday through Sunday. And yeah, it was just everything. So preparing the yogurt, cutting up the toppings, and even on the business side of things, like figuring out that stuff. So it was like, I don't regret doing it. It was pretty rewarding. Like you learn quickly. We won like I can't remember. I think it was Business of the Year or something in Wollongong.
Oh right, that's pretty cool.
Yeah. So it was a good thing, right? Like we had to figure out everything because it wasn't like we took on a franchise. We just started our own brand and just kind of learnt on the go.
Yeah. And why frozen yogurt?
Well, it was at the time like I don't know. I think that was really taking off.
Okay.
And we thought. We're actually like we went traveling over to the US to see if we could like think of any concepts over there that we could bring to Australia.
Yeah.
But then we like kind of got sidetracked, like going out and partying instead of actually like doing any research. Yeah. So we already had the yogurt idea to begin with, and then we're like, okay, well we'll just do that.
Yeah.
Because we didn't see anything else.
Yeah. Okay. No, it's funny how like sort of there are certain foods and sometimes certain desserts which just become like the in thing for 12 months. Like
it was definitely a fad. Like I think our shop is still in operation down there, and it's the only one there. So I think at one point there were about 4 frozen yogurt shops in Wollongong, and ours was the only one that made it through. Okay. So what we did well was we made sure like we were off. We weren't like contracted to like like a Westfield or a GPT group type thing. So we were just outside the kind of shopping precinct. So that meant that our rent was substantially less. And that's obviously the biggest overhead. So the rent wasn't burdensome, and that's kind of what gave us the ability to have that longevity, I suppose.
And did you have to lock in a lease for a certain amount of time? Like usually commercial leases usually run for a couple of years, don't they?
Yeah, I think we had a 3-year lease, and maybe the last year was an option.
Okay.
So we structured that pretty well, I thought, which was good, and we negotiated pretty hard for like favourable terms for us. So
yeah, that's pretty cool. I mean, it's a big thing to take on. Like I always sort of have a bit of a respect for anyone who does that, because it's not like just starting an online business where it's like that your biggest cost is web hosting and a domain name and a few other bits and pieces.
If it goes wrong, there's not like huge ramifications, but in that environment it can get pretty nasty, as we're seeing with like Retail Food Group and some of those franchises that are just going belly up, and it leaves people in some serious strife. So we were lucky. Like we just worked hard, paid off the debt, and then sold the business once we saw like more entrants coming in. So we're just like, okay, we need to pull the chutes.
Yeah. So why did you sell the business? Because you fear of competition?
Fear of competition, and also we were just getting over it. Like we're literally working 7 days a week, like no breaks. I think in 1 year I probably had like 5 days off or something. And I was studying university full time. So.
Oh shit. Yeah. Okay. Did you have any staff?
No.
Okay, so
we're effectively working for free. Like we're working just to pay off the debt. And we got out. I think I had like negative $500 to my name at the end of it.
Okay.
So
well, I guess all in all, that's at least you weren't under, right?
Yeah,
you
yeah, exactly.
paid off your debts and all that. And so what about the sale of the business? Like, was that a win for you, or was that just...
so that basically just paid down like the last remainder of the debt.
Okay.
And then, so we got a broker to try and sell the business. And then I'm like, oh, this guy's like not doing anything. He's just like waiting for someone to walk in and buy it. And we paid like this listing fee, and then it was going to be like a 10% commission or something. And then I'm like, oh, screw this. Like, so I advertised it on Gumtree myself, and I sold it like with my mate. I sold it to this guy, and then we just left. And then the broker's like hassling us because in the contract it was saying, oh, you know, no matter how you sell the business, you still owe me like a commission. And I was like, that just rubbed me like up the wrong way, like completely. So
you didn't get paid?
I negotiated it down. Like, I'm like, oh, well, the listing fee we paid, that's part of your commission, and then we'll just top you up to 10% or whatever it was.
Okay.
At that point, we were just like, oh, like we're just happy to have this behind us. It's almost like hush money, just shh.
Yeah. No, I know the feeling. And then, so what happened from there? So you sold up the frozen yogurt business. What was kind of the next step after then?
So then I got a job working at a company called Wholesale Investor. So that was basically you'd get sort of pre-IPO deals. I guess the company would present to like a bunch of high net worth or sophisticated investors. So I was just doing business development work for them.
So that's what you were doing?
Yep.
Okay. So you were on the phones just ringing up?
It was probably more email based and meetings than like phone work.
Okay.
Yeah. It wasn't like overly like high pressure sales type thing.
Yeah.
So yeah, I did that for a bit, and then at that point in time I was like getting ready to go overseas to do a year of exchange. So that's kind of when the trading thing came about. Obviously, someone you've had on the podcast before, Bryce, we worked together like probably close to 10 years ago now. And he sort of approached me. He's like, oh, you know, you'd probably be pretty good at this. Like, if you want to give it a go, like, let me know and I can help you. And I was kind of like umming and ahhing about it because I wanted to save money so that I could go overseas, and I didn't know if I'd like be risking that if I tried and failed. But then eventually I'm just like, I guess I've got that gambling, not gambling, but like that instinct of just giving something a shot and seeing if it works. So I just bit the bullet and then, got into trading.
Where were you and Bryce working together?
At the boutique stockbroking firm.
Oh, okay. Yeah, I thought so. All right. So, okay, I didn't realise it would have been that long ago.
Yeah, I think it would have been like 2010, 2011, around there.
Okay.
Yeah.
So did you do any good IPOs?
At the broking firm?
Yeah.
No.
What were they? Were just pretty small?
It was like, they'll do like a few corporate deals, but it was mainly like placements and stuff.
Okay.
As opposed to IPOs. And it was like, it was a super small firm. It was not like, they wouldn't be doing many IPOs.
Okay. So Bryce sort of turned you onto this trading thing. Had you done any trading in the past?
I'd like punted around when I was like I think in high school, possibly, or like when I was 18. I think I bought like some Gloucester coal shares or something. Like I had no idea what I was doing. I bought them and then they got a takeover offer. So I was like, oh, this is pretty easy.
Famous last words.
Yeah, and then I put like the profits from that into something else, and that basically went to zero. So got a reality check pretty quick.
Nice.
Yeah.
Okay. So when you started getting into trading, like you sort of had this idea that, you know, this is something I'm going to have a go at now.
Yeah.
Like, how did you go about that? Sort of, how did you go in those first few months? Like, what was sort of your introduction to it?
Yeah, my approach was like I was just trying to be a sponge, like learn as much as I could off Bryce and other people in the chat room that I'm in, and just try and absorb. And basically, I got obsessed with it. Like it was, every waking hour, I'm like, replaying stuff on Spark or, just obsessing about it. Like couldn't wait for Monday. Like I hated weekends.
Okay. And did you have a job at the time, or was it?
Yeah, I did. So the first 3 months, I was basically trading from work, unbeknownst to my boss.
Okay. And what was your job at that time?
That was with Wholesale Investor. Yeah. So there was a fair bit of downtime. Like it wasn't like you had to be constantly on the phones. So that kind of gave me the opportunity to spend a bit of time doing that. Like I would even come into work at like 6 a.m. to do some of the business development work for like an hour or two so that I could prep in the morning and then trade the open pretty much. And then I'd just go from there.
Okay. And then so you kept that up for about 3 months and then you gave away the job?
Yeah. Well, I was going to give away the job anyway because I was going overseas. I quit and then I basically became full-time. Like that was my job from that point.
So what was your experience like in those first 3 months? Like were you profitable? Were you up at the end of those first initial 3 months?
Yeah. So I think the first month, like I might have lost about like $300 or something. And then the next month, I think I made like 800. And then, so I started with 10 grand. And then once I made like that $800, I was like, okay, I've done this for 2 months now. I'm like more or less break even. I'm going to add another 10 grand just so that I could do a little bit more. And then it basically kicked from there. So I think the next month I did like 5 grand. I think I did 16 and then 36 and then 65. So it ramped up like pretty quickly.
Yeah. Did it ever?
Yeah.
Yeah. Not many people can say that. How big were you trading in those first 3 months? Like how much were you risking on a trade?
So when I first started, I've made a post about this on Twitter about leverage and risk. So the way I look at things is always like, what's the tick value of this trade? So I'd size according to that. So I'd be like, okay, I'd try and make things fairly binary. It'd be like, okay, I'm very confident in this setup working, or I'm confident but not as confident in this. So then I would just adjust accordingly. So I might, in a highly confident trade, I would be risking like $50 a tick. On something I was less confident about, it might be like 25. And then I just focused on building that up from there, if that makes sense.
Okay, so if you're saying $50 a tick, let's say you got a $10 stock.
So, okay, that's the other thing. So I was only trading stocks between like 30 cents and $3.
Oh, really?
Yeah. For obvious reasons, like because, on a $10 stock, you might get like a 50 tick move in a day, for example. And if you're starting with, 10 grand and it's $50 a tick, like you can go broke pretty quick, like if it goes wrong.
Okay. So if you're trading a $3 stock, let's say.
Yep.
What's the tick? What's the smallest that can move? It's half a cent, isn't it?
No, they go to full cents over $2.
Oh, is it?
Yep. And then it's half cents below $2 down to 10 cents. And then it's like 0.1 of a cent.
So how many ticks would you risk on a trade?
Ideally like 0 to 1. So a lot of what I was doing initially was I was just purely doing match trades. So I'd be leaning on like a surplus bid or something. So jumping in front, and then basically if I saw, selling action, like someone hitting the bid, then I would just get out and I'd be basically out for brokerage. Or worst case scenario, if it got like wiped in one go and it went offered, then I'd pretty much just hit out straight away.
So can you just explain that a little more? Like, what do you mean by you're doing match trades?
So if there's a catalyst like news, for example, and you see a bunch of buyers coming in, and you can lean on some liquidity in the bid. So it might be like, say, 50,000 shares surplus bid once it matches. Then I would look to jump in front. So I'd put my order higher than the indicative match price, and then it would match. So I'd get my fill at the match price, and there'd still be a bid there. So then that allows me, it's basically getting a free look at the next couple of seconds of action. So then you might see like, more bidders come in at a higher price. Like say it matches at $2.50, for example, and I bought and it's surplus bid. Then someone might jump up to like $2.55 for a bid, and then I'd just sell into them or something along those lines. But then if I saw like sellers coming in the book and volume being done on the bid, then I would just hit out straight away, kind of thing.
Okay. So you're just very, very scalpy to begin with.
Very scalpy, yeah.
Okay. Yeah. And would you trade the rest of the session, or were you?
I wouldn't always trade the rest of the session, but I'd always watch. Like I'd say to people, like, I feel like the market's like a story. If you're not watching or being observant the whole time, it's like you're missing like a couple chapters of the book. So if you're trading just the open and then you come back the next day, like so much stuff has happened between when you left and now, like you just kind of lose this valuable information. Like, yesterday there might have been a constant buyer at this level, or there was a constant seller, and if you don't know that, like you find yourself in trouble because you don't have the full story.
Yeah. Okay, and doing those sort of trades, I imagine you'd only be able to take like a couple trades a day. Like if your trade is trading the open, you'd probably only be able to get it like just
right at the beginning, in the first probably 3 months, I think I was probably only doing like 3 or 4 trades a day, maybe 5. But then, I basically just focused purely on like this one type of setup, and I think that's important for like new traders out there to just hone in on one thing that you can do and do it well, and then that buys you time to figure out other setups that you can do. So I just did that. That gave me time. I made money doing it, but then it's like, okay, the edge is going away there, so you start looking at other stuff, and for me that ended up being like short selling a fair bit.
Is that what you found, that the edge did start to fade away?
Yeah, it wasn't as good like after a little while. So I now almost like don't even do those trades.
Okay.
Yeah.
When you said surplus bid, what do you mean by that? Do you just mean that the bids in the book are thicker than the offers, or?
So when the market matches, it's like I don't know like the full way it works per se, but it's basically just balancing the supply at a particular price, and then there'll always be like a surplus bid, or it'll be surplus offered when it matches.
Right.
So there'll be still some volume left that hasn't been done. So it's basically just getting on the advantageous side of that by Q jumping effectively.
Are you ready to get serious about trading? Then join Tasty Trade, Investorpedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including 0 commission on stocks, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, risk analysis tools, and more features to help you trade smarter. See equities and derivatives with high trading volumes, dividends, upcoming earnings reports, and more with their pre-built watch lists. Or create a custom watch list to keep an eye on the companies and sectors that matter to you. Manage your positions with speed and precision using active trader mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Visit tastytrade.com/chat for more info. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Have you ever watched a stock explode and thought, if only I had the capital? Or sat on the sidelines because your account balance felt too small to matter? Good news, with Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 U.S. listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with 0 locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
So do you recall any kind of breakthrough moments during your, let's just say, first 12 months of trading?
Not really. I think it was more just that feeling of like, I drew down the account a little bit. I think like from 10 grand, I ended up down at like $8,700 or something like that. And then once I clawed it back to even, I'm kind of like, I can probably do this. And
it's a bit of a confidence boost.
Like, I haven't just whittled this away and failed. And then that kind of just gave me the confidence. But I was pretty fearless to begin with. I think I've always been relatively comfortable with like putting on risk, whether it be, playing poker or sports betting or something like that. So I wasn't particularly like fearful of losing money. So that helped a lot. And I think that's a lot of people don't necessarily have that ability to be comfortable with having risk on.
Yeah. Do you think there's a way that people can become more comfortable with the idea of losing money? Like, because it's
probably
inevitable
to lose money.
Yeah, yeah.
I think you need to lose money to figure it out.
Right. Yeah, I mean, that interview I did with Rambo recently, that was one of the big things that he really sort of tried to drive home was,
detaching from the money.
Yeah, but it's like easy enough to win. The hardest part about trading is learning to lose. It sounds crazy, but, listening back over that interview and some of the things he said, it really kind of, I was like, that's
Makes
dead on.
a lot of sense, yeah.
Yeah. Okay. So how long have you been trading for now?
Just under 3 years.
Under 3 years?
Yeah. Beginning of August will be 3 years for me.
Okay. And you've had no breaks during that time? You've just sort of been at the market every day?
No, I wouldn't say that. So in 2016, when I was on exchange, my attention to the market, I guess, was a little bit patchy because I was kind of living the college experience as well, and just trading when I could. So I guess like once I got over there, I didn't really have any friends, obviously. So I was like purely focused on trading. But then as I like formed a friendship group, then they invite you out, like, oh, let's do this, or go on a holiday or something like that. Then my attention to the market kind of slipped a bit, and my performance suffered as a result. So if you look at my equity curve, it kicks at the beginning, and then when I go overseas, it's sort of it's still going up, but at a less steep or
slower
rapid
pace.
rapid rate.
Yeah.
But then once I got back to Australia in January last year, then I was like, I treated it like a job.
Okay.
So
yeah. So what is your style of trading? Let's just sort of go over just a bit of an overview, I guess. How would you describe your style of trading?
I'd say I'm like a scalper and just trading basically off catalysts. So whether it be news or, macro moves, like that kind of stuff. I have a bias towards being short. I just feel like a little bit more comfortable for some reason. I think one of the reasons I like it is because usually stocks sell off quicker than they go up. So as a scalper, it makes it, I guess, easier because you can make money quicker, I guess, and you don't have to have like a lengthy exposure to the market. You can be done in like 5 or 10 minutes. But that's obviously something that I'm trying to evolve from because I'm missing out on like way bigger trades just because I'm too scalpy.
Yeah, you're leaving a lot on the table.
Exactly.
Yeah, so when you say mostly a scalper at this point, what would you say is your average kind of hold time?
Probably 10 to 20 minutes, maybe.
Okay.
Yeah. Like sometimes I could be out in a minute or two. And then, sometimes I'm in for a bit longer. But I want to get to that point, like especially in the morning where I'm holding stuff for at least an hour if it's working in my favor.
Okay. That's one of the things I've found in the mornings is that it's very easy to give some of your profits back.
Yeah.
All your profits back.
Yeah.
Because the market will move so quickly in one direction and then snap right back. And, all of a sudden you've gone from having a reasonably good profit to now back to break even or a slightly negative trade. So, do you think that's one of those things you can sort of get around?
I think you've just got to like continue to work on it. Like I think the key is knowing when to hold and when not to hold. And I think that's one thing that I'm struggling with at the moment. Like I'm trying to hold stuff, but I'm not necessarily holding stuff that I should be holding. Or I'm being scalpy when I should hold, and I'm holding when I should be scalpy. So I think it's a big skill is being able to identify, when it's right to hold and when it's not. Yeah. So I think I need to work on structuring things so I can figure out. Okay, this is a trade where I need to be holding, or to get out, I need to have a reason to sell or a reason to cover, like not just doing it because I'm trading my P&L kind of thing.
Yeah. So let's start at the beginning of the day. Like, how do you prepare for the upcoming session?
Basically, I come in, I have a bunch of watch lists. I have a bunch of watch lists, and then I've got an Evernote sheet. And I'll just go in and populate, I guess, what the macro themes are. So was the US up last night? What's AUD doing? What did bonds do? Commodity ETFs, that kind of thing. So then that gives me an idea or a picture of what stocks I'm going to be looking to trade that day. And then I go through, I'll have a list in each of the group open, so 5 groups, and I'll have the list from yesterday, and then I'll filter through those stocks and see, by looking at the market depth, do I think that this stock is going to move again today? And then I keep it on the list if I think it will, and then I delete the ones that I think are probably out of play. And then as news filters through in the morning at about 8:30, then I start adding stocks back onto that list that I think might move on news.
Okay.
Yeah.
So how many stocks would kind of be in your watch list by the time the market opens?
40 probably.
That many?
Yeah.
Okay. And how are you monitoring those stocks on the open? Like, do you just have a watch list with the kind of, how much each one's moved, or do you have 40 different charts across your screens?
Yeah, I have 40 different things. So I'll just line them up on Spark for each group open. So I've got like 4 screens of Spark open. I'll have 2 stocks on each screen in each group thing, and then I'll basically just click through them as the next open phase starts. So I might get on a position in group 1, and then I'll just kind of keep that up in the background while I'm getting on another position in like group 3 or something, and then I kind of just like juggle them going forward.
Just in case anyone's not familiar with the way the ASX works, or for any US listeners or whatever, just explain the groups and the different opening times.
Yep. So there's 5 groups that are just divided into alphabetical order. So like group 1 is stocks with tickers beginning with A or B. Group 2 is stocks with tickers that start with like C through to F, and then it's G through to I can't remember now. But yeah, so it basically they'll open like 2 minutes apart, and it can open in a 30-second window. So it's the first group will open at 10 o'clock in 0 seconds plus or minus 15 seconds. So it could open at 9:59 and 45 seconds, or at 10 on the dot and 15 seconds.
Yeah. Do you know why they do that?
No clue. I think it's just the way they have always done it. So
yeah,
I think it's a good thing that it's not just 10 o'clock on the dot and then everything goes crazy.
Away you go.
Yeah.
Does that sometimes give you a bit of an advantage in itself? Like, let's say...
I think there's a bit of an edge because you can do more stuff, right? You can look at more things because you've got time. You don't have to, I guess, prioritize as much into like 1 or 2 trades, because you can do something in group 1 and you still have like a bit of like 5 minutes until group 4's opening, or like 8 minutes until the last group opens.
Does it also potentially give you a bit of an insight? Let's say a stock opens in group 2.
That's an oil stock, and there's one in group 5, exactly. And you get an indication. Yeah, sometimes I look at that. Like, you could probably get a read through as to what the market's thinking. So if an oil stock in group 1 opens and it's down 5%, but the one in group 5 looks like it's only going to match down 1%, you can either be like, oh, well, maybe this one's off too much, or that one needs to sell. So yeah, you can play around with that.
Do you do those sort of things, or have you got enough to focus on?
I think there's enough to focus on where there's better probabilities, but if there's nothing doing, then I might look at something like that.
Yeah. So what are some of the things which you're looking at as kind of a catalyst to decide what's going to go on your list? I know you briefly mentioned it before, but can we go into that a little more? Like, why would a stock go on your watch list? Like, maybe just an example of sort of one that's it's on your list because of a news catalyst of some sort. Like,
yeah. So I mean, news by far is the best.
Is there any sort of news, like a particular
earnings announcements are usually pretty good, or like contract wins, or that sort of stuff, really.
Okay. What about like the broker upgrades and downgrades? Like, it's not so much news, is it?
Yeah, I mean they're good. Like, the stock will usually be in play, but I wouldn't say it's as like they can be powerful, but then sometimes they don't work. Like, it's a bit of a hit and miss type. So yeah, I wouldn't say I'm like constantly trading broker calls, but it just is another string to your bow. When there's not much news, then hopefully there might be a broker call, so there's something you can do.
Okay. And one of the things I've noticed is it seems like you're quite knowledgeable about certainly not every business on the ASX, but there's a lot of businesses which you seem to know quite a bit about, or I get that impression anyway, like, you know, who the management is, what they've done in the past, who's holding this, you know, when they sold their shares, etc. Do you spend a lot of time researching that sort of thing, or is it just kind of...
I think it's just being around it like 9 hours a day, like from 7 a.m. to 4:10. You know, you just kind of pick up on things. And I guess I'm kind of like a pretty cynical person. So, like, I'm always looking for the negative in something.
Yeah, typical short seller. Because of that, I believe you actually got into some, I'm not going to say legal strife, but you had some sort of, you received a letter or some sort of notice to sort of stop.
A cease and desist, yeah.
Okay. Can you share that story? Because I don't actually know much about it. I've heard you like mention bits and pieces, but yeah, what happened?
Yeah, so basically there was this stock called GetSwift. A fair few of the Australian like traders or investors have probably heard of it. But basically I was just kind of surprised at how quick this thing went up. And then one night I was just bored, so I went on my computer and like started doing a bit of research. And then I just whipped up like in 2 hours like a 4-page summary of what I thought of the business. And then I just posted on Twitter. Like, this is kind of just when I'd started using Twitter. I think it was back in like October last year. And then, yeah, a couple of people read it, and then I'm like, oh, okay, well, yeah, people seem to be interested in the thing. So I was like, oh, okay, that's pretty cool. And then like 2 weeks later, I get this email with a cease and desist letter from their lawyers saying that I breached like all this ASIC stuff, and you know, we're reporting you to ASIC, like what you're doing is blah, blah, blah. Like, I can't remember exactly what was in the letter now, so I'm just like, oh, crap, like, what's this about? Yeah. Like, I'm just a day trader at home in my underpants, and you're coming after me, like, for all this stuff.
So what did you think of the company? Like, what was in this 4-page report that you put out? I mean, I don't know if you can go into the details of it, or if
I think it's still on, it might still be on my Twitter somewhere. Okay. But yeah, I was basically just going through, because the way they structured like their performance rights and stuff was based around, you know, numbers of deliveries. So they're like an app. I think they call themselves like the Uber of delivery, or like logistics or something like that. So they would sign up businesses and then give them this software, and they would get paid like what they said was 30 cents for every delivery that was done using their platform. And they their performance rights were based on how many deliveries they were doing. And I didn't think that was right, because, you know, if you're a shareholder, like, do you really care how many deliveries? Like, you want to see, I think it made more sense to see revenue-based performance rights being granted, not deliveries, because, you know, if you put someone on a trial and they're doing deliveries on the trial and they're not paying for them, well, that's a little bit deceptive. Mm-hmm. And basically, a lot of their announcements were like pure spin. Like, I didn't think they were being particularly truthful about like some of the contracts, and they were embellishing a fair bit. I thought, like, they're like, oh, this contract is going to be worth, you know, $1.15 billion in revenue or whatever. And like, since then, I haven't heard a single thing about any of this stuff. The only announcements they've been coming out recently is the fact there's like 3 class actions pending on them.
Oh, really?
Yeah.
So was this a newly listed stock at the time?
I think it listed in December 2016. So it had been on, when I like wrote the thing, I think it had been on for like 9 months or something.
Okay, right. And it's still obviously tradable today?
Yeah, it went up to like $4.50 or something from a 20-cent IPO.
Oh, wow.
And then, it's now at like 35 cents or something.
Okay.
So
so were you short it?
I would short it intraday, but I'd never held like an overnight position short in it, just because like that's one of my rules. I don't hold overnight. But yeah, it really like rubbed me up the wrong way, like them trying to go legal on me. So I then just went to the AFR and then gave them all, because I was going to write another report. Like, I was in the process of writing like a more in-depth and I guess a little bit more of a professional report on what I thought, because I'd done more research. Mm-hmm. And then they send me this. So I'm like, all right, well, I shouldn't push the envelope. I'm not going to say anything else publicly. So then I just went to the AFR and said, here's all the information. And then the AFR basically just went to town.
Did they really?
Yeah.
What'd they do? Write articles?
Just writing articles, and then that started doing some of their own research, and yeah. then the whole thing blew up.
Okay. So what were they threatening, like, in this email?
They were saying, like, they were calling it, like, stock price manipulation or something. And, yeah, I was in breach of, like, Corporations Act, like, a bunch of these things, and we've reported the thing to ASIC, blah, blah, blah. Like, it was pretty much just a shakedown. And I just went to see a lawyer, and I showed them, like, everything that I'd written on the internet about the company, and they were like, oh, I don't think you really have anything to worry about, but don't go, like, poking the hornet's nest. Just don't post anything else.
Yeah.
So I'm like, okay, fine.
Did you ever hear anything from ASIC?
No. It was probably a bluff.
Yeah.
Yeah.
Okay. That must have been a bit of a red flag in itself that, a company was coming on to you that strong after, like you said, a day trader at home just...
Exactly. Like if I wrote a 4-page research piece on Telstra, I'm not getting any cease and desist letters from them. They're like, well, the proof is in the pudding. Not that Telstra's a great stock, but yeah.
No, absolutely not.
The point is they're legit, you know.
Did you trade Telstra a couple of weeks back after their investors meeting? You know, when it had that
I
big
did,
gap
but
down?
not successfully.
Okay. Yeah. How come you weren't successful in that? Like,
I think with that, because it's like, it doesn't have huge moves and the book's like so thick. So I get like a bigger position on where I might be like $500 or $1,000 a tick. So then like I'm kind of like super reactive and a little bit uptight about it. Just because there's like, there might be, $5 million on the bid or something, and that will just get instantly wiped. Like it's no issue kind of thing. So that means your risk is a little bit higher because it can go against you, like, because then you've got to cross the spread to get out again. So it's another thing that I need to work on. But I prefer usually like a little bit less liquid stocks.
Yeah, because I traded it that day as well, and also not successfully.
Yeah.
And I just feel like a bit of an idiot afterwards. I was like, I felt really naive actually trying to trade a stock like that, just because it attracts a very different sort of participant.
Yeah.
And I don't know, it just was something I should have stayed out of.
Yeah.
But
it's not like one of my favorite stocks to trade. But yeah, again, it's something that I need to get better at because there's a lot of liquidity there, and if you can get comfortable trading it on these catalyst or these news events, it can be pretty profitable. So,
do you find that there's always opportunities each day? As in, like, there's always a catalyst or there's always a stock in play? Yeah,
there's always something. If there's nothing, it just means you haven't looked hard enough, or you're too hungover or something like that.
Okay. And where do you get most of your information from in the morning? Like, where are you doing sort of your research and prep? Like, are there any sites that you frequently visit or?
So I've just got, like, first of all, like I was saying, those ETFs and stuff into like in my iris. So I just bring that up each morning. That helps me populate the list. And then I'll look at other stuff like investing.com is a decent one. So you can get live commodity prices on there. FinViz to see like what sectors moved in the US. They've got like a market map thing as well.
Mm-hmm.
Also the iron ore futures in the Dalian Commodity Exchange. So there's a link there that I look at, but that's pretty much it. And also AFR. Okay. So I'll just peruse the AFR and see what people are talking about, because that can be pretty good.
Yeah. When you're looking at these ETFs, what are you actually looking at? Are you just looking to see, if the oil ETF's up 3%?
Yeah,
overnight?
So it's more just like the magnitude of the move. Like if a copper ETF's up 5%, then I'll be looking at copper stocks to see if they follow here. Or the lithium ETF gets smashed or something, and then you might look to short lithium stocks. So that's kind of just one way of getting trade ideas.
Yeah. Would that be enough for you to actually get involved in some copper stocks? Like just the fact that the copper ETF might be up 5%. How do you then decide which copper stocks you might actually take part in?
So I'll just look, I'll have them on my watch list, and then I'll watch just before the market opens. Like if I see buyers rushing in, or it looks like this thing wants to go, just by focusing on the market depth, then I'll make a decision based on that.
Okay. And you're obviously also taking into consideration if like how up or down a stock might be during the match as well.
Yeah,
like
yeah, exactly. So like if, say, the copper ETF's up, 5%, but like Oz Minerals or Sandfire or something is up 10%, well, then I'm probably not going to buy that because I think, it's probably gapping too much to get involved.
Yeah, okay. Now, just sort of talking about some of the setups and strategies that you trade today, I noticed that most days you post something on your Twitter, just a quick review of the day, like a trading report. You often grade your setups.
Yep.
I'm interested to just hear a bit more about why you do that, how that actually influences how you trade each of those setups. Can you just share a little bit of insight to how you actually do the grading?
That's kind of based on around I guess Mike Bellafiore's trade review thing, and then Austin Mitchum started doing that. So then I'm like, maybe I should consider trying to grade or rank what I'm doing in terms of is this something where I've got a huge edge in doing, or have I taken that trade sort of for no real reason? So I think it's just important to internalize what you're doing right, and then also what you're doing wrong. And that's kind of what the whole idea of grading the setups is about.
If let's say you have a setup which is grade A in your books, and then you have one which is a C, how are you going to trade each of those differently?
Well, see, I wouldn't say I'm particularly thinking, or at least I haven't in the past been thinking about is this an A plus setup in the moment? This is more like a reflective thing where I'm grading it. So but now what I'm trying to do is start to think, in the moment this is an A plus setup, and then you want to be at your biggest size, and you probably want to hold for longer if it's A plus.
Okay, let's speak about your sizing. We'll come back to this bit more about some of your setups and your particular plays, but how are you sizing into your trades? Are you still thinking about the tick value, which you spoke about, earlier on, or?
Yeah. So I size probably more around, partially around what the tick value would be, but also the liquidity around me. So I don't want to be in something where it's going to move the price 3 cents or something before I can get out, because I'm way too big for the liquidity around me. That kind of just ends in disaster a lot of the time. So I'm sizing based on how much protection I have in the book. So if I'm shorting something and I've got 50,000 units, I want to see 70 or 80,000 other units offered, so that I've got protection if the trade looks like it's going to go against me. Mm-hmm. So that's kind of what I'm looking for mostly.
So it's kind of governed by, like you said, what's available, how much liquidity there is, what's in the book. Do you find in the Australian market that there's much that kind of the liquidity disappears? I don't want to say spoofing, but do you find that there's much of that, sort of liquidity that appears to be there, but when you actually sort of come to trade it, it's not really there? Yeah,
there's a fair bit of that. I think that's a lot of algos will have spoofed orders in there, and then you see as it moves, it might move down, and then they'll on the buy side they'll move back, but that usually is an indication to me that there's a seller in this thing, and they're propping the book so that people think, I've got plenty of protection here, I can buy this kind of thing, and then they step back. So it's a good, if I see that and I'm short, it's something that's going through in my mind, I should probably hold this because there's obviously a motivated seller in here, because they're propping the bid side of the book.
So does that always seem genuine? So what you're just saying is if you're short, there's a big bid at, let's say, $5, and then suddenly
as the price moves to that $5 thing, or that $5 level, you'll see the bid. It might move back to $4.95 or $4.90 or something.
Yeah. Okay. So if you see that sort of action, you'll tend to hold that position for a bit longer.
Yeah, I want to hold it until I see actual real buyers stepping up, and then I'll look to cover.
Okay. So let's go back to your kind of some of your setups or your particular plays which you like to get involved in. And obviously I don't expect you to share all of them or your best ones, but can you just give us an example of maybe a recent trade which maybe checked all the boxes for you?
So there was that COB trade, Cobalt Blue Holdings, which was, I think, or the Wednesday before last, which, was truly an A+ setup for me. So it was a short, like major news catalyst there. Pre-feasibility study or something was being released. It's relatively illiquid, so you know that if anyone wants to sell, they're going to have to do it over a number of days. It's not just because there's no liquidity, they can't get it out fast, so they just have to keep selling. So I thought there was huge potential for a big move. So that one checked all the boxes, and I got like pretty decent size in it as well. I think I was like about 2/3 of the match volume.
Wow.
And then, I covered way too soon, so still kicking myself about.
So that was just an intraday trade again?
Yeah. I was out in like 20 or 30 minutes. So like I say, all this stuff, like this is one to hold, they're going to be selling for days. And then there I am taking profit in 20 minutes. Like, just drives me mad.
Oh, was that something that you traded again the next day? Like, did that stay a stock and play for a few days?
Yeah, I traded the next day as well. Again, not well.
Okay. Right.
I still made money, but again, like there was no reason for me to take profit other than like, just I guess trading my P&L.
How much was this stock? Like, was it
denomination wise, or
like was it a couple cents or?
No, it was. I think it opened at 88 cents.
Okay.
Yeah. And then I think it closed the first day at like 70 cents or something. I think I covered most of my position at like 78 cents. So
right.
I made like 10 cents or whatever on the thing.
How do you control, I guess this is maybe a bit of a psychology question, how do you control your mindset in those types of scenarios when you're like, like this, you had a lot of size on, a really good trade, went in your favour, you're now looking back on it, you go, I took it off too early. How do you not sort of become too caught up in that? Because I feel as though you can do that all the time.
What do you mean, sorry?
Like, in hindsight, I guess I'm talking about hindsight here.
Right.
Like, you often see a trade, you got out and it kept running. You're like, I should have held that.
Yeah.
Or I should have done this, or that sort of thing. Like, how do you stop yourself from falling into that trap?
Of like being too critical of yourself,
I guess so.
I think I just do fall into that trap. Like, but that's one of the great things about trading, right? Is you're never gonna, trade something perfectly. There'll always be room for improvement. And then for someone like I'd probably describe myself as a bit of a perfectionist. Like, keeps me motivated to come back the next day and try perfect it then. So I guess it just keeps it interesting if you keep making mistakes.
Yeah, I guess that's the good thing about day trading is there's always so much happening, and you can always
there's always
each
tomorrow.
day's a new day.
Yeah.
Is there been any other trades recently which maybe checked all the boxes again, which was a good setup that you would take any day of the week?
Yeah, there was probably that ISD trade, which I think the ASX made a mistake. They released some price sensitive news as non-sensitive, and I just saw it straight away and bought. And then the thing went from I think I bought it at 70.5. I kept adding to about 75 cents, and then it went up to 83 cents or whatever, and I held that one pretty well. So I guess the catalyst there is news, and I've just got speed of execution. Saw the news quickly, shoot first, ask questions later mentality.
What was the news on that?
It was just they reaffirmed their full year guidance, and it had been a stock that had been constantly downgrading. So my quick thesis in my head was, the downgrades have stopped now, so that can only be a positive thing. So I was tilted, my bias was to the upside, so I just bought.
Okay, so I think you said you bought it 70 cents initially?
70.5, and I added, so I had an average price of around 72, 73 cents, around that.
Okay, so how did you add going up to, was it 75 cents when you stopped adding?
I was lifting offers.
Yeah, but like what? The entire offer, or
it wasn't like super liquid. There was I remember there was a drip seller at 70.5 when the news hit. So you could have got like a decent amount of liquidity on that iceberg seller. And then he lifted. And then once he lifted, I was like, oh, okay. So there was like maybe 50,000 shares between 70.5 and 75 cents. So I just kept adding. And then I went to sell some at 74. I tried to sell maybe like 1/5 of my position there or something. And I'm like, crap, what are you doing? Like, this is dumb. So I canceled the order. Some other seller came in and I bought it again. And then I added 75, I think, from memory.
And what are you doing when you're in a position like that? Are you just doing market orders?
Yeah, but I'm doing it all manually. So I'll just have like a bunch of buy tickets up and I'm adjusting the price with it. So, but I wasn't sweeping the order book. I was just taking them as the bidders stepped up, like in front. So,
And what if that trade hadn't have worked out? Like, what was your exit plan in that sort of
70
situation?
cents. There was a fair bit of liquidity there.
Okay.
But at that point, like once I saw how quickly the buyers stepped up, like I just knew I was right. It wasn't going to go down. So,
how do you think about an exit plan? Like in your strategies, or sorry, not your strategies, but when you're trading, how do you think about? Do you use stops?
No, it's all like manual mental stops. Yeah, but that's probably something I also need to start developing, like thinking bigger picture and maybe preparing a little bit more before taking a trade. Because at the moment I'm just doing stuff like off the cuff, like I see it and then I do it. And I don't really put that much thought into, where my exit is going to be. Because I guess a lot of like what I do is pretty feel based. And I think I need to step away from being so like feel based and more, I guess, structured in terms of like having a plan for what I'm doing.
Okay. So do you have a rough idea on where you're going to stop out on a trade if it moves against you, or is it again sort of dependent on what you see in the...
I'll usually just stop out a trade once, like if it goes against me, I'm just out. Is pretty much where that's how I manage risk. Like if I put on a trade and it doesn't move for me straight away, I'm pretty much out.
Yeah, okay. So if it was to just continue sideways but sort of not really come too much back, you're going to just get rid of it?
I mean, if it's moving sideways and I think like there's still potential for it to work, then I might hold it. But if it goes the opposite direction to the way I want it to, then I'm straight out.
Done with it.
And then like I can always reassess in a couple minutes or later if I still think the trade could work. But I'd rather just get out, scratch it, and then start again.
And how about taking positions off? Are you normally sort of all out at one price?
Yeah, I'm very much like I'm in the entire position like in one go, and I'm out in one go as well, which is something that I should probably start trying to scale out of stuff. But the problem is like I'm a bit of an adrenaline junkie, so once the position's not as big as what it was, then I like lose interest. Okay. I'm like, oh, this is boring.
Yeah, right.
So then I'm just like, oh, we'll just get rid of this.
Do you find that you get that still in your trading as a bit of a kick when you are, when you do have a bit of size on?
Yeah, definitely. Yeah, I still feel it. Yeah.
Do you think that's a good thing? Like, does that make you perform better? You think more alert, or?
I'm definitely more alert, but I wouldn't say it makes me perform better. I probably need to calm down a little bit and identify like if I am, feeling like a kid on Christmas, that's probably an A+ trade and I should just like relax and hold. So
how much of your money is made in the first 30 minutes of the day?
Probably 70 or 80%, I would say. That
much?
Yeah.
Really?
Yeah. Like you get your odd good midday trade, but I'd say a lot of the my best days, like I'm making most of the money in the first half an hour to an hour.
Right. And what about during the close, like that last kind of...
I don't usually take that many trades then, because like I don't know, I'm just a bit tired by then, because if I'm trading in the States, like it's close to midnight, it's after midnight, so don't want to do anything stupid.
So even though you make most of your money during the the open that you're still sticking around for the rest of the day.
Yeah, I'm watching 100%.
Are you still trading during the, after 11 o'clock?
Yeah, I'll
Just
still be trading.
Smaller? Or?
Yeah, I might be smaller. And sort of then I'm looking more at, mean reverting stuff, like, fading stuff that I think's up too much, or like buying a dip or something like that, which are just like, your smaller, like kind of income trades, I guess you'd describe them as, like wallet padders.
Yeah.
Yeah.
Yeah, I like that term. Now, I can't remember what it was. It was a few months ago. You crossed $1 million in trading profits.
Yeah.
When was that?
I think it was at the beginning or middle of May.
Okay. And that was and how long had you been trading at that point? Must have been, 2.5 years?
Yeah, over 2.5 years, yeah.
Yeah. What was that? What did that feel like when you crossed that $1 million mark?
It was just like, I guess, just an arbitrary number. Like, yeah. I kind of like, I don't really care that much about the money. I don't spend my money on anything other than like, having a good time with mates or something like that. So I don't need $1 million. So I'm just like, oh, okay, that's cool. Like, I have financial freedom, but it's not like I wasn't like, oh yeah.
Yeah.
I was like, oh, that's pretty cool.
I imagine there must have been a point where you kind of gathered that it was only going to be a matter of time until you did.
Yeah, I think that's also another thing. Like, it was just, a matter of time, because I've been profitable since I started pretty much. So it's just like a matter of like when, not if.
Why do you think that is? Why do you think that you were able to make money so quickly?
Bryce's mentorship, for sure. I think like if I went out and did it myself, I would have figured it out, but just being able to cut down that learning curve was like massive. Mm-hmm. And I guess like having him there to like bounce stuff off, it gives you like a certain degree of confidence. So yeah, that was easily the reason that I was as profitable as what I was so quickly.
Yeah. Do you think there were other factors to it as well? I mean, certainly don't want to downplay what Bryce, had done for you.
Yeah.
But I just know, in having conversations with Bryce, he sort of said things like, Nick's just a freak. Like, if he had have tried to train up someone else, he'd probably have like 10 people or so who wouldn't be able to do what you've done.
I'm sure I have some sort of like skill in what I'm doing. Like, it's just something, it's a game that suits my personality. And I mean, that's probably half the reason that he was like, I guess I wouldn't say he was pressuring me to start trading, but he was like, oh dude, like you should really give this a go. I think you'd be good at it. So like, he obviously saw something in me that he thought I would be good at it. And I know he might have been surprised that I picked it up so quickly.
Yeah. What are some of the things which you think you do well? Like, what would you say are some of your strengths as a trader?
Risk management, probably, like just cutting losers quickly. I think that's something that, I guess like you were saying in that Rambo interview, like learning to lose. Like, I've always just been able to take losses and it not like affect me too much. So I think like a lot of people comment, like when I post my things, they're like, oh, like your losers are always so small. It's just because like if I start to see red on a trade, I'm just out. Like, there's no ifs or buts about it, really. There's no point fighting it. So like I might be, fading a stock, like say if something's like too far from VWAP or whatever, and I'll start shorting it, and then like it keeps going against me. Like I'm not holding stuff on the front side of a move. Like, I'll just get out and then try it again in like 10 minutes if it goes further. So just cutting losses and like knowing when to give up the fight, I guess.
What do you mean by the front side of the move?
So basically there hasn't really been like any evidence to suggest that it's going to go down. Like sometimes I'm just too early on the trade, like to fade, whether it be something that's like tanking and then I'm like trying to buy for a reversal to VWAP or something. Just being in too early instead of entering like once there's been like an obvious signal that the flow is about to turn.
Yeah. Do you find that you're often getting in before the moves kind of happen? Or
what do you mean, sorry?
So let's say you have a level which you've identified as kind of like a key level which you think is going to trade and continue to move past.
Yeah.
Do you often buy or sell or enter in anticipation of that level trading? Or do you sort of jump it when everyone else is jumping in?
Probably when everyone else is jumping in. Like I wouldn't say I'm like a huge like charting guy. I'm probably more like watching the tape and order flow is sort of what I do, more so than like worry about levels as much.
Okay. You even get like levels though that you'll see in the order book, like at a certain price, you'll just see that it's just someone keeps buying at that price. Or, are there certain patterns which you look for in the order flow?
Yeah, I mean, so like you're saying, if you see there's a buyer at this particular level or whatever, and you know you feel like it's starting to get a bit heavy, and he's like taking all he can eat, then I'll just be watching that level, and then if the buyer drops, it's a good opportunity to short because you know everyone else is going to see that, and then people probably rush to sell because there's no buy there anymore. So yeah, I'll look at that stuff.
Now, I asked you just before, what are some of your kind of strengths as a trader? How about on the flip side? Like, what are some of your weaknesses, I guess you could say? I know you often say in your trading reports, I was stubborn on this trade or that sort of thing.
Yeah. One of my weaknesses is I short stuff too much. Like I'm fighting a losing battle doing that because everyone just wants to buy, right? Like it's just human nature to want to buy, not the other way around. So I need to get better at, instead of, you know, I might see a positive news catalyst and then instead of buying it when that's the obvious trade, I'm like finding areas like, oh, where can I short this? So I need to just trade with the flow rather than against it. So that's something that I need to improve on. Other weaknesses, like, I don't know, maybe I'm too self-critical. And maybe I just need to like relax on being so harsh on myself when like I don't get a trade right, and just kind of relax a little bit more.
Do you find that it ever throws you off for the rest of the day? Like if you, let's say, stuff up a few trades on the open or make some silly moves?
It annoys me, but like not as bad as if like the internet drops out. That's like the worst thing.
Yeah.
Like if I have like technical issues, like that will throw me off. Like that, I'll just go crazy. If like, you know, an order fails or something like that stuff just grinds my gears like big time.
How's your current setup working for you?
In where I'm staying with mates, or it does the job.
It's all right.
Like not as comfortable as being like at home, like back in Texas, but yeah, just need a chair and a desk and some screens. It's fine.
Yeah. Do you set yourself like a loss limit for the day? Like
no,
nothing like that.
No. It'll be like I used to kind of just step away if I was down. But then like I've got a lot better at just grinding back through the day. So I'm just always hunting. But then if I'm down, like for example, on Friday, I think I was down like $2,200 or whatever. And like just nothing was working and the market was pretty dead. I'm just like, if I try and, you know, take any more trades today, like this is just going to get worse. I'm just going to be paying more in brokerage. So I'll identify when enough is enough, but I won't there's no like a loss limit that I set.
Yeah. So you don't have a fixed amount. It's more just how you're feeling.
Exactly. Yeah.
Yeah. Okay. You know, based on your experience as a trader, what are some of the things which you think maybe more amateur traders could work on or could do to help themselves improve? Like, what's been really key for you? Obviously, having a mentor was a big help.
Yeah.
But you know, besides that, some things which you know traders can do on their own. Well, what comes to mind?
It's a tough question.
What about like the trader reports? Have they been beneficial for you?
I know I've kind of stopped doing them, like part out of laziness and part out of like I'm not sure like how much value I'm getting out of them. But yeah, I mean that's always a good thing. I think like having a mentor is key. Like
if you were starting out today from scratch, like, how would you try and get to the position you're in now as quickly as possible?
I guess I would say, like, just focus on trying to do one thing and do it well. Like, that's how I became good, right? Like, I would just do this one trade that I knew worked and I had confidence doing it, and I'd increase my size, and then that just buys you the time to start finding, like, other stuff. Like, over time, it's just a game of pattern recognition, right? So the more you're sitting in front of the screens, the more you're absorbing, like, information and, like, living and breathing, you'll just pick up these other patterns, and yeah, you'll just naturally adapt to other stuff. I think, like, for a lot of people as well, like, I'm not sure that trading's necessarily their passion. They like the idea of, oh, I'm a day trader, I'll trade for an hour and then I'll go to the beach and, you know, have lots of money and stuff. But it's not like, I think if you want to be good, you've got to treat it like any other 9-to-5 job. Like, it's serious. You're not here to, like, play around.
Yeah, there's certainly a group of people who sort of see it as a path to freedom, right?
Yeah. There's a prison.
Yeah. You know, like you said, you're in front of the screens from, I don't know, what time do you normally get in front of the screens?
Like 7 a.m.
7 a.m.
Yeah.
Okay.
About then.
And then the market doesn't open. Well, pre-opens 9:50, right?
Yeah. It opens at 10 o'clock. Yeah. So yeah, I'm, like, just constantly there. Like, I don't even eat lunch.
Don't you?
No.
Yeah, some of the traders at the firm don't either. I don't know how they do it. I get so hungry.
Yeah.
I mean, I'm always eating at my desk, but I don't know. Can't be skipping lunch.
Don't get between a man and his food.
Yeah. What's Gordon Gecko say? He's got that quote, doesn't he? Lunches for wimps.
I don't know. I can't remember.
I think
it's been a while since I've seen that one.
You know what you're doing tonight. Go watch Wall Street.
That's it.
Why do you think most traders don't succeed? I guess you probably outlined some of the reasons.
Yeah, I think that's part of the reason. Like, I think a big reason for success is, like, you just have to be, like, passionate about it, right? Like, you know, when I go and hang out with, like, Bryce or Austin or whatever, like, go have a beer, like, we're just constantly talking about trading. We're not talking about, like, the weather or anything like that. We're just, like, we live and breathe the stuff. So, and I just don't think, like, for a lot of people, like, it's probably not that stimulating or, like, interesting for them. Like, they're just doing it because, like you said, they're looking for a path to freedom. But I don't think that's the right approach to take. Like, you genuinely have to be, like, passionate and interested in, like, in what's going on.
That's it. Like, you can make a fortune doing pretty much anything.
Yeah.
You know, you just got to be at the top of whatever that industry or that game or whatever you're playing in. Like, you know, the people at the top of anything are making a lot of money. So to think that you should only be a trader because you're going to make a lot of money, I think is kind of flawed.
Yeah. Like, if you look at all the, like, you know, successful business owners around the world, like, you know, you Bill Gates and, you know, even Elon Musk and stuff, like, these guys are just living and breathing, like, what they're doing. Like, they just love it. So that it, like, I don't think of trading as a job. Like, it's just something I enjoy to do, and the positive benefit of it is, like, I make money doing it.
Yeah. I think, I can't remember if you've said this to me in the past or I saw you saying it to someone else, but you think that it's really beneficial to just sort of throw yourself into it.
Yeah, 100%.
In the beginning.
I think too many people try and, like, over-plan starting, but you just got to, like, go and do it. Do you know what I mean? There's no point, like, beating around the bush. And, like, I get a lot of people asking me, like, what's my strategy? And, like, I mean, it's, like, a fair enough question, but I always think, like, my strategy is to make money. Like, I don't have a strategy. Like, it's just to make money. But, yeah, people just want to be, like, want to develop, like, this black box type way about, like, going and trading, like, where I can just, you know, put this trade on and then have a stop loss here and this is how it will work kind of thing, and make it, like, all mathematical. But I think you've just got to, like, go in and immerse yourself and do it, you know?
Yeah.
Like, I'm not saying, like, there's obviously plenty of room for that, and a lot of people are successful doing that.
I know what you're saying.
But, like, for the most part, like, especially for myself, like, I'm not that smart. So I'll, like, let the smart people do the algo stuff, and, like, I'll just do what I'm good at.
And I said as well, like, some of the people who hit me up who listen to the podcast and that, they'll say, oh, you know, I've been paper trading for the past 2 years, and just like, man, that's overkill.
I also think paper trading is like the worst thing you can do, because like you don't, it completely changes like once you have risk on. Paper trading allows you to like mask your deficiencies very easily, because you can be like down $2,000 on a paper trade and you're like, oh, well, I'll just hold it because there's no ramifications, and then you're up and then you think you're a profitable trader. But like that's not the case.
Yeah, absolutely.
I would never like recommend like anyone paper trades. Like just do it. Like even if it's for a couple of bucks, like just have some risk on, because you just have to learn how to manage that feeling.
Yeah, just get a little bit of skin in the game.
Exactly.
Yeah, I mean, you don't have to be, hitting huge size.
No.
But just put...
Even if it's like, $5 a tick or something, or like $1 a tick.
Exactly.
Like, you're not going to be, like, you're probably not going to cover your brokerage, but at least you get the feeling for the process of like doing a trade, even just getting good at order execution, like, because there's a lot of, I'm pretty quick at like executing orders, and I know like a lot of the other day traders I speak to like pretty good at that, but I think that's also an area where people aren't as good. So if you're paper trading, like you're not learning those skills, and you're just better off having some skin in the game.
Yeah. How do you deal with that, the fast execution? Like, do you set up hotkeys or anything like that? Do you have any tricks there?
Not really. Like I just, I do have like a shortcut to bring up like buy and sell tickets, but then from there it's all like manually typing in the ticker code, volume and price. Okay. But yeah, at the beginning, like just before the open, about like 9:55, I'll bring up like 5 buy tickets and 5 sell tickets, and then I'll pre-populate the ones that I think I'm going to trade, and then just adjust from there.
Okay. And how many stocks would you be trading on any given day? Like you said earlier on that you normally have a list of about 40.
Yeah.
How many of those are you typically actually going to trade?
Probably like 8 to 10 maybe on average. But I generally find that my best days are when I'm trading less names. But also like when there's days where there's not as much doing, you've kind of got to go out and find more stuff. Like you might take 12 trades, but you might only be making like $300 or $400 on each trade, and then a couple of them are losers. So you just have to trade them to get your like P&L up, if not much is happening.
Yeah. And those stocks where, you say on some of your best days you're trading less.
Yeah.
Those stocks that you are trading on the days you're trading less, are you typically sort of in and out of those, sort of trying to...
Sometimes, but I think it's more just there'll be a huge catalyst, like obvious catalyst in these particular stocks, so you can just afford to dedicate your entire like time to watching those. Like there's no point going out and like wasting time watching something else.
Now I know you get a few questions from people who follow you on Twitter and that type of thing. Are there any questions which pop up time and time again which you get asked frequently? Besides, what's your strategy?
That one comes up a fair bit. No, like none that like spring to mind really. I get a lot of what reading. Are there any like books, or do you have a blog or something like that? And I usually will always like point people to read Bella's books, like One Good Trade and The Playbook. They're awesome. And pretty much how I've modeled myself in terms of like developing a list of stocks in play, and I guess to really nail down the process of what I do each morning, kind of thing. And I just make it very structured.
Do you think there are any questions which I've missed or should have asked you about? Like, are there any topics which you'd like to speak about which you haven't done yet?
Nothing that comes to mind.
Okay. What about poker? I think when we were speaking like the other week, you said that you think trading's a lot like poker in many respects.
100%, yeah.
What do you think of the similarities there?
Probably psychology. Like I personally think that trading is probably 95% psychology and maybe 5% skill. And also there's just like other comparisons. Like I wrote a little like note about it in like on Twitter and posted it about my cob trade, and like thinking through the trade a little bit more in the same way that the best poker players will think through the hand. They're not just like, they don't care, or they care what cards they have, but they're also thinking, what cards does that guy have? What does he have? Like, what's his range, like what could he be doing here, and then he's thinking the same stuff like, what is he thinking that I'm thinking, and the point is like they just go into a lot of detail and think about like all these different scenarios, and I think that's something I need to do better at, kind of thinking through the trade a little bit more, like being big picture, like in that cob trade, understanding it's in a liquid stock. They're going to have to sell this thing for days. It was bad news, like it's effectively company breaking news. Just thinking bigger picture instead of like, being the kid in the candy shop and like taking the trade off just because like I'm up $7,000 or whatever.
So what are some of the things you're trying to get better at? Like, do you have specific goals or anything like that?
Yeah, I want to like really like nail A+ trade and just basically hold for longer. Like I made some strides in that department. Like after I wrote that little thing on COB, I had like a decent trade in ELD when they had a profit downgrade. Like I held for 35 minutes instead of 20 minutes. So I was like, I pat myself on the back. But again, like out way too quick. I think I shorted at $8.30 and covered on average around like $7.90, and the thing went to like $7.05 if I just held for like another hour. Do you know what I mean? So just like left a ton of profit on the table there.
Yeah. Well, that's that psychology part, isn't it?
Exactly. Yeah. So I think I want to set myself like a goal to, if I've identified, okay, this is an A+ trade, I want to make it like my goal to hold for at least an hour and then reassess. So like hands behind my back. The only reason I'm covering this position is if it goes against me, like early, and then just reassess stuff at 11.
Yeah, I guess in doing that you kind of sacrifice quite a bit of profit.
Yeah, that's also a problem.
The tough bit. Yeah.
I did it the other day in, I think, Sonic Healthcare. It was up on like a broker upgrade, and I was fading it. It looked really nice, and I held for about an hour, and I was up like maybe $2,500 or something on the trade. And I'm like, okay, like I'm just going to hold this. Like this thing's going lower. Had a plan. I'll take half off at $26 and then take the rest off at $25.75. And then just reversed, and then I ended up losing like $1,000 on the trade. So it was like a pretty decent sized profit swing. So that's frustrating. But again, that comes down to like, that's not an A+ trade. That's an A+ scalp for me, but it's not an A+ trade because again, I'm like fighting momentum. Like it's been upgraded. People are trying to buy the thing, and I'm fading it. It's not something that I should have been holding all day.
Yeah, no, that totally makes sense.
Yeah.
Cool, man. Well, I'm just trying to think if there's anything else I wanted to ask you about. What have I got in my notes here? I mean, I think we've pretty much covered a lot of ground. Yeah, I think that's it. Is there anything else you wanted to add?
No, I think I'm good. Appreciate you having me there.
No worries, man. I was going to ask, do you plan on starting a blog? I know it'd sort of been in the back of your mind.
Yeah, I've got I'm not very good with like tech. Okay. Like websites and stuff. I got like a, I don't even know what it's called, but the
WordPress.
Yeah, I think that. And I've like started like tinkering around with it, but I haven't really got very far with it because I just like, I don't know, I'm trading or I'm at my screens like 9 to 10 hours a day, and then to like do that in my spare time, like it's probably a little bit much. So I've thought, maybe I'll just like any blog post that I want to write, I'll just write it in like Notepad or whatever and stick it on Twitter, like I have been doing.
Yeah.
Because that's just easier for me.
Okay, cool. Well, if someone does want to follow you on Twitter, what is your handle?
It's Longhorn Capital.
Okay.
Yeah.
At Longhorn Capital.
Capital, yeah.
Cool. All right, Nick. Well, I appreciate it, man.
No worries.
Thank you very much.
Thanks for having me, mate.
You've reached the end of this episode of Chat with Traders. But rest assured, there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes. And we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
Chat with Traders is brought to you by Trade the Pool. Did you know that every decade the market reinvents itself? Online brokers opened the doors, mobile apps made trading seamless, and commission-free trading erased barriers. Now, a new era has begun. Meet Trade the Pool, limited risk trading. And now you also have unlimited time to reach the profit target. From now on, your trading risk is capped, and your trading opportunities are limitless. Trade the Pool funds home-based stock traders with up to $200,000 in buying power. That means you can trade larger positions and scale your strategies without risking your own savings. It's time to trade with more capital, making it truly worth your time and effort. Ready to trade the pool? Click the link in the description and join the stock trading revolution today.
Are you ready to get serious about trading? Then join Tasty Trade, Investopedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade all in one platform. Get low commissions, including 0 commissions on stocks, so you can keep more of what you earn. Trade smarter with advanced charting tools, a pre-built strategy selector, risk analysis tools, and more features. Visit tastytrade.com/chat for more information. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC.
Markets, speculation, and risk. This is the Chat with Traders podcast, hosted by Aaron Fifield.
What's up, boys and girls? Welcome. Right now you're listening to episode 165 of Chat with Traders. I hope you're doing fantastic, and I hope you're about to enjoy this episode with my guest, who is an equities and also, to a lesser extent, I believe, an equity options trader, Michael Samuels. So I was actually introduced to Michael by an experienced trader and a fund manager who described Michael as being hands down the best trader I know. And having seen his performance, I can also tell you he is an advanced trader. Michael once traded for First New York and Apex Capital, and now he trades his own money under the banner of Broome Street Capital. Michael describes himself as being an event-driven trader. He focuses on news flow surrounding mergers and acquisitions, shareholder activism, and fundamentals to seek out what he calls valuation disconnects. Coming up, some of the things you'll hear about include Michael talking about merger arb strategies, including examples, stories of excessive due diligence, which I think you'll get a kick out of, time during his career where he's made mistakes, and more importantly, what he's learned from these mistakes, and plenty more. But I think there was also much more we could have discussed too. So at some point, I'm really keen to try and get Michael back on for a second episode. And just the last thing I'll mention here is Michael has also recently begun hosting a podcast of his own. It goes by the name of According to Sources. We talk a bit about this right at the end, but if you're curious to know more about merger arb and event-driven trading, take a listen to it because he's doing a great job. That's According to Sources. Now, folks, on with the show. Here is Michael Samuels from New York City.
We're just getting, I'm not sure how the earnings system or, in terms of timing is over there, but right now, like earnings season, sort of like we're just getting going, like we got the banks last week and now we're getting some of the big tech names. And so we saw Netflix last week and Microsoft is coming out any minute. But for me, there was a few trades that I got into today that I got whipped around a little bit today and it all ended up fine. But I had those moments where I'm like, oh my God, I can't believe I'm going to lose this much. And, Domino's Pizza, and then it comes in, but just got too big before a conference call, which is always a big mistake.
Right, yeah, no, it is earnings season over here as well, which has been very interesting. So yeah, let's hear a bit about how you actually got into trading. Like, where did you even start out?
So I would say that I'm. From an early age, and I mean like 10, I know that sounds crazy, but I wasn't really good at sports and those sort of things when I was young, so I didn't gravitate to those things. And when I was 10 or 11, my grandfather gave me some stock for a birthday, and for some reason I was just extremely interested in the tracking of that. And I would ritualistically wake up in the morning. This is when you had to still look up quotes in the New York Times every day to see how your stock had done, and see, I had shares of Coca-Cola, like 10 shares, and I would see that. And from at that moment, and I'm 37, so this is like 1990. And I would see, well, what are they would list stocks. What are the most active? What went up the most? What moved around the most? And you would see the same stocks every day at that point, which was Microsoft, Intel, Cisco, all those sorts of things. And so I wanted to make more money, or I wanted to make money so that I could invest in those. But I was only, 10, 11, and 12. So the only way that I could make money, and this was what my friends were doing, was to be a caddy at the local golf course. So I was a caddy at Wingfoot Golf Course from, 12, 13, 14, 15. And I was able to take that and to take some bar mitzvah money. And my parents were, encouraging, and they let me just put that money into those crazy tech stocks, like the Intels and the Microsofts, Cisco's. And as far as I knew, stocks only went up. And I didn't learn for a long time that wasn't the case.
So when did you eventually learn that stocks do come down also?
So I think I had a very grand plan in my head. So let's say from age 13 to 17, I saw, let's say $5,000 or $6,000 that I had been able to make caddying and in bar mitzvah money, that sort of thing. And that grew to maybe 900,000 or something quite close. And I didn't understand. And again, as I grew older, I got bolder and doing, getting involved in some of the crazier tech names, the names that like, true garbage that I didn't understand was garbage, but just went up a lot. And so I'm trafficking in these garbage names, and I'm seeing my P&L go crazy. And maybe I'm a freshman in college at this point, and I just thought, well, I'll just sit on this stuff, and by the time I'm out of college, I'll be worth like $5 million, right? And I'll be able to move to New York City. I'm going to buy this apartment. Life's going to be great. And by the time I was a sophomore in college, which is a year later, that $900,000 portfolio was probably worth about $150. And so I probably cashed out around $175, something like that.
Now, you told me this the other day when we had a quick chat beforehand, that you'd turn that 5K or thereabouts into somewhere close to 900,000, and my jaw almost hit the floor. How did that feel at the time? Like, I just can't imagine how crazy that would have been for you, being like a, 15, 16, 17-year-old teenager. Like, did you tell your mates about it? Like, how were you feeling?
No. Well, first of all, it just felt like a game, right? Because, well, for starters, while my parents would be very willing to encourage me to do this, there was no way they would ever let me touch that money. So to me, it was like, oh, I'm playing this game, and I'm watching this money go up and down. But because I can't touch it, it's not like I'm going to turn 16 and go buy like a Corvette. Like, that wasn't going to happen. So instead, I was just saying, well, how big can I make this? And no, I didn't tell my friends, because that's one of those things like I always felt awkward talking about that sort of stuff. And, I grew up in like a very middle class neighborhood, and to say, hey, I just, made this crazy amount of money would have felt weird, and it probably would have made me feel a little bit isolated from my friends, if that makes sense. So no, it was really just a hobby that I explored with my family.
Okay. And what did your family think of this?
They thought it was amazing, but they also, and, to this day, it's, my whole family, we have a family seafood business. And, but they're hobbyists as well. They love the stock market, but they never really, not much evolved from where I was in those days, which was you buy, you hold, and you watch it go up. And so they were of the belief that, hey, by the time just like me, by the time you get out of college, you're going to have $5 million. So everyone was on board. There wasn't someone that tapped me on the shoulder and said, hey, maybe you should like take something off the table, or, hey, you're in this pet company that sells pet food online. They don't make any money. Maybe you should sell it. No one was ever doing that.
Okay. Wow. What a crazy time.
Crazy time. I wonder if I had been trading now as an adult in that time, what I would be like. But, we'll never know.
So what did you do after college? Like your 900 grand had shrunken to 150. What did you do after getting out of college when you didn't have that $5 million that you were thinking you may have?
Dream deferred, right? So I guess, for me, I had two passions growing up. One was investing, and the other one was broadcasting and the radio. And if you ask me, when I was 12, what do you want to do when you grow up? I wanted to be on the radio. My heroes growing up were Howard Stern, and we have a local broadcasting station here in New York called WFAN, which has these two guys named Mike and the Mad Dog. So I listened to Howard Stern and I listened to Mike and the Mad Dog, and I wanted to be like them. And so I went to school. I was a broadcast journalism major. And, by the time I was done, I had 3 offers. And the 3 job offers were one was in North Dakota, one was in Texas, one was in another outpost of the United States that you just wouldn't want to live in. And so I was like, okay, so what can I do to blend these 2 interests together? And I got a job at CNBC, working for a show called Street Signs, which at that time was hosted by Ron and Sana. And I would be sort of a producer, researcher, and I would be able to kind of blend the mix of loving finance and the liking of broadcasting and television and, the media. From there, season 1 of Mad Money with Jim Cramer started about 3 months after I worked there. And he was a stock picker, like the show I was working on at that point was very political based. It was like very macro. And here was a guy that came along and was saying, buy Juniper, buy Microsoft, buy whatever it was. And I was very gravitated towards that. So I made a request to switch and get on that team. And I did. And I don't know if he would remember me because I only worked on that show for a year. But if he did, he would probably say, oh, he was the really annoying guy who emailed me all the time.
Why would he say that?
He would say that because, and in fact, they banned me from emailing him, I think, after a while, because every morning I would pitch him on what I thought a great trading idea would be. And I would scour stock message boards and I'd read every newspaper I could find. And I thought I was being helpful, because my role was to be a researcher and producer on the show. But I was just inundating him with so much stuff that in the end he would say, hey, Mike, send me 1 email a day in the morning and we'll leave it at that. And there was an incident. I don't know if you guys remember, there was a character named Lenny Dykstra. He was a famous baseball player in the United States. And then he actually made it on our show, 60 Minutes, which is a news magazine, very popular in the United States. And Dykstra worked for TheStreet.com. And Dykstra would pitch stuff to Cramer. And he eventually went to prison, but at that time he was sort of like Cramer's sidekick. And so Dykstra was looking at the exact same message boards and the equivalent of, I guess, what Seeking Alpha is today, we had back then. And I remember we both pitched the same stock on the same day. And there was a huge incident over who had pitched it. And so like I said, I think I was more a thorn in his side than a help. But at the time, it was a good experience.
So, I was going to ask you that actually. What did you make of the whole experience? Like, did you learn a lot from working on that show? I guess it forced you to be researching every day.
So I think at that point, I'm 23, I'm right out of school. And because I kind of thought I was hot shit, because I had, been looking at the stock market for a long time, that I thought I knew more than I did. And I thought, and by working for him and looking at things on a daily basis, I thought I was only learning more. And that had the effect, I think, of sort of inflating my abilities or inflating what I knew. And of course, when you're sitting in front of a screen on a daily basis and not, in trading, and instead of researching and looking at things from, the far outside, it's really different. It's very easy to make a broad call and say, I like the fertilizer sector. Here is why. But then when you actually sit down at your trading desk and you have to do it and, generate money on a daily basis, it's really different. So I learned a lesson, but I would say I didn't learn it till later, if that makes any sense.
When did you kind of transition from that into like the professional trading arena?
Sure. So after a year of that, I got sick of making TV money. And I don't know if you guys, you're 24, you're living in New York City. It's tough to live on 30 grand a year and have an apartment and go on dates and live in New York City. So I was, and also just doing the research, I had really gotten that stock bug back. And I was presented through a friend of a friend an opportunity to get at a trading desk in like an apprenticeship program at First New York Securities, which was one of the bigger, it still might be today, one of the bigger proprietary trading shops in the United States and had been around since the 70s. And, I clerked for someone for a year. I got yelled at on a daily basis, like the worst stuff you would ever say to someone is what my boss would say to me on a daily basis. But it's like, that's just like, that came with the territory, it's a very fraternity house atmosphere, or at least it was on that desk. But when you're surrounded by all these traders, they probably had 200 guys, you learn, what strategies are going to suit you, what strategies are not going to suit you. And at this moment also was like a very pivotal moment in terms of technology. That year when I was clerking for my boss, I would probably call down to the floor of the New York Stock Exchange 50, 60 times a day and just, try to get flow from different specialists and try to get flow from floor brokers. And, obviously that's a very ancient thing. No one would ever do that today, or very few. But at that time, it was necessary just, to see how many buyers versus how many sellers were involved in a name.
Okay. Now I just want to backtrack a little bit. I'm interested to know how you actually got into the firm. Like, how did you get an in? I know you said you had a friend there, but what was it that they saw in you, or how come you were able to land the job, like besides having a friend that worked there?
Okay, sure. So the foot in the door was getting an interview. And do you want to know how I got the interview, or how the interview I think was handled?
Maybe a little bit of both. I mean, I'm mainly asking the question because I know that there'll be people listening to this who are interested in getting into a proprietary trading firm or something like that. So I think it'd just be interesting to hear how you were able to get into it, because you come from a journalist role. I mean, sure, you had an interest in the stock market, but, you had a chance to now get into a professional trading firm. You know what I mean?
Right. Yeah. So if you had looked at my resume at that point, you would have seen someone with no financial internships, someone that went to a broadcasting school. My resume wasn't sparkling by any means in terms of getting on a prop desk, but I did have that Kramer angle, and at that point, we're talking season 2 of Mad Money, he was still sort of a big deal. And I was able to literally get that interview because my sister's fiance at that point, his cousin was a partner at this firm. So I begged her to ask him to get me an interview. And that's how I got in. So really lucky in that way. And then in terms of the interview, and, I can speak to this a little bit more because later in my life, I ran my own training program at a different prop shop that I worked at. What I really tried to sell myself on is the idea that I live, breathe, eat, have an unbelievable passion for stocks. And when people would come to me and interview with me, those are the people that you really want to hire. Not the people that are like, I want to make this much so I can buy this car. I want to make this much so I can party and live that Wall Street life. You want people that love trading, that love the stock market. And the truth was, for me, I didn't have to pretend. It was a genuine feeling. So, for anyone that wants to get into that field, I mean, for your own good, for your own success in the field, and for your own, I guess, well-being, you should want to love it. And if you don't love it, then you're probably in the wrong business anyway.
Mm-hmm. Yeah. And what was your experience like at First New York? Like you said that you were clerking for a while. How long did that last for? And what sort of role did you slot into once you kind of moved up the ladder a little bit?
Right. So clerked for a year. It's a great experience in just learning the mechanisms of trading, right? And, A lot of it is just, my boss at that point was a crazy active trader. So I would be putting in, I could be putting in a few hundred orders a day, managing, 50 options, positions, spreads. So for me, I learned the language of Wall Street. I learned how to manage a book with lots of different positions. And I guess, for me, I've always been obsessed where people can go wrong. Obviously I'm interested in how people are successful, but I'm more interested in, why do things go bad? And so I was able to see some of my boss's habits and habits in the room of, why isn't this working? Why does this person consistently make money? Why does this guy seem to be pounding the desk in anger all the time? Those are the things that I picked up on. And then after a year, First New York gave you a small book. So they would give you, let's say, $1 million to trade. And you're on your own. That's it. You do through osmosis. You've learned a style or certain people's styles, and you have a general idea of what you think you might want to do. But, when you're thrust out on your own, you do feel like you're flying without a net a little bit. And I learned very quickly, with some pretty big losses in the beginning to ratchet down and be careful.
Can we hear a little bit more about how you did go once you went out on your own? Like, what sort of style did you gravitate towards, and how did you pick things up?
So my first year of full trading was 2008, I believe, either late 2007, early 2008. And, as you know, things were just starting to get a little crazy. So what I ended up seeing, in a lot of my trading was people trying to, around me, catch bounces. And you see this in a lot of trading firms that I notice. People always want to catch a bounce or short a top or, catch that mean reversion and pivot move. And that was something that I tried doing, and I didn't seem to have much success with it. It's such a tough game to play. So I took a lot of lumps trying that strategy at first, and it didn't really work for me. I saw people, trying to trade sectors. So if like one bank was bad, let's say, they would short all the other banks, and that didn't really work for me. But you got to try all these various things until you find something that does work. And in the meantime, I had to not blow up. The whole game is you want to, at that point, not get fired, and you want to come back and play tomorrow. And at the same time, you want to make some money. So does that help answer that a little bit?
It does, yeah. Let's fast forward a little bit and talk about how you're trading nowadays. I think that's probably a good way to lead on. Now, I think, and you can correct me if I'm wrong here, but you would probably describe yourself as an event-driven trader. I think that's how you've described yourself. Can you explain what that means and how you make money?
Sure. So if you're a new trader, we'll go back to, being a first-year guy. If you're a new trader and you're looking at your board, there's thousands of stocks to pick from. So where do you even begin? And when you think about it, I'll put it in these terms also. The idea that, every day Coca-Cola, we'll go back to that, Coca-Cola stock moves sometimes billions of dollars in market cap. And the only reason that happens is because the market's open. But has anything inherently changed in the value of Coca-Cola to make it do that? No. It's just because the market's open and people are trading. And I don't know if you've ever owned a business or if your family had a business. Like I said, we had a seafood company, a small seafood company. The idea that seafood company going up and down 10% on a daily basis would be crazy, but it happens in the public markets every day. So the only way that you could trade that, in my opinion, was to know what Fidelity or Vanguard or BlackRock or any of the 50 guys that actually matter are going to do that day. You can't do that. So the only way that, in my opinion, that I can make money on a consistent basis is by wiping my slate essentially clean every day and coming in and looking, what inherently changed the value of a company today, long or short, more valuable or less valuable today than it was yesterday. And there's so many factors that could make this happen. It could be an earnings report. If it's a pharma company, it could be a drug was approved or rejected. There could be a patent ruling. There could be, an activist may have taken a stake in this and wants to push for a sale. There could have been, one company A buying company B. There's so many things that inherently change the value of a company every day. So I gravitate towards those names because at least it gives me a field of names to pick from where I know that there's something more than randomness that's moving the stock around.
And what sort of stocks are you mostly playing in? Like, I think that you gravitate towards more of the bigger names, like the blue chip type of stocks.
So the names that I'm going to traffic in, by rule, eventually we have to put self-imposed rules in on ourselves, right? Otherwise, and these come from making big mistakes. So one of my self-imposed rules is I try to stay away from companies that have market caps of sub 500 million. And the reason for that is, A, they tend to be less liquid, and B, they tend to get manipulated. And I don't want to take part in someone else's manipulation. And so, if I stick to 500 million and above, I think that things tend to act rationally. And what I mean by that is, I don't know, Aaron, do you play poker or do you play chess or any of those games?
No, I don't.
Well, if you did, or you talk to someone that plays poker or chess, if you play poker or chess with someone that's been playing for a while, they tend to all play by the similar strategies and similar rules. But if you play someone that's never played before or has very little experience, they do their own thing. And sometimes when I'm trading those companies that have small market caps, it's like I'm playing poker with someone that's doing their own thing. And when I do that, things can happen that I won't anticipate because, like I said, they're playing by different rules than the ones that I know how to play by.
Can you just explain that a little more? Like you said that some of the smaller names can be manipulated. You don't want to play in someone else's manipulation. What do you mean? Like, in what sort of way can they be manipulated? Are you just sort of saying that the order book's a lot thinner and it's easy to bully the price a little bit?
I mean, I say this without factual proof, but I think it's a foregone conclusion that stocks are absolutely manipulated, especially these small ones. There's ways of controlling the float. There's ways of knowing short interest. There's ways of knowing when a stock needs to be bought in. I say this mostly on small cap stocks that go from, one, or, that a penny stock that goes from $1 to, 20 or whatever it is. Often these are triggered by, some sort of small event. So I'll give you an example. 5 years ago, and you see this in other examples, but 5 years ago, there was an Ebola scare in the world. And you saw a lot of these stocks, maybe ones that made hazmat suits, maybe ones that made, any sort of equipment that would go along these lines to help a situation like that. These companies went wild. And these aren't companies, this isn't a permanent thing. These companies aren't going to have real value in 20 years, most likely. But it turns into a game that people play. And I guess what I'm saying is, it's like you don't want to be the last stack on that pancake stack, if that makes any sense. Because it's just, people playing momentum, people, one to the next, hoping that someone will just buy the stock from them for higher than what they paid for it. But there's no inherent value to it. And so those situations kind of scare me.
Yeah. Okay. No, fair call. I think with those Ebola stocks, Lake might ring a bell for some.
Right.
Are you ready to get serious about trading? Then join Tasty Trade, Investorpedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including 0 commission on stocks, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, risk analysis tools, and more features to help you trade smarter. See equities and derivatives with high trading volumes, dividends, upcoming earnings reports, and more with their pre-built watch lists. Or create a custom watch list to keep an eye on the companies and sectors that matter to you. Manage your positions with speed and precision using active trader mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Visit tastytrade.com/chat for more info. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Have you ever watched a stock explode and thought, if only I had the capital? or sat on the sidelines because your account balance felt too small to matter. Good news, with Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the US stock market. Bypass the PDT and tap into over 12,000 US listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with zero locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
Okay, so let's speak about, being an event-driven trader. You said earlier on that, you come to the market each day, you've got thousands of stocks in front of you to choose from. You want to focus on the stocks which you believe have a reason that the value of that company is either going to increase or decrease that day. You're not trying to participate in just kind of somewhat random market movements.
That's right.
How do you actually go about researching and finding the type of events which you'd like to get involved in?
So I would say there's a few things that you can do. If you're trading, you need some sort of news aggregator, and there's lots of platforms that will do this for you. I've had subscriptions to briefing.com and Street Account. And, nowadays, if you have a Bloomberg terminal, they'll aggregate it for you and they'll tell you, what's moving. But also really important, you should have a calendar of stuff in front of you. And you should know, who's reporting today and tomorrow, who reported last night. Then, and I'm just taking you through my morning routine, so you do this. And then you spend most of your time reading Wall Street notes. And having access to research is so important because at the end of the day, that's what's moving stocks around. People at Fidelity, if you're a fund manager at Fidelity or Vanguard or BlackRock, and you're going to make a decision whether or not to buy or sell your stock today, you're listening to Wall Street, research. And so essentially what we're doing as traders, right, is we're just front running Fidelity. We're all doing that. And so I guess what I'm saying is the research and getting ahead of that is the most critical thing, and anticipating what these big funds are going to do.
So what are some of the sources which you depend on most for your research? Like, do you have like access to brokers and that sort of thing, which provide you with special information, or not special information, but information that isn't, readily available on, the front page of Wall Street Journal?
So all these banks, I pay each Wall Street bank to get their research. So, there's ways of sort of circumventing that. But at the end of the day, if you want Bank of America research, you have to either pay a Bank of America broker, or you have to put money in a wealth management account and get their research. There's no other way to do it. There used to be ways, and Bloomberg would turn you on temporarily, or sometimes there would be a subscription that came for with your Bloomberg terminal. But the only way to get that stuff is to pay for it. And with recent rules, this MiFID rule change that has really clamped down on free research is costing me a lot of money, because now I've had to pony up for stuff that I didn't, have to do before. And as an individual trader, I have a fund, a family office at this point, but it's just me. And you would think that, so let's use this analogy. First New York has a fund. They have 200 traders. And if they want Bank of America research, they'll pay as a firm $100,000 to Bank of America. If I call Bank of America with one person in my office and I say, I want your research, they'll say $100,000. They don't look at it as how many terminals are going to be turned on. They look at it as this is a company and they're a company, which is crazy, but that's how they do it.
Mm. So where do you get most of your research now?
Like in terms of, I'm not sure I understand the question. Like it shows up on my Bloomberg terminal.
Okay, so mostly through Bloomberg.
Right.
Okay, cool. Now, you speak a bit about earnings, but obviously earnings is only, 4 times a year?
Mm-hmm.
What about on regular day-to-day trading, what other sort of events are you looking to get involved in?
The other events I'm looking to get involved in. Well, we've been seeing a lot of activist short situations and a lot of activist long situations. So those are always something that can be very interesting. I don't know if you've been following, Elliott Advisors. They've been very successful in a lot of recent campaigns. It just seems like there's a lot of BS though that goes around in terms of even today I was looking, there was probably 3 activist short campaigns that came out on these random blogs. And, again, I try to stay away from that stuff, but, as traders, I go where the action is. And so if the action is in these places, sometimes I feel like I'm, forced to play, or sometimes I'm trading out of boredom, which is always a huge mistake. But, I'll go where that is. I'm trying to think of, what else happened. Earnings season does get stretched over, let's say, 6 weeks. But, to your point, it doesn't exist the rest of that time. Sometimes there might only be 10 situations to trade in, on a daily basis. It might have been a critical upgrade from an influential analyst, or it may have been a drug approval, or it may have been a court ruling. These days with politics, you never know what Trump could say that might sway an entire sector. So there's never a shortage really I'm rarely getting to the open where I'm like, I have nothing. I usually have something.
Right. How about merger arbitrage? Is that something you do much of?
So I would say I do something that I would coin pre-merger arbitrage. And what I mean by that is you're sort of putting the puzzle pieces together of what a deal might look like if it happens or if it doesn't happen. And so, what I mean by that is, let's say a month ago, the Wall Street Journal breaks a story and they say company A to buy company B. Well, then the game begins, and the game starts with, okay, well, what might they pay for it? Let's say a stock is trading for 100. The Wall Street Journal story comes out. It's trading for 115 now. Now, what do? So the game is, well, do I think they could be bought up for 150 or 140? What sector are they in? Is it biotech? In biotech, I might get a crazy premium. Is it, we didn't talk about technicals here, and it's something I really stay away from. But when you get into these situations, it is important, because then I look, well, is it possible that the story's been leaked? Did the stock ramp up into the story, and therefore I might like it a little bit less? Then I look into, well, if a deal was to happen, would it get approved by our government? Would it get approved by foreign governments? If the deal happened, what sort of spread would it trade at? Because people would be worried that it might get blocked by a foreign government. Right now, there's lots of anti-China stuff, anti-US stuff happening between those two countries, and we're seeing it hurt and block deals. So all these different puzzle pieces have to come into your brain before you get involved in a name. Was an activist involved? Who's pushing for this? All these things go into my thought process before I enter a trade like that.
Okay, and you called this, what was it? Pre-merger?
I call it pre-merger arbitrage.
Okay. Can you take us through an example, like a specific situation that you liked?
Sure, I will. So recently, Warren Buffett, he's been a 18-year holder of a company called US Gypsum, or USG. They make container board. He's owned it for 18 years, and they got a bid about 5 months ago from a company called Knauf, which is a company in Germany, private company, does the exact same thing. And Knauf, the stock was trading for 35, USG was, and Knauf publicly bid 42. And USG rejected the bid. And Warren Buffett did something that he hasn't done in 50 years, which he sort of went activist in the situation. And the reason how he went activist was he's been in this situation for 18 years, and the stock is flatlined, hasn't gone anywhere. And so in his mind, he said, I've owned this for 18 years. The stock hasn't gone anywhere. What right do you have to turn this bid down and probably not even consult me? He owns 35% of the company. So he went public with his displeasure in this and said he would replace the board. So now you've got a situation where your biggest holder is threatening to replace the board unless you sit down and negotiate. Now, at this point, the stock is trading around 41.
Sorry, can I just interrupt you?
Yeah.
Who declined the bid for 42?
USG, the company that got the bid, rejected it.
Without
they said,
consulting Warren Buffett
without
about
consulting Buffett.
Okay.
And the reason that they rejected this bid was they said it undervalued the company, and they called themselves the crown jewels of this housing business. So you had a company that had a really inflated view of themselves. But how can you have an inflated view of yourself if the stock price hasn't moved in 18 years? So Buffett goes activist and forces them to sit down and negotiate. And so now you've got a lot of questions that I'm asking myself. Is there any way that they can get more than 42? Because the problem is, if you're the buyer, right? If you're the company that launched that bid, you're thinking, why would I ever need to raise my bid? Warren Buffett already said take 42. So, you can imagine this negotiating room where the USG says, well, we think we're worth 50. And then the German company comes back and says 42. And then they say, how about 48? And they say, how about 42? Because what leverage do you have? So, the way that I was playing that was just every time the stock would get below 41, I would buy it. And the reason that I would do that is because if a deal was consummated at 42, I think I couldn't lose money. So I want to be in situations, in my opinion, where the likelihood of a deal is extremely high. And I want to buy that, I want to buy that stock at a price where I know it'll trade above if it's consummated. So in that case, with a 42 deal, when I could buy it under 41, that was a good price for me. And the deal ended up happening at around 43.50.
Okay. Now, I just want to ask a few questions around this because I don't have a great handle on how these whole takeover deals actually work. So if the stock's trading at $35, why is a company going to bid $42? Because if it's trading at $35, is that not the value of the company?
Right. So what do you get when you own a company? So, let's take an example using an oil company. You're getting, if Exxon bought, a small oil company, let's say the company was trading at 20, Exxon launches a bid for 30. Why would they do that? So not only are they getting the revenue stream, the yearly revenue stream from this oil, but they're getting the entire, what I would call their surplus of oil. They're getting what they have in the ground, and there should be a future value placed on that. And so you're buying future earnings. When one company buys another, they're buying this year's earnings, and hopefully, if they have a long-term plan, they're buying 50 years more worth of earnings. So that's why companies will overpay. You're getting an asset, you're getting, and that asset could change. If it's oil, it's obviously going to be oil. But, we're seeing Fox and Disney get into this huge merger now. You're buying, all these characters, you're buying movies, you're buying, lots of things, you're buying brands, that has value. But also just, we need to be more humble and understand as the public markets are wrong all the time. So if the stock is trading for 35, the public market might be very wrong, and this company sees more value.
So if the stock's trading for $35 and a company comes out with a bid of 42, what's going to happen to the stock price in most cases on the exchange?
So, obviously it will go up to reflect that deal. When a deal is signed, and now we're talking once a deal is signed, now it's merger arb, right? So the deal is signed before we were playing it, that was pre-merger. Deal signs merger. So now it's how long is this going to take to close? Because deals don't close, with the snap of a finger. It takes a lot. It takes some time. Sometimes is it going to be all cash? Is there a stock component to it? Like I said, does it need to get approval from foreign governments? There's lots of different factors, and people will price that discount, meaning with the stock we talked about was for 42. That discount will be based on how many months it's going to take. We're watching right now a deal about to fall apart, and it's a deal that I've been watching for 19 months, which is Qualcomm's deal to try and buy NXP Semi. And if you bought that deal when it was announced, you've been waiting a long time and you're down a lot of money. So you calculated that wrong.
But how does the stock price get from 35 to 42? Like who? Because it's only going to get to that price if people are willing to buy it up to that price. You know what I mean?
Well, let me ask you this question. Would you pay $41 today if you got $42 in a month, guaranteed?
Yes. But is there a guarantee in the listed markets?
There's a merger agreement. Yeah, that's the guarantee.
So how do they guarantee that, though? How do they guarantee that the price is going to come from 35 up to 42? Because what their deal is done off market.
Well, it's a deal that's announced publicly, and if you have what I would call a real buyer, so if BHP is buying a minerals company or a gas company, BHP has a reputation for being a good buyer that isn't going to back out. So you have to have faith that they're going to consummate the deal.
Can you tell us a little bit about this situation with Qualcomm? And I can't remember who the other company you mentioned was. You said this deal's kind of falling apart at the moment. I mean, how are you trading around that?
One of the mistakes that I've made is I'll call it the cost of time being sunk in, or time sunk cost. The more time that I put into something, and the more money I invest in it, the more research I do with it, the harder it is for me to change my mind on it, if that makes any sense. So the short story in this, again, this is 19 months that I'm going to try to sum up in 2 minutes. The short story is Qualcomm tried to buy this company, NXPI. They needed 9 different countries to approve this deal. 8 of the 9 countries agreed, and 1 country did not, and that was China. And what ended up happening was it got very wound up and wrapped up in all sorts of different international conflicts that are currently happening between the United States and China and Trump and and Chairman Xi. And I have found myself at points, head spinning over this thing, and I've gone to drastic measures to try and gain an edge in this, and the only result has been that it's just made me crazy. And, if you want to, I can tell you about some of these drastic measures.
Sure, yeah.
So, and again, you have to stay within the confines of legality, right? So there was a point in this story where the Wall Street Journal broke a story that said that Qualcomm executives were waiting for the 10-4 from China to fly over there and finalize the deal. So in my mind at that point, the signal that I wanted to see was the Qualcomm plane taking off from San Diego, California, and going to China. And now there's various services that track these sort of private planes. But in this case, that wasn't possible. And the reason that wasn't possible was because Qualcomm themselves blocks the tail number on their plane. So the only other option you have then at this point is, and again, this was a story that I had made up in my head, was that the only way to track this plane is to physically be out there in San Diego and watch it take off. And so I literally just posted we have something called TaskRabbit. I don't know if you guys have that there, but
we've got something similar, yeah.
Okay, so I posted something on TaskRabbit, and the TaskRabbit post read something like, go to this airport and watch this plane take off and send me a video of it. And I got a response in about 15 seconds. And this woman who was, just a mother of 3, she would drop her kids off at school, and she would go to the airport, and she sat there at the airport for me day after day after day after day. And she was probably there for like a week. And I had to deal with her, and the deal was this. I'm going to pay you this much a day, and if you get a video of this plane taking off, I'll give you this bonus money, this big bonus money. And she calls me a week later, and she says, it's happening. And, you're probably wondering, well, how did I know where the plane was going, right? That's the big question. They have this plane. How would I know? And the thing is, you don't. But the way that, and again, I was making a lot of this up perhaps. Qualcomm has two planes. One is for short distances and one is for long distances. And so I was tracking the big one, and the big one took off, and she sent me a video of this. And of course she sent me the video of this at like 3:45 on a Friday, where I have 15 minutes to make up my mind of what I want to do with this situation. And, you know, that's the kind of stuff that can make you crazy. And because you think you have this piece of information that no one has, you think, well, what if it happens this weekend and I don't take advantage of it? So I had better do that now. And not only that, but I was so mentally wrapped up in this thing. I was so like emotionally committed to it, like it was a person, this trade, that I wasn't thinking rationally. And of course, I ended up putting on a large position. The deal is still not happening. And, you know, it's probably taken a few years off my life just watching this situation unfold.
Right, man, that's a crazy story. Have you done things like that in the past? Like other situations where you've kind of done some, I don't know, stakeouts?
Excessive due diligence?
Yeah, let's call it that.
Nothing to that extreme.
Okay.
You know, nothing to that extreme. I mean, a lot of this job, in my opinion, is, you know, you could call it getting lucky, but you have to be on these conference calls. You have to like be in the game. Like, don't be lazy. You know, one of the best trades I ever had, I happened to be a bit lucky, but I happened to be on this Lumber Liquidators, which is sort of like a lumber supply company, conference call in you know 2014 or 2015, and they happened to mention in the call for, you know, at complete random, that they were going to be on a show called 60 Minutes, which is an investigative journalism show that Sunday. And it was like, you know, a grenade went off in the middle of this call. And one of the analysts, you know, it was an earnings conference call. Suddenly no one cares about the earnings. And they said, well, what's the deal? Well, why are you going to be on 60 Minutes? And he said, well, you know, I can't really describe, you know, the contents of it, but I will say this. I stand by the safety of our wood, you know, which implies, oh shit, well, the whole segment's going to be that the wood's not safe. And you probably had 5 to 6 minutes before this hit, you know, the Bloomberg wires and all the major news wires. And, you know, in trading, that's an eternity. 5 or 6 minutes is an eternity. And, you know, I did great in it, but you look back and you say, well, man, like I could have done this or I could have done that. But I guess what I'm trying to say is one of the things to always remember is just don't sit on your hands, like get in there, like be on every call that you can get on, like just be there.
So when you got that information, how did you actually build a trade around that? Did you just instantly go short the stock, or was there something more to it?
In that situation, and again, I've replayed this in my head, oh, I should have done this or I should have done that. I mean, at that point, the stock was trading for 69. You could have shorted it all you wanted down to, let's say, there was unlimited amount of liquidity in this name till, you know, 65. And at that point, I think it was still like maybe down small on the day. And just so you know, on Monday after that segment, the stock opened at 30. So, wow. You know, there's lots of things I could have done. You know, I could have bought puts that were going to expire the following Friday, and, you know, before the vol and the puts had exploded. There was lots of things I could have done. What I did was just short the stock outright, because in the moment, you know, when it's happening, you just think, what's the easiest way for me to get exposure?
Yeah. Wow. Man, that's incredible. Reflecting on your career, just moving off, you know, kind of the merger stuff a little bit, just reflecting on your trading career, what's some of the times where you've really messed up?
Sure. When I get in trouble, when I screw up, it's because I sort of veer out of the lane of what I'm good at. And what I mean by that is, at this point, trading for 12 years, I'm good at these events. I'm good at, you know, analyzing some earnings. I'm good at following the research. That's what I'm good at. All the stuff we talked about before. When I get into trouble is when I decide, you know, I'm going to trade S&P 500 ETFs today, or I'm going to trade the bond market today because, you know, Trump's saying this, and interest rates are going to go this way, and the Federal Reserve is going to go this way. And, listen to what I'm saying right now. This is so not in my wheelhouse. I shouldn't be involved in it. And, at this point, I think I'm pretty good at these event names. That's something that I think I'm better at than a lot of other people. So then think about it. When I'm veering out of my lane and I'm going in and I'm trading macro stuff, trading bonds, trading S&P 500 ETFs, I'm getting into someone's lane where they're really good at it and I don't know much. And when I do that stuff, I'm going to lose because I'm playing against people that know more than I do. And so that's when I get into a lot of trouble. Now, that being said, this is important. The only way to expand your horizons is to try and do this stuff, right? Like if you're the first year trader and you're listening to this podcast, you're probably like, well, how do I know what I'm good at yet? You don't. And the only way to learn is you do veer out of your lane a little bit and you try it, but you got to start small. That's all I'm saying. You start small and you gradually go up and you see where you gravitate towards and what you end up being good at.
Yeah. Yeah. You got to experiment a little bit.
You got to experiment a little bit, but today, and this is something I still fall susceptible to this, sometimes it's because it's out of boredom, as a trader, I'm always like, when a trade is done, my mentality is, okay, well, what's the next one? And sometimes there is no next one. One of the hardest things in this business is sitting on your hands and doing nothing, being patient. And I know what a good trade looks like when I see it. But sometimes I don't want to wait for that. So I said, I'm just going to manufacture a trade on my own. And, doing that in a sleepy market, that could be dangerous. Another thing that is a really dangerous game that's gotten me into a lot of trouble is when I decide that I'm going to either short good news or I'm going to buy bad news. And that's a game where I've decided as the trader, well, this is up too much. Even though the news is good, this is up too much. And when it's bad, I say, well, it's bad. The news is really bad, but I don't think it should be down 20%. I think it should be down 15%. And, that's a crazy game because let's go back. Let's get into the heads of Fidelity again. If Fidelity is selling, they're selling. And they're probably not going to stop selling if it's down 20% versus 15%. So you're getting in front of this freight train hoping that, the buyers show up or Fidelity stops. So, that's something that always has tended to get me in trouble. I've had big losses doing that. Envy hurts me. Envy's real bad. If I'm sitting next to someone and they're trading a product that I don't understand and they're making a lot of money from it, I didn't trade Bitcoins and all these cryptocurrencies, but I know a lot of people that did and they made a lot of money. And I was certainly tempted to do it, but that temptation was just out of envy because I wanted to be making that money. And if I did start trading that stuff and losing, then I would have been kicking myself. If I lost $1 short, buying Bitcoin, I would have been so mad at myself.
Yeah.
Because it's not something I understand at all. I don't want to just I'll just keep bringing up points and
keep going.
things that have hurt me, but when I have an idea, if I think something's a buy, one thing that I tend to do is, and this is a big mistake, is I try to find things that agree with my point of view. So if a company had really good earnings reports, what I'll do is, and sometimes this is conscious or subconscious, I'll find the research notes from Goldman Sachs and Bank of America that reinforce my viewpoint, and I'll ignore the ones that disagree with me. And the reason that I'm doing that is just because, I want to be right and I want people to agree with me. But the truth of it is I shouldn't be doing that. I should be listening to all different vantage points and all different viewpoints. That can get me in a lot of trouble. My tendency is to hold on to losers longer than I should. I'm sure that people who come on your show probably talk about that all the time. I hold on when I get into trouble when I hold on to my losers longer than I should. And the main reason I do that, honestly, is because I'm trying to preserve my ego because I don't want to admit defeat yet. If I don't cover a position that's a loss or I don't sell a position that's a loss, there's a slight chance that it'll come back and go the way that I want it to go. And how often does that happen? Rarely, right? If I put on a position It's a slippery slope. If I'm putting on a position at 9:30 and at 1 o'clock it's way against me, I should get out. But I'm going to hold on till 4 o'clock because I don't want to admit defeat yet. And what ends up happening, it usually is at its most worst against me by 4 o'clock.
Yeah, when it just rips up into the close.
Yep.
Yeah. All right, Michael. Well, let's leave it there. There is one other thing I do want to ask you about. I believe you've also started a podcast recently.
So if you like or want to learn more about event trading and about activism and about these names that I'm trafficking in, I do have a podcast, and it's called According to Sources. You can find me at accordingtosourcespodcast.com, or you can find me on Twitter at accord2to sources. And, the reason that I started this is very simple. One, I like the medium. I told you I love the radio, and that's something, if I wasn't doing this as a trader, that's what I'd be doing. But the second reason is, like I said, I follow Wall Street research, and there is a humongous void in this area of Wall Street research. No one is covering this. If you want to know what the spread's going to be when, Shire gets bought by Takeda, I can't tell you how much bad information that I'm paying for. Now, I'm paying Bank of America $100,000 a year for bad information. I would rather be the media in this case, be the person that posts about this stuff. Sometimes I'll post stuff, I'll end up being wrong, which is a good thing, because what ends up happening is people wrote me and say, hey, you're missing this. And I was like, oh, okay. Well, that's great. What I'm doing is I'm opening up the conversation. And that's why I think it's important. This is a sector, like I said, billions upon billions of dollars trade in this every day. The people that cover it, these event desks, don't know anything for the most part. So I'm looking for a conversation to get started, and I'm looking for people to write to and to write me back, and just to open this up a bit more, so that we can all understand things that are happening.
And are you having guests on your show?
I do.
Okay.
I do have guests on the show.
What sort of guests are they? Like, what sort of things do they do?
So the head of the event desk at Nomura is coming on next week. We're just going to go through a bunch of different situations. The reason that it's called According to Sources is because I do want to talk to the journalists that break this story. So my goal is to have guests on from the Wall Street Journal and other media outlets. I would love eventually to have bankers. Sometimes some people might have to come under the cloak of anonymity. That's just, something I'll understand. But, to specifically highlight these stories and talk to the journalists, about, things like, if the Wall Street Journal came on, one of the questions I would ask them is, well, why does the story get leaked? What's the motivation? When company A is buying company B, how does that story get out to the paper, and why? And there's so many reasons that could be. The CEO might just want, it could be ego. The CEO might want his picture on the cover of the journal. But it might be because he wants to see how his stock's going to react when the market sees that he's going to buy this company. There's lots of different ways and things that are happening and dynamics at play. And I just want to learn about it. And so that's why I'm doing this.
Okay. Yeah, cool. So if someone wants to check that out, according to tosources.com, that's the best link.
It's according to sourcespodcast.com.
According to sourcespodcast.com. Cool. Well, guys, make sure you check that out. Michael, thank you very much for doing the podcast. It's been very interesting. I appreciate your time.
Thank you, Aaron. Have a great one.
You've reached the end of this episode of Chat with Traders. But rest assured, there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes. And we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
Chat with Traders is brought to you by Trade the Pool. Did you know that every decade the market reinvents itself? Online brokers opened the doors, mobile apps made trading seamless, and commission-free trading erased barriers. Now, a new era has begun. Meet Trade the Pool, limited risk trading. And now you also have unlimited time to reach the profit target. From now on, your trading risk is capped, and your trading opportunities are limitless. Trade the Pool funds home-based stock traders with up to $200,000 in buying power. That means you can trade larger positions and scale your strategies without risking your own savings. It's time to trade with more capital, making it truly worth your time and effort. Ready to trade the pool? Click the link in the description and join the stock trading revolution today.
Are you ready to get serious about trading? Then join Tasty Trade, Investopedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade all in one platform. Get low commissions, including 0 commissions on stocks, so you can keep more of what you earn. Trade smarter with advanced charting tools, a pre-built strategy selector, risk analysis tools, and more features. Visit tastytrade.com/chat for more information. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC.
Markets, speculation, and risk. This is the Chat with Traders podcast, hosted by Aaron Fifield.
Hey, what's up, crew? Welcome back. Or if this is your first time listening, and I anticipate this episode may attract a few first-time listeners, then welcome. It's nice to have you tuned in. I'm your host, Aaron Fifield. For this episode, I got to speak with Hugo Bown-Anderson, who, as far as I know, has never traded a single share in his life, but he is a brilliant programmer. More specifically, Hugo is a data scientist at DataCamp, which is an online educational platform for learning data science. And Hugo also hosts Data Framed, which is a podcast by DataCamp. So I guess the idea for asking Hugo to appear on this episode was essentially to chat about learning to code. Because for some traders, having the ability to write code can have great advantages, such as having the ability to collect statistics on market behavior, perform research in a robust data-driven way, visualize large amounts of data, backtest and analyze trading ideas, and also to go as far as implementing algorithmic strategies, etc., etc. Plus, as some of you will already be aware, more professional trading firms and even broader finance-related positions are requiring applicants to have some programming skills. And, this spreads across all industries too, which I guess should be no surprise considering a recent IBM study revealed that about 90% of the world's data has been created in the last 2 years alone. So some of the topics we dig into during this episode include when should someone actually consider learning to code, how to determine what's relevant for you, how long until you'll become somewhat fluent in a programming language, and how to work with new data sets, what to be wary of when using predictive models. And just for the fun of it, I also asked Hugo, as someone who's a non-trader, how he'd go about creating a basic quant strategy. Now, if you like the episode and if you're keen to learn more about this type of thing, I do have an affiliate link for DataCamp, which you can use. That is chatwithtraders.com/DataCamp. Unfortunately, you won't get a special discount for using this link, but you will be helping to support Chat with Traders. I myself, I've been a paying subscriber and a user of DataCamp for the past couple years, so I've got no hesitation recommending this resource to anyone else who wants to learn how to code. So again, that's chatwithtraders.com/DataCamp. Thank you very much. And I think that's everything. So here is Hugo Bown-Anderson for episode 166. Well, obviously, most of the things we're going to be chatting about on this particular podcast are going to be around programming. But that aside, I'm interested to hear a little bit about your own personal background. I know you're at DataCamp now. What did you do leading up to this?
Yeah, that's a good question because it does. My passage to programming, I think, is one of many routes that people take these days. So my background is actually in science and humanities, science and arts. So I did my undergrad. I did a combined Bachelor of Arts, Bachelor of Science, and I had a double major in pure and applied maths. So I finished the science part, and then I went to grad school. So this was at University of Sydney. Then I went to grad school to do a PhD at the University of New South Wales in pure maths. Tried to finish my arts degree at the same time, but they kicked me out because purportedly you can't be enrolled in 2 different degrees at different institutions, and I wasn't aware of that. So I got kicked out of my second undergrad. When I finished my pure maths PhD, which was in an area called algebraic geometry, I realized I wanted to get more into the applied mathematics, applied math, or applied maths, as we say. And so I actually started working in biology. I started a postdoc in Germany, in Dresden. There's a big Max Planck Institute for cell biology there, doing applied mathematics, working in a biology lab, thinking about cell growth, cell dynamics, the physics, the biophysics behind these types of complex systems. And this is the first time I started working with a lot of data. And I actually started calling it data then because people, my American colleagues thought I was talking about a surrealist movement when I said data too often. But I started working with a lot of data at this point, and biologists kept asking me the same questions about statistical tests, about cleaning their data, about learning R and Python and this type of stuff. So I essentially taught myself data analysis, statistics, a bunch of machine learning in order to stay ahead of the curve working in these fields. I then wrapped up my postdoc. My postdoc boss accepted a professorship in the US at Yale University in New Haven, Connecticut. So I spent 2 years there doing research. And I was doing a lot of teaching and a lot of education there. Because biologists kept coming and asking me the same questions, I started to run what I called practical statistics and data science workshops. At that point, I met the data camp team, who was around 8 or 9 people then. And they were really trying to get moving on their Python curriculum. So, they put the hard sell on me, and I jumped on board to come and build kind of online education systems to teach in browser experiences for learning data science, essentially. So that's really how I ended up at Data Camp. A lot has happened since then, though.
Okay, and how long have you been with Data Camp for now?
So I've been here for 2.5 years now. And we've grown from 10 people to 75 in that time, and moved from teaching essentially R and Python to now teaching R, Python, SQL, command line stuff, Git, which we may get to, which is version control, so kind of versioning your code for reproducibility, and spreadsheets now as well. So we've got our first several spreadsheets courses, which we're really excited about.
Yeah, I did see that, which is kind of interesting. Just going back to your background, it kind of sounds as though, and I might be wrong here, but it sounds as though you kind of took it upon yourself learning how to code. Like, it wasn't something that was expected of you in your role. You just sort of saw it as something that would be very beneficial to what you were doing. Would that be a fair statement?
Yeah, that's absolutely right. And so you hit the nail on the head. My job was to do applied mathematical modeling, whatever that may involve, right? And I realized at that point that it actually involved learning a lot about the data I was trying to model, learning a lot about the data generation process, thinking about it statistically. And the way we do that these days is using programming languages. I mean, essentially people used to flip coins and use pen and paper. But if you want to deal with large amounts of data, complex data from different sources these days, you need to do it using programming. So that's I did self-start in that way, and I think that's a lot of people's journey to coding as well. I mean, a lot of data scientists and programmers and coders don't have computer science or software engineering degrees that they did learn on the job.
I'm a little bit surprised that you didn't learn any of this type of thing with the studies you were doing at university.
Yeah, that's a good point. And I think that definitely in pure maths, I did a bit of a small amount of MATLAB, and a bit of a language called Maple, but very minimal. In the applied math stuff, it was really more focused around differential equations, real analysis with kind of leans towards applications. But this is something that, it's a big question in how we're teaching people mathematics and statistics now, in that maybe we haven't necessarily done our job with too much of a focus on calculus, for example, and not enough on getting people analyzing data and simulating stuff and looking at distributions and all of this fun stuff.
Well, let's kind of turn the conversation now to maybe help some of the people who are listening to this podcast. So most of the people, naturally, who tune into this podcast are traders and investors, etc., who are participating and betting in financial markets. When or why should someone consider learning to code?
So I think, firstly, I want to say that one of the alternatives is spreadsheets. And I think spreadsheets are amazing in a lot of ways. I mean, tens of millions, if not hundreds of millions of people are using spreadsheets to do their job, right? I do think there are challenges involved in using spreadsheets, and I'll kind of discuss this in a variety of ways. But, there are even online resources as to the types of mistakes people have made with spreadsheets. We don't have access to all of this information, but I've met, a significant number of people in finance working for, big companies who've, lost a significant amount of money due to spreadsheet errors, for example. So if you're working in spreadsheets, I definitely think it can serve you well. But essentially, in today's job market, and even for a lot of traders, if you want to have an edge or a differentiating factor for your practice and the type of work you do, I think programming is definitely a very viable option. And I think we see now companies and organizations like Citigroup and Bank of America and JP Morgan. I mean, all of these places put Python first now, and I think. Who was it? It was Robin Wigglesworth, right, in the Financial Times a few years back, wrote that it used to be traders who were first-class citizens of the financial world, but it's technologists now who are the priority, and people who can work robustly with large amounts of data coming from disparate sources. And the way to do this now is with programming, whether that's Python or R or databases. I'm not really. We can have that conversation, but I think the real conversation needs to revolve around whether you can do this stuff in a GUI, a graphical user interface, which, Excel or spreadsheets is an example of, or you want to do it in a programming language. And if I may, I think I'd like to just give you a few things about programming that I think really help with this type of process. The first is that it's reproducible. So, when I'm using a spreadsheet or some sort of GUI, I do a bunch of clicks and I can send you my results, and you can't reproduce what I did. All you have is the results. Whereas if it's text-based, I can share it with you straight away. So it's reproducible in that sense. You can reproduce it on your own operating system. It's readable. And on top of that, it's what we call diffable. So you can see the diffs. And what I mean by that is, if you write some code to automate a process and then you change it, because it's plain text, we can see exactly what the changes are that have been made, and we can see the workflow and the process there. On top of that, one of the strongest aspects of coding and programming is that it automates stuff. And I've hinted at this throughout what I've said already, but if you do something like, if you're doing pivot tables a few days a week or whatever, and you can write 3 lines of code that do it for you, I mean, that's just common sense to me. And pointing and clicking isn't scalable in that way. So I think these provide general arguments for why programming is good. We can talk about why open source programming in particular is good, depending on how you'd like to frame the rest of this conversation as well.
Okay. Yeah, cool. Well, I'll make note of that and we might get to it. Just right now, I'd like to ask you spoke there about spreadsheets, and I presume you're talking mostly about Excel, right?
Yeah, or Google Sheets. I mean, these are the two big ones that I know of.
Okay. So it's probably fair to say that there's a large majority of people who are very familiar with Excel or Google Sheets and spreadsheets in general. When is it beneficial for someone like that to actually take the next step and learn an actual programming language?
I think it's beneficial when they're doing the same stuff all the time. So doing pivot tables was one example, but if someone finds themselves in Excel on Monday, Tuesday, Wednesday with different data sets doing a similar thing, it makes sense for them to learn to write some code in order to automate that, I think. When it wouldn't be beneficial for them is if it's like a one-off job doing a bunch of data entry, for example. But in terms of automating time-consuming rote tasks, it definitely makes sense then. It also makes sense when they want to do more robust modeling and understand why their models are saying what they're saying. I mean, you can model stuff in Excel. Excel's relatively powerful with basic modeling. But if you want to build models that you can dig into and find out why they're doing what they're doing, I think both Python and R are exceptional at this as well. Another aspect, I think, is if you want to share your workflow with other people. As I said, you're doing a lot of pointing and clicking. Collaborators and colleagues can't really get insight into what you're doing. Whereas if you're working on a team of people writing code together, you can see exactly each step, especially when it's well commented, right? Which I'm a huge fan of. So these are several reasons. I would also say one of the problems with spreadsheets is that your data source and your logic and your functions and formatting are all intertwined. I mean, you see nightmare spreadsheets where people like highlight a row in order to mean something. And I think separation of data from this type of logic and from formatting is incredibly important to do robust data analysis and data science in the end.
I like that last point you gave there. I hadn't really considered that, actually. Now, you mentioned Python and you've mentioned R. Obviously, there's many programming languages which exist and which are open sourced, which anyone can access easy enough. How do they decide which one they're going to focus their time and energy on to learn, like as a trader?
Yeah, so I think this is a deeply personal question, and I need to be as sensitive as possible because there are very strong sides on each side of the argument. But I think so. If your main interest is in doing statistics and exploratory data analysis and data visualization and these types of things, R is a really good place to do this. Particularly in the way there's a set of packages referred to as the Tidyverse, which by Hadley Wickham, who's from New Zealand as well, and he and his colleagues have developed this kind of set of packages which allow for very I think thoughtful exploration of data and data visualization. And one of the great things is they've written these packages that you write code kind of the way you think about the data, and they refer to not as functions in these packages, but as verbs. So you'll filter something, then select something, then arrange something, and it's very easy to read in that respect. So for these types of things, I think R is incredibly strong. I do think Python, if you want to do, machine learning on large data sets in production and serious automation of tasks, which I think perhaps is more what traders are interested in, Python is probably a win there, particularly in the machine learning and deep learning space, although R is seeing strides there also. I would also add that I personally, the barrier to entry for Python is slightly higher, I think, but I like to refer to Python as the Swiss Army knife of programming languages because rarely will it be the best tool for the job, but you can do anything with it.
Yeah, okay. So what are some of the limitations of R which you're going to be able to do with Python? Obviously, you mentioned machine learning there. Is that kind of the key one, or are there a few other things which separate the two?
Yeah, I think probably productionized machine learning models, as opposed to, getting a machine learning model working on your laptop, which you can submit to, an online machine learning competition. Getting something productionized, Python is definitely, so getting it, coming in with your streaming data source and getting all the results out there, or, feeding it into another API or something like that. Python is a lot stronger. I do think, though, we are seeing massive strides in R on that side. But in all honesty, I think the deep learning packages are probably more mature on Python, and the way that they all interact as well, kind of the way these packages all interface to each other. So I think those are the places that Python win. Having said that, the open source software community on both fronts, they're moving so much more quickly, so quickly that what I say could be outdated tomorrow.
Yeah, well, that's the world we live in, right?
Exactly.
So let's say that someone wants to begin learning R or Python. It's they've never looked at a programming language before. They've never written any code. Maybe some basic Excel. Where should they even begin to start out? Like, what are some of the best first steps you can take when learning to code?
Right. So I'm definitely biased. I would say DataCamp is a fantastic place, and I'll tell a few others afterwards. But one of the reasons I initially joined DataCamp, and one of the reasons that I'm still here, is DataCamp has helped to lower the barrier to entry for so much of the learning process, in particular the initial steps, right? So you don't need, when you come to DataCamp, you don't need to install anything locally on your machine. We spin it up for you. It's all in browser. You can start learning and writing Python code straight away and feel functional straight away. And that's one of the most important things for our learners and for learners in general, is to feel like you're doing something, not like spending the first 90 minutes installing something and then having an error returned, right? So
I've been there.
Exactly. We've all been there, right? So I definitely think that's very helpful and motivating in all honesty. I also think, so for people interested in finance, we have finance curriculum here. I also think, you've spoken with Eve Hilpish in the past, and his quant stuff is also, his Python quant stuff, I think, is really, really interesting. And he has online courses for those very interested in the finance stuff. I'd also, depending on whether you've chosen R or Python, figure out where you want to write your code. And what I mean by that is, there are these things called IDEs, integrated development environments, and that sounds like a mouthful. All it is like a piece of software that you'll click on and open, and it's where you write code, save it, execute it, this type of stuff. For Python in data science, and you can do R and Julia and all of these things in this infrastructure as well. There's an incredible project called Project Jupyter, and they're Jupyter notebooks, and now they're Jupyter Lab. Are really good for getting started running code, because it's kind of like an interactive data science notebook, essentially, where you can write text, say store images, videos, write code, execute it in your browser, and it's all going straight away. And on top of that, on the internet, there are lots of galleries of interesting Jupyter notebooks that you can get up and running with. There's one actually called a gallery of interesting Jupyter notebooks, actually, where, there's a whole bunch on finance, among other things. The two other things I'd really suggest is to read as widely as possible. Blogs. We've got, a lot of blogs and tutorials on our DataCamp community. Fast Forward Labs has a lot of great stuff on data science. ODSC, which is a conference, the Open Data Science Conference, got a lot of finance stuff as well. And wherever you are, go to meetups and meet people and hackathons, because in all honesty, doing this after work, like in your own bedroom, it can get hardcore. And, we've all been there. But seriously, coding with other people and pair programming, the learning curve there makes it a lot more fun. And the last piece of advice I'd probably give is try to get your day job to give you time and or money to do this. So, for example, if you're want to subscribe to DataCamp, we've got a whole bunch of free stuff that you can check out first. But tell your boss that, this is your learning stuff that's going to help your job. Or try to get Friday afternoons from your work to, invest in your future to make you more efficient at your job and work at that, because wherever you're working is going to win in the end, in all honesty as well.
Yeah, that's a really cool tip, actually.
Yeah.
I like it. Yeah, and obviously I recommend DataCamp as well because, that's one of the reasons I got you on. I mean, I'm a paying subscriber of DataCamp. I'm always on there checking out new courses and material, etc. So, I mean, it's certainly helped my learning curve and learning how to program as well. So, obviously, that's why I thought it'd be really cool to get you on the podcast because, I've seen some of the courses which you've been a lecturer of.
Appreciate that. And I would be, one thing I'd like to add is, as you know, I host a podcast called Data Framed, which we put out weekly episodes for DataCamp. And I'd urge you to listen to that as well, because, the premise of this, of Data Framed is to interview thought leaders and working data scientists from all over the place, whether it be finance, tech. The most recent one was health. It was data scientists from Doctors Without Borders. So I think this type of stuff will definitely give you insight into how people think about data science and what's kind of really current and modern in the space at the moment.
Yeah. And I said this to you when we spoke, actually it was a few months ago when we first made the connection, but that, I thought it was really cool when you guys actually started a podcast because prior to that, I hadn't really found any great, and I'm not saying they don't exist, but I just hadn't really come across any other sort of really cool podcasts on programming. So I was kind of excited to see yours pop up.
Yeah, I appreciate that.
Are you ready to get serious about trading? Then join Tasty Trade, Investorpedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including 0 commission on stocks, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, risk analysis tools, and more features to help you trade smarter. See equities and derivatives with high trading volumes, dividends, upcoming earnings reports, and more with their pre-built watch lists. Or create a custom watch list to keep an eye on the companies and sectors that matter to you. Manage your positions with speed and precision using active trader mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Visit tastytrade.com/chat for more info. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Have you ever watched a stock explode and thought, if only I had the capital? Or sat on the sidelines because your account balance felt too small to matter? Good news, with Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 U.S. listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with 0 locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
Now, obviously, there's a lot that you can explore. There's plenty of subjects and areas that you can go into, and I guess it's very easy to get sort of led astray in some ways when you're new to programming because you don't really know what's relevant. You don't really know what you should be learning. As a trader who's learning to code, you're mostly going to be wanting to learn to code for the purpose of exploring data, getting some sort of statistics, some probabilities, visualizing data, backtesting certain strategies and trade ideas and market behavior. How do you determine what's relevant? Like whether this is something I should be learning at this stage early on in my, while learning to program, or is this something more of an advanced topic that would be nice to know a little further down the track? Like, how do you determine what's relevant?
Yeah, that's such a good question, Aaron, because on top of all the good reasons you've just said, if you go and look at like the amount of Python packages out there for, time series and data analysis and this type of stuff, it is so overwhelming that you can just freak and probably like run away forever. So I definitely think this type of conversation is super, super valuable. And the way I generally approach this is take a bunch of courses, sure, and get introduced to the main players in the space of Python packages. And for those who haven't heard the term package before, a package is really something that's developed that's, a set of functions and utilities that will help you to do stuff, right? And of course, you'll come across the main ones like Pandas, which is, seminal now, and absolutely undeniably necessary for all data science, all financial data analysis in Python. And it's really a way of structuring data in order to facilitate analysis. So the basic unit in Pandas is a data frame, which kind of looks like a matrix of numbers or whatever with column names, essentially. But that having been said, besides learning courses and becoming familiar with the main players in the space, I always advise learners to do a project on something they're interested in. And of course, in this case, if you've got a trading project that you want to do, definitely jump in. And what will happen then is you'll learn all the tools you need for that particular project, right? And you'll be drawing on a lot of stuff that will be relevant in future for you, whether it's, Pandas or some nice visualization libraries, or if you start doing statistical modeling packages around that, or time series analysis, or even, machine learning, right? You'll meet scikit-learn among other packages then. So if you do a project from go to woe, I'm not saying it's going to be easy. It'll actually probably at some points be super frustrating. But if you're invested in the goal, right, you'll learn what you need to. The last thing you want is to do a project that you kind of half-assed about, right? And you get to a roadblock and you're like, oh, I don't care about it so much. So if you pick something that you're super passionate about and get to that end, and by the end, I don't only mean getting out a result or an actionable, I also mean talking about it with mates, or giving a talk about it at a meetup, or writing a blog post about it. I think these types of things definitely get you far more acquainted with everything you've used. And on top of that, it doesn't only have to be a trading project. I mean, I encourage people to get out of their professional zone when doing this. So I met a student who is all about their fitness tracker. It wasn't a Fitbit, but it was something like that. And I was like, dude, just get all your fitness tracker data, and, analyze that and see if you can predict, what's going to happen in the next 3 months and that type of stuff. And they learned a whole bunch of cool tools around that. If you're a foodie, you can scrape Yelp reviews, right? And do some analysis there. I met a law student who wanted to get into data science, and they did a project of, it was something like, I'm gonna bugger this up, but it was something like looking at Supreme Court judgments that were handed down and trying to cluster them according to whether the judge was like Republican or Democrat or in the middle or whatever it was, right? So find something you absolutely love, and get in there and get into it.
You said something really key in your answer there, that there are going to be points when you try to step out on your own and do an exercise that it's going to be very frustrating and you're going to get stuck. What's the best thing to do when you do get stuck? Because as you said earlier, if you're just at home and you're trying to work this out and it's not something you've done before, and like I've had it before, and where I've gotten stuck, and I've literally been stuck on it for 2 days. I just can't work out why this won't work, and it just keeps spinning out the same error. And often some of the errors that you get in Python, especially for new programmers, are quite confusing and not always very clear. What's the best thing to do if you're in that situation where you're trying something, you get stuck, you don't really know where to go? Where do you go?
Yeah, so firstly, I agree completely. The amount of frustration you can experience with like really idiosyncratic, esoteric error messages is wild. And I do think open source package developers are kind of getting onto this, and they realize that if they want more users, they need to provide more helpful feedback messages. One example is Keras, which is a deep learning library developed by Francois Chollet, who's at Google. And it provides some error messages that are along the lines of, hey, you use this function, but why don't you try this instead, right? So it's as opposed to error, syntax error, backtrack, whatever it is, right? So if you're getting wacky error messages that you don't understand, my number one answer to that question is Google it. Google knows, or your search engine of choice. I don't know if many people use Ask Jeeves anymore, but I would Google it. And a lot of the time, you'll end up on a website called Stack Overflow, which is essentially a Q&A, a forum for answering these types of questions. So if you copy and paste your error message into Google, a lot of the time you'll find something, you might end up in a Stack Overflow question that links to an issue on, the repository, which is a repository is where, you store code for the particular package. And then you need to go through a few other things, but definitely search engines will be your best friend, I think.
Yeah, agreed. I know this is going to depend kind of person to person. It's, again, a very personal thing. But I know there will be some people listening to this who are kind of wondering, what is a reasonable time frame for someone to learn the basics of programming, let's say in Python, for example?
It depends what you want to do. But if you want to get a sense of how to analyze data, of how to get a result, and of the basic packages you need in a space, and you work full time, let's say you've got a couple of nights a week, let's say 5 hours a week or something like that, I'd say 6 months you could get up and running pretty well. Yeah, maybe less, but I would say 6 months is pretty good if you're efficient and and scrappy and resourceful yourself. But it's hard. It's just always remember that it's hard work as well, and it's, as we said, frustrating. It can be infuriating at points. In all honesty, particularly when you work full time and you've got a family and all of this stuff. You're taking a lot of time out of your full time life in order to learn something new. But just remember that this has a pretty serious payoff as well. And I do think that we all know this, right? But computation is becoming so much more important, and the ability to code and have these conversations will make you a far more valuable member of the workforce, for example. And I think, there are really big wins to be made if you put in the time here. Yeah.
And on the flip side, when you do get some code working exactly how you wanted it to, it's also very rewarding. Like it feels awesome.
Yeah, it's beautiful. Yeah. Couldn't agree more.
Yeah. I'd like to ask you a couple questions, Hugo, about maybe what questions to ask your data. So I think this is interesting because obviously you're not a trader. You don't come from a trading background. You come sort of more from you're a data scientist. I'm interested to sort of hear a little bit about your thoughts about, how you perceive some of the challenges that traders may come up against. So I guess maybe one of the first questions on this topic would be, how do you think about what questions to ask your data? Because essentially that's what you're doing as a data scientist. You get a data set and then you're trying to use that to solve problems or to answer certain questions. You're trying to find answers within the data. How do you think about what questions to ask that data?
Yeah, that's a really interesting question. And there are actually several ways to approach this. A very common way is actually to flip that entire process. And a lot of the time you ask the question first before you even have the data. So one great example is, I think, in kind of the modern age of data science, emerged in tech, right? So LinkedIn is a really good example where they, one of their first MVPs of data science was they were trying to figure out how to get more people active on LinkedIn, and how to get more connections made. And they realized, for example, if you and I are connected on LinkedIn and you're connected with someone else on LinkedIn, then it would make sense for them to suggest that I connect with that other person on LinkedIn, right? And so then they decided that the data that they needed to work with was a network graph of people, a social network or professional network of nodes of people and edges as connections, professional connections between people. So all this is to say that their question existed pre any data, and then they figured out what was that they needed to look at. So essentially, in this framework, the data science question emerges from a real world business question, and then you kind of transition down to this level of data science and data, and then to get the business solution, you transition back up to this world of business questions. Another prevalent example is fraud detection for credit cards, where you can ask a question straight away like, how do we detect whether a particular credit card transaction is fraudulent, right? And that doesn't involve any data at all. And then you're like, oh, okay, damn it. We need to look into the data and figure out some patterns and do some prediction. And wait, that's machine learning. That's probably supervised learning, fraud or not, a binary classification problem. And suddenly you're speaking the language of data and data science. And then you can answer it in that realm. And then you transition back up to this business question of, is this fraudulent or not? And the reason I like to frame at least part of data science this way is because it actually speaks to this huge challenge of getting decisions made in organizations, right? Because people hire data scientists to turn data into insight. But in the end, if you're not making business decisions around it, how do you see the value of it? And who makes business decisions? It's rarely a data scientist who makes business decisions. It's usually someone that they report to or a team of people they need to convince, whether they're, C-level or management or whatever it may be, right? So in the end, data scientists need to get non-technical people on board. So the point there is that, the question can pre-exist before data's even involved. Having said that, of course, there is a lot of data already existing within tech companies, for example. So figuring out which questions to ask from them, definitely, exploring it. So an example that we're having in Data Camp at the moment is we can look at, and this is something I'm actively thinking about, we can look at learner activity, right? So we can think about how often someone logs onto Data Camp, how many exercises they do, and how often how long the duration of each visit to Data Camp, right? And suddenly, if you start looking at this data, you start to see clusters emerge. You see, the students who come on once a week for a long time, and then you see the learners who come on every day for half an hour, right? And so I didn't ask a question there at all to start, but suddenly I'm seeing some sort of segmentation emerge, and you can then ask questions like, maybe would different parts of our product and our platform be more beneficial to some students than others, for example. So, and I think these two approaches are definitely complementary, and a lot of kind of the most thoughtful data scientists, I think, work in both across many organizations, if that makes sense.
Yeah, no, it does. And I imagine this is probably quite an important step, that you actually do think about what kind of questions you want answered from your data, instead of, just sitting down and then getting lost in the data.
Yeah, absolutely. And as I said before, like, companies are writing, serious paychecks to data scientists, right? So they need to see the value. They need to have their business questions answered, and they need it early on as well. I mean, to get a company to invest in data science and analytics as like a defining aspect of their business, they need to see value demonstrated early on, right?
Hugo, I want to ask you this question. It might be a little bit of a curveball, but I think it'll be a little bit of fun. So just answer it the best you can. And given the fact that you're not someone who is a trader, but let's say you were throwing some stock data. Let's just say open, high, low, close data for the stock price. And you were challenged to develop a strategy or to gather some insight from that. Preferably a strategy or something, so where you would buy, where you would sell, etc. How would you go about that?
Right. So I like this because I would have no idea how to do this. But the way I'd probably think about it is I'd get the data, I'd load it into Python in a Jupyter notebook, using the Pandas package, which, as we discussed, I think was, literally developed for these types of financial questions by Wes McKinney. And then I'd start to visualize it. I mean, I'd literally start eyeballing, the time series of what's happening here, to just get a sense of what it looks like. And I think, I don't know a lot about, trading and finance in this sense, but when thinking about time series, I suppose the three things that I usually think about are trend, to see if there's any general upward trend or downward trend, seasonality, so looking at those types of fluctuations, and then whatever random noise is associated. And then I think after doing that, I'd probably try to develop some sort of basic model to predict what's going to happen in the future, to see when to buy and sell. And the two approaches to that, which in time series forecasting, which is essentially what we're talking about, I think, the two, I think, orthogonal approaches to that are some sort of like a REMA model, like auto-regression moving average stuff. And once again, I don't know whether this is used a lot in trading, but to predict what's going to happen in the future with these time series. The other approach, which is becoming a lot more prevalent, is using machine learning approaches. So, getting a whole bunch of machine learning models, having your in-sample training and your out-of-sample testing, and seeing which models do the best there with their prediction, and then basing my decisions around what I predict the movements will look like in the future.
And just a fun fact, you mentioned Wes McKinney, who created the Pandas package. He actually works at 2 Sigma. Some listeners will know that's a serious, a major quant fund. So yeah, I think that's kind of cool, actually.
Absolutely. And in fact, too, so he actually, I think he may have left 2 Sigma very recently, but he still collaborates with them. He started his own company called Ursa Labs to develop open source software. But 2 Sigma also works with and pays a number of other developers of Pandas and the open source community. So 2 Sigma in open source land, they do a lot of good work to support open source. And this is one of the other things, like we haven't really talked a lot about open source stuff, but if you've got organizations like 2 Sigma realizing the power of open source software development, I mean, that's the writing's on the wall, if you ask me.
Yeah. 2 Sigma also did, what's that website where they run a lot of machine learning competitions? Kaggle? I think it is. Yeah, 2 Sigma, I don't know how, it was a little while ago, ran a competition on Kaggle as well.
Yeah,
so
that's right. And in fact, another fun fact, 2 Sigma in the West Village in downtown Manhattan hosted our launch party for the Data Framed podcast in January this year. Yeah. With the Pi Data NYC meetup as well.
Yeah, okay. Oh, very cool.
Yeah.
What are some of the common problems that data scientists encounter? I know that's kind of a bit of a vague question. I guess one of the things I have in mind around that is actually the data itself, being able to clean data, access data, etc. Are there any efficient data cleaning methods which you can suggest, or even, like I said, broader common problems that data scientists encounter?
Oh, dude, this is an absolute nightmare. This is a minefield of pain and suffering. I mean, there's the old joke that 80% of data analysis is cleaning and importing and that type of stuff. I actually saw a while ago. There's a Twitter account, and we should include this in the show notes. There's a Twitter account called Big Data Borat, and it's like Borat's take on stuff. And I'm not going to try to do the accent, but Big Data Borat says, 80% of time is cleaning data, 20% of time is complaining about 80% of time being cleaning data. So, no, you're absolutely right. And even, cleaning, missing values, the fact that you'll have data corrupted, the fact that sometimes you'll get a data source which, for some reason, some of the values have like 3 more zeros on the end. It'll be the millions instead of, the 100,000s. And I think, there aren't necessarily a lot of good automated ways to deal with this yet. There are, some things in development, but essentially a lot of data scientists are siloed in different companies and have reinvented the wheel. I mean, everyone writes their own scripts to deal with this type of stuff. I mean, Pandas, for example, and a bunch of packages in both Python land and the R ecosystem deal with this, but you need to kind of hand code it yourself, essentially. The other thing, though, that I find super cool is something we get from engineering, which are testing principles. So you've got software testing, right? You get, you can write tests to make sure your software or your code that you're writing does what you think it does. Now, you can also do this with data. So if you load a data set into your Python environment, you can write a set of tests to make sure that the values of, your price column are actually numeric, right? And you can flag it if not. So having these types of automated tests, which once again you would hand code yourself, but you can use them across a variety of projects, will allow you to do this type of stuff. We are seeing increasing automation around this stuff, though, and I do think that in the next this is pretty broad, pretty vague. In the next 2 to 5 to 10 years, what data scientists do on a daily basis will be a fundamentally different thing. And I don't necessarily know the time scale. Definitely in the next 10 years, a lot of the cleaning, the basics of writing statistical models and selecting features and tuning hyperparameters, which happens in machine learning a lot. All of this stuff will be automated, and it'll free up a lot of our time for far more creative, interesting work.
How about on the subject of creating predictive models? What are some of the pitfalls that data scientists or traders who are learning to code could fall into? Is there anything you need to be mindful of when you're working with data and you're trying to create predictive models that I'm sure that if you're not careful, you can get results that are actually going to trick you and going to have very little value when you actually try to implement that in the real world?
Yeah, there are. And I think the two big ones are, if you have a small amount of data, you'll be prone to overfitting. And what that means is, every data set, if you're trying to model it or something, you'll be trying to model some sort of signal, and there'll be noise, there'll be fluctuations around it. And overfitting means that you're really modeling the noise in your data. And so if you try it on new data, you won't signal, you'll be getting the noise as well. So it won't generalize well to new data sets. So when you've got a small amount of data, you may be overfitting quite a bit. If you've got a large amount of data, this won't be a problem, though, because essentially the task there is to see how well it performs by, building the model, otherwise known as training, on one subset of your data set, and then testing it to see how well it performs on this, what's called an out of sample or holdout test. And you've had people on the podcast before who've explained this far better than I have. Well, that's the basic idea there. So in the small sample size, overfitting can be an issue. I personally think one of the biggest issues in the machine learning and the deep learning space now is model interpretability. And what I mean by that is, we discussed before this idea that, as data scientists, we need to communicate our findings to non-technical stakeholders, whether they be managers, decision makers, citizens, if we're influencing, legislation or, parole hearings, right? Like literally there are black box models. So I'll explain that term in a second and then give that example. But the point is that when you have a model that predicts something, there'll be people who want to know why it predicts or what it does. So if I'm telling my manager that we should make a business decision based around a model, he or she may want to know why it makes that prediction and what the drivers are there. So this idea of model interpretability as opposed to black box models, and what a black box model is, and deep learning models are a famous example of these, are where you just can't peer into it. You can't see why the prediction is what it is, right? And so the famous example, there are a series of fantastic books. There's one in particular called Weapons of Math Destruction, which is not only a great title, but a great book about, black box models, among others, having deleterious effects on society. And I think one of the most telling examples is in the United States, in the justice system. There's a model that's used in parole hearings to predict the recidivism rate. So how likely the person on parole is to reoffend, right? And this is a black box model, and the judge uses the output of this model to influence their decision on whether to grant parole or not, right? So this is an obvious case in which we would want to be able to peek into this model to see the inner workings, to understand what's happening there. So I think this is one of the biggest challenges moving forward, which, in all honesty, speaks to a far greater challenge of developing a system of ethics around the practice of data science as well.
Yeah, it's funny you mentioned that title, actually, because I have read that book. I think that's about it. I don't know. Is there anything else that you wanted to discuss?
Not really. I mean, I just want to encourage people. Like, I want to reiterate that I understand, when you got, we all work more than we should. We all got, so many obligations in the world. So, take your time, have some fun, do stuff you enjoy with coding. If you got kids and you want to learn to code with your kids, that's also awesome. Also, the other thing about learning to program that I haven't mentioned yet is that Twitter is an incredible place to ask questions and to receive answers. So R in particular, the hashtag R, and it's the letter R. I know because I'm Australian, it sounds like what the doctor makes me say. But, it's hashtag R stats. A lot of people will jump on board and answer your questions there. But feel free to ping me on Twitter. It's at Hugo Bowne, Bowne for Edward. And, be part of the community as well, because it's getting more and more welcoming. I know that there are some gatekeepers out there who will, shake their fists at you, but in the end, we're all trying to help each other.
Yeah, too right. And I will throw it out there as well. I'm a affiliate for DataCamp. So if you do want to sign up and, check out the courses, obviously, as Hugo's already mentioned, some of the courses are free. There's also some paid courses as well if you want to take a deeper dive. So chatwithtraders.com/datacamp. I don't think it gives you any special discounts or whatever, but if you do sign up, please use that link because it will obviously help to support Chat with Traders. So yeah, chatwithtraders.com/datacamp. I appreciate it if you could use that link. Now, Hugo, you've already given out your Twitter handle. You also mentioned earlier that you do host a podcast of your own for DataCamp, and that's called Data Framed. Where's the best place to listen to that? Probably wherever they're listening to this podcast, right?
Yeah, exactly. You can, it's on iTunes and Google Play and all of that. It'll be on all your apps. You can also check it out at datacamp.com/community/podcast. We host it on our website there. But yeah, Data Framed, and it's one word. And it'd be great to, if you checked it out and gave some feedback as well. We always welcome as much critical feedback as possible. So
cool. Okay. Well, let's leave it there. I'm glad we could tee this up, Hugo. I know it's been a couple months in the making, so I appreciate you making the time to make it happen.
Oh, look, this has been a load of fun, Aaron, and I really appreciate the invitation.
Cool. Thank you very much.
You've reached the end of this episode of Chat with Traders. But rest assured, there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes. And we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
Chat with Traders is brought to you by Trade the Pool. Did you know that every decade the market reinvents itself? Online brokers opened the doors. Mobile apps made trading seamless. and commission-free trading erased barriers. Now, a new era has begun. Meet Trade the Pool, limited risk trading. And now you also have unlimited time to reach the profit target. From now on, your trading risk is capped, and your trading opportunities are limitless. Trade the Pool funds home-based stock traders with up to $200,000 in buying power. That means you can trade larger positions and scale your strategies without risking your own savings. It's time to trade with more capital, making it truly worth your time and effort. Ready to trade the pool? Click the link in the description and join the stock trading revolution today.
Are you ready to get serious about trading? Then join Tasty Trade, Investopedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade all in one platform. Get low commissions, including 0 commissions on stocks, so you can keep more of what you earn. Trade smarter with advanced charting tools, a pre-built strategy selector, risk analysis tools, and more features. Visit tastytrade.com/chat for more information. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC.
Markets, speculation, and risk. This is the Chat with Traders podcast, hosted by Aaron Fifield.
Hey, what's up, everyone? Welcome to episode 167 of Chat with Traders podcast, featuring Bobby Cho. So Bobby first appeared on the podcast in August last year. Some of you may recall that episode. He's the global head of trading at Cumberland, which is the crypto arm of Chicago trading firm DRW, and it's one of the largest liquidity providers in the crypto space. I thought it would be fitting to check in with Bobby again because of the events which have unfolded in cryptocurrency markets over the past 12 months. So our chat actually begins with some of the highlights from the recent Cumberland Summit, which was an industry event for insiders. Then we discuss Cumberland's international expansion, and from there we get into Bitcoin's sudden rise and decline from 20K, whether or not crypto markets have matured, decentralized exchanges, crypto's value and use cases, institutional involvement, and the bigger picture as we move forward. If I happen to miss any topics that some of you diehard crypto fanatics did want to hear about, sorry, please don't be too mad. I would suggest, though, going back to episode 139, our first podcast, because we spoke about other topics then. Anyway, without any further delay, let's get into it. Here is my second conversation with the man, Bobby Cho. I was looking, we might as well just get started now, I guess. I was looking at when we actually did the interview last time, and it was August last year, I believe, is when we actually spoke and recorded it. I think it came out a little bit later, but I was looking back at the price of Bitcoin then. It was $4,000. So there's certainly been a lot happening since. So we've got a lot to get into. But before that, I just wanted to ask you a little bit about the Cumberland Summit. I saw some photos that you were posting on Twitter. It looked like a bit of fun. How was that?
Yeah, it was great. So obviously we have a number of counterparties, all over the globe. And along with counterparties, we have a number of service providers that we deal with, exchanges and infrastructure players as well. And so we said, well, man, why don't we put on an event where our, let's call it our network, is able to network with one another, right? And really the genesis of it came about where we saw what some of the larger firms were doing with their, either their customer base or their client base or counterparty base, such as like the Salesforce Dream Summit or things like that. And so we just basically said, hey, let's open up kind of our network to themselves so that they can build synergies and really see that, what we're trying to do here is trying to grow the industry. And it was not open to any media. I think people really enjoyed kind of the conversations that happened there.
Yeah. And was that in Singapore or was that in China? In Chicago?
No, that was Singapore. Yeah. So yeah, okay. I think part of it was, we tried to couple it in because it's not very easy to get to Singapore. Well, for you it is. For most people on this side, it's not that easy. And so we said, well, let's couple this with some of the conferences and events that were happening in Singapore. And so we were very surprised at the RSVP rate of people coming. We had thought, hey, it's a big ask, but I think when a few pieces came together, I think everybody felt like it'd be a worthwhile time.
Yeah, it certainly looked as though you had the kind of the who's who of the crypto world there. I noticed the Winklevoss twins, the Binance guy was there, and obviously many others. So yeah, no, that's very cool, man. What was the general sentiment like in the room? Like general sentiment on the actual crypto space and where we're headed from here?
Since everybody's so tied into the crypto space there, obviously people are very bullish on the outlook of the industry as a whole. We had people from both kind of the crypto asset side along with the blockchain technology side. And so it's good to kind of get both those feelings. And it seems like on the blockchain technology side that it seems like products are now being delivered and being tested against, which is nice. On the crypto side, everybody acknowledges that we are in a different environment than we were in Q4, Q1 this year. But at the same time, I think, and I'll go into this kind of in my chat, is that it helped a lot of these companies build infrastructure around what they were doing. Because I think if the pace at which the industry was evolving or prices were the way they were in Q4, Q1, it would have been much, much harder for those companies to build kind of scalable solutions for their customers.
So when you're saying companies here, like what sort of companies are you referring to?
So the demographic of the people that were there were obviously, you named it, right? Exchange operators. You had funds, which, are typical counterparties. You had different protocols, or I guess you can loosely call them, crypto projects that we wanted to bring together with investors.
Okay. And as you had, such a great group of people in that room all together, I mean, what were some of the highlights of that for you? Was there anything which was said which was kind of surprising for you or shocking in some ways? Like, was there any sort of notable topics that were discussed?
It was basically, we had created an agenda for people, but at the same time, there wasn't anything, let's say recorded or anything like that. But it was kind of everything that was going on in the industry at the time. One of the things that we have mentioned was like, some of the panels and topics were like mining versus staking and just kind of the relevant things that were happening in the industry. And also, it was kind of like a fine balance of basically, hey, well, we want people to feel like they're in an open environment and that they can be transparent with this network. And we obviously want to respect that privacy aspect of it as well.
Okay. And maybe similar sort of question phrased a little differently. Was there anything which kind of got you excited? Was there any talk about upcoming developments in the space?
It wasn't discussed there, I'll say, but what we did see was, you think that the crypto industry is, fairly small and compared to other asset classes. And I agree with that. But it was really interesting to see the dialogues and the connections that were happening between different companies from Asia versus the US, gathering information, just how things are being done in different parts of the world. And I think getting that cohesion amongst the network was something that for me, that's probably the greatest output that we could have gotten from that event.
Yeah, no, that's cool, man. So are you guys doing this each year or what's the deal?
I think that's the idea, but we haven't put anything down on paper yet. But the hope is that we'll kind of see how the year develops and maybe that will become part of it.
Okay. So you said that was in Singapore. And I'm pretty sure you guys have opened an office in Singapore since we last spoke. Is that correct?
Yes, that's right. So I want to say it was right around October or November of last year that we had officially opened Cumberland in Singapore. And that was kind of a good natural step for us, mainly because DRW already had a presence there. And so infrastructure is already set up and things like that.
Okay. And do you have an office anywhere else besides Chicago and Singapore for Cumberland?
So, we do have different locations all around the globe, which kind of helps, one, do our business 24/7, which I'll go into in a little bit. But so we're headquartered here in Chicago. We have offices in London and Singapore. And about 3 months ago, we launched our Tokyo office. And then more recently, we launched Seoul, South Korea. Our Japan and Korea office are more of in a discovery mode, if anything, and just trying to figure out kind of the lay of the land, what's going on there, and how we could build a business there.
So where are you spending most of your time now?
It is in Chicago. Everything that I do kind of internally, although I do manage the trading desk and kind of our operations folks and the broader business, my main focus is just making sure that the company as a whole is operating efficiently and to the caliber that we hold ourselves to.
Right. And what's the idea of having all these various offices in different locations around the globe?
Sure, that's a good question. So I'll just say that Singapore and London were kind of natural hubs of whether you want to call it financial activity or, crypto asset activity. That was just natural to us. And that helps us provide markets to our counterparties on a 24/7 basis, right? Because, when Chicago leaves for the day, Singapore gets into the office and, London then gets in and then we pick up the book from London. The reason why Tokyo and Seoul we're looking into were mainly because of some of the specific jurisdictional, regulatory environments that crypto lives in those regions. And so we realized very quickly that it was hard as, a company that's not boots on the ground there to get involved and figure out what's going on.
Yeah, okay. And so were you not always a 24/7 operation?
That's correct. So I think it was in Q1 of this year that we had launched 24/7 operations, and that means everything from providing markets, quoting, settlement, and everything kind of comes along with that. That's when we had built out that infrastructure in Q1. And a lot of the things that we do at Cumberland are driven by our counterparty feedback. What we had noticed was that people wanted to trade with us. One, it was a symptom of the underlying market being, 24/7, but we realized our counterparty base was also wanting to trade 24/7. So we said, how can we get this going in a manner that we felt comfortable with in terms of, risk management and trading? And so we got that up in Q1.
I guess I should probably ask you just to, real quick, just to explain actually what Cumberland is, because I'm sure there's people who are going to be listening to this podcast who haven't heard our last conversation. And if they haven't, they should go back and listen to it. That was episode 139. But just so the rest of this, our conversation here makes sense to everyone, can you just give us a real quick recap on Cumberland and what you actually do there?
Sure. So Cumberland is the crypto trading arm of DRW. DRW is about a 900-person principal trading firm across multiple asset classes. Cumberland is no different. We are one of the largest principal liquidity providers in the crypto space, where we make two-sided markets for different institutions, whether you're a fund or a different entity out there that's looking to get access or liquidity in the crypto asset space.
Okay, so like you just said there, your customer base is mainly institutions, and sorry, I forgot the other title you gave there, but
I just said entities broadly, but so it's not our customer base per se. It's more we deal with counterparties.
Right.
So DRW as a whole, we have no investors, no shareholders, no customers. It's everything is on a principal basis.
Yeah. Have you noticed that the sort of the people who are coming to you, who you're dealing with, are different? It's sort of changed over the past year or so?
I think so. I think what we saw, especially when we launched Asia, in terms of, the number of funds, crypto-specific funds, I think it's upwards of about 300 now. And that, evolution really came about, I want to say the last time that we had chatted last August. That's when, I think there was a lot of interest pouring into the space. Obviously, as the price started to ramp up from, the August pricing that you mentioned of 4,000, hitting the peak kind of in December and January, people started to create their own funds and fundraise. And so funds are definitely a profile of counterparties that we make markets for on a daily basis. But aside from that, we deal with a number of high net worth individuals or family offices, and a number of traditional funds that have kind of carved out things on the GP side of things to trade the asset class.
Can you just dumb this down a little bit further? So when you're talking about making markets for your counterparties, you're talking about making markets in like an OTC type of way?
That's correct. So traditionally, we had done transactions or quoting or making markets to our counterparties via voice or by chat. So that was typically done over some sort of communication portal, and that's how we did it. And as I mentioned before, in terms of we really value the feedback that our counterparties give us, because that helps us get better. And so two of the developments that we really started to dig into this year was the idea of how people could interact with us in a non-voice, non-chat way. And so we looked at how other traditional markets were doing it or how they've evolved. And so we concluded on two things, two which we're really excited about in terms of presenting them to our counterparties. But one, it's an API that people are going to be able to see our pricing, whether it's on a streaming basis or something like that. And the other thing is a platform base, or we call it a single DR platform, where people are now able to log in and view all of our markets in a more visual standpoint than the API would.
Okay, that's really interesting.
Yeah, again, it's all driven by just what our counterparties are looking for, and we really take that to heart because, again, that helps us get better.
Yeah, I mean, it seems like a much more efficient way to do it, I'd imagine.
It's kind of just like there's kind of a method for an array of different counterparties now, and I think it actually helps open up the way that people interact with us much more wider than before.
And why are these counterparties dealing with you specifically, or other desks who do things similar to what you do, instead of just interacting with the actual various exchanges?
Sure. So there's kind of like there is a trust factor involved with that. And then there's also an efficiency standpoint with it. And I'll go into both. So on the trust side of things, obviously, DRW has been around for greater than 25 years. So we leverage a lot of what DRW has done over the past few decades into what we do on a day in, day out basis. And so in terms of being able to manage risk, in terms of being able to provide the markets that we do and the spreads that we do, we wouldn't be able to do it without the infrastructure of the broader organization. And so I think people come to respect that and they like that feature. And obviously balance sheet plays a factor into it as well. And then the second part is, in terms of exchanges, we work with a number of exchanges, but we are a risk-taking entity. And so what I mean by that is that we can provide, I think, a greater level of liquidity for certain coins that are out there than possibly other exchanges. One of the main features of efficiency that we like dealing with on the OTC side of things are institutions are very mindful of whether it's internal cost of capital or their return on their capital. And so when we trade, it's on a bilateral basis, and settlement happens after execution. So we don't hold anything in advance of any transaction, whereas an exchange, you need to hold the funds there for the time that comes that you actually want to do a transaction. Well, that tends to not be an efficient way to manage your capital. And so, just the way that we trade and settle, it tends to be a little bit more efficient for certain funds out there because of whether it's size or just capital efficiency.
And what markets are you dealing in now? I know, not what markets, what products? I know, obviously, Bitcoin, but
yeah.
I believe you've kind of expanded the products that you're dealing in as well, the different coins and that sort of thing since we last spoke as well.
Yeah, that's right. So we trade upwards of about 35 different cryptocurrencies. Most of the top coins by market cap, and other ERC20 tokens as well. And then along with that, we also trade whether it's cash settled or physically settled futures as well. So it's not just the number of coins has expanded, but kind of also the product set at which crypto assets are traded in.
Yeah. How do you feel about the introduction of Bitcoin futures? Like, is that something which was welcomed by you guys?
I think so. We were there day one on the CME and the SIBO launch. We've seen those markets continue to grow over time. I think you're seeing kind of more volume going into the CME market. I think mainly because of its access and reach to the broader kind of futures market. But I think it gave an opportunity for those that wanted to participate in the market in terms of whether speculating on price or putting on a position without actually having to hold the underlying or deal with kind of that side of the trade. And so I think it's all net positive. But at the same time, I think there are more and more infrastructure providers out there that are building products that may be better in the future. But that's kind of where we are today.
I guess we should get into talking about the big run up towards the end of last year. Like I said earlier, Bitcoin was around about $4,000 when we last spoke, August 2017. How was the run up to 20,000? Like, what was that like for you to be trading and making markets during that time?
Along with working in an environment where kind of the land around you continues to shift, whether it's because of different movements that are happening on the regulation side of things or infrastructure side of things, then you add on kind of the volatility of the market. And so I'll just say every day was an adventure for us. We got a lot smarter at what we're doing. It helped make us realize how we can scale better as a business. And also just how we can manage risk better as well. And so I think, obviously, those were very volatile, very adventurous times. And so I think we're in a much more sustainable kind of pattern in the industry right now.
As a market maker, that type of environment, is that a good thing for you, or is that put you to the test a little bit?
I definitely think it puts you to the test. I think it tests your ability to manage risk. It tests your ability to provide markets and be accurate on everything that you're doing. Prices were all over the place. It makes you become super efficient on how you're managing your coins and cash, making sure you're getting, the return that you'd like on every single dollar that's on exchange or every single dollar that's out the door or every single coin that you're trading. It makes you be much more mindful about every part of your business because things are happening so quickly and you need to have a pulse on everything that's going on. And it definitely stress tests things, your own operations internally.
Was there a point during all of this where it sort of clicked that this was all becoming very bubble-like?
I think very early on we said that the markets had bubble-like characteristics. And so I think the broader audience or the community recognized that this was not, the velocity was not sustainable. And so really when you started to see prices kind of come off in later Q1 and the subsequent months, I think that actually gave the industry an opportunity to take everything that they had learned from the previous quarters, in terms of, stress testing their operations, things like that, and we're no different, and gave them an opportunity to actually build scalable solutions for the marketplace. And that's where you're seeing a number of different infrastructure providers come out, whether they're new entrants or older entrants, whether they're building out their current offerings or offering new things. So I think that really helped the industry figure out kind of where they were at and how things could end up going down the line.
And when you sort of sense that, we were entering a bubble or this was becoming very bubble-like, was there anything which you had to do to kind of prepare for the backside of this move?
It's a good question. I would say that, we try to approach every single opportunity by just looking at the broader picture, not just kind of living in the moment. And so you obviously have to, from a risk management standpoint, understand that things don't always go up and to the right forever. And so you have to understand that, you need to be mindful of all your open settlements. You need to be mindful of all the transactions that you're doing. And so, I'll just say that, we kind of anticipated that pricing could correct, and I think any trader out there would have recognized that as well. It was just when was that going to happen? Was that going to happen at 20,000, or was that going to happen at 40,000?
And what about when it did turn around on the flip side? How was the decline for you? I mean, was that, I presume that was probably interesting times as well. Did that have any greater impact on your business as opposed to when it was ramping up?
No, I don't think so. I think if anything, what we are in the market every single day providing two-sided quotes. So whether the market is going up or whether the market is going down, we are going to step in and provide you a quote or quotes. And so there, it was kind of no different. It was just the reverse, basically. And so even today, where you see kind of pricing trading in a fairly tight range over the last few months, we're still being very, very active and aggressive out there.
This whole thing where Bitcoin's gone from, well, depends how far back you want to go, but let's just talk about from August last year. It was $4,000. Everyone thought it was really high then. Well, I shouldn't say everyone. There were many people who were saying that. We saw it go all the way up to 20,000, and it's come back, and it's sort of flown just above that $6,000 mark for a while now. For someone like yourself who's been active in the crypto market since, I think it was around about 2012, you might have been earlier that you...
right around 13, I'd say. Right around 13, yeah.
Okay. So you've been doing this for a while. Are there some things you've learned or some things which have been confirmed over and over for you about, how markets work, how markets move, and how market participants think?
I would just say probably the biggest takeaway that I try to instill kind of everybody on the desk, everybody that works for Cumberland is in this market, especially because it's still growing and it's still very new and infrastructure is still being built out and still very early. Never assume anything. Always do the work. That comes down to, the addresses that you're sending coins to, in terms of double checking that. Just never assume anything in this market and make sure to validate kind of everything that you're doing over and over again. And I try to kind of beat that into the team every day, just because things just change and you just have to adapt to what's happening around you.
Are you ready to get serious about trading? Then join Tasty Trade, Investorpedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including 0 commission on stocks, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, risk analysis tools, and more features to help you trade smarter. See equities and derivatives with high trading volumes, dividends, upcoming earnings reports, and more with their pre-built watch lists. Or create a custom watch list to keep an eye on the companies and sectors that matter to you. Manage your positions with speed and precision using active trader mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Visit tastytrade.com/chat for more info. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Have you ever watched a stock explode and thought, if only I had the capital? Or sat on the sidelines because your account balance felt too small to matter? Good news, with Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 U.S. listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with 0 locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
And what do you make of the fact that Bitcoin's kind of fluctuating around the $6,000 mark. Like, it seems to have almost found a little bit of support there. Is there anything which you read into from that?
Not too much. I look at kind of like the broader picture of what that provides to the marketplace. And I'll just go back to the fact that it allows people to kind of go back and focus on building scalable products and solutions for the marketplace. And granted, we are kind of in this low volume environment. But, that really provides an opportunity for companies to reassess what they're doing. And to some degree, there is a level of consolidation that's been happening in this environment and in this market. And so that makes business plans of a lot of these companies have to be much more bulletproof than they were, in the run up of Q4 last year. Right. I think even whether it's an ICO or a different protocol that's out there, I mean, people have gotten smarter over the past year. They know the right questions to ask. So you better believe that the economics behind your token offering, that the economics behind the token that you're launching needs to be much more soundproof, because people have seen the boom and kind of, if you want to call it the bust of a lot of these projects.
Yeah. Would you say also how volatility is decreased over the last sort of little while, that it's possibly a sign that the market has matured a little bit as well?
Yes, I think that can be a safe assumption, along with the other products that have been launched out there in terms of futures and other products like that, allowing people to participate on both sides of their perspective.
Yeah, and what about the altcoin space? How has that been affected by all of this?
Yeah, I think you're seeing it in the numbers. A few months ago, I kind of looked at one of the articles and said that 60% of all ICOs have gone away, and they're not relevant anymore. And so again, going back to the whole sound business models, they need to be tougher today than they were a year ago. I think the altcoin market volumes have definitely dried up. Things have become very, very illiquid, even more illiquid than some of the other cryptos out there. And there's been sort of this, whether you want to call it like flight to quality or flight to safety, but it's kind of gone back to Bitcoin a little bit. The interesting dynamic kind of that we've seen out of Asia is that, more than 10% of the transactions that we do during Asia hours are actually Ethereum based, more so than the US hours. And so that was an interesting dynamic for us, mainly because it gave us an idea of kind of what our Asian, the folks that are trading with us in Asia are doing and transacting in and excited about and involved with.
Now, I guess just taking a little step back, that run up to 20,000, I don't know, maybe you can share your thoughts on this, but I think, if we were just to make a general assumption, it was a lot of it was driven or fueled by people thinking that Bitcoin and some of the other coins could possibly become widely accepted as possibly a form of currency. Is it safe to say that the majority of people no longer believe that this is still the case?
I actually want to say that the run up in Q4 and Q1, or kind of the broader tail end of last year, was driven mostly by retail. And I think most would agree with that. And I think you actually saw a number of places, different jurisdictions, different regions, where being able to trade crypto became more accessible. And so that's why you had, premiums on various different exchanges that were maybe servicing, people in Japan or servicing people in Korea or in India or different places like that. So you basically had pockets of retail investors and traders that now were accessing a market that kind of, they were able to kind of play off of the market side of things, but also there's this technology aspect to a lot of these coins that they can express their views on. And so I think that was kind of a big catalyst to the run up. I still think the whole use case aspect of whether it's Bitcoin or other crypto technologies out there, it still lives today. It's still being built on and iterated on. But I think a lot of that was kind of trumped by just the price action that you saw day to day.
Mm. Yeah, but why was retail buying this up? What was their motivation for buying into this? Was it just to try and get try and get rich, try and get a Lamborghini?
I don't know the exact answer, but I can look back at history a little bit in terms of, brief history. The run up for Bitcoin going into, let's call it $1,000 or $1,500 a few years back. I mean, a lot of that was driven by China. Well, why was that driven by China? Well, it's because it gave them an outlet to or an access for loosening capital controls. And so people realized that there was this vehicle or this asset that they can get into, and they can then go ahead and send funds all around the world however they like. And so I would actually look at the regions during the run-up of Q4 that they had very similar profiles of just capital controls in place, and how they were able to access those markets that they couldn't before.
Yeah, okay. So I guess, if we go into this a little more, what I'm sort of trying to get at here is, where's the value in Bitcoin? Like, where do you see the value in it now? I know a lot of people are asking this. I posted in the Chat with Traders Facebook group and mentioned that I was going to be having you back on, and this question sort of came up a few times. What is the real purpose is a question that a lot of people are asking. Like, what purpose does crypto serve beyond just speculation?
Sure. So I think the bottom line, to level set everything, is that it's still very early on. And so what you have a number of entrepreneurs, whether it's in Bitcoin or other crypto assets or even new tokens. Everybody in that space is still trying to figure out the killer app or the killer use case for cryptocurrencies. So that's where we're at today. But when I look at kind of whether it's like, you want to put a valuation on Bitcoin or anything like that, if you were really to take a poll and all around the world and say, well, what's Bitcoin good for? You are going to get an array of different answers out there, mainly because it's going to mean something different to different people. And what I mean by that is, just by our counterparty base in general, people look at Bitcoin as almost a store of value, right? Especially with pricing being where it is, right? So gold 2.0, well, the critics of that use case said, well, Bitcoin's too volatile. It can't be a store of value. Well, now Bitcoin isn't as volatile. So maybe people are considering that it could be a store of value. That's one way people can look at it. Other people look at it as a way of payment. And we deal with corporates every single day that use Bitcoin for their service, where they get paid in Bitcoin because it's quicker, faster, easier than traditional channels. So that's another use case. And so people are interacting with, I'll just say Bitcoin directly in different ways than the next person. And so I think that's where kind of the difference comes about in terms of how people are looking at the space, because they know the world that they grew up in and the rules and regulations that they live within, and that's how they're going to view Bitcoin, versus somebody who may have grown up in a very capital controlled environment, and where kind of governments can control a lot of the aspects of what they're doing, and they may look at Bitcoin very, very differently than the other person. So hopefully that helps kind of round out the view of why there are so many different views on the price of Bitcoin and what it's worth and what people are using it for. The bottom line is people are using it for a lot of different reasons. And so I think that's also one of the fascinating parts about it.
One of those reasons you sort of briefly touched on earlier was the technology aspect of it. Being as involved in the space as you are, have you seen any notable applications of blockchain being used in the real world?
I think people are still, there's this whole concept of like private blockchains versus public blockchains. But I think on like the private blockchain side, I mean, that's kind of going full steam ahead. There are a lot of enterprise companies out there that are building products for a number of institutions out there, whether it's on, the financial services side or anything like that. And on the crypto asset side, where you actually have a native token traveling within these blockchains, that's still being built out. Obviously, Bitcoin is the most inherent one that everybody knows about, but I still think people are very, very excited about what this can do, right? Because the way I look at it is, there's this public ledger that gets reconciled every 10 minutes, just talking about Bitcoin. I mean, just the sheer possible applications of that you're seeing play out in the market, where you have entrepreneurs trying to build, and who knows if it's the right business model or not, but they're trying to build, medical records on top of Bitcoin. They're trying to build, real estate transactions on top of blockchain technologies. They're trying to figure out ways that they can leverage this technology. And again, it's still early days where people are kind of throwing things against the wall and trying to figure out what sticks, because I think they realize that if they're able to leverage a different market along with crypto, that could be kind of the killer use case that people see out there. But I actually don't see it as one killer use case to trump them all. I think there's going to be a number of different applications and ways that people interact with it. And maybe in the future, people aren't even going to know that they're interacting with it, and they're just going to be using it.
Just to pick on one of the examples you gave there, I think it was health records being stored on a sort of a blockchain. I mean, what would be the benefits of that?
I don't work directly in that field, but I would just say that, I think it's this idea that you have a ledger that's timestamped, that's immutable, that is also global in distribution and then decentralized. So I think all of those attributes kind of help not just medical industry, but any industry that has differing sets of information at different times. And it kind of level sets all of that onto an even playing field for everybody involved.
All right, so let's talk a little bit about some of the trading opportunities. Last time I remember we spoke a bit about arbing the various price discrepancies between various exchanges, and you sort of spoke about how it's a bit more difficult than what most people think it is on the surface. Where do you see possible opportunity for your average kind of independent self-back trader? I'm talking about things which aren't necessarily worthwhile for a bigger player like Cumberland, but might be worthwhile for smaller participants to sort of look into. Like, is there anything which you think is interesting, worthwhile investigating?
I'd say definitely on kind of the major exchanges or major coins out there, that the opportunity is not there. You've had a number of entrants into the market where spreads have come in and markets have tightened, and any opportunities that may have presented themselves years prior, they are kind of getting taken up, and the space is getting a little bit more crowded there. But in terms of, I guess, other opportunities that maybe, other people can be looking at, I think one of the interesting things and developments of this year is the idea of like decentralized exchanges. Although we don't participate on any of the decentralized exchanges, I can see that being an interesting arbitrage opportunity for different folks who can. Granted, those markets are mainly focused on retail size transactions. And they have their own nuances, but that's definitely an interesting development as more and more of these decentralized exchanges kind of come about.
So what is a decentralized exchange?
A decentralized exchange is almost just like a peer-to-peer exchange where people are trading with one another on kind of a singular network that allows them to kind of transfer and trade different crypto assets for one another.
And are these decentralized exchanges, are these just a recent development?
I'd say so, probably in the last year or two, but more so today as more people started to figure out kind of the interestingness about it.
Okay. And do you think this is possibly a way that, these sorts of exchanges are going to overpower is probably not the right word. But do you think this is sort of something that might catch on and sort of be a serious competition for the other exchanges that are already sort of running the game?
I think that the idea is very fascinating. But as we've seen it play out over the last few years in terms of, Bitcoin adoption or Ethereum adoption or things like that, it's always going to be slower than what you think is going to actually happen. And so I think it's probably too far to tell exactly how these are going to impact the way that traditional exchanges work. But I'll just say that the idea is out there now, that someone has built this thing or built multiple things. And this idea of decentralized clearing, decentralized trading is now an idea out there that's working in practice. But again, I still see it kind of more within the retail circles. I don't, at this point, I'm not sure if there's going to be any institutional involvement just yet.
So how come you mentioned this? Because it's a very new thing. You feel like there could be some inefficiencies which traders could take advantage of. Is that why you sort of thought to bring that up?
No, I just think that it's an interesting development that kind of happened over this year. And when you had mentioned just, well, what are the opportunities for other traders that may be out there, on the, quote unquote, the traditional markets of the crypto exchanges? I mean, the arbitrage opportunities are few and far between, but decentralized exchanges may be something that's more interesting.
Yeah. Okay, cool. Bobby, obviously I'm not, I don't follow the crypto market too closely. I do follow it with a little bit of interest and a little bit of skin in the game, but I don't, I'm not as involved in it as you are, obviously. Are there things which you feel as though I should be asking you about, which I haven't? Are there any topics which you think are worthwhile discussing?
Sure. I mean, there's like this, and people brought this up a lot last year. They continue to bring it up